Oil prices up in today's session, leading to strength in the dollar, yields up, bonds selling off, and the picture for equities uncomfortable. European futures pointing lower by 0.6%. FTSE 100 futures pointing lower by 60 points. Maybe there'll be some support there from some of the energy majors with the oil prices up. DAX futures pointing lower by 117 points. What are the individual names that you're looking at, Jemima?
Yeah, well, a couple of different sectors that we're watching out for. First, let's start with tech stocks. And remember, we had those software companies reporting yesterday. A bit of a divergence, as we've been speaking about on the show, between the likes of Snowflake and Salesforce. So let's see how the open is for some of these European tech-related stocks as well. Delivery Hero also in focus. Uber raising their stake in the company. And, of course, this is around lots of talk that they're going to make a formal bid for Delivery Hero. So that is one stock we're going to watch at the open. And then L'Oreal, we saw an upgrade come through, upgraded to a buy by Berenberg overnight. So let's see where the stock opens up in a couple of minutes.
Energy, travel and leisure, the banking space. Banks have typically fared relatively badly when yields have been up on the geopolitical risk. We'll see if that translates again, of course. And we focus on how things reflected with the geopolitical risk and risk off. Certainly the Asian session has been softer, although we've seen some volatility in the Kospi. There is the print so far on the FTSE 100, currently flat. Let's see how that adjusts, of course, as we wait for the benchmark to open. We'll see what happens in the autos trade as well. Again, typically when we get these geopolitical risks flaring, autos comes under pressure, and again adds to some of those luxury stocks and, of course, travel and leisure, the airlines, on what happens in terms of fuel prices going forward. Across the benchmark then, you're seeing losses right now, Jaman, of 0.2%. On the FTSE 100, a drop of 0.6%. The CAC current is also lower in France. Risk off across all of these major indexes. The DAX down 0.4%. This isn't dramatic, but certainly there is more caution on the back of what we're seeing emanating out of the Middle East, and down 0.4% on the Spanish IBEX right now. What are you seeing across sectors?
Yeah, and Tom, and certainly in terms of sectors, there aren't that many sectors that are trading or opening up in the green today, as you can see from the dashboard over there. The only exception is, and this isn't going to surprise anyone, the energy sector, moderately positive this morning, up about 0.5%. And then we also have tech. As I said earlier, we're watching out for the open there. We are up about 0.3%. So a little bit of optimism in that part of the world. However, other indices are dropping. Other sectors are dropping, I should say. Healthcare leading the declines this morning, down 1%. We also have media down about 1% as well. And then the travel and leisure sector down 1%. And that tends to be very highly correlated with what's been happening to the price of Brent this morning. The rise in the price of oil, obviously a clear focus for that sector. But in terms of individual movers, Tom, what are some of the names that you're looking at today? Yeah, to your point, so tech and energy, the two sectors in positive territory so far with modest gains. But tech is interesting. BE Semiconductor is up 2.6%. You're seeing the likes of Infineon over in Germany. The chip maker, of course, also up 2%. ST Micro gaining 2%. In the consumer space, interesting to see that Adidas is also gaining up 1.8%. But tech is holding its head above water in an otherwise risk-off environment, Jemima. All right, let's get some further analysis now with Henry Allen, macro strategist over at Deutsche Bank Research. Henry, really good to have you with us. We walk in another day, more incidents on the Strait. You're seeing an uptick in the price of oil. You argue in your notes that the world can live with $100 as a backdrop to Brent energy prices. The energy shock is not as bad as people had feared.
Well, it's not that this is great by any means, and I certainly don't want to underplay what's happening. But if you compare what we've seen since late February when the US strikes on Iran began, the energy crisis we've seen is certainly nowhere near as serious as several past episodes like 2022, let alone what we saw in the 1970s. So I think when people are surprised, for instance, that risk assets have been so resilient, I think if you compare this energy shock by a whole range of metrics to previous energy shocks, it isn't as serious. So the fact that risk assets have been that resilient shouldn't come as much of a surprise.
Yeah, isn't the word that's missing here yet? It's not as big a shock yet, but the longer this goes on for, the higher the probability and the likelihood is that you are going to continue to see upward pressure, physical markets tighten, and all these ongoing second derivative effects, as Tom and I were just speaking about. You know, you're beginning to see these producers pass on costs to consumers.
For sure, but I recall a lot of those arguments being made right since the first month of the conflict. We're now 3 months in. I remember in the first month it was like, you know, we're fine for the first month. All those barrels that have left the Strait of Hormuz are still on to their destination. The second month is really going to be when it's going to hit, and then it's the third month, and then it's the fourth month, and so on. Because, I mean, when this campaign began, the US administration were openly talking about a 4 to 6 week timeline, which has clearly slipped. So, you know, that point of reckoning, as it were, has been repeatedly delayed, yet the S&P has continued to all-time highs. And one thing that I think is critical this time, and Mark Cudmore, I know, was making this point on the reverse side of the argument, is that expectations have consistently remained positive, i.e. the oil futures curve is deep in backwardation. There are expectations that oil prices are going to come down because people expect this is going to be a temporary conflict. And whether that's true or not in reality, markets always trade expectations. That because of that expectations for a temporary conflict, that is itself supporting risk assets. It means that we're not seeing the negative wealth effects associated with the bear market. We have seen credit spreads in both the US and Europe tighter now than before this Iran conflict began in late February. So again, you're not seeing that contraction in corporate credit, which itself is in turn supporting growth. So long as those expectations remain positive, that's a crucial pillar that is helping sustain a more positive reality too.
Yeah.
Just to be absolutely clear, you are not concerned about this gap that we're seeing in terms of the reality on the ground, physical product, and market optimism. That gap is not a concern to you?
It is a concern, but I don't think that markets are irrational, is the argument we've been making. And it's not just in terms of expectations. You know, if you look at the data we've seen at a global level, yeah, there are a few regional pockets of weakness, but at the global level, again, a lot stronger than people expected. And again, that differs from several previous oil shocks, where even in the first month or two, you were seeing immediate data downgrades. We're not seeing that. Another positive difference is, again, compared with 2022 or the 1970s, inflation was going into this shock almost at target, only slightly above, not well above target, and then going extremely above target, necessitating the kind of hawkish response you saw a few years ago. No one's talking about multiple percentage points of rate hikes today. We're talking about modest hikes at most. So by a whole bunch of metrics, the severity is just not what it was.
Goldman's raised their target for the S&P to 8,000 from 7,500 by the end of the year, 8,000. Do you lean into the rally that we're seeing? It sounds like you lean into the rally. Is 8,000 conservative?
Well, DB's target is also 8,000 as it happens.
They've matched you now.
Well, not me personally. I won't take credit for that target, but yes, in terms of our house view, yes. And I personally, think that, as I say, firstly, the energy shock, is not as serious as some of those past ones, but also a lot of the bull catalysts we were talking about earlier in the year have still not gone away. We've still got the AI story, huge capital expenditures, big productivity gains. We've still got tariffs coming down, particularly since the Supreme Court case ruled against the IEEPA tariffs in the United States. The replacement tariffs have not been as high. We've still got a lot of fiscal stimulus coming through, the Trump tax cuts, the German fiscal stimulus, actually a lot of rate cuts too from last year. Those operate with a lag, still taking effect. So a lot of those bull catalysts that were already there, we've not talked about mostly over the last 3 months because of what's happened with the Iran conflict, but there are a lot of tailwinds behind markets still going.
Okay, so you're leaning bullish. How are you thinking about hedges? And an interesting article from our colleague John Authors up overnight, and he flagged that on the VIX, the restraining influence on President Trump has been these spikes up in the VIX. So we saw the U-turn on reciprocal tariffs when VIX hit 50. We saw the ceasefire announcement around the time VIX hit 30. Would you think of buying upside calls on the VIX just to position for things actually deteriorating on the ground?
Sure. Well, actually, I think that's an interesting point you raised, because to some extent, the market is now an endogenous variable to what's actually going on. We have seen repeatedly, not just with President Trump, but with other leaders too, that there is a serious unwillingness to let consumers feel pain in a meaningful way. We haven't just seen it on the tariffs, like mentioned. We saw that with Greenland back in January. We saw that with several rounds of fights over central bank independence as well. So to some extent, the market is an endogenous variable is the way I look at it. We often think about, what's going on in the Middle East, what's going on with tariffs as this external shock that hits. But to the extent that you get these sell-offs, that itself makes a U-turn more likely. Indeed, it was notable even in the last few weeks And at the point when the S&P hit its recent low at the end of March was the point at which the rhetoric around what was happening in Iran started to turn a lot more positive towards a deal. So I think that pattern is very much there.
So Henry, you're betting on the Trump put?
Yeah, in essence.
How about yields? And again, I come back to the point that historically in the past, when you've had a very fast upward move in fixed income, it tends to have knock-on effects in equities. Once again, equities immune to higher bond yields, particularly in the U.S., and we're around 5% in the 30-year. At what point does that break, if it does?
Well, that's a good question, because actually what we've seen is a dislocation. That in the first month of the conflict, you were seeing yields and equities both track oil. But since really that low point for the S&P, when the Trump put was activated, equities are completely decoupled from rates. The 10-year yield is basically trading almost in line with the oil price. The oil price goes up, and the yield goes up, and vice versa. Equities have completely decoupled. Now, I do think there are some stress points, but actually one of the factors, not the only factor, but one of the factors that has supported yields is the fact that growth has been so resilient. So, for instance, US payrolls, for example, we've seen back-to-back above 100,000 in the last 2 months for the first time since late 2024. So actually, some of that yield upside is actually a reflection that central banks now feel a bit more confident, not needing to cut rates in the same way. So some of that is actually a positive story, not a negative one. So in that scenario, and we've seen this a few times before, actually you can get yield upside without taking down the equity market, because the thing that's driving both is actually stronger growth than expected, and that's a repeated theme throughout this conflict.
Does European equity underperformance reverse if there is a deal?
Yes, I do, because what we've seen repeatedly is where Europe is more exposed to the energy shock, the beta on European equities to the oil move has consistently been greater. So if we did get a ceasefire, a durable one that is, oil prices come down again, European equities definitely stand to benefit a lot more on the upside from that. And actually, we've seen that in the data as well. The one point which I think is counter to the argument of general global resilience is in Europe. The flash PMIs we had for May were showing dipping into contractionary territory in multiple countries. So actually, if we did get something that resolved this conflict and brought down oil prices, given Europe's relative exposure as an oil importer and geographically to the Middle East, then definitely I think there's more upside.
What's your favoured approach to getting exposure to the AI story? The hyperscalers have massively underperformed semiconductors. Does that story continue? Do you want to be looking at kind of the optics? Do you want to be looking at the networking? Where within? I know maybe you don't go as granular as this. I get that in terms of your role, but how do you play that AI theme going forward, and how do you see that evolving?
So, I mean, I've always been consistently skeptical that this is an AI bubble. Clearly, that chatter has grown again, given the huge rally we've seen for the Mag 7, the Nasdaq, and those other stocks. But, there has been weakness in other areas, like software, like you say, is still, not quite flat on its back, but hasn't moved anywhere since February. So it's not a consistent tech doing wonderful performance. And, at the end of the day, we haven't seen the sort of rally that we saw, in the dot-com bubble today. We haven't seen those kind of Nasdaq up 80% in a single year that we're seeing today. The cross-asset moves as well have been very, very unlike what we saw in the dot-com bubble. One example I often give is, gold was doing terribly in the late 90s. No one wants to own gold. Everyone wants to own the shiny new tech stocks. Today, by contrast, there's a lot of fear. Hence, we're talking about these discussions of, have equities gone too far? Yeah. Gold is doing really well. There's still a lot of caution around tech stocks. The fact that people are skeptical indicates that positioning is not max overweight here. So I still think there's opportunity there. And
you pointed out there's still cash on the sidelines. Henry, always great to get your thoughts. Thank you very much indeed, as ever. Henry Allen, macro strategist at Deutsche Bank Research. Let's check in on the core six right now to see how they're faring on a day where you're broadly risk-off across global equities. Novo Nordisk is down 1.2%. You're seeing some losses there for LVMH after the gains for the luxury space yesterday. That was expected, of course, on the geopolitics and high oil and concerns about the consumer. You're seeing strength, though, in the defence space for Rheinmetall, up 1.8%. That is a decent move, of course. Sizable company in terms of its market weight. ASML also gaining, and tech is getting a bit of a lift in the European session, up 0.5%. Nestle, though, down 0.8%. Let's check in on some of the other individual stocks on the move this Thursday and bring Chloe Malley. Chloe.
Good morning, Tom. We're seeing a little bit of weakness, actually, in Delivery Hero this morning after Uber raised its stake in the company. So Uber bought the stake, the shares that were owned by Aspects Management, and is now, it was already the biggest shareholder, but is now an even bigger shareholder and laying the groundwork for a potential takeover of Delivery Hero. And we had seen Delivery Hero shares really rise quite strongly over the past month because of this potential deal, and also because the CEO had left. But now we're seeing pairing some of those gains, actually, and we're down about 2.7% on the back of Uber raising that stake. Moving on to oil, which is seeing some gains this morning. We are in the green across the European oil sector because oil has risen on the back of fresh attacks in the Middle East, which is hurting this optimism that there's going to be a deal soon and that this Iran war might end soon. And so we are seeing some movements there. Across the equity sector, we're seeing quite a lot of sector in the red, but one sector that's actually in the green was the tech sector, but we are going to be starting with L'Oreal first. So L'Oreal was upgraded to a buy rating by Berenberg, with analysts saying that it is returning to historical growth levels and is able to be quite resilient to the consumer uncertainty at the moment, and really benefiting from things like younger consumers being really interested in skincare and in beauty. And so we are up to a buy rating and therefore in the green this morning. Now we can talk about the chip sector, which is doing quite well. We've got this continued AI optimism that is really fueling those stocks across names like STMicro, Infineon, BE Semi up quite strongly, especially Infineon up almost 3% this morning. And related to that, we've got Soitec, which is a company that also operates within that semiconductor materials sector, and we've got revenue coming in ahead of estimates. And so we have a really strong boost this morning in the stock, up about 13% on the back of those strong earnings.
All right, Chloe, thank you so much for giving us an overview of some of the stocks that have been on our radar this morning. Well, coming up, more on Soitec as shares surge after strong revenue numbers, and more on the French chip company's latest earnings results up next. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Verrett.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Welcome back to the opening trade. We're about 20 minutes into today's session, and peeling back some of the initial losses, I will say, on on all of these bourses. We have the stocks 600 now down about 0.5%. At one point, we were down about 0.8%. So recuperating some of the losses at the open. The DAX also down about 0.1%. CAC 40 down 0.3. The FTSE 100, the main underperforming index today, down 0.9%. So the setup is risk off, and we've had a pretty negative handover from Asian equities overnight as well, Tom.
If you're looking for optimism, you can find it in the tech space, even in Europe, where that is the best performer in terms of your sectors. That sector is currently up 0.7%, and Soitec is playing a role there because shares in that French company soaring after the semiconductor materials company posted revenue above expectations in the final quarter of the year. The firm's saying it expects to see continued margin pressure in 2027. You can see the stock is up almost 12% right now. Matt Bloxham of Bloomberg Intelligence joining us for the details. What are they doing so well at Soitec? What is happening? This is a semiconductor materials company in France. Is this clearly just a company that's benefiting from that AI demand story?
It is, and it's like a market leader in what it does. And I think the real area of excitement is what they're doing in photonics, because that's the future of everything we do. Historically, everything that's kind of connecting to data centers powered over copper. That's too slow. It's too high energy consumption. So the future is connecting everything with photonics, and that's where they've got a big edge. So it's not really kind of a big part of their revenue mix yet, but it's got massive growth potential, and they took that up again in the results. And it was, of their three segments, the only one that was up year on year, because the others are suffering from some inventory pressure.
Yeah, and how much is that driving the broader tech reaction today in Europe? I mean, this is a day where everything's decisively risk off. Pretty much every single sector is trading in the red, with the exception of tech, energy for obvious reasons. Why is tech an outperformer?
I don't know, because it's Thursday, maybe.
More broadly speaking, is there an opportunity in European tech?
I mean, obviously, the broader AI momentum trade is still there. I mean, obviously, Salesforce results overnight were a little bit soft in terms of the momentum of Agentforce, but again, they're still talking about the second half inflection point for Agentforce. It's gaining traction. So I think there's still that perception in the market that AI is going to continue to get bigger and bigger and bigger, and people are identifying, particularly like Soitec, companies that are kind of really exposed to kind of the next wave of that opportunity, and that are perhaps still a little bit under the radar and not fully reflected in market expectations.
Matt, do we have a bit more clarity in terms of the AI disruption on software? So we have Snowflake and then we have Salesforce. They seem to tell two different stories. I noticed that Dan Ives from Wedbush, notoriously bullish, is pretty optimistic about Salesforce despite the disappointment and the initial reaction. Are we starting to see a cleaving out of the software names?
I don't think we are, to be honest. I think it's going to take a while for this to shake out. I mean, you would like to think that a giant like Salesforce can actually eventually shift the direction of its supertanker and actually really kind of gain a lot of momentum in the AI world. A lot of customers are going to be kind of risk off and say, well, I'm not going to shift to a completely new CRM system. I'm going to stick with Salesforce and trust that they're going to get it right eventually. But, given where the shares are year to date, that's not a widely held view. And I think a lot of fund managers thinking, in a year or two's time, if the stock's gone down another 50%, you're going to look back and say, well, it was obvious that this was going to come under huge pressure because it's kind of yesterday's technology, not the future's technology. So I think we're still very much in that kind of two-way trade on these kind of names.
Yeah, I mean, going back to what I was asking about the European tech trade, there are obviously the picks and shovels, but then you have the industries that are ripe to benefit from some of the AI productivity gains. And how do you think the street is drawing a distinction between the two in terms of implementation of the tech trade?
I don't think my personal view is I don't think there are many of those kind of downstream industries where people have kind of really got it. I mean, one of the industries I cover closely is advertising. You know, the agencies are massively in the whole AI kind of transition. But if you kind of look at the multiples, you know, WPP on the one hand, Publicis on the other, really contrasting in terms of how the market's looking at them, and yet they're both doing very similar things in terms of deploying AI in how they offer their products to customers. So I think there's still a lot of confusion in the market about which are going to be the winners and users and how much benefit there's going to be to these end markets.
Yeah. Matt Bloxham from Bloomberg Intelligence, thank you so much. Well, U.S. retailers Costco, Dollar Tree, and Best Buy are all out with earnings later today. The results will provide a read on where the U.S. consumer stands after confidence edged down in May. I'm joined now by Bloomberg strategist Rural. I mean, good to have you with us. So, you know, one of the themes that Tom and I have been talking about is just how robust the performance we have seen in equity markets. It's, you come in day after day, it's a new record high. But at the same time, there's some warning signs on the ground. Consumer confidence continues to dip. And I wonder whether that is going to show up in some of the earnings out of these U.S. consumer good companies later today.
Yeah, it's a good question. So you're seeing mixed signs and mixed signals from the U.S. consumer. But the way I describe it is a real bifurcation. So there's two types of consumer, really. There's the higher-end consumer who continues to trade as normally. They're continuing to spend, and they're benefiting from wages, asset price growth, buoyant equity markets. So that segment of the consumer is still very healthy. But the lower-end consumer is really starting to feel the pressure from inflation, gas prices, rising energy bills and utility bills. And that consumer is starting to show signs of weakness.
Yeah, we're seeing sentiment surveys around the consumer. We're seeing some evidence around wage growth as well. So this is the K-shaped economy, and the big names in terms of the retailers in the US are going to have to adjust to that.
Yeah, exactly. And I think the earnings that are due out later will provide three different reads on the consumer. So if you think about Costco, indexes slightly more affluent, but you might start to see trade down dynamics from that lower-end consumer. Best Buy, obviously a bit more discretionary, and Dollar Tree, you know, very exposed to that lower-end consumer. So you're going to get three different reads, and depending on what they say, I think we'll get quite a strong...
I didn't know that Costco was more affluent. That's interesting.
Yeah, it actually over-indexes slightly more kind of suburban and kind of middle to higher income. Consumers love value, and in more challenged economic climates...
So does Mr. Brzezinski. He comes back with kilos of toilet roll.
Yeah, exactly.
So can I just ask you, you know, we're going to get these headline figures, but perhaps should we be more discerning beneath the surface about exactly, you know, what is going on and selectivity as it shows up with these U.S. consumers?
Yeah, exactly. I think it's less about the headline beat with these earnings. It's more about the quality of demand and the quality of the beat. Like I said earlier, you're seeing a real divergence in consumer spending habits, consumer spending very differently. But what they say in terms of traffic, average basket size, the types of categories that are being spent on, whether we're seeing a mix shift from kind of discretionary to non-discretionary, those are the signals that investors are going to be looking for to get a real read on the consumer and the economy more broadly.
We've seen some evidence, haven't we, some executives in the US talking about the fact that consumers are obviously paying more for their gas prices, and so they're adjusting their spend maybe on discretionary as they take a bigger hit and a bigger slice of the income comes out on gas, and so they have to adjust around that. So that could be ties into what you've been discussing.
Yeah, absolutely. And to what you were saying about the K-shaped economy and who is the type of consumer that's getting hit most by rising gasoline prices, with, once again, you know, the backdrop to all of this is U.S. gasoline prices continue to hike. Is it going to push out the otherwise discretionary spending that we would have seen in the U.S.?
Okay, Bloomberg strategist Rahul Amin, thank you very much indeed for that analysis, setting us up nicely as we look ahead to those earnings coming through from some of the major retailers in the US, and that gauge on the US consumer, of course. Coming up, the war in Iran, which ties into all of this, of course, is reshaping global energy markets. We're going to speak to Phoenix Energy's Sharif Souki. That is next. Really interesting conversation coming up as well. Stay tuned, stay with us. This is Bloomberg.
scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back. This is the opening trades. We are half an hour into today's session, and it is risk off behind me. All of the main European bourses trading in the red. This after once again an incident on the Strait of Hormuz overnight with the U.S. firing at Iranian drones, Iran retaliating on a U.S. military base, but both sides maintaining that the ceasefire is still in place. However, risk sentiment is negative. The handover from Asia negative this morning. Stock 600 down 0.5%. A relative outperformer. The German index down about 0.1%. Seeing a bit of green on energy, no surprise this morning as well. And tech sector are the ones that are leading. But to the downside, you can see quite clearly FTSE 100 down 0.9%, with many of the healthcare and telecom names coming under selling pressure this morning. So the setup pretty risk off as we head into the European trading session.
So let's get a little bit more granular then as we look at the volumes are down about 30% in terms of the volumes versus the 20-day average. So you can bear that in mind. Volumes are lower and pretty significantly lower, 31% across the makeup then in terms of the breakup, in terms of the upside and the downside. As Jim was saying, negative across the equity market, and you're seeing that reflected. So you've got 456 stocks in negative territory right now so far in the session, just 120, 123 or so. A lot of those, of course, in tech and in energy. Let's flip the board and have a look at some of the gainers then, the leaders, and then we'll get you to the laggards. Defense names are getting a lift today. We're seeing that with Rheinmetall. We're seeing that with a Renk Group as well. Both those stocks up strongly in today's session. Again, we've got more kinetic energy, or at least kinetic attacks, military attacks, of course, US attacks on some targets in Iran. That is potentially a factor as well. Renk Group up 4.5%. You're seeing gains in Rheinmetall, 31 points, up 2.5%. The tech story is there, as we've been discussing, and European tech is getting a lift this session on the back of this. Infineon, the chip maker, of course, up 2.5%. That's a decent gain for the German chip maker. Let's flip the board and have a look at some of the laggards. Interestingly, Uber coming out with a renewed offer for Delivery Hero, but investors not liking it. The stock is down 3.3%. Adyen has faced its challenges. Now the CFO is out at that fintech company, currently down 2.4%. And AstraZeneca, this is a broader touch on what's happening in terms of the pharma space, which is softer in the session. And AstraZeneca is currently down 2.7%. Jumana.
Well, here's what else you need to know this morning. Wall Street CEOs are predicting another banner quarter for trading desks. Bank of America's Brian Moynihan says second quarter sales and trading revenue could rise around 15% from a year ago. And Jamie Dimon is also bullish, expecting markets revenue to climb about 11%, alongside a double-digit gain in investment banking fees. Now, Bloomberg has learned that TSMC's chief executive told staff they can expect profit-sharing payouts to rise this year by more than 30%. A source says that C.C. Wei made the announcement during a town hall meeting after employees voiced concerns online over TSMC's incentive plans. The chipmaker is amongst the prime beneficiaries of the AI boom and is facing increasing pressure to share the profits. And the Democratic Republic of Congo is seeking access to an experimental antibody treatment as Ebola continues to spread. The country's health ministry says suspected cases have climbed above 1,000, with 238 suspected deaths. The World Health Organization says the Eastern Congo faces a catastrophic collision of war and disease as fighting and displacement accelerate the spread. Tom?
Okay, let's switch focus right now and get back to the energy story. Oil, of course, jumping as the US strikes an Iranian military site and imposes new sanctions aimed at stopping Tehran from profiteering from Hormuz vessel transits. This comes as President Donald Trump asserts that no one nation would control the waterway. Joining us now is Phoenix Energy Chairman Sharif Souki, who previously founded Cheniere Energy, the largest U.S. exporter of natural gas, someone who has deep and arguably unrivaled experience when it comes to natural gas in the U.S. and LNG. Great to get you around the desk with us this morning. I want to start with a broad, sweeping question about what the biggest impacts are across the LNG and gas space that you've seen as a result of the conflict with Iran.
What I'm really struck by is the fact that it is not a lot worse than it should have been. Mm-hmm. So the thing that we've noticed in the last decade, since we exported the first cargo of LNG from the United States, is that LNG has become a true commodity on a global basis and has increased in size on a very, very dramatic pace. And that the United States has transformed itself from the largest importer of natural gas to the largest exporter of natural gas in a very short 10-year period. And when you think about the impact, both on oil and gas, of what a disruption of the magnitude that we've seen, 20% basically of the global flows, all of a sudden being affected. I'm not going to say disappearing because we quickly found solutions. The impact should have been a lot bigger historically. So what I'm struck by is after 3 months, oil is only at $100. Natural gas has increased more, but nothing compared to what happened 4 years ago when Russia invaded the Ukraine and disrupted the flows of natural gas in Europe.
Does that relatively benign picture persist, or are you concerned that we get a sharp tick up in prices as long as this drags on, if this drags on further?
It's very, very early to tell on a long-term basis, but right now what I've seen is first a supply response. So clearly we had some room in the supply picture that was able to be brought to the market. The U.S. exports increased very dramatically, very quickly. Yeah. Second, logistical. So people had storage, people had some ability to use different pipelines, different ability to move. And third, a demand response that was pretty quick. First, China was buying 1 million barrels a day. That was not really necessary. It was just to put in storage. You have to wonder, did they know something? Why were they doing this? You could see that at $70 a barrel for the last year, they were buying. So they were actually helping OPEC to maintain the price around $70 a barrel, which is very unusual.
And it's interesting because that showed up very clearly in the oil markets, the destocking theme as well as China's demand for oil sort of waning over the last couple of months. But I wonder to what extent it's actually driven gas markets and actually whether the bigger driver there is the fact that the U.S. stepped into that market in a meaningful capacity.
Well, this is where the flexibility comes in, because the saving factor on the demand side is fuel switching. So you have a lot of ability to go, okay, so if oil is becoming too expensive, I can go to coal, I can go to gas, I can go to renewables. So you have a lot of flexibility in that. And then the third chapter is the demand that is not strategic. So there's like low-hanging fruit that you can get rid of. You don't really need to have it. It's nice to have, but not necessary. So you see all of this happening, and that is all of these things have mitigated the prices and the reaction so far. So to your question, whether it lasts or not, I don't know. It's too soon to tell, but it's very interesting to observe the flexibility that exists now in the global markets.
And of course, the backdrop to all of this, Sharif, is even before it kicked off, I remember we'd have lots of conversations about the supply glut to come because of the new fields that Qatar is bringing online, U.S. obviously ramping up capacity too. What happens after the Strait is fully reopened? At some point it is. We have to assume it's going to be fully reopened. Are we going to see prices plunge because of that?
Probably for a short period of time, if the straits are reopened. But ultimately, the burden is shifted. It is always incumbent on the owner of the molecule to convince the market that he's the cheapest molecule. And that's not how the LNG market started. It started as a replacement for oil and power generation. So we had a history that kind of got us into a certain box, which is no longer the case today, because LNG is now one of the top 5 traded commodities on a global basis.
Yeah.
And for that, if you own the molecule, you have to convince people that your molecule is the best. So if you can provide your molecule in the top quartile from a cost standpoint, and I would limit it to natural gas, but it really doesn't work that way anymore, because you can switch from natural gas to renewables to coal and people have demonstrated that they have the ability to do that.
What's the capex impulse at this point in the US? Is more money being put into the ground to extract more LNG? Are we going to see more terminals built out? What is the ability for the US to continue to build on this momentum? Is pricing at a sweet point where that capex can be spent, or not yet?
So remember that this is very recent for us. 3 years ago, we were still talking about energy independence.
Yeah.
And then all of a sudden, we became energy independent and didn't notice. So it took us a while to get adjusted to this new role that we have. For 50 years, we were thinking about where we're going to get all these molecules that we need. And then all of a sudden, we have them. We don't know what to do with them. So when I started, we didn't know that the Permian Basin existed. Mm-hmm. We didn't know that the Marcellus was going to be as significant as it is today. So we were looking at all of this with a little bit of skepticism. It turned out that we were wrong. The resource is really incredibly large. The infrastructure doesn't exist. So just simply finding the molecules is easy in the United States. Today you have 3 major basins that are capable of increases all of them, very, very dramatically.
Is it lack of terminals?
So no, it just before you get to the terminals, you need the pipelines.
Yeah.
And if you don't have the pipelines, then you can't take it from the northeast down to the coast. You cannot take it. I mean, look what's happening at Waha today. You have natural gas that is being produced as a byproduct of oil. The decision to make the investment is not about natural gas, it's about oil. And the associated gas is roughly 40% of the mix. You have to do something with that gas. Yeah. So you have Waha today that is negative. In other words, the producer of oil in the Permian Basin have to pay somebody to take his gas away.
Yeah. So from what I'm taking away from all of this, the issue is not the availability of the molecule. The issue is going to be, at least, for the sellers of the molecule to convince their buyers to buy their molecules. And I just wonder whether, Middle East, obviously, Qatar Energy, some companies have declared force majeure on some of their customers. Is that going to have longer-term ramifications on where customers get their molecules from?
So Qatar is going to have exactly the same issue that the United States has, but they're in a privileged position. They have a very, very large basin, and they are going to have to continue to convince people that their molecule is going to be the cheapest. And from a standpoint of the basin itself, it's very cheap. They can be on the water easily for $3 or $4 an MMBTU, which is very attractive on a global basis. So they will always have a very significant role to play. and they have the privilege in terms of what the cost of the molecule is. They're going to have to build the infrastructure pretty much like everybody would do in the United States as well. And that would be two major poles of natural gas on a global basis going forward.
Yeah, and how do you see Europe's position in all of this? And once again, there's been a lot of scrutiny on European sensitivity, reliance on gas imports coming through from Qatar. How do you see the landscape there?
I think Europe has to sort of grow up. They're sitting in a position where they're not resource rich from that standpoint. They have a lot of other advantages, but not energy sufficiency. And they have to come up with a solution. The issue that we have on a global basis today is not simply this, but electricity is going much faster than any other sources of energy. So energy is going at about 1.5% per year for the last 40, 50 years. Electricity demand is going at 3 to 4%. That presents a problem in terms of what is your fuel mix. So if I were European today, I would think in terms of if we're going to continue to electrify with AI, AC, EV, anything that you want to put two letters to, you need to figure out where your electricity is coming from. That is a fundamental issue if you want to remain competitive on a global basis. And I don't see Europe dealing with that central issue at the moment. They're going to have to.
Okay. Europe needs to grow up. There we go. Phoenix Energy Chairman Sharif Suki, really appreciate your time. Thank you, sir, for joining us in the studio. Coming up, former Prime Minister Tony Blair accusing Labour Party politicians of playing with fire over the UK's future. He also has views on the UK's energy mix. That is next. This is Bloomberg.
cidade estava sitiada.
Nisso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you
up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Welcome back to the Opening Trade. Happy Thursday. We are 47 minutes into today's session. Not very happy across these markets. European stocks are down 0.6%. There's renewed concern on the geopolitical front, of course. We are risk-off. US futures also in negative territory. To the UK now, where speculation about whether the UK Prime Minister Keir Starmer will face a leadership challenge continues after former Prime Minister Tony Blair warned the ruling Labour Party was now, quote, playing with fire and not conducting itself seriously. Bloomberg opinion columnist Adrian Wooldridge says the intervention by Blair serves as a reminder to the current Labour government that policy must always come before personality. He joins us now. Adrian, as someone who has spent a lot of time thinking and analysing UK politics, is the prescription that Tony Blair laid out the correct prescription, not just for the Labour Party and the Labour government, but for this UK economy?
50%. I think he's absolutely right in his economic policies, suggesting that we need to stop taxing business out of existence, suggesting that we need to have cheaper energy, we need to focus on energy supply rather than on clean energy. All of those things are absolutely right. But I think the one area where I'd question him is he doesn't think enough about sort of issues of social inclusivity, issues of feelings of belonging. I think people feel that society is out of control and they want to get back in control. So half right and half failing to address really big problems.
I think the crux of what he was saying, though, is you've got to put policy before personality. Absolutely. And that's not just endemic to the Labour Party. It's every single political party around the world, even outside the UK. Yeah. But on the Labour Party specifically, he's saying we need to return back to this concept of a radical centre. Yeah. What does that mean, in effect?
I think he's right about the radical centre, that there's much more room in the centre than there is on the extremes, that any party that tries to govern from the centre can win. But I don't think we need to just resuscitate the radical centre of the late 1990s and early 2000s, which was Blair's radical centre. We need to do that, but we need to do something more than that. We need to reassure people that they're more at home, more comfortable in the world. I think he failed to address sentiments about belonging, about your place in the world. So the reason that the populists are gaining so much ground is not just because of economic stagnation, although that's one very important reason, but that people don't feel in control of their own lives. They feel as though they're the victim of big forces that they can't understand or control, or of just social anarchy.
Yeah.
Do you think, Adrian, what do you think this does to the leadership race? We're not there officially yet, but certainly we seem to be in the foothills of it. Yep. Do you think it changes the fortunes of those contenders, whether that is Burnham or Wes Streeting or the Prime Minister himself? How do you think this affects that?
I think it's shown how weak these people are compared with Blair. I mean, he is just on a different level intellectually and on a different level in terms of his seriousness and his ability to articulate problems. So I think and I also think it injects a new seriousness into the debate. The debate has been so much about personalities, about manoeuvring, about the process of politics. And Blair rightly says we need to talk about big issues.
The critics would say that the Prime Minister does not have the personality to shape the agenda, that Tony Blair had that force of personality, that ability to communicate. So part of this maybe is personality.
Well, there are two problems with Keir Starmer. One is that he doesn't have any personality, and the second is that he doesn't have any ideas, which is a big problem in politics.
So I want to come back to a question that I think most of the viewers will be asking, which is, to what extent are bond markets, are fixed income markets going to shape policy and decision-making, right? And it was interesting that Wes Streeting this morning put out an opinion piece in The Guardian saying Blair wants to leave our future to the markets. I believe democracy can still shape our lives for the better. And what's he saying here, essentially, that we should not pay heed to bond markets?
Well, he's talking nonsense, and this is just another way in which we're demonstrating now how much bigger and more serious a figure Blair is than the current contestants. Democracy does not mean being able to vote for unicorns and expecting them to be delivered. Democracy means coming to terms with reality, and part of that reality is the state of the markets. In fact, you're less in hoc to daily pressures from the markets if you run your economy well than if you run it badly. We've been running it badly. That's where the markets have so much power at the moment.
But still, it's going to constrain their position to maneuver because interest rates are so much higher now.
Absolutely, and this sort of irresponsible talk about being in hog to the bottom markets from Burnham or believing in democracy rather than markets from streeting does increase the anxiety in the markets that the Labour Party is drifting, signalling, manoeuvring to the left.
Okay, Adrian, thank you very much indeed. I should point out as well that the Prime Minister and his team would probably push back on the idea that he has no ideas. They may point to planning reform. They may report to spending around the NHS and shrinking of wait times and additional measures that they would argue they have pushed through in their terms so far. Bloomberg opinion economist Adrian Waldron. Adrian, thank you. Let's look and get back to the markets then and think about what else we are watching throughout the day. 10 a.m. UK time, the IEA releases its World Energy Investment Report for 2026. Interesting, of course, in terms of what we're seeing right now in the dynamics of the energy markets. 1:30 p.m. UK time, it is US PCE inflation data. To what extent will that reflect the increase in energy costs? And at 4:30 p.m. UK time, the ECB's Schnabel on the hawkish end of the spectrum will be speaking at Cologne, and the Reykjavik Economic Conference gets underway with the Fed's John Williams and Alberto Musallam due to speak. More Fed speak then after we heard some hawkish commentary overnight. And on the consumer front, retailers, Costco, Best Buy, Dollar Tree, but also on the tech front, Dell as well. Earnings stateside.
All right, let's bring in Bloomberg MLive strategist Skylar Montgomery-Koenig this morning. All eyes in the U.S. session will be on PCE, and we are expecting an uptick in the headline figure versus where we were last month. How much of a market-moving number is this going to be, do you think?
Yeah, I mean, I think I'll focus more on the direction of travel for inflation rather than anything else. I think what we've seen from the data in the last month or so is that there is a real economic impact when you have higher commodity prices, right? So the U.S. is less exposed than, say, Europe or Japan because it's a commodity exporter. So growth isn't hit as badly. You've had fiscal kind of pump growth from the other side. So economic surprises have been very positive in the U.S., but inflation surprises have also been positive. So you get less of a growth hit, but you still get that big inflationary impulse. Now, that's fed into markets more strongly as we've had inflation come in hotter, particularly the last CPI print. So this print is expected to show that same kind of resilience and activity from personal income and spending, but with year-on-year inflation, as you say, upticking to 3.8%. Now, when we expected the Fed to be dovish regardless, in that we had inflation above target for years and you still got cuts, that was because inflation was declining or at the very least steady. Yeah. Now that we have inflation rising, that macro shift means that even if we get a downside surprise today, as long as inflation is rising, that's negative for U.S. bonds and it's positive for the dollar.
Brent is still below $100 a barrel, and it's still set to end the week in negative territory. I mean, the oil has not broken out to the upside in a way that would cause many anxiety. Is that not a comfort blanket, at least for these markets at this point?
I don't think so. I mean, it's comforting for equity markets in that if you have another narrative in terms of AI, that means that can drive prices. But I think it's just a matter of time before you have higher oil markets. And that's because it takes a very long time for supply shocks to feed out of the system. You're getting some kind of supply response now in that U.S. oil rigs have risen. They've risen the greatest degree in 3 years. But you're still well below levels in kind of U.S. oil production or rig count that we had the last time we had prices this high. So the oil rig count is like 425, whereas previously you'd expect something like 500 at these levels. And that's just because it takes time for stuff to come online. And what you do have coming online doesn't offset to any kind of great degree what's come offline. So physical markets are becoming tighter and tighter as your reserves are run down. We've already run down quite considerably to the lows that we reached post-Russia-Ukraine in the U.S. And that just means, you know, as that market gets tighter from a physical perspective, oftentimes your spot price or your forward price is forced to roll up to your spot price, meaning that the path of least resistance is higher oil prices.
Skylar, thank you very much indeed. With the view still consistent that oil prices will be moving higher. Skylar Montgomery-Koenig from our Bloomberg MLive team. Thank you. Do not miss, by the way, my interview is coming up with Mistral's AI CEO. Mistral AI CEO. That's coming up at 10:15 a.m. UK time. We've been talking about their push into data centers and their spend as they push into the enterprise space. That is it. The Pulse is up next. This is Bloomberg.
into the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
US and Iran trade fresh strikes, oil prices climbing on fears of escalation and mixed signals on the status of peace talks. Central bank chiefs, meanwhile, warn on inflation ahead of key US data today. The Fed's Lisa Cook says she's prepared to hike rates, and Philip Jefferson warns inflationary risks remain tilted to the upside. Plus, snowflakes melt up. The software maker surges more than 35% in late trade on a deal with Amazon, but Salesforce slides as its revenue outlook misses. Well, a very good morning. Here's where we stand in markets this Thursday. Geopolitics firmly back in the driver's seat. We're looking at US futures pointing south as we head towards the Wall Street Open following losses in the Asian session. This as those fresh attacks in the Middle East have sent oil higher. Brent there at $96.41 the barrel, up 2.25%. Yields higher across the curve. The 10-year Treasury yield now at 4.49. And you're looking at the Bloomberg Dollar Spot Index higher as well for a third straight day on those strikes. Now, taking a look across Europe, if we bring up our map, losses across most of the continent this morning, including on the FTSE 100. That is the laggard, despite energy being one of the best performing sectors today. The FTSE down 0.8%, the CAC 40 in Paris down 0.4%, and the DAX in Frankfurt flat to the downside, which comparatively for today is one of the best performers. Let's get you started for the day ahead.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Well, US forces have launched airstrikes on an Iranian military site, signalling how fragile hopes have become for a deal now. President Trump earlier said that the Strait of Hormuz will remain open to all, though he didn't outline how that'll be enforced. He did, though, add a new name to the list of countries that he's threatened now to attack.
The strait's going to be open to everybody.
And who would control it?
It's international waters. Nobody's going to control it. We're going to watch over it. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. They would like to control it. Nobody's going to control it. It's international waters, and Oman will behave just like everybody else, so we'll have to blow them up. They understand that. They'll be fine.
With me now is Jomana Basechi, Bloomberg Horizons Middle East and Africa anchor, with us in London. Jomana, where are we up to now? Doesn't seem like there's sign of a peace deal just yet.
Yeah, well, once again, the ceasefire is being tested. We saw another incident on the Strait of Hormuz. This is the second time this week. And essentially what happened is the U.S. maintained that a commercial vessel came under fire by Iranian drones. They shot back at 4 of these Iranian unmanned drones, in addition to a drone launching site around Bandar Abbas, which is a port around the coastal city very close to the Strait of Hormuz. In retaliation, the RGC did say that they struck back at a, quote, U.S. military base from which the attacks were launched. Around the same time, sirens and the air defense system went off in Kuwait. So we can infer that perhaps they had retaliated on that military base in Kuwait. However, U.S. once again maintaining that they had acted in a defensive capacity, that this does not violate the ceasefire. The ceasefire is still in place. And so far on the Iranian side, once again, not seeing any signals that they want to escalate this even further. But of course, Lizzie, it is the second time we get an incident like this around the Strait of Hormuz. And I think underscores still, for many of the vessels around there, how dangerous it is to attempt to cross.
So both sides blaming each other. Where does it leave diplomacy, though?
Well, you know, don't underestimate the diplomatic progress that has been made in the background. There have been plenty of talks, and this time in Qatar. So Qatar is emerging as one of the new key mediators. It seems as though the location for these talks has sort of shifted away from Pakistan to Qatar in the last few days. We know that the Iranian foreign minister, the Speaker of the House, had been there. Again, yesterday, a deluge of media reports coming through from Iranian state media, Iranian state TV. One of them moved the market. Iranian state TV suggesting that they had reached a deal, or at least an MOU, on reopening the Strait of Hormuz in the next month in exchange for the U.S. retreating fully from the region lifting their own blockade. But that was denied later by the White House. It seems as though we're getting close, though, to a point where such a framework will be released. And as we spoke about yesterday, Lizzie, one of the key points of contention is just what the U.S. are going to offer to Iran in exchange for lifting the blockade, or lifting the control that they have around the Strait of Hormuz. And that comes down to the question of economic relief. Once again, Iranian state media this morning saying that they want instant assets unfreezing of $12 billion. Whether the U.S. accepts is a big question mark. We know President Trump is already coming under a lot of pressure internally. Some more hawkish members of the cabinet pushing back and saying you can't give too much in phase 1 of the deal. At the same time, he was also asked by PBS whether Tehran would get sanctions relief for giving up the highly enriched uranium, and he also said no. So again, the conversations continue. But one thing's for sure, Trump has reiterated time and time again that this new protocol that Iran is suggesting, even a joint protocol with Oman, is a non-starter for the US.
So you've got control of the Strait of Hormuz, frozen assets, nukes, Lebanon, all the sticking points remaining.
Yeah.
But for now, what's happening in the Strait of Hormuz? What's getting through?
Well, we reported earlier in the week that there had been a more trickle of vessels coming through. Iranians saying that they that about 30 to 35 commercial vessels went through at the beginning of the week. But then you had the incident a couple of days ago. Since then, you've also seen some non-sanctioned vessels, non-sanctioned oil vessels go through, linked to Saudi Arabian oil, to UAE as well. Our LNG colleagues are reporting that a couple of LNG carriers are also passing through. So there has been a trickle. But ultimately, look, this goes back to what we've been saying time and time again. Even if you get a dozen or 20 or 30 vessels going through a day, it's still a far cry from where we were pre-Strait times. We were looking at 100 to 150. The fact that you run the risk of being caught in this exchange of fire is also a big risk for any vessel looking to cross, and also for insurers. And at the same time, I mean, the U.S. proved the point that there are actually mines in the Strait by hitting at boats that were laying mines a couple of days ago. So if you were a ship owner, why would you run the risk of going through the Strait knowing that there's a potential for these mines going off? It's going to take some time for the mines to be cleared, essentially, and for us to go back to how things were before the war.
So even if they get that deal, could be a long while till we get some relief. Jomana, thank you very much. That's Bloomberg's Jomana Basechi. As we look at Brent, trading up 2.5% now at $96 a barrel. Well, turning to tech, Salesforce shares down in pre-market trading after the company's revenue outlook for the current period fell just short of analyst estimates. The leading maker of customer management software unnerving investors already concerned that AI could disrupt the sector. sector. Let's get more now with Bloomberg senior strategist Neil Campling. So, Neil, the market's not impressed. What were you taking away from those Salesforce numbers?
I think on Salesforce specifically, the risks of AI disruption, investors were going into the print hoping that there'll be some relief in terms of maybe an upgrade to the guidance going forward. And we didn't get that. And then the problem is that their AI toolset, something called Agentforce, grew substantially year on year by 200%. Sounds great in principle. The problem is it's less than 10% of revenues. So when you've got an industry in terms of facing AI, you've got agentic AIs like Anthropic growing at 200% in terms of their revenues, and you've got Salesforce growing their top line at just 10% year on year. The problem, the questions around software, terminal values of software companies, the risk of disruption, none of those have been sort of relieved, if you like, in terms of that print. And so high free cash flow generation, a cheap valuation in principle, high margins, but where's the growth acceleration? It wasn't in the results last night.
And yet, if we look at a completely different story, another software maker, though, Snowflake, actually doing pretty well.
Described by some analysts this morning as outstanding, an acceleration of growth in contrast. So they've actually increased their revenue guidance to be above 30% this year. This is a company that's transitioned from a pure software data warehouse company into an AI data cloud. And you saw this evidence last night by signing a $6 billion deal with Amazon's AWS. They are AI platform agnostic, so they can really work with all of these various AI platforms to deliver these solutions. So you have sort of the haves and have-nots within software, one company growing at a substantial rate relative to the other. And sort of, I think, if we backtrack to the start of the year, perhaps both were seen as a risk, whereas one has pivoted to sort of embracing AI, and it's coming through already in terms of that revenue growth.
And that exposure to AI really the separator when it comes to being successful in software. Neil, thank you for the analysis. That's Bloomberg senior strategist Neil Campling. Well, turning now to the macro, Fed Governor Lisa Cook says that inflation's headed in the wrong direction, and she's prepared to raise rates if it persists.
I see elevated risks to both sides of our mandate. And from a risk management perspective, I currently believe that the right course of action is to hold rates steady. However, I want to be clear about my risk assessment. The risks remain tilted toward higher inflation. In my baseline forecast, disinflation should resume in upcoming months without having to raise rates.
Well, attention now turns to the US PCE data later, the Fed's preferred inflation gauge, of course. And we can speak to Greg Peters, Co-Chief Investment Officer at PGIM Credit, for more thoughts on this. So, Greg, the market's underestimating inflation's threat even still. Good morning.
Good morning. Yes, I think they are. I mean, the markets are taking so much comfort in the jawboning aspect, right? So whether it's the Trump administration talking about reopening the strait and ending the war, to central bankers across the globe focused on inflation and ready to hike. And I think ultimately it's about action and not rhetoric, but the rhetoric is definitely driving the market in ways, quite candidly, I haven't seen in my career.
Okay, so a market's too complacent about the prospect of Fed hikes before cuts?
I think the markets are too complacent around the impact of inflation itself, right? If you look at the forward curves, if you look at where inflation is pricing out in the future, it's a resumption of normal. And I don't think we're in this normal environment. I see a market where there's just shock after shock after shock that leads to higher inflation, not less inflation. And I do think it changes the trajectory of interest rates. Most importantly, the market was really leaning into this narrative of this global rate cutting environment. And now we're talking about rate hikes. And so it's caught the market completely flat-footed and looking the other way.
Well, yeah, Jamie Dimon says that yields are only going to climb further. Where do you see them getting to?
Yeah, I think the bias over time is higher yields, not lower yields. If you believe that inflation is in the system, that means that central banks have a lot less room to move rates lower. that means that the yield curve has to stay kind of higher. And then you think about just the debt and the deficits and the political disruption, so to speak. I see risk premium moving higher, and I see the bias for higher yields, not lower yields, over the course of the many years, let's say.
Well, yeah, you've kind of described it as a boiling frog situation. It's not like there's going to be one trigger that triggers a sovereign debt crisis. Yeah. How far away are we from that?
Well, I think that's the whole thing. We don't know, but I think we're getting, like, the preconditions matter, and I think that's the concerning part. So you have, elevated debt and deficits. You don't have a political will to change it. Sovereign supply is just going to increase over time. You're also seeing this digital infrastructure supply competing, so you're in this crowding out effect. And so what that means ultimately is that yields have to be higher to attract that capital for those risks. And it's a story that is just starting, I think.
Well, in the meantime, is there anywhere you actually like along the Treasury curve?
I do. So the irony is I am dancing through the raindrops somewhat here. If you look at where base level yields are, it's actually pretty attractive. And the curves are reasonably steep. So investors can kind of earn money the old-fashioned way, which is just yield and carry. And that's something that's been missing in the bond market kind of pre-COVID, right? When interest rates were at zero or close to zero, it was really difficult, near impossible for fixed income investors to make money and put it in a balanced portfolio. With yields as high as they are, it definitely helps on the margin, but that pressure will continue regardless.
You talked about the lack of willingness to kind of control debt at the moment, and we've been hearing from the former UK Prime Minister Tony Blair overnight criticising the Labour Party that he used to run, and then Wes Streeting, the former Health Secretary, also saying that it should be democracy that runs government, not the bond market. Do you think that when you have the likes of Andy Burnham, the Mayor of Greater Manchester, who could replace Starmer potentially as Prime Minister, saying that they'll stick to the fiscal rules, do you think that the bond market should be less scared of the Labour Party? Or are comments like this from Streeting just another in hoc to the bond market moment?
I think it's the latter. So, I mean, just look at the market reaction pre and post Burnham's comments. So at first he said, he's less worried about the fiscal rules, then changed the mind, and then the market rallied, the gilt market rallied quite significantly, 40 basis points or so. So
unwarrantedly?
Well, I think, I go back to this narrative is the market's putting too much faith in the jawboning and not enough of what's happening. And if you look at the political will, I think it's really difficult to kind of make these hard decisions, right? It's hard to cut entitlement programs, hard to cut spending. There's a general, aversion of higher taxes, so to speak. So it's just a really difficult spot, and it takes political will in a stable political environment. And, we're in this environment where everything is happening so quickly that it's hard to make these harder long-term decisions.
I mean, do any of the candidates look like they could be the more friendlier version to the bond market?
Well, I think, once again, it's about the action, and I think it's all basically virtually the same.
Okay. All right, Gregor Peters there, Co-Chief Investment Officer at PGIM Credit. Great to get your take. I'm sure we'll have to get it again as this leadership battle continues. Not quite formally a leadership battle just yet, but we'll see where things are headed. Coming up, though, we'll discuss where the opportunities are in private equity and why investors are excited about Europe. That's next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
What we believe is that it's very possible to take an existing workforce that used to do a certain task without AI and where their jobs is profoundly changed with artificial intelligence and to reskill them on time. So we work with our customers to make sure that they can reskill, that they can equip their people with the best AI technology.
The Mistral AI CEO Arthur Mensch speaking there to Bloomberg's Tom McKenzie out of Paris. Well, private credit may have made headlines recently for the growing number of redemption requests because of worries over exposure to software firms threatened by artificial intelligence. But when it comes to private equity, my next guest believes there is continued strength to be found out there. Elizabeth Weymouth is founder and managing partner at Graphene Partners, an investment firm that backs up-and-coming private market fund managers. So really good to see you.
Nice to see you too.
Thanks for coming in. So I wonder, when you have all of this optimism around AI, but then all of the worries about geopolitics, what's the mood among investors that you're speaking to at the moment?
Well, interesting. Yes, so we've got a dichotomy here when it turns out there are lots of risks and lots of opportunities in the market today. So I was just at Milken about a few weeks ago, and it turned out that the general sentiment among investors is pretty positive. There's confidence in the system. They're a tale of almost two cities in the sense that markets are opening up, M&A is continuing, IPOs, as we know, are alive and flourishing and increasing. And so the exit windows for private equity are increasing the strength, which we haven't seen in the last couple of years. On the other hand, there are actually more companies that have yet to be exited. So there's a lot of companies waiting to exceed their exits. And then we have other ideas that are increasing. Oh my God.
Yeah. Well, I mean, what should we make of all the dry powder that PE firms are yet to deploy?
Yes, there's a lot of dry powder that people have yet to deploy, and it's one of those things where we're still seeing opportunities. So with the M&A markets increasing, I think that we will ultimately work through the dry powder. Interestingly, the fundraising market has been a very difficult situation for the less than big, the lower middle market and middle market private equity companies. The large cap companies are raising new capital. It's almost, again, another tale of two cities where the big firms are getting bigger and the small firms are having more difficulty, but there's still float to be done.
Yeah, okay. I mean, do you see exit options for PE? When will we start to see more PE firms starting to sell?
We're starting to see it already. So we have seen more exits in 2025 than we saw in the previous 3 years alone, and we are on deck to see, in the first half of 2026, very healthy exits. Now, these are larger companies that are being exited, so we are going to see more exits in the middle market and lower middle market, and the middle market and the lower middle market actually has more opportunity for exits than just the IPO markets or big-scale M&A. So these are sales on the smaller end to other firms that are a bit bigger on strategic side or private equity funds that are a bit sizable.
And what's your IPO outlook then?
Well, it's positive as long as we see what SpaceX will set the tone, I think, in the next few weeks. So once that goes off, hopefully well, then we see the rest of the pipeline continuing.
Do you expect to see more zombie fund managers having to wind down because they're not going to be able to raise money after poor performance?
It's a great question, because what we do see is that there is this gap between the bigger platforms continuing to raise a lot of money. In fact, 80% of the capital now going into private equity funds are going into funds that are $1 billion of AUM or greater. And then there are 20% of capital that's going obviously to the below $1 billion, which is where we focus at Graphene, so those lower middle market firms. With respect to zombie funds, there is a saying going around right now, and particularly the middle market indistinguishable from each other type of strategies, where some of them have raised their last fund, but they don't know it yet. Having said that, there are still opportunities to be found. There's still great deal makers in those funds.
And where do you see opportunities in Europe then, when our private markets are less developed?
So yes, in Europe, the private markets are certainly less developed than they are in the US, but that's an opportunity. So our focus at Graphene is really finding private markets alpha, and finding private markets alpha with the next generation of private equity leaders in particular. So there is a trend of new managers spinning out of the larger firms. First-time funds have outperformed funds 4 or later for almost every vintage year for 25 years. And that trend is really alive and well and really starting to kick up here in Europe. So we've had a presence here for the last 3 years in London. We think we're a little bit ahead of the trend to identify this talent that can generate the 3x multiple of invested capital or better. So that's where true alpha lives.
Well, we heard from Arthur Mensch there, one of the exciting AI companies in Europe. How do you play AI specifically on the continent?
Interesting. Our AI trade is not what you might expect. So we are not investing in data centers. We're not investing in semiconductors, but we are investing in the infrastructure behind AI. So particularly in the US and globally, the power that's required to support AI is extraordinary. And so there are the infrastructure components of infrastructure services, power generation, things that go behind the scenes and help the infrastructure for the grid, for jobs that are being more automated these days. So it's really in the services, Lizzie. So it's industrial services. We also think anything that is non-discretionary demand-oriented. So that extends into business services, healthcare services. The boring businesses, so to speak, is where we're focused. So it's almost the anti-AI play. But when it comes to AI, it's really the infrastructure behind it that we get behind.
Okay, so the pipeline and then how AI is going to change industries that already exist.
Exactly.
Also, last time you were on, there was a lot of talk about redemptions.
Yes.
Now we're talking about write-downs of some of the loans to software companies and other companies. Is there more pain to come? I know you're very positive, but realistically,
you're absolutely right. We're in the next phase of this. So we're seeing there was fear at first chapter and concentration in the software sector when it comes to private credit and redemptions. Now we're seeing some reality of some markdowns. Still in context, though, private credit as an overall component of the fixed income market is rather small. We do think that the risks are sort of concentrated in sectors. But at the end of the day, it comes back to underwriting discipline one more time. So we have to really keep our standards high. What's happened in private credit is not unlike what we've seen happening in private equity, which is why we created our strategies to sort of be the antidote to the growth of the bigger firms. But as the asset class grows, size can become the enemy of returns. And in that case, sometimes underwriting restrictions loosen a bit and you become a little lax. And so we just need to keep our discipline up. And I think there's opportunity to be had when there's uncertainty.
Okay. Elizabeth, really nice to have you with me this morning. Elizabeth Weymouth, founder and managing partner at Graphene Partners. Thank you very much.
Thank you.
Well, coming up on The Pulse, the ECB warns of sudden and significant correction in the markets. We'll discuss with Lorenzo Bini-Smaghi, former ECB executive board member and former chairman of SocGen. That conversation coming up next. This is Bloomberg.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning and welcome to The Pulse. I'm Lizzie Verdon in London and these are your top stories. The US and Iran trade fresh strikes, oil prices climbing on fears of escalation and mixed signals on the status of peace talks. Central bank chiefs, meanwhile, warn on inflation ahead of key US data today. The Fed's Lisa Cook says she's prepared to hike rates, and Philip Jefferson warns inflationary risks remain tilted to the upside. Plus, snowflakes melt up. The software maker surges more than 35% in late trade on a deal with Amazon. But Salesforce slides as its revenue misses. Well, if we turn to central banks now, the outgoing ECB Vice President Luis de Guindos says that policymakers should take a close look at just how badly the Iran war is weighing on the economy when they decide whether to raise rates next month. He also told us that policymakers should have better data by then.
I have never commented about decisions taken by the Governing Council on monetary policy, and well, I am not going to be there in 2 weeks because I haven't finalized my mandate in 3 days. No, but let me say something. I think that in June the Governing Council will have new projections, an update of the projections. We will have more data. I don't know whether we are going to have more clarity with respect to the situation in the Middle East. It's something that is difficult to say and to tell. But I think that the approach is the correct one. I suppose that the Governing Council will analyze all this new data, will take into consideration the situation in the Middle East. Simultaneously, there are some positives. For instance, inflation expectations are well anchored. And I think that simultaneously, well, the impact of this global energy shock and this global supply shock on growth is something that, for sure, that the Governing Council is going to consider. Mm-hmm. Because, the problem with a supply shock of this nature is that it increases inflation, but simultaneously reduces growth and reduces domestic demand. And this reduction in domestic demand could reduce inflationary pressures.
Mm. How big of a risk do you think is a recession in the euro area, given the risk you just described?
Well, I think that it's not going to be the baseline. If you look at, for instance, the growth rate in the first quarter of the euro area was 0.1. I think that the baseline is not going to indicate a risk of recession. I think that, the situation is clear: lower growth and higher inflation. But this lower growth is not going to give rise to a recession. That's our baseline scenario.
Do you think it's also a matter of credibility, of the ECB's credibility? Some of your colleagues have said that a rate hike could be possible also to preserve this credibility.
I think that the credibility of the ECB, is much more concentrated on inflation expectations. Inflation expectations in the medium term are well anchored. So I think that that's the main gauge of the credibility of the ECB. I think that the credibility of the ECB is not going to be enhanced because of a rate hike in June or a lack of a rate hike in June. I think that's something much more structural.
Do you think if the ECB were to hike in June that at least one more step would be needed because just to have an impact on the real economy, or would you say that a one and done could also be an option?
Well, I'm not going to elaborate on the potential actions taken by the ECB over the next Governing Council meetings, but let me say something. I think that we have to take into consideration the impact on growth. I think that the data that we have received so far, inflation immediately reflects the evolution of energy prices. But I think that for growth, it's going to take a little bit longer. But if you look at soft indicators, sentiment indicators, I think that these indicators clearly point at an important impact on growth.
ECB Vice President Luis de Guindos speaking there. And we can speak now to another face of the ECB, former ECB Executive Board member and former chairman of SocGen, Lorenzo Bini-Smaghi. Really a treat to have you with us. Thank you so much for coming in. It was your last ever shareholder meeting at SocGen yesterday, so I want to start there because you've been more than a decade at SocGen. How has it changed since 2015?
Well, many things have changed. I mean, the management changed, the governance of the bank has changed. I think we have left, I would say, a best-in-class governance, which has been able to foresee the change in management. The last 3 years have been really a turnaround for the bank. I leave with the share price about 60% higher than when I joined, so that's not bad. So I can't complain. But it has been a long process and difficult times for the world economy, COVID, Russia. We had Russian banks. We had to exit quite rapidly, actually. We did it. But now things are better, and there's a long way to go, but things are much improving, and I'm very confident that my successors will do the right thing. So
when will SocGen start thinking about substantial acquisitions then?
Well, we have done a few things, like Allianz Bernstein, for instance. The restructuring is not fully over. I think it's going to take a couple of years, but the environment is changing. The valuation of banks has changed, so shareholders are starting to ask, what's next? Where's growth coming from? And that's where I think some consolidation and acquisitions will take place. And you'll probably hear from at that point that things will happen, I think.
Okay, one to watch out for. Over the years, Lorenzo, you've been very critical of how Europe supervises and regulates its banks. On supervision, do you think that the ECB has done enough to make its supervision of banks less burdensome?
No, I wouldn't say I've been critical. I think we have to discuss these issues. There are no sacred cows. What I'm struck is that at the Fed, Kevin Warsh is stepping in, and he wrote an article a few months ago saying Basel endgame is not America's endgame. So after 10 years, we have to rethink issues. In Europe, we kind of have difficulties in questioning whether really what we've done over the last 10 years is in the interest of Europe. Just asking the question and trying to reassess whether we may want to change certain things or not. So the idea that just going through with what we have agreed 10 years ago is the best for Europe, it's not. I think it's not the smartest way forward. So I think we should engage with the supervisor, and we discuss openly. The supervisor said we need to simplify. We haven't seen many simplifications so far, and the burden on banks. And the result is that basically bank credit is going down in Europe. If you look, and not only in continental Europe, but if you deflate by inflation, banks are lending less. And you have these new operators, new institutions like private credit, which are growing. And they're not supervised. So is this in the interest of stability in Europe, that banks have a lesser role than others? So these are the kind of questions we should have the courage to discuss openly.
Well, do you notice that the tone from the top of the ECB is filtering through to the staff that you were supervising on a day-to-day basis at the bank?
Well, I mean, I think things are changing gradually, but frankly, the things are changing much more quickly in the US and probably a little bit in the UK also. So we can't be the last ones in continental Europe to adapt to a changing world. So just asking, you know, all these measures we have put in place, all these stacks of capital that are not very transparent, is this good for the real economy? Is this good for financial stability? I think there is a lot to discuss, and probably some rationalization would be very useful.
Well, we're waiting for the European Commission's report on banking competitiveness. What do you want to see in it?
Well, you know, there's a lot of, you know, let's compare with the US, let's compare with... But in the end, what matters is the results. The result is that in the US, bank credit is going up, in Europe it's going down. So something, and it's not just, I'm thinking, you know, it's going up in real terms and in percent of GDP. So it's not an issue of demand, it's an issue of supply. Let's face it. Then let's see, you know, what are the measures that really can improve the competitiveness. So that's what I'm expecting from the Commission. You know, how can we improve the competitiveness of the banking system in Europe?
Well, perhaps we could see something on the treatment of software investments, leveraged loans. Yes. Does that sound like the sort of thing? You
have a lot of ideas. Maybe you should talk to the European Commission. But
well, we'll wait for the report.
Yes.
Let's talk about private credit as well, because you've also previously lamented that private credit isn't subject to the same rules as banks. Some would say that that's rightly so, given that they don't take deposits. Right, but at the same time, the SocGen CEO has worked with private credit for years. So how do you see the relationship between private credit and banks developing? Are they more competitors? Are they partners?
No, they're both, I would say. It's very useful for us because we can offload part of our balance sheet working together, so we can make new loans. But that's due, so this originate and distribute, that kind of work that we do with the private credit, that's very useful. But on the other hand, the treatment that this credit has in terms of regulatory transparency, that's not so obvious. So we need more of a level playing field to be sure that, you know, if something happens, I mean, private credit is so big now that if something happens systemically, you know, you just can't say it's a small portion of the economy. It's a big portion of the financial system. It will affect the rest of the markets. So we have to be attentive to that. And the fact that they are not supervised and not regulated means that it's not clear what would be the contagion to the rest of the system.
Okay, Lorenzo, really lovely to have you with us in the studio. Lorenzo Bini-Smaghi, former ECB Executive Board member and former chairman of SocGen as well. Thank you. Well, as President Donald Trump continues to suggest a deal with Iran is close, he finds himself caught between two extremes: Tehran's demand to end attacks and pressure from Republican hawks to finish the job, or at least not to sign a bad deal. With the midterms approaching in November, the next few months are crucial for the president. And we can get analysis now with Katie Gadini, who is Associate Professor at University College London and also author of Esther's Army, The Christian Women Who Power the American Right. So, Katie, really good to have you as well. I wonder how you'd characterise the mood in US politics at the moment, when you've got the crisis in Iran on the one hand and the midterms approaching on the other, because the president says he doesn't care about the midterms after the Ken Paxton victory.
Yeah, I'd say it's definitely a tense mood, and it's starting to dial up the heat. There's a lot of complicating factors. So on the one hand, the economy is not in a great position. Majority of people who voted for Trump in 2024 voted for him to help the economy. On the other hand, we've just gone through a year of very intense ICE raids, which have been extremely polarizing to the country. And then we have the war with Iran, which continues to drag on. There is lowering approval for and support for that war. The closer we get to the midterms, that's going to have an effect. Not necessarily a massive one, but there are a lot of elements in flux right now that are making it a very tense midterm season.
Do you think that Paxton can beat the Democratic nominee, James Tallarico?
I don't know. There's a lot of buzz for Tallarico. I mean, it's similar to what we saw for Mamdani in New York City. You know, this is a candidate who is outside the box, who's fresh, who's presenting new ideas. It's a candidate that we didn't necessarily see with the Harris campaign, and we haven't seen in California with the governor campaign. So it's hard to know if that excitement will translate to a victory, but it certainly did with Mamdani, and it seems to have a very similar lead up.
Well, do you think that Trump's grip on the Republican primaries could actually start to become a liability?
Well, you know, I think it's hard to separate his influence on the Republican Party and then his influence on the MAGA base in general. And a lot of the MAGA voters are independents. And that's where we're seeing a lot of the disillusionment with the war in Iran, is with the independents, with the Gen Z voters. A lot of the mainstream Republican voters who, like Trump, are supportive of the war. So you kind of are seeing some fractures also develop at the same time.
I thought your book was really interesting. I've got it here. So you explain how right-wing Christian women powered Trump to victory in 2024. You pick out these 6 archetypes of those Christian women that, you know, were important in that campaign. What role do you see those archetypes playing in the midterms?
Well, you know, it's interesting because some of the powerhouses, that's one of the groups I profile in the book, have started to turn their back on Trump. So Megyn Kelly's a great example of this. You know, she's been very pro-Trump for years, despite their previous squabbles, and she's speaking out against him now because of the war in Iran and the siding with Israel. Tulsi Gabbard has left her position. Other women in his cabinet, who I profile in the book, are turning their back on him. It's not clear if that's going to trickle down to everyday women, some of the other ones I profile in the book, but we're certainly seeing that group of women starting to distance themselves from Trump.
And how much is religion important still in the Republican coalition? How much is it actually about populism?
Yeah. You know, I think both are happening at the same time. So religion's a huge element, especially when it comes to some of the racial and ethnic minority groups that are part of the MAGA coalition. So they are identifying with the religious sentiments and a lot of the sort of political sentiments of Christian nationalism, which allow them to be part of this coalition, even when they're excluded in other areas. And I'm thinking here of Black Americans and Latino Americans that are now part of the MAGA coalition and really see their faith as a binding element.
So what does the coalition look like beyond Trump?
After Trump? You know, I also think that...
Dare I ask?
Yeah, I do think that MAGA will outlive Trump. I've been saying this for a long time. I think even when he is no longer in power, the movement that he has helped build will outlive him. And we're seeing now that even when disapproval of Trump is happening, MAGA itself is continuing. Yes, it's a fragile coalition. There are a lot of elements in there that could fracture, but I do think it will carry on beyond his tenure.
And what about the Democratic Party? Are they struggling to build that same grassroots identity that you found in the Republican Party?
Definitely. And what they're struggling with is building the wider coalition that MAGA was really good at in 2024. They're not pulling in the disparate groups together under a shared tent the way that MAGA has. The California governor race is a great example of that. It is a race that is flooded with Democratic candidates. There's no clear vision in that race, and that is emblematic of the Democratic Party that we've seen for the last 5 or so years.
Okay, Katie, a pleasure to have you with me this morning. Katie Gaddini, who is Associate Professor at University College London. Thank you. Well, coming up, we'll be speaking to the CEO of EY as the company hosts its World Entrepreneur of the Year event in Monaco. That's next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Key investment
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Welcome back to The Pulse. Now, business leaders from around the globe are in Monaco this week as EY stages its World Entrepreneur of the Year event. Perhaps unsurprisingly, a third of the finalists this year are from AI-focused firms. And joining us now, the CEO of EY, Janet Truncale. Really good to have you with us, Janet. I'm so jealous that you're in Monaco. It looks much nicer where you are than where I am. So my first question to you is, how do I get there? What makes a successful entrepreneur in 2026?
First of all, we'd love to have you. And yes, we're coming from beautiful Monaco. The weather's great, the setting's great, but the company is even better. We have 58 finalists from 46 countries here with us, and we will announce our winner for the 26th year for World Entrepreneur this evening. And we have entrepreneurs from all of our sectors, all of our industries, and they're just really fascinating people to meet, and they are plowing through in times of uncertainty, and they're just great to be part of. More importantly, they represent $30 billion in revenues, and we don't talk enough about the jobs, but they've created over 157,000 jobs, and so that's really why I'm so excited to be here. And then, you know, Lizzie, we are always measuring CEO sentiment. And coming into this week, we actually did a special cut of our CEO survey, really to see if there's any divergence between long-standing CEOs and more mature businesses and entrepreneurs, and where there may be some divergence. And we saw some interesting things that we're really testing out here on the ground with our finalists. And some of the things, they might not be surprising to you, but where there is convergence is clearly all of our leaders are focused on geopolitical risks, operational risks. Clearly, they're all focusing on AI transformation in many different ways. But there are still areas of divergence, and I was listening to your show earlier. For entrepreneurs, capital raising continues to be front and center for them, and it has become more challenging over the last 12 months. And clearly, if you're outside of the AI investment pool, it's becoming even harder. But you did mention about a third of our entrepreneurs are AI-driven companies. That's very similar to what it was last year when we were here at this time. But clearly, all of the companies here are talking about AI in many ways in terms of transformation of the workforce, upskilling. But again, about a third are truly AI-focused companies.
Well, yeah, what does that actually mean in practice? Nearly all business leaders say that AI will reshape the workforce. What does that look like, Janet?
So a couple of things I'll mention. You know, if we think about the last 2 years, there's definitely been more of a move to use cases and piloting of AI to getting it more embedded in the work that they're doing. So that's been the journey in the last couple of years. We're still seeing significant investment made by companies. In our survey, 80% of businesses were going to increase their AI spending in the next 2 years. And almost all, 97% of the leaders we surveyed, and this is similar between entrepreneurs and our broader population, are expecting to see impact in their business in the next 2 years. But what we're really focused on now is how do we get AI embedded in the transformation in the business at scale. And it's really not a tech challenge. It is a human challenge that we're talking about here on the ground. And what do I mean by that? I mean workforce adaptation, I mean workforce readiness, and then trust is also foundational. And so the challenges here on adoption on broader scale are really human in nature. And what do we need to do about that? I mean, I do think as business leaders, we have a responsibility to make sure that we are upskilling our workforce. There is not enough expertise to really solve for this problem in all of our businesses, big or small. So we have to upskill the workforce that we have. And in our last survey, we're seeing, again, hiring is not, decreasing significantly. We're seeing the vast majority of our respondents are holding the workforce steady or increasing hiring, but they're really focused on upskilling. But in our survey, I'm still disappointed. We're only seeing broadly that organizations are saying that only 20% of the workforce are receiving the skills and the training that they need. And I think that there is a responsibility of leaders to make sure that this is a primary focus. At EY, we're really proud that over 90% of our 400,000 people have received the right type of introductory AI training. And then I always ask, are we doing enough? About 60% of our workforce are getting advanced training. And that's what we really need to be focusing on, bringing our people along. This technology can be frightening to the workforce, but we have a responsibility to bring them along, show them how they can use it in their everyday work, how it helps our people work at the top end of their license, and how we look at the technology and humans really at the center to drive change going forward.
Janet, you talked about some of the issues in the fundraising environment right now, and the split between raising money if you're an AI company and raising capital if you're anybody else. How do we close that gap?
We've talked a lot about that here, and I think the real conversation that we need to have is not to go it alone. We talk a lot about entrepreneurs get to where they want to be because they have resilience, decisive action, they're very agile, and again, they get there with their families and their friends, but they are, the mindset that an entrepreneur has is really to kind of forge forward and drive, expansion and growth and the like. And what we saw in our survey, that less than a third of our entrepreneurs had really accessed a greater ecosystem of partners, whether that's tech partners, alliance partners, or partners like EY to help them on their journey. And so I think in a time where there is limited capital because of what's happening with AI, that they have to look at different ways to bring in and accelerate transformation at scale, bring in the expertise that they need. And I do think that this confident collaboration is something that our more experienced CEOs have dealt with, and we need to kind of get that mindset embedded in the entrepreneurial cohort as well. Again, only a third, and that's what we've been talking about here. And we have lots of our folks here. We've got some of our alliance partners here on the ground in Monaco. And I think opening up the eyes to the art of what's possible for our entrepreneurs, when they can collaborate with others to get to that end game faster. And by the way, speed is the most important thing today in creating that kind of value that our entrepreneurs are seeking.
Janet, great to have you on the programme. I hope you enjoy Monaco for us all. That's EY CEO Janet Truncali. Thank you very much. Well, let's look ahead to what else we're watching throughout the day. At 10 a.m. London time, the IEA releases its World Energy Investment Report for 2026. Of course, oil very much in focus, given the Middle East situation. Then at 1:30 p.m. London time, the main focus for investors, US PCE inflation data for April, the Fed's preferred inflation gauge, of course. 4:30 p.m, we'll hear from the ECB's Isabel Schnabel speaking in Cologne. We've also got the Reykjavik Economic Conference getting underway. The Fed's John Williams and Alberto Masalem's due to speak there, and we'll get more earnings from Dell, Costco, Best Buy and Dollar Tree stateside. So it's a lot on the docket for you, but don't miss our exclusive interview with the St. Louis Fed President Alberto Masalem. That coming up at 6 p.m. UK time, 1 p.m. Eastern time. And up next, we'll be handing over to New York. The Bloomberg Brief is coming up next as we look at the futures picture. Pretty dour this morning. S&P E-minis and NASDAQ futures both pointing to the downside after the losses we have already seen here in Europe and in Asia. Have a great day. Stay cool. This is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said,
Succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Fresh attacks in the Middle East. The U.S. strikes Iranian military targets for the second time this week. Stocks slip on doubts over an imminent end to the war. A mixed bag for tech. Salesforce gives a tepid outlook while Snowflake reports blowout numbers and an Amazon deal. And traders brace for the latest read on U.S. inflation, PCE numbers on deck, personal income and spending as well. Let's get a check on markets around the world now. We'll start with Winnie Su for the latest from Asia. Winnie.
Good morning, Bonnie. We're seeing Asian stocks taking a bit of breather today, especially with these mixed signals from the U.S.-Iran conflict driving oil prices higher. Now you see the MSCI Asia here down nearly 1%, actually coming after 5 straight days of gains. And in fact, leading the declines today, we see shares in Hong Kong also dragged down by these e-commerce giants that are struggling with intensifying competition among themselves. Now, flip the board and take a look at the South Korean market, because here we have the Kospi here off that record high, with the Korean won also coming under pressure with this stronger U.S. dollar weighing on the currency as well. Now, we had the Bank of Korea keeping rates steady today, but the tone was slightly hawkish, especially as we have 2 out of 7 members voting for a rate hike, with the central bank also raising its forecast for both growth and inflation. Hence, we're seeing bond yields here tracking further higher.
All right, Winnie, thank you so much. That is a Bloomberg Asia Equities reporter, Winnie Su. Have to give Paul Donovan credit this morning for the best no title. He says, firing, not ceasing. And that's exactly what is being reflected in these markets. Not a ton of stress. At the same time, there is this idea that the ceasefire, which the U.S. says is still in effect, might be a little more fragile than we thought. So we have Brent crude higher now once again today, up by about $2. That said, if you look at the December contract, we're not seeing much stress. It's still trading below $80 a barrel. Stocks Europe 600 down about 2/3%, reflecting marginally lower across Europe for the major indices. And we are seeing yields higher in Germany, so a little bit of selling in German bonds. We'll see the same thing in the United States when we look. Crude, again, same picture. We're back above $90 a barrel, but this is not the war on trade, right? This is just kind of a liminal phase between war off and war on. S&P futures pointing to a small decline, but remember, we hit another record yesterday, eking out that record on the S&P. NASDAQ 100 futures pointed lower. And if we look at bonds, once again, we are seeing just a little bit of air coming out of of treasuries with that 10-year yield about a basis point and a half higher. Gold down 1.5%. We're well below $4,400 now. And the VIX just ever so slightly elevated. We're still trading with a 16 handle. All right, for some stocks to watch, let's get to Chloe Melly in London. Chloe.
Good morning, Vonnie. The software company Snowflake is soaring in pre-market trading this morning, up more than 35%. It announced results that beat expectations, it raised its guidance, and it also announced an expanded collaboration with Amazon Web Services. So this points to very resilient results and very resilient AI offerings as well, which is very reassuring for investors given those competitive threats from AI on that software sector. So we're up very, very strongly there. We're also seeing the drone company Unusual Machines rally this morning very strongly after a report from the Wall Street Journal that the Trump administration is looking to fund some of these U.S. drone companies. And of course, that could be a huge boost for the likes of Unusual Machines. And we're seeing that reflected in that share price this morning, up about 34%. And finally, let's end with another positive mover. We've got Dell winning a $9.7 billion contract to help the U.S. military streamline and consolidate all of its Microsoft software. And so it'd be a bunch of competitors to get this really big contract, this big deal, and we are seeing the market reward that, and we're up about 5% for Dell Technologies this morning.
And we're also waiting on Dell earnings. Big day for Dell. Chloe, thank you so much. Chloe Melly there. Coming up this hour, Michael Sneed of BNP Paribas talking to us about this market. But let's kick it off with the latest out of the Middle East. The U.S. saying it struck Iranian military targets for the second time this week as negotiations for a peace deal remain fragile. President Trump commented on the main sticking point, control over the Strait of Hormuz, during a cabinet meeting yesterday.
The Strait's going to be open to everybody.
And who would control it?
It's international waters. Nobody's going to control it. We're going to watch over it. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. They would like to control it. Nobody's going to control it. It's international waters, and Oman will behave just like everybody else, so we'll have to blow them up. They understand that. They'll be fine.
Jumana Bersecci, author and anchor of Bloomberg Horizon's Middle East and Africa, joins us now. Jumana, the U.S. insists that the ceasefire is holding in spite of these strikes. Iran insists there have been multiple violations. Where do we stand on any kind of continuation of the ceasefire?
Well, certainly the ceasefire is being tested for the second time this week. This is the second day or second time this week that we get an incident on the Strait. A U.S. Central Command saying that they shot down 4 unarmed drones that were being directed towards a U.S. commercial vessel. They shot them down. They also went on to target a drone launching site around the port of Bandar Abbas, which is very close to the Strait of Hormuz. But the U.S. also saying that they had acted in a defensive capacity, that this does not constitute a full violation of the ceasefire. The ceasefire is still in place. Now, Iran, for their part, also retaliating. IRGC is saying that they would have to respond to these types of aggressions. And around the same time, in the middle of the night, we also heard of air defense systems in Kuwait being triggered too. IRGC saying that they had fired back at a military base. So there hasn't been any confirmation that the response had been directed towards Kuwait, but perhaps you can infer in light of the events overnight. So the bottom line is we did get another incident around the Strait, but where we are this morning, neither side is showing an inclination once again of taking this one step further. And I think President Trump had ample opportunity over the course of the last weeks or so, last few weeks, to go down the path of resuming military operations. He has not done that. And the takeaway from all of this is, in the background, while we are seeing these skirmishes on the Strait, negotiations are still ongoing. And you're seeing a big push, this time out of Qatar, who are emerging as a more forceful mediator in that respect, to get the breakthrough that the market has been looking for. And specifically, this one-page memorandum of understanding that would allow for the unconditional reopening of the Strait, and then later on, at some point, discussions around the nuclear file. Now, whether this entails a 30-day, 60-day ceasefire, we don't have full details, but President Trump once again maintaining that the U.S. are not going to offer extensive economic relief in exchange for the reopening of the Strait. So the sticking points are still the same as they were, Vonnie.
We're not seeing a huge amount of stress in the oil market. Definitely movement over the last couple of days, but we're not even close to the $100 a barrel mark. Jumana, does this suggest that there is, in fact, oil getting through and the market knows this, or are we still pretty closed?
Well, this is something that I think many analysts and industry experts have been discussing, but bottom line is this is also a market that is trading on hopes of a breakthrough. There has not been an actual breakthrough, and you don't have to go that far. It's still very headline driven. At one point yesterday afternoon, Iranian state TV published what they said was a framework for an agreement between the U.S. and Iran, saying that they would, within 1 month, fully open up the straits, that Iran and Oman would have joint monitoring of what goes on around the straits. In exchange for that, the U.S. would withdraw fully from the region. You saw oil retreats on that. Of course, it was denied by the White House later. President Trump once again saying that these are international waters and they will continue to make sure that the U.S. will watch over it and that Iran and Oman will not establish this new protocol. But ultimately, I think the oil market is pricing in for that normalization. And if you look at later dated Brent futures, like towards the end of this year, we're trading closer to $80, which is, you know, the market's expectation that things at some point will resume and that the free flowing of vessels through the straits will be returning in the next couple of months. But again, that's a big assumption.
Yeah, exactly. Jumana, thank you so much. Jumana Bersachi there, anchor of Bloomberg Horizons, Middle East and Africa. Turning to earnings, as Chloe mentioned, Snowflake posting stronger than expected outlook for revenue, and Salesforce forecast, well, it was tepid. Matt Bloxham of Bloomberg Intelligence joins us for more on those results. Talk to us a little bit about Salesforce. Scalers, AI models, that they're just not enough, that Salesforce can do better for business.
Yeah, I think the kind of answer question with Salesforce continues to be how they're pivoting their legacy software into the AI era. And yeah, they've got this product Agentforce, which is their solution, and it's gaining traction, but it's still kind of relatively modest. They're talking about an annualized revenue run rate of about $1.2 billion. Now, in the context of a kind of $46 billion business, that's not much. And I think analysts are still looking for momentum to pick up more significantly. Now they're talking about that in the second half of this year, but I think it's still a bit of a wait and see, and I think there's still a lot of question marks there about whether they can successfully manage this transition into an AI-led world. And obviously, there's a lot of new competition out there with some companies looking to shift their CRM platforms to kind of new AI-based partners.
Yeah, CRM down 33% year to date, Matt, a real whack for that stock. Let's talk about Snowflake for a second. So it could lift sentiment across software, but there is this deal with Amazon. Is that what's causing investors to be so enthusiastic about Snowflake?
Yeah, I think so. I mean, obviously, they kind of gave a slightly more encouraging outlook for kind of full year sales, and I think particularly also on the kind of profit guide too. But I think that the kind of real sentiment boost here is the $6 billion 5-year agreement they've announced with Amazon Web Services. I think that that essentially is confidence from the management team that they see a very robust forward pipeline, and they're willing to commit that level of investment to kind of grow the business going forward. So I think the near-term numbers, they're a little bit better than the market was looking, but not much. But it's that kind of mid-term confidence they give with that new contract.
Yeah, but it's essentially that CapEx optimism again, isn't it? Just in a different sphere. I want to ask you about HP and whether it's a red flag, because it did give a profit forecast for the current quarter that signals they're contending with a huge increase in memory chip prices, as you might expect. Is this the beginning of the end, though? Is memory prices going to bring this trade to an end?
Well, it still seems that the memory price is going to continue to rise through the rest of this year. So I think this is a cost pressure that many businesses are going to be facing for some time. It seems that HP are doing a fairly good job of passing those costs through to their customers and diversifying their supplier base. There is perhaps a little bit of a squeeze on margin, but not much. I think also here with HP, there was a sense that perhaps some of their customers had brought forward demand, so kind of building their inventories in anticipation of price increases later in the year. So that may well mean that there's a little bit more softness in the second half of the year than people were expecting. So things may be just kind of balancing out a little bit differently through the year than people thought.
All right, Matt, another round of earnings, and we're almost there, Dell, later on as well. Matt Bloxham of Bloomberg Intelligence, thank you. Now to other top stories trending on the terminal this morning. Perella Weinberg is cutting almost 10% of its workforce, including a dozen partners. Bloomberg sources say the dismissals will be concentrated in industry subsectors that have lagged the broader market. The move is part of Perella's attempt to channel resources into higher performing areas of its business. Wall Street banks are signaling another blockbuster quarter for trading. Bank of America predicts second quarter sales and trading revenue could climb 15% from a year ago. JP Morgan CEO Jamie Dimon says markets revenue at the bank could rise 11%, which would make it the second best quarter ever for that business. Some U.S. liquefied petroleum gas buyers are cancelling cargoes to Asia after the conflict in the Middle East sparked a surge in freight rates. At least 2 July shipments from the Gulf Coast were scrapped, with more cancellations possible. The U.S. to Asia freight shipping cost is at its highest in 6 years. Coming up, we're going to be hearing from Mistral AI CEO Arthur Mensch on the company's expansion into physical AI. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Startup Mistral AI is expanding into advanced manufacturing and striking new deals. Bloomberg Tech Europe anchors Tom McKenzie spoke to the company's CEO Arthur Mensch in Paris.
For us, it's a massive market. We see, in particular, Europe is our anchor market, but one of the European the strength of Europe is in its high-end manufacturing. So it's the manufacturing world is the 30 trillion market. If you think of the uplift that AI can bring to it, if you only look at 10% of that, you're looking at the 3 trillion market, and that's happening in the next 5 years. But you also need to have models that deeply understand the physics of the world, that deeply understand how real objects are functioning, and that deeply understands how to control those objects. So you have a design problem where you want to understand the fluid dynamics when you're doing plane design, for instance, but you also have an operational problem when you're trying to optimize your process for your factories. So the total addressable market of that is in the trillions, and you need a unique combination of skills. So coming from artificial intelligence, but also coming from the domain itself. And those are the skills that we are gathering together today and that we are going to continue to invest in.
And this is also Mistral going full stack. So you're going to have data centers, you're going to have the models, you're going to have the applications,
You've got the forward deployed engineers. What is the strategy behind going full stack?
In order to provide business continuity to our customers, we need somehow to host the systems in a way where we can guarantee that whatever happens, we are going to keep the switch buttons is under our control and is a button that we can put under the control of our customers. So that has naturally brought us to expand toward infrastructure. In that our business is to transform intelligence into tokens. Really, we take electrons and we transform them into intelligence. And in order to do that, we need the models, which is the thing we started with. We need the forward deployment engineering because you need to understand the problems you want to solve. But at the end of the day, you need to host the model in a place that you can control, in a place that we can put the control under our customers. And so that brought us to create capacity. We're announcing today a new site in Les Ulis in France, and that is part of our roadmap to build 200 megawatt by the end of 2027 and a gigawatt by the end of 2029.
Arthur, I think of data centers, I think of infrastructure, and I think of CapEx. How much is this going to be costing you, and does it push out further into the future your targets around profitability?
This is effectively CapEx. So we're talking about billions in CapEx. Basically, 100 megawatt costs you around 5 billion in CapEx plus OpEx over 5 years. So that's the kind of scale that we are dealing with all the way to 2027. So that's around 10 billion. Is it pushing profitability? No, I would say our business is we're continuing to invest, and so we're of course fronting some CapEx investments, some people investment as well. But what we see is that the value creation that we're bringing to customers is really worth the investments.
Is Mistral still on track for what is it? We're looking at $1 billion of annual recurring revenue this year. Is that target still achievable?
We're still on track, absolutely. We intend to beat it.
You intend to beat it by a significant amount?
Well, I would say $1 billion. We're still announcing $1 billion by the end of this year, and so that's driven by all of the growth that we see on the software and on the solution side, going for the mission critical workloads of our customers, and also driven by the infrastructure deployment that we're doing.
And should we assume that with those acquisitions, with that cloud build out, the data center build out, that you will be fundraising again this year?
We do not need to, but we're starting to see a lot of demand, so that's definitely a possibility.
So it sounds like fundraising this year is likely, additional fundraising this year.
I would say it's as likely as it is not, yes.
That was Mistral CEO Arthur Mensch speaking to Bloomberg Tech Eurobanker Tom McKenzie. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Featuring a new book just hitting the shelves now. During the chaos of Cambodia's civil war in the late 20th century, priceless treasures of the ancient Khmer Empire were stolen and sold to elite collectors. Bloomberg's senior reporter Matthew Campbell's book, The Man Who Stole the Gods, unravels how investigators tracked down a former child soldier whose theft of these treasures drove a global art conspiracy. Matthew joins us now. I'm pleased to say, Matthew, it's your latest book. It's another phenomenal read. It spans everything from history to crime to investigations. It essentially revolves around two men, one in the SDNY and a lawyer in Cambodia, and then a third protagonist. Tell us more.
So the book tells the story of this remarkable U.S.-led investigation into this enormous stolen art ring, basically, and it was co-led by federal prosecutors in New York City and an American lawyer who has been living in Cambodia for a long time, and they eventually tracked down a former Khmer Rouge child soldier turned master art thief living in retirement, essentially, and convinced him to share his story and reveal what he had done.
And this man who had been a child soldier, Tok Tik, he had not necessarily gotten rich from this, but somebody else had, and he had done a lot more than just getting rich. He basically ran a conspiracy.
There had indeed been someone who got quite wealthy from all this, a British art dealer named Douglas Latchford, who lived in Bangkok for most of his adult life. He ended up as the leading dealer of these amazing artworks, particularly into the U.S. market and particularly into very wealthy collectors here in New York City and museums like the Met.
And the story doesn't end with this child soldier, which, by the way, was amazing to find. It's amazing these people are still alive and can tell the tale and have such clear memories, but also so many works of art were recovered. How many works of art were stolen from Cambodia?
We don't actually know. The best guess in the course of the Cambodian Civil War, which went for 30 years, from the late 1960s as an offshoot to the Vietnam War, all the way to 1998, is that we're talking probably about thousands, if not tens of thousands of artworks that were looted, in many cases by the Khmer Rouge, and a huge proportion of them ended up in the United States.
Well, it is a phenomenal read, and it will keep you busy for hours. I would suggest everybody buys The Man Who Stole the Gods on your shelves now. That's Matthew Campbell, Bloomberg senior reporter.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy. in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US, or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Fresh attacks in the Middle East. The U.S. strikes Iranian military targets for the second time this week. Stocks slip on doubts over an imminent end to the war. Mixed bag for tech. Salesforce gives a tepid outlook while Snowflake reports blowout numbers and an Amazon deal. And traders brace for the latest read on U.S. inflation. April PCE on deck. Let's take a look at these markets. Then S&P futures and Nasdaq 100 futures pointed to small declines. It's across the board, but we did eke out yet another record on the S&P yesterday, so that's where we're starting from. We have oil rising. WTI is above $90 a barrel, but it's not so high. It's just the market reacting in a fairly muted way to these continued strikes. The U.S. insisting that the ceasefire is holding, and as Paul Donovan of UBS says, firing not ceasing. We'll see if that continues. We're seeing the December contract on Brent and on WTI trade below $80 a barrel, so not too much stress in the oil market, too much extra stress, let's say. And then in terms of bonds, we are seeing yields come up just slightly, 449.26. We're off our highs of the day, though, across the board. We did start the session with maybe a little bit more trepidation than we are continuing through the session. Gold below $4,400 an ounce, and the VIX, well, it's ever so little higher, but really, still below 17, signaling pretty much all is calm out there right now. Let's get to some individual movers. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. The software company Snowflake is rallying this morning after providing a stronger than expected forecast and also announcing a $6 billion deal with Amazon. And so this is, of course, very reassuring for investors, given that we're still dealing with some of those worries about AI displacement in that software sector. But it seems that Snowflake's AI offerings, and in particular the launch of its own coding agent, are working very well, are being very positive developments for the company. And we are seeing that reflected in that huge rally this morning for that company. Moving on to another big mover, and that is Unusual Machines, the drone manufacturer, which is up after the Wall Street Journal reported that the Trump administration was looking to fund some of those U.S. drone companies. And so we're up almost 35% on the back of that, because of course that will provide a huge boost for that firm. And finally, we have also got Dell Technologies, which is also in the green this morning. It signed a $9.7 billion contract with the U.S. military to help it streamline and consolidate all of its Microsoft software. And so it'd be a bunch of different competitors to get this big contract. And we're seeing that really boost the shares, drive the shares this morning. And we're up about 4% for that stock in pre-market trading.
And up 142% year to date already, Chloe. And we have earnings later on as well. That's Chloe Melly there, and we thank her. We get the Fed's preferred inflation gauge in a few hours. April's PCE data out at 8:30 a.m. Personal income and spending as well. Traders bracing for a hot print on PCE. Joining us now is Bloomberg's Balazs Pence. Balazs, what will we learn today about the pass-through effects of this oil price spike that we saw at the beginning of the war?
Well, as you said, the PCE is often called the Fed's favorite inflation measure, or its most closely watched measure, and that's because it measures consumer spending, not just price levels. And of course, we are heading into the first rate decision with Kevin Warsh as Fed chair, and a lot of people, the president included, have thought that that would usher in a more dovish period of Fed policy, but it doesn't look like the PCE will allow that or will be a dovish signal. The consensus estimate now says that it will be a 3.8% rate, which would be the highest in 3 years. Now, that is, of course, partly the effect of the energy price shock in the aftermath of the war in Iran. But more worryingly, the core PCE rate is also tipped to tick up a little bit to 3.3%, which suggests a pretty sticky inflation, a pretty sticky demand, which will make it very difficult for the Fed to lower rates, even as we look forward to the rest of the year.
Yeah, I mean, it seems quite elevated, Balazs. I mean, at what point is there a level at which Fed policymakers will get worried about inflation expectations getting unanchored?
That's right. These numbers and all the previous numbers that we have had suggest that consumer demand in the U.S. remains robust, that prices remain elevated. They're actually going up right now. So now a lot of people are questioning whether there will be actually room to lower interest rates this year. We have even heard a few voices suggesting that if this trend continues, they might have to consider raising interest rates, which is, of course, the opposite of what Kevin Warsh has talked about when he was discussing the job, when he was coming into it, when he told us about his preferences. So it's very interesting to see what this number is going to look like and how the Fed is going to react to that.
Yes, and of course we get payroll data on Friday as well, which will be another part of the puzzle. Balazs, thank you so much. Bloomberg's Balazs Pence there. Joining us now is Michael Sneed, Head of Cross-Asset and Macro Quantitative Strategy at BNP Paribas Markets 360. Michael, thank you so much for joining. Is the macro outlook binary in the sense that, if war subsides, the Strait of Hormuz reopens, oil goes down, U.S. growth is protected, and yes, maybe there's a tail end of some inflation or inflationary forces, but generally all is good, or the opposite? Or is it a little bit more nuanced than that?
So we think it's more nuanced. Good day to you, Bonnie. So we think it's more nuanced. In particular, you're seeing kind of underlying trends in economic activity, particularly in the tech sectors, kind of causing some kind of differentiation from what's happening with the Strait of Hormuz and energy. I think also what's very key is the market has continued to anchor onto optimism that there will be a reopening of the Strait before we have a substantial drawdown of inventories, which could start to cause some supply issues. So we think the situation, is reasonably nuanced, and against that backdrop, we're actually still remain quite positive on risk and positive on equities.
Yeah, I mean, we were just talking about the PCE deflator that's going to come out later, personal income and spending, and Kevin Warsh and his dilemma, potentially. Not sure if he sees it as a dilemma, but what are you guys thinking that he will do? Is he going to reduce the balance sheet and have that take care of inflation, as he says will happen? Or might he actually consider hiking?
So we think that a few things on this. So one is we think the balance sheet will be gradually reduced, but that's probably not going to be enough to kind of necessarily tighten financial conditions if there was deemed to be inflation concerns in the market. We think in terms of Kevin Warsh himself, when he leads the committee, we have to keep in mind that it's a committee of decision makers. And those decision makers have a variety of views looking at different aspects of the US economy. So we don't expect him to be the kind of key decision maker. And then maybe perhaps linking the pricing that we're seeing in the markets, and the market starting to put greater weight on perhaps the next move from the Fed being a hike. If we think about that from a kind of a market regime perspective, the market pricing is really a reflection of the strong US economic data. And this we define as being an expansion regime. And in that type of regime, you can have yields heading higher whilst risk assets continue to perform well.
So you sound broadly positive. You say your outlook is broadly positive, but what to do about something like this? So Ed Yardeni pointing out today that Micron earnings per share revisions alone account for 51% of the S&P 500 earnings revisions since February 27th. Is concentration risk not something that we should be well aware of and protecting ourselves against, Michael?
So I think as a portfolio manager, there is a need to be very much aware of that concentration risk. A strategy that's been very popular is to be long the kind of momentum factor, or just long the S&P being market cap weighted, puts you in more kind of tech exposure. But I think it's also important to think about some of the economic justifications of some of these moves that we've seen in the tech sector. And we think when we look at the impact of AI on the real economy, that actually some of these valuations, some of the rise of the earnings expectations, it can be justified. I mean, to give you an example, we think that the impact of AI on productivity on the US economy alone could add up to 10% of GDP over the next 8 years. That's our top line estimate. But once you start to think about it from the kind of bottom-up economic impact, actually some of these earnings expectations, some of these valuations do not necessarily look quite so lofty.
So the fact that downside protection is being priced so cheaply, you say that's also warranted then?
So we think that investors do need to focus on having protection in their portfolio. I think in particular, at the moment, we think that bonds are not going to be a source of safety within a portfolio. If anything, they could be a source of uncertainty because there is still likely to be lingering inflation concerns, lingering fiscal concerns. So what that means is that when investors are thinking about risks, which we think they still need to very much consider, they need to think about protection, and they probably need to pay a bit for that protection. So paying, for example, a bit of premium in order to buy out-of-the-money put options on S&P.
You also think other jurisdictions look a little attractive. So, for example, Europe at the moment. But I'm not sure I follow, because if the US is growing and you're very positive about US and AI and so on, I mean, Europe is not growing at the clip of the United States. So why would you be so positive on Europe then?
So a key part of the European story at the moment is really about sentiment and positioning. The market is quite bullish and is owning US stocks. When we compare that to our indicators for Europe, we see that actually European stocks are still very lightly owned. So this gives a chance for a kind of a catch-up effect of European stocks. We also note as well that earnings expectations in Europe have been heading higher, not to the same degree in the US, where we think that rise of earning expectations combined with the very light positioning does give scope for European stocks to recover over the coming months, particularly if we have a peace deal in the Middle East.
All right, Michael, thank you so much. Michael Sneed of BNP Paribas. Appreciate it. Now to other top stories trending on the terminal this morning. A Google software engineer was charged with insider trading after he allegedly made more than $1 million on Polymarket by betting on one of last year's most popular internet searches. The engineer had access to company data that tracked user searches when the bet that Google's most popular search of 2025 would be the singer David. President Trump filed a new version of his $10 billion libel lawsuit against the Wall Street Journal and its parent company, News Corp. The suit was filed over a July 2025 story that said Trump sent Jeffrey Epstein a bawdy birthday note in 2003. The original complaint was dismissed for lacking sufficient claims that the story was filed with, quote, actual malice. Fed Vice Chair Philip Jefferson says he expects inflation to ease later this year as the effects of tariffs and higher energy costs fade. But he warned inflation risks still lean to the upside. Speaking in Tokyo, Jefferson also said that the Fed's current policy stance is well positioned ahead of next month's meeting, the first under new chair Kevin Warsh. Coming up, oil spikes after U.S. forces shoot down Iranian drones and target military sites. This is Bloomberg.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah, probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Is the U.S. considering easing sanctions on Iran to allow Iran to sell its crude to market?
No, we're not talking about any easing of sanctions or giving money. No sanctions, no money, no nothing. We have control of money that they claim is theirs. We'll keep control of that money. When they behave properly and when they do what's right, we'll let them have their money. But right now, we're not doing that, and it's not. One thing is not contingent on the other.
President Trump answering a question there from Bloomberg's Tyler Kendall after Iran suggested lifting sanctions is part of negotiations. Overnight, the U.S. struck Iranian military targets as peace talks remain fragile. Bloomberg government senior White House reporter Mika Sollner joins us from Washington. Mika, bring us the latest. It's very difficult to know what's going on behind the scenes versus what we're hearing publicly.
Yeah, absolutely. I mean, the ceasefire right now that the Trump administration is aggressively pushing for is extremely fragile, as we know, with the latest launch of U.S. strikes in Iran. I think that this is causing a lot of confusion among lawmakers and people within the White House in terms of where things stand. The president's also caught between kind of a difficult spot here between these defense hawks and Republicans that really want him to continue on with the operation, and those who say it's time to end this and end this well. I know that the president is really adamant on getting the quote-unquote best deal he can, as he laid out yesterday, but it's really unclear what exactly that looks like. He has said that he does not want Iran to have a nuclear weapon. Iran has clearly denied that that's the case, but you know, we're going to have to see more of a framework here, maybe this week or next.
Meantime, the president obviously very focused on, you know, what's coming up in November. His approvals are really at an all-time low, and congressional Democratic leaders just lost a bid for a court order to block the Trump administration from prohibiting mail-in voting for anyone not on a pre-approved list. So after some of the losses from the primaries, this was at least a little win for the administration. Is that a correct interpretation?
Yeah, the president has had some very strong legal challenges against Democrats lately, the latest being the mail-in ballot voting. Essentially, this gives DHS the authority to allow mail-in voting only for people deemed on a certified list, ideally looking at citizenship records, et cetera. And this is another push by the president to try and curb some of the voting laws and create some more restrictions and emphasize the fact that they want only U.S. citizens to vote in elections. Of course, that's already in law, but this stems back to the 2020 election where President Trump has still has said that there was fraudulent activity in that election.
Mika, he said that, at least in regards to Iran, he doesn't care about the midterms, right, that one isn't impacting the other, but he necessarily must be thinking about the impact of what's going on in Iran and the fact that we still haven't come to any kind of an agreed truce or anything like that, and what that will do in voters' minds.
Yeah, absolutely. I mean, the war remains very unpopular among the public, and it continues to have a huge economic impact, not only in the U.S. but worldwide. But speaking with two Americans' pocketbooks, gas prices have gone down slightly, but there's still a huge issue for a lot of people. It's also costing consumer goods to go up. So the administration really has to get a handle on this, especially ahead of November. I mean, we're only roughly 6 months out from the midterms. I know that the president right now is confident because he's had these winning streaks in these primaries, but the general election is going to be a totally different question.
Yeah, and we're only just back below $4.50 a gallon after a good 3 weeks above that. Bloomberg Government's Mika Sullner, thank you so much for joining. Turning to earnings now, Snowflake shares surging in pre-market trading after posting a stronger than expected outlook. Salesforce is lower though. Tepid forecast, perhaps, there. Matt Bloxham of Bloomberg Intelligence joins us for more on those results. Can we start with Salesforce, Matt, and whether it portends anything for other software companies? Any ray of hope at all?
Maybe a glimmer. I mean, obviously, Salesforce is one of these legacy software companies which people are looking at to see whether they can transition into an AI-led environment. And they're making some progress with their Agentforce AI tool on track to kind of generate annualized revenue of about $1.2 billion. But that's, just a few % of their annual $46 billion revenue. So, there's still a long way to go for them to demonstrate that they really are successfully transitioning into an AI future, and they can kind of protect their very well-established position in the CRM marketplace. Still some work to do, I think, there.
Snowflake, on the other hand, soared. So the results were good and everything, but it was really this Amazon deal that seems to have sparked investor appetite, a $6 billion deal, but it's essentially Snowflake promising to spend. So CapEx once again, no?
Yeah, that's right. I think that the numbers themselves were good, and the guidance was a little bit above expectations and a positive surprise on the margin. But the $6 billion commitment to invest more with Amazon Web Services, I think for the market really giving a strong signal that management is confident in the midterm revenue runway that they have. So as you say, it's incremental investment, but clearly tied very much to clear revenue generation in the future. And so I think that's kind of boosting the market's confidence in the midterm outlook for the company.
A separate issue now, and that is memory costs. How are companies dealing with it? Because we've seen a variety of reporting. Some companies seem to have been able to eat the higher cost of memory, no problem, right? They just disappeared and margins just came out the same and as everyone was expecting. Other companies, not so much. HP is the most recent one, signaling that they're, finding it a little difficult.
Yeah, and I think actually what we heard from HP kind of shows the full range of tools that companies are looking to deploy to kind of combat the memory price increase. So the first is obviously increasing their own prices to end users, which HP is doing to with some success. The second is kind of really shifting to products that don't really use so much memory. And so that's a kind of another way that they're trying to kind of balance this out. So, I think there's a number of techniques companies can do with kind of varying degrees of success. Obviously, some bigger companies which have much bigger buying power in the market have done a good job of building up inventory, so they're actually kind of able to kind of delay and absorb that memory price increase because they're not really yet seeing it in their own input prices. So I think that's going to maybe push out the margin squeeze story into the kind of second half of this year and perhaps into 2027 for some.
Matt, some of these legacy companies like Dell, I'm thinking they can do no wrong these days. It won an almost $10 billion defense deal. We got that word last night. We're waiting on earnings later, and it's already up 140+% year to date. Is there anything Dell could say that would disappoint investors?
I think with a lot of these companies discuss really just that nuance of kind of the kind of momentum in the business and whether they can kind of say enough about the kind of forward outlook that kind of really gives you that incremental expectation of midterm scale. You know, I think a lot of these share prices are already anticipating significant midterm growth, and so you need to kind of keep that story bubbling away. So yeah, it's kind of really about the nuance. And again, it may well be that if they signal additional investments in the business, that would be a strong sign that management sees a really good midterm outlook.
All right, we shall see. Matt, thank you so much. That is Matt Bloxham of Bloomberg Intelligence. Coming up, economic data and the earnings you need to watch as we get you set up for your trading day. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead for today. We got PCE, personal income and spending, out at 8:30 a.m. Eastern for a look at secondary effects of the oil price spike. Earnings from Best Buy, Kohl's, Dollar Tree, they all come before the bell, and then we get Dell, Gap, and Costco after the market close. So still a busy day for earnings. And then we get plenty of Fed speak. We have John Williams on deck. Also, Alberto Musalem joins Bloomberg's Balance of Power at 1 p.m. New York time. You don't want to miss that interview. This is how we're shaping up into your Thursday session, then, with Brent crude trading higher, but not at panicked levels, and December's contract below 80 still, so that'll tell you even after the strikes. The market with a muted reaction. The 10-year yield just actually off its highs now. It was up a couple of basis points earlier, and we're basically just flat now, and S&P futures pointing to small declines. That's it for Bloomberg Brief.
famous dogs. You have they look like balloon kind of figures to some extent. How do you make those?
In the case of the balloon dog, I blew up a balloon dog. So I had this balloon, which is kind of like a latex type of piece, molded it, cast it, and then blew that up in scale and put it into a clay, and eventually had that transformed into stainless steel.
So when you have a balloon dog, let's say, a regular size one or then a big one, did people say, Jeff, you're crazy? Were you shocked that people were willing to pay very high prices for this?
When I was making my first balloon dog, one of the purchasers was Eli Bro. And originally I thought I could make a balloon dog for around $300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, you know, Jeff, I can't do it for $300,000. It's going to be $650,000. But eventually, then they raised the price again, and they finally brought it up to $1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production costs.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This cycle has been very much infrastructure CapEx driven.
I do think you favor tech here.
We're bullish on the S&P, but we're probably even more bullish on this rally broadening out.
The basic thrust of the market is to go higher.
Missing out on the upside is like participating in the downside.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, facing down higher prices, crude bouncing, following another round of strikes on Iran, as Fed officials are bracing for a jump in the latest inflation data. Earnings from Costco to Best Buy offering a read on the U.S. consumer. That consumer is getting squeezed.
And we get those earnings later today. Best Buy before the bell, Costco after the bell. You know, there's been a dissonance because all of the negativity has come with data that has otherwise been really resilient. And the reason why we've seen inflation be sticky is because consumers have been able to absorb this. Are we starting to see fraying around the edges? And that is what I think will be interesting from Best Buy and Costco. Do they show what we're hearing from some other places? Top end of the consumer still spending, lower end of the consumer looking for bargains, pulling back.
Energy prices multi-year highs. Check out mortgage rates 6.5%. PCE expected to spike today, and the Fed stuck between a rock and a hard place.
Rock and a hard place. So is this administration. I was pretty shocked yesterday. The Treasury Secretary sitting down with the president at the cabinet meeting decided to use the T word when it talked about prices. Right now, he says it's transitory and things like gasoline will come down when this war ends. And right now, Jonathan, it looks like actually the ceasefire is barely holding on when it comes to the conflict.
Let's spend some time on that. Let's bring up the crude price. Brent, WTI, check it out. We're up this morning by not even 2%. And what we've seen overnight is the second round of strikes so far this week and zero progress towards making a deal. Yet this is the move on crude this morning. That's nothing. If you just looked at that, waking up today, you wouldn't have a clue what happened overnight.
Yeah, the fact that actually there were active strikes, that Iranian drones were shot down out of the sky. The way you could potentially read this, if you want to be really positive, is the U.S. is essentially escorting ships or trying to keep ships flowing on the margins through the Strait of Hormuz that aren't necessarily Iranian. So at least something is getting through. It is leaky. On the flip side, the fact that there is kinetic warfare, but everyone's saying there's nothing to see here gives you a sense of the cognitive dissonance.
But the red lines are being blurred. And what the United States is doing is they are responding to Iranian attacks. This is not necessarily deterrence. It is defense in that nature. And at some point, you have to basically ask the administration what would constitute, at this point then, an end to the ceasefire, because you're acting like this is pretty defensive in the Strait of Hormuz.
That's the energy story. 2 minutes into the show, let's bring up the tech trade. Salesforce versus a very, very different story coming from Snowflake. And the opening up of a discussion about winners and losers. Snowflake up today. Check it out, not a typo. up by close to 40% in the pre-market. Salesforce down by close to 2%.
Yeah, so this goes to the forward look, right? And the idea that we're looking at Snowflake potentially partnering with Amazon.com for a pretty big deal using some of Intel's chips. This question around exactly how they're going to adjust and adapt to the AI era. Meanwhile, Salesforce actually disappointed, and it was a small disappointment on its earnings, but just a little bit of disappointment gives people a little bit of agita about the road ahead. They have to prove they have a very big moat around them that prevents themselves from getting disrupted out of business from people doing it themselves with all of their little programming bots, because essentially that is the fear.
Dan Ives, 6:30 Eastern Time, joining us on this program to break down the software trade. Coming up this hour, we'll also catch up with Bob Doll of Crossmark as equities pull back from record highs, General Karen Gibson of Academy as new strikes test the US-Iran ceasefire, and Kay Her of JP Morgan Asset Management as the Fed awaits a fresh read on inflation. We begin this hour with the US striking Iranian military targets for the second time in just 3 days. Bloomberg's Tyler Kendall joins us now from Washington for the latest. Good morning, Tyler.
Hey, John, good morning. Well, a U.S. official characterized this latest round of military strikes as being defensive in nature after Iran launched several drones at commercial ships in the Strait of Hormuz. It comes after just yesterday, President Trump maintained that no country will have formal control over the strait in any potential deal, as the waterway remains one of those top points of contention in the ongoing talks. The president also added that the U.S. would, quote, watch over ships that are transiting through, though declined to give specifics on how the U.S. is thinking about ensuring freedom of navigation. At this point, the White House says it's not satisfied yet with the progress in the ongoing dialogue, though has appeared to confirm that the U.S. is pursuing this phased approach where we would see the Strait of Hormuz prioritized to be reopened and only then formal conversations about potential curbs on Iran's nuclear program. But as we try to glean any details on what is in this potential memorandum of understanding, I asked President Trump yesterday during his cabinet meeting about whether or not the U.S. is considering easing sanctions as Iran pushes for financial relief as part of any deal. But he told me that's not happening anytime soon. Is the U.S. considering easing sanctions on Iran to allow Iran to sell its crude to market?
No, we're not talking about any easing of sanctions or giving money. No sanctions, no money, no nothing. We have control of money that they claim is theirs. We'll keep control of that money.
John, I also asked President Trump whether or not he was expecting Congress to pass a federal gas tax holiday as the administration faces pressure when it comes to retail gasoline prices and we get closer to November and the midterm elections. He told me it's something that they might talk about, but ultimately he wants to give negotiations 1 to 2 more weeks, in his words, before he thinks about that.
Tyler Kendall with the latest down in Washington. Tyler, thank you. We'll catch up with you in the next hour. More to discuss down in Washington, D.C. It's a complex, multidimensional negotiation between 2, maybe 3, 4, 5 sides across the Middle East. Let's pick out 2 dimensions of that. Let's start with 1, Iran wants to control the strait and the US wants free passage. 2, Iran wants to keep the uranium and the US wants it either destroyed or sent to the US. And I have seen little progress on either of those 2 major aspects of this very complex negotiation in the last few weeks.
That's the reason why when you hear this administration say it's 95% done, just these 2 major sticking points that were the ostensible reason for the war are still remain to be negotiating. From the market's point of view, though, I wonder whether that actually matters. Is it just the idea that there actually is some movement through the Strait of Hormuz, agnostic to exactly the method or the longevity of that? That's the sort of interesting aspect, maybe, of what we're seeing play into markets.
But that just got a whole lot harder as of last night because OFAC decided to sanction the Persian Gulf Strait Authority, basically the tolling booth the IRGC is using to collect these tolls. So if you're a trader that's been maybe trying to go through whatever bank this is in China or Hong Kong with this Bitcoin to get your vessel through for $2 million, Treasury is basically saying, we will find you, and now we're going to come after you.
Equities this morning not blinking. We're down just 0.15% on the S&P. Here's the view from Wall Street. Bob Doll of Crossmark Global Investments writing, investors are positioned for an imminent reopening of the Strait of Hormuz, which increases the short-term risk for asset markets. Bob joins us now for more. Bob in the studio. Good to see you, sir. Good morning.
Same here.
Is there a credible bear case for this stock market, and what is it?
Good news is good news, bad news is good news, no news is good news. I mean, what more do you need to know? Look, you know the story. It's all about earnings. Earnings expectations for this year are 15% higher than they were at the start of the year. That's not a 15% growth, that's 15 increased growth rate. And the market's only up 10. So PEs are down 5 since the first of the year. Hard to throw mud at that.
Some people throw mud at it by simply saying it can't last, that this is backward-looking, it's not forward-looking, and it hasn't fully adjusted to some of the pressures that we're seeing overseas and the supply constraints. What do you say to that?
I say, back to earnings, if you're telling me earnings estimates are not going up any further, I fully agree with you. But as long as earnings are moving up at this pace, and the Fed is not antagonistic to the stock market, stocks will move higher.
So why is there this incredible earnings boom if you're not seeing it in some of the consumer data? I mean, you're seeing resilience, but you aren't seeing this kind of boom condition, and you get a lot of commentary about people feeling pretty crappy.
Great question. I don't think first quarter earnings have answered that question very well. Top line growth's been just fine, thank you. It's margins that have exploded. And now, is that because companies haven't had a chance to say, my profits are up so much, where am I going to spend money to increase my business, and therefore it's all gone to the bottom line? I think there's some of that, but I'm with you. The consumer seems to be fraying, particularly at the low end.
Does it matter? Does it matter to the index? Certainly matters to a lot of people, but given the composition of the S&P 500, does it matter? And I know that's an uncomfortable question to really answer directly, but do you think it does?
Yeah, it's the right question. It matters less than it used to, can I say it that way, because of the percentage of the market that's related to the stuff outside the U.S. Technology, I mean, who cares what happens in the Strait of Hormuz? To some degree, the technology sector might be saying.
It sounds so complacent, but then you see the capex intentions of these companies, and the numbers are astronomical, and they are driving GDP to a greater extent. We had a conversation just this week about whether the Federal Reserve can really slow this thing down. Apollo's Thorsten Slog saying the Fed is fighting FOMO. It's fighting more than that. It's fighting price-insensitive investment from some of the biggest, richest companies on the planet.
Yeah, essentially, is Amazon or Microsoft going to stop spending because the Fed raises rates by 50 basis points? The answer, resoundingly, is absolutely not. Key question, when does it actually matter to the physical world? Because this is a very physical process to build this stuff out. Suddenly, that does enter into the inflation picture. That's why I said, this idea of, fantastic earnings momentum is maybe a fear of surging prices, because ultimately, we end up in a place where the real pain comes from inflation.
We're raising a lot of money and pushing it through a supply-constrained economy that's gone through several supply shocks across goods, labor, and now energy. Is the end result just higher prices?
I think so, and that we're on to the real problem. It's inflation. I know it's not 6%, but it's not the Fed's 2%. It's 3.8 at the headline level last 12 months, 2.8 ex food and energy, rising. That's just not good news. And the stock market seems to look the other direction for now.
So the Strait of Hormuz does matter, though. It just matters to different people.
I think it does. My view is, and we can talk about everything we're hearing, I think it's going to be a two-part deal. The first will be, let's get the Strait open, and we'll make some concessions to make that happen, is my guess. And then we'll have a multi-month period on the uranium, and that's where I think it falls apart.
The issue is the concession the Iranians would be willing to take from the United States to open up the Strait of Hormuz is the United States red line. It's about enrichment of uranium. So it feels like they're talking past each other because the red lines are not moving.
Agreed, but I think that if they separate the two, there's a chance we get some solution around the Strait, punt on the uranium issue, deal with it later, and then it falls apart.
So what do you do? I mean, given the fact that ultimately you do see the potential for bad news, it has not paid to hedge against that. It has not paid to be skeptical. It has not paid to really know more information, it seems like. This idea of the less you know, the better off you are, which is something that Chris Verone was talking about. Do you go just into big tech and avoid bonds? Because ultimately inflation is the bigger concern.
First of all, context. I believe we're in a high-risk bull market. Bull market means you got to be invested because the path of least resistance is higher. Why? Earnings, earnings, earnings. and a Fed that is not antagonistic, at least yet. The high-risk part says, but if something goes wrong, the decline's not going to be 2.5%. It's going to be a lot worse than that. And that's what I'm watching every day, fully invested. Where are we invested? We're trying to go where, more reactionary than usual. That is to say, in this environment, letting some semiconductor stocks go, not the whole thing, just bits and pieces, and buy stuff that has okay fundamentals that's a whole lot cheaper. That's the trade I'm playing. Maybe 2 weeks from now, semis will have corrected. We'll be buying them back and selling the whatever we bought in the meantime.
Which is why they haven't corrected much, because everyone's just waiting to buy the same thing. Can I just ask you, what is an antagonistic Federal Reserve? A Fed that drops its easing bias? A Fed that talks about hiking 25 basis points? When does it become so-called antagonistic?
The fact that the market hasn't begun to think it's antagonistic blows my mind. It's because of earnings.
Not making it, just written down.
but you're absolutely right. This next meeting, they have to move to neutral, if not to a tightening bias. Maybe it's neutral bias, next meeting tightening bias, and then we'll have to see if they're going to raise rates. Market will not like that at all.
Bob, it's good to see you. It always is.
All the best.
Thanks for being here. Thank you, buddy. Bob Dole of Crossmark Global Investments. Futures this morning doing okay, down a few tenths of 1% on the S&P 500 this morning. With an update on stories worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. For the second time this week, the U.S. carrying out airstrikes on Iranian military sites. Officials saying the attacks were defensive and intended to maintain the existing ceasefire. The attacks coming hours after the U.S. denied an Iranian report of a peace deal. Snowflake shares surging in the pre-market, the software maker giving a stronger than expected annual outlook, also signing a $6 billion multi-year agreement to use Amazon's cloud services and chips. American Airlines CEO Robert Isom says travel demand held up in the first quarter. Speaking with Lisa, Isom saying both business and leisure travel has improved despite global economic uncertainty.
Year-over-year revenue improved 10-11%, and we're forecasting revenue to improve 15%, year over year, in a year where price of fuel has spiked $4 or $5 billion. We're still projecting the same type of profitability that we had last year. That means good things.
Isom also saying American intends to grow its premium seating at twice the rate of its main cabins. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Great exchange yesterday. It's just amazing to see rock bottom, consumer confidence, and then hear the words tremendous demand come out of another airline.
The airline industry is a perfect example of a K-shaped economy because you have a very much tale of two consumers, and you're seeing one do very well, one not so much, and for a lot of the big players, it just doesn't matter.
Said it a few times. It's the Delta Airlines economy. Half the country is struggling, and half the country thinks it's Group 1, and they're lining up for the lounge.
I think everyone thinks that they're Group 1. I think that everyone feels like they deserve it, which I
You
understand.
are Group 1, Bramo. You're Group 1.
Definitely
You're
not.
Group 1.
Usually 4 or 5.
If there's
6.
more than 5 people in the line for something you're lining up for, if there's a line, none of you are Group 1, all right? Up next on the program, diplomatic deadlock.
Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. We will be either that or we'll have to just finish the job. They're negotiating on fumes.
Just for the record, I'm in the line, and I'm not Group 1. All right, just want to clarify that, okay?
Wow,
just want to make sure that's clarified, okay? No.
You're not Group 1.
No. It's been very clear. We sort of lost track on what exclusivity actually is.
You're pre-boarding. Like you understand.
Do you know what I mean?
Yeah, exactly.
For the people going to the airport this morning, if there's a line for the lounge, there's nothing exclusive about it, right?
I won't wait on a line for a lounge. I refuse. I'd rather go get coffee or food somewhere else.
It's a group bonding experience. I love it.
I'm pleased I've cleared that up. Up next, we'll catch up with General Karen Gibson of Academy Securities, live from New York City this morning. Good morning.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm election.
hear it first on Bloomberg.
Tons of earnings today, stacked with retailers. Check it out. Dollar Tree a little bit later this morning, 6:30 Eastern Time. Costco, The Gap after the close. Best Buy in the next hour. Look out for all of that going into PCE data at 8:30 Eastern Time. The scores into it look like this. Equity futures on the S&P 500. Looking to squeeze out a loss of 0.2% on the S&P 500 after just about squeezing out a gain in yesterday's session. On the Nasdaq down by 0.4%. On the Russell, negative 0.2. Check out the bond market yields shaping up as follows going into the 8:30 inflation data. Just a little bit higher at the front end of the curve, up by 4.06%. And a new voice, Jefferson, and another one, Cook, out of the Federal Reserve, voicing their concerns about higher inflation.
Yeah, Lisa Cook actually coming out pretty aggressively and saying if you don't see any disinflation, she'd be inclined to hike rates. My question, listening to all the Fed speak, where exactly are the people who want to maintain an easing bias? Other than...
Who are they?
I mean, who are they? Please stand up. I mean, ultimately, we saw Governor Myron be the one stalwart voice. He's off. He's not at the Fed
gone.
anymore.
It's true.
Who is that person?
I think Chairman Powell should do an interview. Now Governor Powell.
Yeah, I agree.
Who were they?
I mean, who actually...
wanted it then?
And if they didn't want that, why didn't they remove it?
There's a sense that some people believe this anyway. There's a sense that they wanted to maintain the easing bias for the incoming Fed shares, so he had the decision to make, and that it wasn't down to Chairman Powell. Maybe that was the agreement, because to your point, it's very difficult to find a Fed official right now who actually wanted to keep it.
So to me then, how does it serve as forward guidance? If it is ultimately a way of signaling to one another, you know, what about the rest of us who are in Group 7?
I'm with you, or Group 8 or 9. Well, no group at all. You know, that exists too. Everybody else...
Ryanair.
Yeah, been there. No seat assignment.
Yeah, exactly.
Yeah.
The roof.
That was sport.
Yeah.
Brent crude this morning up by 1.7%. WTI up by 1.65. Under surveillance this morning, a diplomatic deadlock.
The strait's going to be open to everybody. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. We will be either that or we'll have to just finish the job. They're negotiating on fumes.
So here's the latest this morning. The US and Iran exchanging fresh strikes, with the White House saying little progress has been made towards a deal. General Karen Gibson of Academy Securities writing, I suspect and hope negotiations may be more advanced than either side is letting on, at least publicly, despite the rhetoric. And in many ways, the action too. General Gibson joins us now for more. General, welcome to the program. Where do you suspect we have made some progress?
Well, I think that if we had a complete lack of progress, we would be seeing more aggressive actions on the part of the United States, whether that was additional significant sanctions or strikes beyond the ones we've been doing. You know, I maintain that the ceasefire, while fragile, is still holding despite the strikes that we've had over the last 3 days. What characterizes these strikes is that they are very narrowly specific to aggressive actions that Iran was alleged to be making in and around the Strait of Hormuz, Bandar Abbas, whether that was vessels laying mines that would potentially constrain navigation and traffic, or one-way drones. And it's important to remember that even under a ceasefire, you do not lose the inherent right of self-defense. So if we were not making progress in negotiations, we might see broader strikes further somewhere else in Iran that more clearly violated the ceasefire. But I think these are very defense-related, self-defense-related, and within the bounds of the ceasefire.
If these are defense-related, then is the United States doing anything in terms of deterrence when it comes to Iran?
Well, I think our presence acts as a deterrent as well. I mean, the fact that if Iran were to, you know, out of the blue strike some kind of Gulf infrastructure or civilian targets or something else that was in the broader Gulf region against one of our partners, I think it would be, certainly I would expect the United States to take some broad action, probably additional punishing airstrikes. And Iran knows that we can do that and that we're prepared to do that, won't hesitate to do that. And that in itself is a form of deterrence.
Given these recent clashes, do you understand where the red lines are in terms of kinetic warfare between Iran and the United States?
Yeah, so again, you never give up the right of self-defense, even under a ceasefire. And so if these were activities that were identified that looked as though they would threaten navigation or directly threaten our naval assets and air assets that are there right off the Strait of Hormuz, that's permitted. I think that's an important distinction. And even Iran's counterstrike, in which they launched assets towards Kuwait, they claim to have shot down one of our predators. I don't believe it. It's always kind of a given that they're going to exaggerate for their own domestic audiences. Those are, I think, probably within the bounds of the ceasefire. I'd make two more points there. One, if we were striking dual-use military civil infrastructure elsewhere in Iran that wasn't directly related to the navigation in the Straits, that's probably not within the bounds of the ceasefire. Again, back to if Iran were to strike, say, Fujairah again in the Emirates, their port outside the Strait of Hormuz, that would probably not be within the bounds of the ceasefire. But the last point I'd make is that a ceasefire is not a real physical thing. It's a construct that's developed between the two negotiating sides by policymakers or leaders. And it's really up to them to decide that a ceasefire is no longer holding, whether it's because of a single shot across the bow or something far more extensive.
General, you said something there that I thought was really important, that Iran obviously exaggerates for its audience. The U.S. also tried to jawbone markets, and this is one reason why markets have tuned out. Who are the respective parties trying to speak to, and how is that muddying the message?
That's a terrific point. I think, both sides, in probably any conflict, I think the leaders are speaking, particularly in Iran, to their own domestic audience. They need to appear strong. They need to make the United States look weak. They want to make it look as though we are the ones that are about to give and concede something. That strategic narrative is actually also an area where we're competing. They are speaking directly to their domestic audience. Our president is speaking to our domestic audience, but there are also broader market audiences that both are speaking to. And I think we have to be really careful about taking literally everything that's said by a spokesperson from either government. There's often truth within it, but then there will be other things that are said that are hyperbolic or, again, intended to calm or influence markets, to shape public opinion, and to influence the other side.
We've been wrestling with that for months. General, appreciate it. General Karen Gibson there of Academy Securities. That was the question. We know what the audiences are. What do you trust? And that's the problem.
Yeah, in this swirl of disinformation, a lot of people have tuned out. And that's the reason why the moves are getting smaller and smaller as people say, earnings, 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 which is what essentially we heard from Bob Dole earlier
Stocks
this
down
morning.
a few tenths of 1% on the S&P 500. Fresh strikes overnight. Check out crude. Brent and WTI were up this morning by close to 2%. Not even a little bit early this morning.
I understand the market's focused on earnings, but when you're trying to understand what the teams are negotiating, it's why I look at what is happening. And we continuously see, I know that no one wants to say it's a break in a ceasefire, we continue to see clashes, and at some point the red lines just evaporate.
Twice in 3 days, we've seen that. Up next on the program, we'll catch up with this guy, Dan Ives of Wedbush, on the winners and losers emerging in the software space.
we are dealing with supply issues, and so therefore fertilizer, the planting season, food security is high up there, but so too is fuel and energy. So yet again, as we had with Ukraine, the energy crisis, the food crisis, the cost of living, and that kind of fiscal space needs to be created for countries that are going to be dealing with the debt crisis. They are still repaying their debts. Inflation will result in interest rates that will put many countries in jeopardy on the debt issue. So we're looking to find solutions here from the IMF, from the World Bank. There have been many offers of the windows and facilities that could be put at the disposal of countries. But I think at this stage we need scale. Many countries are still recovering from the previous shocks, and some of those crises are not over yet.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Coming up a little bit later this morning, check out this interview 60 minutes away, catching up with the BNY CEO, Robin Vince. Looking forward to this. Need to talk about the Trump accounts and the fact the stock hit a record high earlier on this week. Robin, about 60 minutes away. Equity futures on the S&P 500 this morning look like this. Equity futures pulling back by just 0.2%. On the Nasdaq down by 0.4%. In the bond market, 2s, 10s, 30s shaping up as follows. 2s up by 2 basis points this morning, 4.06%. PCE 2 hours away, and this is the problem right here. Energy prices spiking higher this year is producing higher inflation and pushing the Fed into a corner, a Fed that is sounding more and more hawkish by the day.
The data points today are going to be really important for this. On one hand, you have oil prices a bit higher, and you have core PCE, and then you have earnings. And the idea of Costco and Best Buy, and if they come out robust, the way that we've seen some earnings come through, well, then it can be stickier because people are saying, oof, I don't like that, but I am still buying. And that is sort of the conundrum for the Federal Reserve that they don't want to have to see, but it seems like they're trying to wrap their heads around.
Such an awkward, crazy dynamic right now to see consumer confidence at record lows. Coming from you, Mitch. Whether you believe that, okay, but still, record lows and a stock market, record highs.
It has to do with inflation. The idea that people hate inflation. People feel like it is a tax on their paychecks. They see inflation prices going up more than they see their paychecks going up. That is just psychology and how it always has translated. So right now, people see that we are in a higher inflation moment. At the same time, that is very good for stocks as long as it's not run away, because ultimately they can charge more. And guess what? Their margins are growing, so they're probably charging a little bit extra. You put these things together, you get a surging stock market, you get confidence falling off a cliff, and you've got very confused Fed officials.
Well, you have the Conference Board as well not coming in too well when it comes to how consumers are feeling, plus University of Michigan, plus the polling. To Lisa's point, everyone hates inflation. Why I was struck by the Treasury Secretary decided yesterday to say that it's going to be transitory. This administration really does need to hope it's going to be transitory before the midterm elections. At the same time, what do we hear from everyone? The consumer still is resilient. They're complaining, but at the moment, they're still spending.
Still spending at the headline level, and that's driving this stock market too. Earnings, earnings, earnings. How many times have we been told that in this equity market? Your stock market just off record highs this morning. 3 hours away from the opening bell. Let's get you some single names to morning movers. Yahara has more. Hey, Yahara.
Hi, John. I did not expect Snowflake to be the star of earnings yesterday, but here we are. The stock is soaring nearly 40% in the pre-market after it raised its full-year outlook and said it signed a massive $6 billion deal with Amazon Web Services. But as you can see, this marks a clear sign of relief for investors who have grown increasingly worried about AI disrupting the software industry, but Snowflake is signaling the opposite here with usage for its new AI coding tool doubling from the prior quarter. Turning to Dell shares, they are also rising in the pre-market, up 4% after landing a nearly $10 billion Pentagon contract to help streamline Microsoft software across the U.S. military. But the timing here is notable because this name reports after the bell today, and AI server demand will be closely watched. Analysts expect sales in that category surge more than 600% in the fiscal first quarter, and they expect that will drive a revenue beat. And we end on Marvell. Those shares are falling nearly 3% in the pre-market, even after the chip maker posted a beat and a raise on what they're calling exceptional AI demand. But with Marvell shares up some 130% year to date, this may have just been a story of high expectations. John?
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. On our radar this morning, the US and Iran exchanging fresh strikes near the Strait of Hormuz. US forces shooting down 4 Iranian drones bound for a commercial ship. A US official saying the ceasefire remains intact. Elsewhere, Wall Street's biggest banks are calling for another banner quarter for their trading desks. Bank of America CEO Brian Moynihan and the JP Morgan boss Jamie Dimon both expecting double-digit revenue growth after posting record hauls in the first quarter. And finally, Salesforce and Snowflake reporting earnings at a key read on the software sector. Snowflake shares skyrocketing after the earnings topped analyst estimates, and it signed a $6 billion cloud deal with Amazon. Salesforce edging lower after its outlook fell short. It's the winners and losers in the software space.
Just in one chart, there you go. This explains the software story of 2026. The reason why you're not seeing Salesforce CRM down more is because it's already down some 30% so far in the past number of months. So we're already seeing some pretty big declines. Prove it. Show me the money. Show me your path ahead in an era of AI. That has been the story. It's not just the miss for Salesforce and revenues for the second quarter. It's also not showing a path forward that is credible enough to people. They did show that their agent force is really gaining a lot of steam. They did show promise there, but it's not enough to convince people that they've got the moat around them that Snowflake seems to be developing with their partnership with Amazon.com.
This is the moment to provide some hot guidance. That's the problem. And if you're in the software space, you need to keep providing it quarter on quarter on quarter on quarter to disprove the thesis out there at the moment, and providing a lukewarm, kind of cold forecast, not going to get it done.
And actually not breaking out some of the data in the same kind of granular way that you have in the past, which also is something that came out of Salesforce, also giving people a little bit of skepticism about exactly how to move forward. It hasn't been an easy time for Mark Benioff. He's been really struggling to try to prove the story of why software will still hold the same kind of high margin revenues that it has in the past in an era of commoditized bots.
Dan Ives of Wedbush maintaining his 325 price target on Salesforce and raising his year-end forecast for Snowflake to 280, writing there is growing speculation that enterprise software budgets have started to shift towards AI initiatives, cannibalizing software spend. But these results represent an important gut punch to the AI ghost trade. Dan joins us now for more. Dan, good morning. Good to see you.
Great to be here.
What is separating the winners and the losers right now in this space?
Look, I mean, at least did a great job talking about it comes down to monetization of AI. And there, look, it started off Palantir, then you saw Datadog. Snowflake, I view as really a seminal quarter for the software.
Just describe what they do and why they're in the sweet spot right now.
So if you think about the data layer, what this is really showing is LLMs, as the models are ultimately getting deployed, you know, the data warehousing, who the middle layer. As companies go down the use case path, you need a Snowflake. So the point is that you're trying to now find companies in the second, third, fourth derivative who are actually going to benefit. You have chip players over here. You have the hyperscalers over here. In the middle is a Palantir, is a Snowflake, is a MongoDB. And I think what this shows, I call it the AI ghost trade. You can't just paint every company with the same brush, saying that Anthropic's going to destruct software. Snowflake's basically saying, you know, this is a Jalen Brunson-like quarter.
Just to sort of frame this in a more comprehensive way, when you take a look at Salesforce versus Snowflake, how do you identify a moat that is enough for a software company to be sustainable in an AI era?
Yeah, and Benioff, look, back against the wall, right? And you're talking about 150,000 customers. Now you have to show Agent Force clearly was what I view as a pretty big step in the right direction, but we're still talking 3-4% of revenue. It's not significantly moving the needle. Now you guys show over the next 2, 3, 4 quarters that they're able to monetize 15-20% of the customer base. And that is right now, I wouldn't call it a race against time, but that's why there's so much pressure on Salesforce, pressure on Oracle, pressure on Adobe. Look what happened to Intuit. And I think that's why it's investors, Winners bracket, losers bracket. CrowdStrike, Palo Alto, winners bracket on cybersecurity. Zscaler obviously got put in the losers bracket.
I'm just trying to figure out if there's some sort of generalities we can that we could make about what these brackets of the winners look like and what these brackets of the losers. I mean, I can have the Lisa bot do my taxes, which is why Intuit's struggling. You can potentially have different kinds of homegrown bots do a lot of the different functionality. You can't have somebody manage your cloud data in a comprehensive way, the way that Snowflake is going to do in tandem with Amazon Web Services. So is there some kind of characteristic of what the winning feature really is for software today?
It's one word, it's data. I mean, data is the new oil, the new gold. And who has control over that data? That's what's going to separate winners from the losers. Snowflake, front and center on data. Palantir, front and center on data. LLMs, the models, they're not going to commoditize data. They could commoditize pieces of software. We see like UiPath and some others. You see it on Intuit. So that's why investors are trying to figure out which bracket. If you're in this bracket, stock's up 30, 35%, and I think going higher. On the other side, like a Salesforce, they need now to prove it over the next 6-9 months. And Benioff is used to being Mount Rushmore, you know, obviously at the top of the mountain. This is, I think, for the first time, a true test. I think they'll ultimately succeed, but this is definitely, you know, pressure environment.
So for Snowflake, if it was a Jalen Brunson quarter, was for Salesforce this like a James Harden quarter?
Oof. I would, and that maybe that would be a little too harsh in the, you know, but I'd say...
You just said he has 6 months to prove himself.
Yeah, look, I'd say it's one where if you look at Salesforce right now, they're in a situation where, let's go, it's a Cleveland Cavaliers situation where, you know, you had definitely green shoots, but now you got to prove yourself out. And I think Benioff understands the challenge there, what they need to do. But it comes down to investors need to see execution, monetization. That's going to be front and center.
What wouldn't you touch in tech right now?
Well, look, to me, I think you want
to sell. What would you avoid?
You want to continue to own chips. You want to continue to own software. I think the areas, like if I look at like where Adobe plays into it, I think IT services is areas you want to, you know, right now I think avoid in terms of, you know, some of those components. And I think it's the legacy names, specifically in software and infrastructure, that you don't think that they're going to be able to turn around. I think it's truly a stock picker's market in terms of what we're seeing here play out.
Can we finish on Tesla? SpaceX IPO later this year. It's going to be a blockbuster, massive numbers we're talking about here. And then an additional sideline conversation whether Tesla becomes one with SpaceX. What do you think about that as an analyst?
I think that is, we've talked about it, it's the no-brainer move. We think 80 to 85% chance that we're sitting here a year from now, SpaceX and Tesla have gone down the aisle in terms of marriage. Because to me, that is one, in SpaceX clearly being from an IPO perspective, you had the XAI, you know, integrated there. But when it comes to Tesla, from a data perspective, from AI, from an engineering cross-pollination, I think that's the grand vision for Musk. And I just continue to view this is a step process, but I think that the extremely high chance that that's emerged.
What does SpaceX get out of it?
Well, for them, you get the data, you get the engineering, you get ultimately what I view as autonomous physical AI, combined with what SpaceX bring, obviously, on the space and when it comes to Starlink and the foundation. And look, there already is cross-pollination between Tesla and SpaceX, but I think this would really be more of an official sort of combination. I think it's all part of the grand vision of Musk in terms of he's almost building out his own, just like NVIDIA and The Godfather, they're making stakes in companies. Musk has almost done it, you're really step by step here.
Dan, it's good to see you. It always is. Thank you, sir. Dan Oster of Wedbush. You liked that, didn't you? What would you avoid? And he just started listing things he'd buy.
Yeah, what would you avoid? I absolutely buy chips. So thank you. Can I just say that Tesla owes Ferrari a thank you?
Go on.
Because when Ferrari comes out with their $640,000 car that was mocked roundly around this table,
sure.
I concede, everyone pointed to the high-end Tesla and how good it was, relatively speaking, and it was only $100,000. It was the best marketing ploy for Tesla you could ever imagine.
There was only one person I saw that said they liked this car.
Me.
Ian Bremmer. Well,
That's
no,
weird.
you were just trying to be controversial.
Why did he say he liked it?
He just didn't think it was that bad. I could go find the tweet, but he was like, no, he was like, I think it's like a good-looking car for an EV. The issue is, would you be willing to pay $650,000?
I think this is not complex. As a standalone vehicle, as a car, it's fine, right? We can agree on that. As a Ferrari, absolutely not. $650,000, absolutely not, right? And if it was 100K, I'm sure they'd sound low to them. But the problem is, it's got a Ferrari badge on it and not an Apple badge.
Which is the reason why you see people pointing to the Tesla and saying this only costs $100,000.
I agree with you,
and all of a sudden, the high end looks really good, and it has better, the RPM or whatever the language is.
After Ferro got me into F1, Ferrari does not belong with an EV.
There we go.
Wow.
You found the tweet?
So Ian Bremer says, first one in years that looks like you don't need to be an insufferable explicit to drive it.
Oh, that's a different sort of story.
Oh, come on. You can say the arsehole, is that what he said?
Yeah.
Okay, I think you can say that word. Yeah, I don't think that's
my nephew's watching.
I apologise to people at home. The problem is, with that statement, it's the lack of self-awareness there. Yeah. It will be the insufferable assholes that actually buy the car.
Exactly.
You're going to see them in San Francisco and Los Angeles.
Exactly.
I think his failure to actually understand what one of those actually is. Anyway, let's give an update on stories worldwide this morning with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The Democratic Republic of Congo is seeking access to an experimental antibody treatment as Ebola continues to spread. The country's health ministry says suspected cases have climbed above 1,000, with 238 suspected deaths. Shares of Dell trading higher in the pre-market. The Pentagon says a unit of the company won a nearly $10 billion contract to provide a suite of software to the U.S. military. Dell reports earnings after the close. A Google software engineer is charged with insider trading. The 36-year-old allegedly made more than $1 million bet on Polymarket by betting Google's most popular search of 2025 would be the singer David. He had access to company data that tracked user searches when he bet. And that is your Bloomberg brief. John.
Vonnie, thank you. I apologise. Is that a bad word?
My
on my scale for profanity, that's just not, that doesn't register at all.
My 17-year-old wrote it. He was like, oh my God, I've never heard that
word
before.
No, he didn't. I don't believe it. No way.
Oh my goodness.
No way. I remember when I first moved here and started cursing in the newsroom.
Yeah, that was.
Right, just throwing around the odd casual word. You know what it's like in London, right? Very casually, just sort of throwing in, lacing everyday language with profanity like an everyday Brit word.
Yeah.
And Americans being like, oh my goodness.
Oh, not New Yorkers.
Oh my goodness.
I think you're allowed to say it also because it is a direct quote. So we want to be transparent and honest with our audience.
Thanks for cleaning that up. Appreciate it. Up next on the program, counting down to inflation data.
Everyone is focused on core PCE. I'm worried about real personal consumption, real personal spending at a moment in which nominal wage gains are not keeping up with headline inflation.
Up next, Kay Herr of JP Morgan Asset Management, live from New York City. You're watching Bloomberg TV.
Wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Inflation data a few hours away. Your scores into that look like this. Equity futures this morning pulling back after stalling yesterday, just about squeezing out a day of gains on the S&P. We're down this morning by 0.2%. In the bond market, switch on the board, 2s, 10s, 30s. Yields higher at the front end of the curve by about 2 basis points this morning, 4.06%. Under surveillance this morning, counting down to inflation data.
Everyone is focused on core PCE. I'm worried about real personal consumption. Real personal spending at a moment in which nominal wage gains are not keeping up with headline inflation means that consumers are losing ground in real purchasing power. And at some point, that starts to flow through to the broader economy.
So here's the latest this morning. Fresh data from the Federal Reserve's preferred inflation gauge due out in just under 2 hours' time, as more policymakers signal a hawkish pivot could be on the horizon. Kay Herr of JP Morgan Asset Management writing, it's a long way from an easing bias to an actual hike. We'll need to see signs of demand-led inflation to traverse that particular distance. Kay joins us now for more. Kay, good morning.
Good morning, John.
It's good to see you. I'm very well. Let's talk about this inflation data.
Sure.
What are you and the team expecting to see at 8:30 Eastern Time?
Look, let's start with, first of all, isn't it nice to not be talking about Iran and to go back to macroeconomic data?
Kay, give
I'm
it a minute.
sorry, but every morning we wake up and it's like, you tell me what crude's doing, I can tell you what stocks and bonds are doing.
That might be the follow-up question, but please.
So look, I think that the inflation data has been very hot and very sticky. We've had a supply-side shock, and that's exactly what happens. It's going to translate through, and I would not be surprised if we get another hot PCE number today. And as you know, that's the Fed's preferred number. Is it going to be, the 3.8 consensus or higher or lower than that? I don't know. I don't have any insight on that. But I can tell you, almost guarantee that it will be higher than the Fed's 2% number that they're looking for.
How do you determine whether it's demand-led or whether it's supply-led? Right now, people talk about supply-led, but demand-led is allowing the inflation to remain hotter in the system because people are still buying.
So it's a good question. And the two things that we really focus on the demand side are wages and shelter. Those are the ones where we haven't seen it yet. We haven't seen, have you gotten, you don't have to answer this on air, but have you gotten a raise from Bloomberg lately? Jamie Dimon's not throwing out raises at JP Morgan. Like, there's just not a lot of wage inflation that we're seeing. Same on shelter. You saw a major M&A deal in the REIT market in apartments last week. There's not a lot of revenue growth for them. So those are the two things that we're watching and will continue to watch.
If you don't get some sort of rate hike, does that make you more skeptical about the long end of the yield curve? The idea that this is going to be a structurally more dovish
Whoa, you have
Fed.
Just gone like you guys were talking about Ferraris. You're in a Ferrari going all the way from not only might PCE
you just
hot
took away
to
a raise from me.
But she's in a real Ferrari, not the EV Ferrari. Spicy this morning.
Well, I mean, look, let's be fair. This is the concern.
I was trying to calm us down a little bit. Dan Ives is bright, colorful.
You're
I'm
wearing
in
black.
a somber black.
I'm wearing red. So let's go.
Okay, there we go.
There's a sense going forward that ultimately there is structurally higher inflation, and the commodity shock isn't going away anytime soon, and that's going to lead to structurally higher prices along with the AI build-out. So at what point, without a rate hike, do you start to get more skeptical of long-duration bonds?
So let's take everything a step back here. First off, the Fed unfortunately ruined the word transitory for us because in 2020, to, they were talking about transitory, and inflation was not transitory. We were all out there spending, buying things, doing things. Inflation was not transitory on our side. You know, my colleagues, we were not saying that it was transitory. And that's put the Fed in a little bit of a box of they can't say it's transitory because nobody's going to believe them. They've lost credibility on that, right? And so now what are you seeing here? You see Fed officials moving behind, much more hawkish. And I think that's intentional. You know, in the 90s, we used to talk about the Federal Open Mouth Committee. I think we're back to the, do you not remember that? That's what it was. They're like jawboning about stuff. And guess what? The bond market is doing their work for them. The bond market is having the discipline. You worry about fiscal discipline. You worry about easy monetary policy. The bond market does the work for them.
But do you think it is transitory? Because the Treasury Secretary seems comfortable using that term.
Like I said, that word has been ruined, but yes, so far it looks very much supply driven. What I can't tell you is how long it persists. The struggle is, I think people thought, especially after Venezuela, people thought Iran is going to be, we're in and out and it's fine, and it keeps getting extended. So I think the risk to it, and I have no insight on this, is the longer that this conflict stays on, the longer that gas prices stay higher, and then what happens? Does that continue to get passed through? You know, we've seen evidence that in the $4 to $4.50 range on gas prices for consumers, they substitute. You've started to see that the spending, the total dollar spending by consumers on gas isn't keeping up with what it should just purely based on what gas prices are doing. So consumers are trading down. You see it in retail on that. So if it's a year from now, then maybe things change.
What if it's the rest of the year? Conventional thinking is that the Iranians are well aware that the president has a big midterm election coming up.
That's a little bit hard to game. What I want to go back to is, you asked me a very good question a month ago, if I may.
Yay.
Last time I was on. No, you asked me, you were kind of baiting me on Warsh and trimmed mean. Did I accuse you of baiting me? You were.
I'm wearing red.
Right? So, and the Fed put out a paper last week on the measurement error around software services. You probably have not been on this, but the Fed themselves are saying that the contribution from software and accessories to core PCE is 9 standard deviations from the mean over the last 4 months. So the point is, when you look at something like trim mean, maybe that should get tossed out in terms of the influence that's having. So we're back to, what does this data mean? John, you're looking skeptical.
No, I just thought it was a really great effort not to talk about Iran there. The pivot.
I have no insight into Iran. I have no insight into Iran. I'm telling you, the bond market prices
Lisa said that continuously. I think a lot of people feel the same way, so they're looking elsewhere.
There's no edge. How do you get an edge on something that is a morass of disinformation and complication and difficulty, and it has a lot of human elements to it, but from a market standpoint, if you don't have an edge on it, it just is noise. It's like...
So that's exactly right, and you got to take it back to, what are we supposed to be doing? We're portfolio managers. We're supposed to beat the ag on a daily basis. So the first thing is, don't get whipsawed. You look at this market, there have been multiple opportunities to get whipsawed, and we haven't. Stay the course. You know, the bond market itself has gone from 2 cuts to 2 hikes and everything in between. Yep. We've had a more neutral view on that. We're going to be range bound, so you sell at the high, you know, you're buying at the highs of the range, you're adding a duration there, and you're trimming it at the lows of the range. I mean, I just think it's that. And on the credit side, you know, while all the Iran stuff is going on, the IG bond market has priced almost $1 trillion of supply at a new issue.
Hey, I got to go. Kate Hurd, bullish bonds, JP Morgan. It's good to see you.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
A cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne
num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
On the macroeconomic side, everything is going quite well.
A lot of that upside risk around the unemployment rate has moderated significantly.
We have some structural things building up in the inflation pipeline.
We still don't see the Fed hiking anytime soon.
The Fed is well positioned to wait and see.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Pulling back from all-time highs on the S&P, down by 0.25%. On the Nasdaq, down by 0.5. In the bond market, yields creeping higher at the front end of the curve. Twos up by 3, 4.06%. Building off this move in the energy market. A small bounce on Brent and WTI. Brent crude this morning up by close to 3%, close to 97. Heading into this data point later this morning, 90 minutes away, PCE in America.
Yeah, so core PCE is expected to come in 3.3% year over year. That is not 2%. That is not 2.5%. It's actually above the 3.2% that it was in the prior reading, which is exactly the wrong direction and the wrong type of levels that this Federal Reserve would like to see. Does it matter? Is it transitory without saying transitory? This is going to be the key debate. But when you pair this with the robust earnings that we've been seeing from a lot of corporations, as well as ongoing improvement that you're seeing in the labor market, you saw that this week with a little bit of peripheral ADP data, it seems to point to a direction that makes the Federal Reserve incredibly uneasy.
We've started every year for the last 3 years worried about above target inflation before the Federal Reserve has gone on to cut interest rates 3 times by 75 basis points at the back end of the year. I have to say this time, going into this summer, listening to these Fed officials, it feels slightly different.
Especially because ultimately there are a number of different nodes of this. It's not just coming from the oil prices, and we could talk about the Strait of Hormuz. It is very important. We all understand that we have to keep that in the back of our minds.
Anne-Marie, have her moment in a moment.
But there is also the whole build out of AI. There also is this K-shaped economy where at the higher end, a lot of different retailers and travel companies are able to raise prices and pass that along, and demand remains robust. So you see it kind of trickling into the economy in different ways as we move from a financialized economy into a very physical one that suddenly needs to build for a new industrial revolution.
And a lot of that building, a lot of that spending price insensitive, and that's part of the issue right now for this Federal Reserve. Anne-Marie's moment, it looks like this. Brent and WTI up by more than 2% so far this morning, call it 2.5. Moments ago, we heard from US Central Command about just what happened in the last 24 hours. The second time we've seen this in just a few days.
Yeah, and the U.S. Central Command is saying that Iran launched a ballistic missile toward Kuwait, successfully intercepted by Kuwaiti forces, and then they're saying that it was an egregious ceasefire violation on the part by the Iranians. So then also the Iranians launched 5 one-way attack drones, and then those were near the Strait of Hormuz that then they struck down. So basically what we're seeing is tit-for-tat clashes. They're saying it's defensive in nature, but my question is, at one point, as we see these red lines really start to become pink, at one point do you actually say, no, this is proper end of the ceasefire, we might go back to attack?
For now at least, and not to trivialize the moment, but I think the market sees this as expensive fireworks, expensive skeet shooting, so to speak, if you've ever done that, at a very expensive level on the US side. For the market, you nailed it, the word agnostic. The market is agnostic about how we get there, and there being energy flowing. And you're starting to see some ships, some vessels get through the strait in ways that you haven't done a month or so ago.
Yeah, there have been a couple of vessels going to places like China, but also other places in the world. And every time you see a report, the greatest amount of oil that traversed the Strait of Hormuz going back to the beginning of February, suddenly you get another pop in markets because they're looking for just some leaks, to Anne-Marie's point earlier, that could allow oil to keep flowing and to mitigate some of the price increases that we've seen.
To that point, an Iranian news outlet is saying that Iran allowed 26 ships to cross the strait in the last 24 hours. I would love to know what flag these were, exactly where these ships are going. Also because last night, OFAC came out and basically sanctioned the tolling authority. And anyone that deals with that tolling authority is going to now be in the crosshairs of the U.S. Treasury Department, and they can also get fines and be sanctioned. So it's interesting to say Iran's allowing this, but it does seem like the U.S. administration is doubling down.
So we've got a bounce in crude, a pullback in equities of about 0.25% on the S&P 500, and a big data point dropping later this morning at 8:30 Eastern Time. Coming up this hour, we'll catch up with Emily Rowland of John Hancock, with stocks hovering near all-time highs. Bloomberg's Tyler Kendall with crude rising following fresh strikes on Iran, and the BNY CEO, Robin Vince, on the debut of the Trump Accounts app. Look out for that a little bit later this morning. We begin this out with stocks flat and crude elevated as investors await the latest round of inflation data. Emily Rowland of John Hancock writing, if the Fed must slam on the brakes by year-end, we are in the danger of the economy contracting. There is a tail risk where the bond market is starting to put in odds of 2 to 3 hikes. Emily joins us now for more. Emily, good morning.
Good morning.
That's the tail risk. Is it the base case?
It's not our base case. We think there's some underlying factors in the market that are actually disinflationary and have the ability to sort of offset this increase in oil prices that we've seen. But we're not in Kansas anymore, meaning we're not in Goldilocks anymore right now. And clearly we're seeing that, and the PCE data later this morning probably confirmed that. At the end of the day, though, we look at the sort of heat that's coming from inflation, but the macro picture is actually quite a bit cooler. Underneath the surface, things like housing data. We got Case-Shiller home prices earlier this week, up 0.7 year over year. We're seeing job openings slowing. We look at real-time measures like Indeed.com and Linked Up, which are both showing that job openings are actually plunging as of the month of April. So I think when you look at the Fed's dual mandate, it's, you know, employment and inflation. The employment side's quite a bit weaker than the inflation side.
In other words, you don't think the labour market is hot enough to worry. Is that fair?
That's fair.
Is the bond market a buy then?
To us, we are looking at every backup in bond yields as an opportunity because equities are priced for perfection in a world that's not that perfect. And as asset allocators, and we're making the decision between stocks and bonds, we see bonds as a value here. So we would lock in that elevated income and build a return stream that can last for years rather than sit in cash, which is what every investor that I talk to is still doing.
The issue a lot of people have is that financial markets seem to have broken down from the fundamental economy underneath.
Yeah.
There is a sense that some of the concerns and the weakness that you're seeing in certain pockets of the consumer, not seeing significant wage growth, doesn't matter for where inflation is. It doesn't matter for where growth is. It's this price-insensitive buyer in terms of technology, as John was mentioning. And frankly, it's efficiency. So how do you kind of rebut that argument?
You don't. Nothing matters except AI, and earnings. And a little more AI. And it comes back to earnings. Like, you know, and it's funny, John said it, so I'm going to say it, like, this time's different. Those are the four most dangerous words in investing. I thought we grew up learning not to say
this. This time feels different.
He's
right. Caging it.
You're right.
A little bit of a
yeah,
little bit of
a
caging there. It's a hedge.
But it feels that way in the sense that the economy's like, okay, but the market is just on fire right now. And we had, you know, there's a number of things happening, but every single person that comes on your show is talking about earnings, earnings, earnings. And it was just absolutely explosive to see S&P 500 earnings coming in at 28%. Analysts had estimated 13%. That's great. Like 28%, and you know, it's the valuations are actually shrinking a little bit because the earnings are so good. Like the denominator is amazing, and it's global. You look at emerging market equity earnings, of course, it's only 3 stocks. We all know that. But it's companies that are selling things to the United States from a semiconductor perspective that are also seeing their earnings booming. So we have used earnings as the #1 input into our work for the last 10 years, and that tells you there's support for this.
Why can we see, or how can we see growth and these incredible earnings and incredible financial market gains without seeing incredible inflation? I'm just, this is what I'm struggling with. You know, like, and I understand what people are saying, which is that people don't feel very good. But unfortunately, this market is not kind. Averages are not kind. No. And they really cater to the upper end of the K, and the upper end of the K is feeling very good. Yeah. So how do you counter that?
Yeah, it's amazing. It's the wealth effect. Like, investors have never been richer and more miserable in history. You look at the Michigan Sentiment Index, and I understand why it's plunged, but it's at an all-time low last week, and meanwhile, the stock market's at an all-time high. It is remarkable. There's now $175 trillion in consumer net worth. People own more stocks than real estate for the first time since the late 1990s right now. So that wealth effect has been huge, and if you think about the way that it's all connected, you've got booming AI earnings, you've got semiconductors that are acting like they're sold out right now, so there's a scarcity issue there. There's a booming CapEx cycle going on, and then if you think about that wealth effect, it's translating into helping the financial sector, the wealth management businesses of some of these firms are booming. And then you've got, to your point, margin expansion for the first time in a while. Like, remember, we were worried about that for a while, company margins shrinking. Well, they're back to expanding again because companies broadly are using AI to do more with less. So there's a number of elements here that I think are supportive. Meanwhile, the lower end consumer, not so hot.
Well, at some point, the lower-end consumer, they've been somewhat resilient, maybe having to move money around. Yeah. At some point, do they just have to stop spending?
I mean, it's certainly a risk, and you know, I've heard several economists say, like, we don't need jobs for the economy to grow, and I disagree with that. Like, the more that you see the labor market deteriorating, where does that top-line growth come from if people aren't spending? So I think that's a critical issue to watch.
So you don't believe in jobless growth?
I don't.
Wow, okay, because that's potentially where we're going with AI, right?
Yeah, I think it's gonna, for now, so far so good. And the labor market, by the way, is not falling off a cliff. Like, we look at initial jobless claims, we're still in the low 200,000s, that's great, but I do think at some point, if the unemployment rate goes up, then we're gonna have a problem in terms of the consumer. But more important, if the market corrects. So then you're gonna see that upper end consumer pull back. If you did see a 10% decline in the market, I think a lot of people are gonna be looking at their portfolios.
It's funny how few people put any weight on you, Mitch, and that sentiment number being at record lows. And I understand why, because I think typically we look at it from the following perspective. How on earth can this be worse than GFC, being locked up at home in a pandemic? Allow me to try and shift the perspective just a little bit on that number. It's not about viewing this economy in isolation right now. I think you should view that number as an accumulation of feelings over the last couple of decades, the accumulation of feelings through GFC, through the pandemic, and the consumers and what they felt about this economy. It's not just about now, it's about them, where they were before. And for them right now, yes, it's got to that point where it's never been worse because prices still keep climbing. Now, yes, sure, 3% is not 9%, but that doesn't matter. It's on top of the 9% before. So you're looking at a basket of goods that might be 30% plus higher than it was going into the pandemic. And it keeps getting worse, not better.
And if you're 30 years old today versus a 30-year-old in 1990, could you buy a house? Could you have confidence about what your job would be? How do you develop a family? There are all of these huge questions, which is a reason why that long-term interest rates matter quite a bit. At the same time, averages are not kind. I keep coming back to that. And if you have hyperscalers spending on incredible goods and paying $100,000 bonuses every week, well, suddenly there's a cohort of people that can still afford these things. It becomes a policy issue on the fiscal side, not necessarily a policy issue on the monetary side.
Emily, it's always good to see you. You're going to stick with us. Emily Ronan there of Jan Hancock. Emily was talking about EM. Take EM. She mentioned 3 stocks, right? You ask people in emerging markets right now how they feel. I'm sure they're struggling with access to energy at the moment. They probably don't feel very good, but that's not the emerging market stock story right now. The emerging market stock story right now is Taiwan Semi, SK Hynix, right, and Samsung. 3 names. That's the story.
It's not exactly diversification from some of the winners that we've seen, which is sometimes people come on and they say, we like EM, but we like the EM names that are sort of the ones that are traditional that have actually gotten their balance sheets together. Maybe you developed markets could learn something from them.
We'll spend some time on this story in just a moment. Let's get you an update on stories elsewhere with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. U.S. officials saying Iran violated its ceasefire agreement with the U.S. In a post on X, Central Command calling Iran's launch of a ballistic missile toward Kuwait a, quote, egregious violation. Dollar Tree shares surging in the pre-market. The discount retailer reporting first quarter earnings that beat on the top and bottom lines. Dollar Tree also boosting its adjusted EPS forecast for the year, surpassing Wall Street estimates. Meta is rolling out a paid subscription model for its AI chatbot as it aims to offset big spending. The tech giant is unveiling a 2-tiered subscription model at $7.99 per month and a premium plan for $19.99. It's being introduced in Singapore, Guatemala and Bolivia, with plans to expand to more countries. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. I'm next on the programme, trading strikes at the Strait.
Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. We will be either that or we'll have to just finish the job. They're negotiating on fumes.
In just a moment, we'll catch up with Bloomberg's Tyler Kendall from the nation's capital in Washington, D.C. From New York City this morning, good morning.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
15 minutes away, this conversation right here. Looking forward to catching up with the BNY CEO, Robin Vince, at 7:30 Eastern Time. Don't miss that in just a moment. Don't miss this either. In an hour and 14 minutes time, inflation data in America. PCE, the Fed's preferred read on inflation, expected to climb to close to 4%. The estimate for this morning, 3.8% year over year. And every single Fed official we've heard from so far is worried about upside risk to inflation.
I keep asking, and I kept thinking about this last night as I was going over some of the commentary from Jefferson and Cook, the Fed officials who are talking about the potential to raise rates. Who exactly wanted to keep the easing bias in the Federal Reserve? Ultimately, this is not what we're hearing in terms of the rhetoric. Clearly, the numbers aren't doing so well. We're going to be dissecting them. And Kate Herr actually did have a really good point, which is ultimately there are some inputs here that might be skewing things. And so a trim mean might be looked as political. At the same time, economists that are well-versed in markets are looking at this.
There seems to be a conversation, speculation, if you will, that maybe this was about just setting things up for the new guy to make the decision himself, not to take it away from him. Maybe. And I have to say, so far the data backs that up, because to your point, and you're absolutely right, I can't point to a single Fed official right now that does support the easing bias at the Federal Reserve. So who did at the last meeting?
And if they did it and they aren't going to come and say it, well, then what good is some of this easing guidance to markets? Right now, how much is the Fed trying to do with job owning and how much are they actually willing to do? And that right now is the debate for bond markets.
So we've got some data and some earnings too. Later this morning, we'll get numbers from Costco. After the closing bell, we'll also hear from the Gap as well. Look out for Dell after the close as well. Some of these old school tech stories really taking off recently, so look out for that name too. In the commodity market this morning, we're bouncing back on Brent crude 97, WTI around 91. The Savannah's this morning, trading strikes at the Strait.
The Strait's going to be open to everybody. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. We will be either that or we'll have to just finish the job. They're negotiating on fumes.
So here's the latest this morning. The US and Iran exchanging fire in the Persian Gulf. Within the last hour, US Central Command saying Iran egregiously violated the ceasefire agreement. Bloomberg's Tyler Kendall joined us from Washington for more. Tyler, we saw the reports over the night. We're now getting some detail of what just happened in the last 24 hours.
Right, John, breaking moments ago, this statement coming out from CENTCOM saying that this egregious ceasefire violation on the part of Iran comes after the country launched a ballistic missile towards regional partners like Kuwait. And CENTCOM goes on in its statement to say that CENTCOM stands behind regional partners and remains in part, quote, vigilant and measured as we continue to defend our forces and interests, not taking the threat of further military escalation off of the table after overnight the U.S. conducted this freshest round of military strikes in response, according to CENTCOM, to multiple drones being launched at commercial ships in the Strait of Hormuz. And just yesterday, President Trump maintained that no country will have formal control over the Strait in any potential deal that the U.S. signs. But we're starting to see Iran try to tighten its grip in multiple ways, including laying mines in the Strait, conducting these drone strikes, but also releasing this new set of rules that vessels would need to comply with in order to transit through. And new this morning, we heard from Iranian state media that confirmed that so far the country has let through 26 vessels in the last 24 hours and says that the IRGC is vowing that they will respond to any disruption to its efforts to try to control traffic in the Strait. This is just raising the risk here and showing us how, at least publicly, the two sides feel very far apart on what appears to be the first phase of any potential deal. John, we know that the White House is pursuing this phased approach where we would first need to see a reopening of the Strait of Hormuz before we can even talk about formal dialogue around what potential curbs on Iran's nuclear program would look like and what happens to that stockpile of highly enriched uranium.
Tyler, appreciate it. Tyler Kendall down in Washington, D.C. Everything's lined up to squeeze this consumer right now. The labour market's not too hot. Energy prices at multi-year highs. Mortgage costs at about 6.5% for a 30-year mortgage in this country. But some retailers are executing. Best Buy this morning up in the pre-market, Lisa. Earnings just moments ago, the stock is up by more than 9%.
Yeah, it came out with first quarter revenue of $8.94 billion versus the estimate of $8.8 billion. If that had been NVIDIA with $1 trillion next to it, it would have been absolutely penalized because stocks have been bid up so much. But because it's Best Buy and because people have been so skeptical of the U.S. consumer, stocks are surging some 9.5%. You're seeing just the maintaining forward guidance, and that is enough. Similar story for Kohl's, reporting stronger than expected sales, but just talking about less of a loss than people had previously expected. That's enough to send these stocks surging. So it gives you a sense of just how much people have a very low bar for consumers, cyclicals, and if that starts to change in any capacity, that will be rewarded in a significant way.
Best Buy up 10% at the pre-market. Emily Rodent of John Hancock still with us. Emily, let's continue this conversation. Earnings. Can the earnings story broaden out beyond just these select chip names in the tech sector?
Well, you're seeing it, and I think this morning certainly is evidence of that, but it almost does feel like the entire stock market is becoming an AI stock market. It's bleeding into small caps. It's bleeding into mid caps. One of the things that surprises a lot of the investors I talk to is that value is handily outperforming growth this year. Guess why value is outperforming growth? Guess what's in the value index? Semiconductors. It's Micron and Intel are the top two names. So the value factor is wildly outperforming. It's the combination of value and momentum. That's kind of an odd couple, if you ask me. And meanwhile, low volatility and quality are way behind year to date. So very interesting dynamics if you're somebody that's doing asset allocation or doing attribution analysis. There's a lot of surprises under the hood there. And there's a know what you own, I think, element to the market.
What do you think is more durable of the things you've identified?
Yeah, I mean, I think quality can come back here. Typically in an environment where economic growth is slowing, and I'm not saying again, economic growth is significantly slowing in the United States. I don't think it is, but I do see this modest deceleration that typically benefits quality, that typically benefits growth, that side of the market. So I do think we could see a handoff here if that continues.
The signal here is that people are looking for buys. People are looking for steals. They want bargains. And I'm not just talking about going to Kohl's and looking in the sales rack. I'm talking about the idea that Kohl's shares are down 36% so far year to date. Yeah. So when they come out and they maintain forward guidance, that's enough to send the stock to the races. Best Buy down 3.5%. Yeah. When they maintain guidance and have a little bit of a beat, people are just cheering. Is that healthy or is that concerning?
I think it's okay for now. I think the challenge is obviously there's a tax on the consumer right now in terms of paying at the pump, and meanwhile you've got wage growth at a pretty meager about 3.5%. Just a few years ago, wage growth was like 6-7%, much higher than inflation. So I think the consumer is starting to get pinched here. We do have some advantages versus a few years ago. Obviously, the energy independence in the United States is something that's helpful. We have the electrification going on. I wish I personally had an EV. I didn't make that investment a while ago, but that certainly would help. So there are some offsets here, but I do think the consumer can start to come under some pressure in the back half of the year, and that's really important as it relates to how much risk-taking there is in markets today.
How exhausting is it to maintain your cautious stance?
It's exhausting. So the dip buying is just absolutely relentless. And you and I have talked about this. It's the retail investor that's just so powerful. And I think you're seeing it in momentum. You're seeing it in technicals. You know, the best investors this year have been my 16-year-old son and the rest of his friends on the Marblehead High School lacrosse team, because they all have, you know, they're all trading every day and they're all very busy with their, you know, their strategies that they've learned on TikTok or whatever else. And it's frustrating when the team is beating me at the investing game. So I think it's a challenge. You know, we're being put through the ringer, but at the end of the day, I think fundamentals will matter again, earnings will matter again, quality will matter again. We may just have to wait a bit.
I wish we had more time, because I was just about to lean in and get ready for what sounded like a therapy session between two mums, both of which are bearish, and both have very bullish sons at home who are very long this equity market.
I have to say that we were talking, my son in March, when the NASDAQ was down some 1%, Mom, I bought the dip, I went all in.
See?
You know,
you were like, son, but what about the straight and the price of oil?
Exactly, and I said to him, Anne-Marie tells me about the straight all the time, and he said, you don't get many dips, and he crushed it, and I feel like we're in the same boat.
We saw this in the pandemic, right?
I know.
Same thing. They got long early, and they were right.
Yeah.
And they were right too.
Yeah, they're conditioned to be bullish, and so if you have a whole generation conditioned to be bullish, do you fight it? Do they get reconditioned at some point? I mean, these are some of the big questions.
What's the phrase we love? The less you know.
The less you know.
The less you know, apparently. Emily, it's good to see you.
Yeah.
Thank you. Ellie Rowland there of John Hancock. Up next, the BNY CEO, Robin Vince, on the debut of the Trump Accounts app. Look out for that in just a moment. Plus, Yahira has your morning movers. Dollar Tree rising following a strong earnings beat. They're not the only ones this morning. Dollar Tree up by 11%.
tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
5 days, no losses on the S&P 500. Equity futures pulling back just a little bit. That might change today. We're down by 1/3% on the S&P 500. On the Nasdaq 100, down by 0.5. Plenty of decent retail earnings stories out there. We'll spend some time on that in just a moment. Turn to the bond market, though. Front end of the yield curve in focus going into this PCE read. The inflation read at 8:30 Eastern Time, the Fed's preferred read on price pressure in this country. 4.06% on twos and up 3 basis points. The move in crude this morning not helping. WTI and Brent bouncing just a little bit, up by close to 3%. Brent at 97, WTI at 91.
When you pair the higher prices with some of the earnings that we've gotten from retailers that have been fairly robust and some of the forward guidance, which has been either maintained or upgraded from a number of different retailers, it gives you a sense of how inflation can be sticky. Whether the Fed will actually hike rates is an interesting question because right now, the front end of the yield curve pricing that in, so many people don't believe it. Stock market investors don't believe that the Fed will have the will or desire to raise rates. Bond investors don't seem to think so either, and yet the bond market's pricing it in, so try to square those two ideas.
It's a weighted average. Very unusual for the Federal Reserve just to come out and hike once, which is basically what we're priced for. So there's a risk they do a lot more than that if they start. And there's a sequence they have to go through. As you know, it's a delicate dance, it's very slow. First of all, you remove the easing bias, you slip into neutral. Then you start saying things like, there's an equal chance of a hike or a cut, we don't know, let's get more data. And then you start to think about whether you really need to hike rates. I don't think this Fed hikes 25 if it starts to hike. It's going to do more than that. In the same way it doesn't cut 25, it cuts 75. You know, if you're going to do 1, you'll do 2 or 3. So for them to start really thinking about signaling that we're going to hike interest rates, I think they've really got to believe you need much tighter policy than where we are right now.
Well, the rhetoric is outpacing maybe their willingness to move because the rhetoric is actually increasingly shifting toward the possibility of a rate hike. And that easing bias I can't find in the rhetoric, even though I saw it in the document. So it is going to be a curious mix that, good luck, Kevin Warsh.
I guess they're hoping it does something to tighten financial conditions and ultimately they don't have to do anything.
As a market representative, sick of being jawboned, whether it's by the straight or whether it's by this. I think there is a sense of people just looking at the data and trying to make decisions.
The earnings, and they're absolutely fantastic. Yes, every single time. Let's talk about it. 2 hours away from the cash open, your morning movers, Yahara has more. Hey, Yahara.
Hi, John. Well, these retail earnings have been fantastic, and we start with the standout. Dollar Tree shares are rising 9.6% in the pre-market, and it's perhaps no surprise that a name like Dollar Tree is seeing strong demand as we continue to see signs of a more price-conscious consumer. It posted a beat and a raised quarter, and what's interesting is that it was still able to improve margins even with tariff pressures in the backdrop. And no, it's not because it's raising prices, it's because of less theft and better shipping costs. And interestingly, while you're seeing a stretched consumer trading down, you are also seeing them able to splurge on pricier consumer electronics items. Best Buy shares are up 10% in the pre-market after it posted better than expected results and just reaffirmed its full-year outlook. And as Lisa said, there's just been so much skepticism around the U.S. consumer, so this is enough to lift shares. And we end on our big mover to the upside, and that is Snowflake. Shares are still up nearly 40% in the pre-market after the cloud software company raised its full-year outlook and announced a massive $6 billion deal with Amazon Web Services. This is clearly a relief for investors who have grown increasingly worried about AI disrupting software. John?
What a move. Yahara, thank you. Appreciate it. More from Yahara in the next hour. On our radar this morning, US Central Command saying Iran violated the ceasefire agreement, launching a ballistic missile towards Kuwait. The attack coming hours after Iranian forces launched 5 one-way drones near the Strait of Hormuz. The missile and drones were all intercepted. Elsewhere, a fresh round of retail earnings out this morning. Dollar Tree shares soaring after increasing its full-year outlook. Kohl's and Best Buy also rising. Both retailers reaffirming their guidance. Earnings continue after the close, with Costco and the Gap set to report. And finally, Fed officials continuing to warn about rising inflation ahead of today's PCE report.
The risks remain tilted toward higher inflation. In my baseline forecast, disinflation should resume in upcoming months without having to raise rates.
I believe this policy stance leaves us well positioned to respond to economic developments based on the incoming data, the evolving outlook, and the balance of risks.
The Fed's preferred inflation gauge expected to climb closer to 4% today, marking the biggest 2-month acceleration going back to 2021.
This is clearly Fed officials taking it into their own hands to remove their own easing bias. You heard Lisa Cook, for example, saying inflation is clearly moving in the wrong direction, a similar type of tone from Jefferson. A question here about the delta between removing the easing bias, having hawkish rhetoric, and actually hiking rates. This is a chronically dovish Federal Reserve, and unless there is some external factor, it is unclear what could prompt them to be different and to actually be proactive in hiking rates at a time when there clearly is a lot of distress in certain pockets, even if the overall averages seem to be climbing.
So this conversation that you and Jonathan have been having is maybe this is to offer almost a clean slate. Kevin Warsh needs to come in and be the one to make that decision. If it's not him, who else is on the Fed to really take the reins? Or also any individual there that thinks potentially they would want to keep it, if Stephen Myron is the one that maybe is the only individual that was going to want to keep the easing bias, because maybe Kevin Warsh would want to.
Rip the Band-Aid off, new regime, hike rates June 17th.
Yeah.
No way.
Right? Just total reset.
Base case.
Who would accuse Kevin Warsh of sacrificing central bank independence if he hiked 25 basis points on day one?
Everyone when he gets fired, when he gets canned by President Trump. No one's expecting that, but he can rip the Band-Aid off and move to a neutral position, which is really interesting. Also, we'll hear from him. I mean, again, who is the real Kevin Warsh?
We might find out in the news conference on June 17th. Stay tuned. Got some cool news for you. The Treasury Department launching the Trump Account app today in collaboration with BNY and Robinhood, the partnership between the public and private sector aiming to expand access to long-term investing for American families. Robin Vince, the BNY CEO, writing, "We're bringing together the administration's vision and leadership, Robinhood's digital accessibility, and BNY's infrastructure." Robin, I'm pleased to say, joins us in studio for more. Robin, good morning.
It's great to be with you.
This is a very cool day, so let's spend some time on this. So you do the back end and Robinhood does the front end.
Yeah, we're the financial manager, and Robinhood is bringing all of their expertise in the front end, as you point out, the app, and don't forget the National Design Studio as well, because they've partnered with the Treasury Department, with BNY, with Robinhood to make sure, as part of the administration's push, to make services more accessible and easier to use in the U.S.
What are signups like right now ahead of this?
So 5 million accounts, people indicated interest in the IRS Form 4547. So that was the first step. You had to actually register interest. And once you've done that, you can go to trumpaccount.com, which will actually then take you to the App Store. And then as the App Store rankings grow, you'll see it easily pop up on the App Stores. And then you can download the app, and then you can actually register and actually put the rest of the information, get up and going. Now, the actual program for investing the money doesn't actually launch until July 4th. So these are ready, set moves ahead of the full go July 4th.
What does this mean for the future of BNY? Will you make money off of this, or this is solely for the public good?
Well, we believe in the program. I think that's really, if you step back from this whole thing, what is the public policy? So the administration really deserves a lot of credit. President Trump, Secretary Bessent in particular, the leadership of the Treasury Department in driving this forward, that actually creates the framework to be able to have everyone in America be able to participate in growth. And so we provide, as a company, a bunch of different services to the US government. We do it at the state level, the local level, and at the federal level. And so for us, we're frankly just proud to be able to participate in this. Of course, as part of providing the service, we're doing a bunch of different things, so are Robinhood, but it's the public policy that we are most focused on here. What else have we done? Well, we were the first financial firm to actually offer matching into the program. So remember how it works. Everyone kid who's born in America, the parent or guardian get to be able to put $1,000 in if they want as matching, or they can put additional money. The government's going to put $1,000 in. Employers can match. We've matched with the program. And then we're really leveraging the power of compounding. And this is the magic of the program. Just let's do the math for a second. $2,000 in right at the beginning, $1,000 from the government, and let's take the example of a BNY employee, $1,000 from us. Now you've got $2,000. You compound that with the historic rate of return in the stock market over the past 30 years, compound that for the next 30 years. And in 30 years, that kid will have $40,000. Now, if the parent added just another $10 a week into the same program, $10 a week that they're putting into that same account, now you'd have $140,000 at the end of 30 years. Now that's real money. That's participation in the American dream. And I think that's the program and the vision that the administration and the Treasury Department
Sounds like almost an incentive to have a child in America at this point. But when you think about post-Trump 2028, does this have longevity? Will it continue, say, a Democratic president won?
I think great public policy, and again, stepping back from it, what is the policy? The American dream, and what a time to be thinking about this, the 250th of America. The American dream is one of the things that's fueled this country over the course of the past 250 years. But we have a problem, which is not everyone is participating in the American dream. And so now you're talking about taking the 40% of people in America who have zero stake in the equity markets and actually making them stakeholders in the American dream and doing it from birth. So the ability to do that, to be able to grow, compound, participate, learn how to invest, learn how to be part of the capital system that we actually have, that's a really important piece of public policy. And so none of us can predict the future, but this has been a bipartisan effort from the start. There have been folks on both sides of the aisle who've joined into this. There have been wealthy philanthropists like Michael and Susan Dell who've said they're going to match. Employers like us are matching. I'd encourage all employers in America who are able to do so to be able to offer matching to that initial seed investment. And collectively, if we can increase this participation, we're really growing participation in the American dream. And I think that is why it's a great piece of public policy. And so I'd really hope to see it be able to continue.
It also potentially improves the delta between people who feel really disenchanted by Wall Street and feel like Wall Street's really let them down, as a number of people get very wealthy and they aren't necessarily getting wealthy. I just wonder what the guardrails. Yeah, so to try to say, like, well, you can participate too.
Absolutely. What sort of American dream is it if we have a bunch of people who aren't participating in it?
I just wonder the ideal versus the reality. When I think about a Robinhood account and then I think about a teenager or some kid who has access to it, I think about my own experience, which is essentially it's very high-end gambling, but essentially gambling, right? I mean, it's essentially turning into trying to pick winners and losers. How do you know that that's not going to be leading to people going and saying, we're going all in on GameStop, here's your future?
Well, I think this is the key to the design. If you step back and think about what is it that Secretary Besson and the Treasury Department, when you actually get into the brass tacks of how it works, you're talking about a custodial account. So for the right to start with, the kid can't touch it until after they turn 18. So there's no opportunity to be able to take the money out and go and spend recklessly. Now, once they become 18, that's the law of the land. They own their own future to some extent.
GameStop all the way.
But up until then, it's primarily about index funds. So the initial investment will be index funds only. So people aren't having to make choice about individual stocks. They're participating in the US stock market. They're participating in the growth of the economy, and that's actually the design principle at work here.
You've got to acknowledge where the YOLO trade comes from. The YOLO trade comes from this idea that they're not participating, that the only way to benefit from this economy, because they feel frozen out from the gains, is to take these high-stakes risks. So in some ways, this is a long-term goal to do something about the kind of thing that you're complaining about.
Yeah, 100%, and to potentially equalize people who feel completely left out and are earning minimum wage as other people do nothing and watch their money grow and create income. And this is sort of the gap that you need to bridge in order to create a little bit more of, you know, the market and the economy can move a little more together.
Robin, I just feel like we're losing the argument at the moment. The arguments on the left and the more populist arguments seem to be winning this moment. We see this in our UK, the shift towards the left and the politics of Labour more recently. We see it here in New York City, the heart of capitalism, and a socialist mayor got elected in this city. What else needs to be done to counter some of that, to make sure that people recognise the benefit of free markets and capitalism, the very idea that we've seen this mass affluence in this country because of those things?
Well, I think it is about inclusion ultimately and having people be able to participate. So let's go back for a second to this concept of the American dream and let's define it. What actually makes up the American dream? I'm an immigrant into the US. I've lived here for 25 years and very excited to be able to be part of this. And if you think about folks here in the US, what do they aspire to? They aspire for a great life for their family. They want to be able to have a great education. They want to be able to grow. They want to be able to have their own home. And so what I think Trump accounts represent is one piece of the American dream, which is the ability to have a stake in the country, a stake in the capitalist system. And so to your point, it helps to include that 40% of people who today don't. But there are more things. It's not by itself the solution. Financial education matters a lot. That is actually part of the app. If you actually look at the Trump account app, financial education, because we've got to recognize that saving, investing, starting early, compounding, you were just having that conversation, the value of money over time and the value of what it means if you start early, those make a difference. But housing matters as well. Owning your own home over the past 50 years has really become part of what a lot of people define as being part of the American dream and being able to enjoy that. So as a company, we've taken a step in that direction. About a month ago, we announced a new program at BNY, which is to help people get that first step on the ladder. If you work for us and you earn less than $100,000, we will actually give, and you're buying your first home, we will give you the equivalent of $5,000 after tax to be able to help you with your down payment. The average home in America, median price, about $400,000. Our largest office is actually in Pittsburgh. There, the median price is about $250,000, $300,000. We've got a huge, one of our largest growing offices is down in Florida. There, the median price is about $400,000. The average down payment for that type of home, call it about $30,000. Now, there are government assistance programs for first-time home owners that are available. And so depending on where you are, that might be $10,000, $15,000, even $20,000 assistance. But you're still left with a gap. $10,000, $15,000. So for us, that $5,000 is bridging either 50% or a third of that gap for the prospective homeowner, so they can get their step on the property journey of the American dream. So those things really matter. Now, we're doing that with Bank of America, who's our partner. They're providing subsidized mortgages to our own employees.
Brian's big on this, I know.
He is, and he's also leading on this point, which is leaning into the topic. How can we actually help? Financial education. So if you can give people through the Trump accounts a stake in capitalism over time so that they're part of it and don't want to have to throw stones at it, and you give people a leg up on the property dream, now that's inclusion and bringing people along the journey. And I think, again, back to America 250, what a time to be focusing on this.
Robin, you're going to stick with us, I'm pleased to say.
Yeah.
It's good to see you. Thank you, sir. Robin Vince there, the BNY CEO. Let's give you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thanks. Ukraine President Volodymyr Zelensky rejecting a partial membership in the European Union, arguing the country deserves full membership because it's defending the bloc from Russia. Zelensky responding to German Chancellor Friedrich Merz's suggestion that Ukraine be granted an associate membership. Congressional Democrats losing a bid to block the Trump administration from prohibiting mail-in voting for anyone not on a pre-approved list of citizens. A federal judge ruling the legal challenge to President Trump's executive order is premature because the restrictions aren't in place yet. And Best Buy rising in the pre-market after reporting better than expected earnings. The retailer seeing the most growth in gaming and computing. Best Buy previously announced CEO Corey Barry will step down later this year and Jason Bonfig will take her place. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, a generational change in the workplace.
Businesses are adopting AI at an increasing rate, but many have not yet used it to change the way they organize work. We could be approaching the most significant reorganization of work in generations.
Up next, more with the BNY CEO, Robin Vince, live from New York City. You're watching Bloomberg TV.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
I'm going to do this because Robin won't, so check it out. 5-year chart, BNY, all right? Look at that dip around 22. When did you take over? August 22?
September 1.
September 1. Okay, we're trading in the 40s, and now we've had a 200% plus gain on that name. You're never going to say this, but your bank is the best performing bank stock over that period out of all the major banks on Wall Street. What have you and the team been doing to get that chart to go up and to the right so aggressively over the last few years?
Well, first of all, look, I'll credit we're 242 years old, right? So we've been around for a little while. And what does that mean? We were here from the start. Again, in America 250, it's kind of a fun story over time, the evolution of the bank. But we had a terrific set of businesses, and those had been accumulated over a period of time by my predecessors. What this leadership team has done, and our broad company has done, is we've recognized the power of what we have. We have a great set of businesses, we have an incredible client franchise, and we decided to put culture at the heart of a transformation. And so we've invested in coming together as one company to really run the company differently and then to show up differently for clients. So we've had a commercial transformation, we've had a platforms transformation, but more than anything else, it's been a cultural reimagination of our company. And it's incredible what you can do when you bring a group of people together with like-minded, with purpose, intensity and you really go for it and you deliver for clients. And that's the result.
And now you've got the technological revolution to layer on top of that in AI. So I'm going to ask the cliche interview question. How do you see your next 5 years? How do you see the next 5 years? What does it look like? How different is it going to be?
I'm an AI optimist. I think this is a revolutionary technology that for sure has to be well managed. It has to be put in well. It's difficult to be able to adopt AI in an established company, for sure. So people talk about clean sheet of paper, sitting in the garage, you can reinvent anything. Absolutely. But wouldn't you prefer to have a clean sheet of paper philosophy inside a company that already has great assets? And then you have the best of both worlds. And so that's the way that we see AI. We see it as a superpower that will help us to be able to run the company better, that will help us to be able to really do more things for our clients, improve our products, and ultimately be able to just do new things as well. It's a capacity creator. And so there's a lot of doom-mongering around AI. And I understand none of us know exactly how the world's going to unfold. But, you know, back in the day, all of the folks who were stable hands and who ran horse and carriage businesses, I'm sure they didn't love the creation of the motor car. But they also couldn't imagine that there would be new professions and trades that were built around that new industry. And guess what? There are now more jobs. They're just different jobs, and they've evolved.
So Robin, you don't see AI as replacing lower value human capital. That is what one of your colleagues
Not one of my colleagues.
Well, peers.
I understand. Again, there's an aspect of thinking about AI, and I think he has walked back those comments, but I think there's an aspect of AI where you can get all pessimistic and negative about it. For sure, it's going to make some roles unnecessary. And so there's a reskilling that's very, very important. And as leaders, we have to own that. We have to own that at the government level. We have to own that at the company level. We have to have some individual responsibility around increasing all of our AI IQ. If there's a new technology and you don't know how to use it, and you don't care, and you want to hide from it and wish it got uninvented somehow, I mean, to me, that's fantasy land. It's about how can you accept the reality of the fact that it's here. There's no great technology that's really ever been uninvented. And so we might regret the creation of AI. That's an individual sort of point of view. Free country, everybody can have their own point of view. But the reality is it's here. So I would prefer, and certainly what we're doing in our company, is to just deal with that reality, get into it, and try to equip everybody. And I think this is a public-private sector. We started off talking about Trump accounts, the public and private coming together to enable good things for the United States. I think AI is the same thing. It requires public leadership, it requires private leadership, and coming together to upskill people for the future.
30 seconds left. Will the intern class at BNY be bigger or smaller in the next few years?
We've tripled it since 2022. You put that chart up of what we've done. We've tripled our intern and analyst classes over that period of time. And because we think that's a cohort that is naturally AI inclined. And so we want to continue to bring these new skills, these fresh people into our organization, but we also want to equip our existing team. So we've rolled out 170,000 hours of AI education last year. We're doing a full week of training for what we call AI pioneers to be able to get people to be super proficient so they can build agents, use our platform across the company, Eliza. That's the future for us.
We'll be joining the class. Robert, it's good to see you. Appreciate it. Thank you. Robin Vince there, the BNY CEO. Equity futures this morning, slightly softer. Up next, we'll catch up with Katie Kaminsky of Alpha Simplex, Sucharita Kodali of Forrester, Matt Lazzetti of Deutsche Bank, Matt Stuckey of Northwestern Mutual Wealth Management. Inflation data 34 minutes away.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time
We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly. Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersachi in Al Ula, Saudi Arabia, and this is Bloomberg.
This cycle has been very much infrastructure CapEx driven.
I do think you favor tech here.
We're bullish on the S&P, but we're probably even more bullish on this rally broadening out.
The basic thrust of the market is to go higher.
Missing out on the upside is like participating in the downside.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Pulling back, we've gone 5 days without losses. We're looking like we might not be able to stretch that to day 6, at the moment at least. We're down by 0.25% on the S&P. On the Nasdaq, we're down by 0.4. In the bond market, setting the tone for some of these moves. This move right here, up 3 basis points at the front end of the curve, 4.06%. Crude pushing yields higher. WTI and Brent crude up by close to 3%. Let's call it 97. And setting the tone for the rest of the trading day might be this, another read on inflation at 8:30 Eastern Time.
It's expected to come in hotter than the previous read at 3.3%, well above that 2% level that is the bogey for the Federal Reserve. Remember, this is the key inflation metric that the Federal Reserve tends to look at for now. That could change going forward. At the same time, it's sort of underscored by some of the earnings that we've gotten from retailers that continue to show that despite some of the higher prices consumers are spending, even Dollar Tree, which has dollar in its name, it means it has a higher price point and it is seeing people still come through their doors. So this gives you a sense of how there is a stickier inflation even amid some pushback at the lower end.
This print's going to be really important. It's going to be the start of the journey, really, for the Federal Reserve, potentially, possibly, most likely, at minimum, to remove the easing bias when it comes to how they're feeling, especially after what we've heard from all the Fed officials, that the balance of risk now is to both, and they do see this concern when it comes to inflation.
$2 tree doesn't quite work, does it? Doesn't quite have the same.
$2.99 tree.
$2.99. treat.
$15 treat.
Your point on the easing bias, by the way, and if you're just joining us, welcome to the program. I think Lisa made the point of the morning. Think about all the Fed speak you've heard in the last few weeks. Can you pick one person that supported the easing bias of the Federal Reserve? Which is curious because the data hasn't changed in between that meeting and where we are today. We haven't seen anything that would change anything at all. So what did they discuss at that meeting that kept that bias in that statement?
So there are a couple of potential options. Number one, they wanted to give Kevin Warsh a clean slate, as you've been mentioning. Number two, they want to jawbone the market into a more hawkish position to do the work for them so that they don't have to consider hiking rates. But they are getting on board with the idea of potentially removing the easing bias, but they still are all biased to restrictive policy that they are going to have to cut going forward. And then there's a third point, which is maybe we don't really have a clear understanding of what's going on the FOMC. Maybe there is something to be said for forward guidance sort of losing its clout. I mean, was Governor Myron really that convincing that he single-handedly kept that easing bias in the statement?
There seemed to be some separation, some daylight, if you will, between the minutes and what was articulated in them compared to what the chairman was doing at the news conference. There was daylight there. And there's massive daylight between the so-called consensus the chairman was meant to reflect in the news conference and the subsequent Fed speak we've heard from basically everyone on the committee.
Look, this market is used to being manipulated. It's used to being jawboned. It clearly views this as a whole host of jawboning, and yet the market has actually moved ahead of the Federal Reserve. And this is interesting to me, that in some ways these Fed officials are coming around to the view that the market is putting out there. Whether or not they would actually come to a hiking bias, another story. Okay, the easing bias is going to be removed in June. I think that we probably can say that with some degree of certainty. Going forward, this is the debate in markets. How reluctant or not is this Fed to actually execute a rate hike? How high is the bar in terms of how the data has to come in for them to actually tighten policy? That, I think, is increasingly the debate and is getting priced in the bond market.
Inflation closer to 4 than 3 is deeply uncomfortable for this committee. Coming up this hour, we'll catch up with Katie Kaminsky of Alpha Simplex as the equity rally stalls following fresh strikes. Matt Lazzetti of Deutsche Bank reacting to breaking inflation data, and Matt Stuckey of Northwestern Mutual on why he's underweight US large caps. That conversation later this morning. We begin this hour with stocks edging lower as investors grow cautious over an end to the war. Katie Kaminsky of Alpha Simplex writing, despite the recent rally in equity markets, there is clear fatigue over the continued conflict in the Middle East. Katie joins us now for more. Katie, welcome to the program. Let's just dissect the bond market sell-off, the individual drivers of it. What's been driving yields higher?
Well, this is a good question because what we have really seen, and I want to point this out, and I really liked what Lisa said, is that you've seen the bond market get ahead. So the bond market has been selling off pretty aggressively since the geopolitical risk sort of got into the markets. We have seen some retracement more recently in terms of yields coming back down. So people thinking that some of this inflation uncertainty is going away, but today just sort of reiterates that it's not gone yet. So we're kind of seeing that come back again today. So you can see that right in the chart that, yields have gone up substantially on inflation concerns, but that hasn't dissipated yet.
Do you think we're overestimating the potential for yields to fall on a resolution in Iran? Is there more to this move up than just the Middle East?
That's a good question. I think the positioning of the Fed relative to other central banks is also important. So if you look at where the U.S. is sitting and how much higher U.S. rates are, that matters. But also the fact that other markets outside the United States is pricing in things like hikes, that does complicate sort of the relative positioning of the U.S. Fed and sort of add on top of that sort of a changing Fed dynamic. So I do think it's not just inflation, it's also figuring out how monetary policy is going to be set in a new FOMC.
This is a great point, Katie. How much does the move that we're seeing in bonds in the United States have more to do with Japan and Europe, frankly, than it does the United States?
I think there's a mix. I mean, just given how much bond moves have priced out cuts and move towards a higher chance of hikes. If you look outside the U.S., for example, the ECB or Japan, even also Australia, you start to see a much bigger shift globally towards a potential for hikes. And that means that overall, across all regions, that there's more of a chance of hikes, which could put pressure on the Fed. But remember, U.S. rates are higher, so that means that we have less need to move as quickly as other regions.
You follow trends and you follow some of the momentum that we're seeing in different technical readings across the market. And I wonder how much we've seen a breakdown between yields going up and stocks responding in any way, shape, or form. I mean, how divorced is this relative to history when the common mantra was when yields went up, stocks went down, risk assets used to wobble, especially if it was coming with some mixed readings on the consumer appetite?
So I love that you asked this question because we look at short-term correlations between stocks and bonds. And whenever inflation is the key driver of stock bond movements, you tend to see positive co-movement or positive correlation. And we have seen consistent positive correlation between stocks and bonds since March. It is not unprecedented. We've been seeing that since particularly 2022. And it's just a point that stocks and bonds, or bonds basically, do not provide a hedge during periods when inflation is a persistent risk. And geopolitical risk is a key driver of inflation uncertainty. So I think for now, bonds are going to be much trickier for investors to deal with. And until we see this inflation pulse go through and we figure out how much higher oil prices changes the inflation dynamic, you can't count on bonds when things are tough.
At some point, though, will what's going on in the conflict and the inflation driver start to hit equities at all?
It should at some point, because how I see geopolitical risk is that it initially becomes an inflation impulse, which is a stressor to bonds. But at the point where we start to see that we need to have tightening, we start to see an effect on growth, that's when you start to see that the equity markets will react. We have seen the equity markets react to higher yields this month, so that might be an indication that there is starting to be some concern about higher yields actually being a negative driver for equities
As
going forward.
Lisa and John have been talking about all morning, likely we're going to see the Fed remove the easing bias. Would that be something that could be a catalyst for this equity market, maybe to be softer, or is it already baked in?
I mean, I think I would kind of assume that it's somewhat baked in at this point. I do think it is very interesting that they haven't removed it, just given where we are in the current geopolitical landscape. I mean, just the idea that you could cut rates in a period where you have a huge oil spike, it just kind of already puts the Fed in a neutral stance already. So I think some of it is already baked in, but there's always room for surprise where you could actually see that maybe this conflict accelerates more, or you have sort of more of a chance that that could be even less of a case that, you are going to have a resolution. That could be more negative for bonds.
Kelly, it's good to see you. Kelly Kaminsky there of Alpha Simplex. It's such a different conversation speaking to someone in fixed income or commodities at the moment. Then you speak to the equity guys, upgrading their outlook for stocks left, right, and centre. Last week it was CIBC and Chris Harvey. He went to 8K plus. This week it was Ben Snyder over at Goldman Sachs going to 8K. You see Jamie Dimon yesterday of JP Morgan. Check this out for a quote. It's gung-ho, folks. Companies are busy. There's a lot of exuberance out there. That describes this moment for many of the largest companies in corporate America.
He even went on to say that they're over-earning, which created a little bit of a stir in terms of its share price. The bonuses that some of the traders are getting are sky high because the performance has been there. This is actually a frothy market, is what you hear from a lot of banking executives when you speak to them, despite where interest rates are. So regardless of potentially underneath the hood of the averages, there is a question here about restrictiveness. Can you arguably say that this Fed funds rate is restrictive if you see frothy market conditions with a prolonged pace of rates at this level? And that is the reason why the bond market has moved ahead of the Fed commentary.
Bill Dudley's words. Imagine if he was still at the New York Fed, former New York Fed president, quote, "It isn't credible to judge monetary policy as restrictive." Bill Dudley, imagine if Williams was saying that right now at the New York Fed, the kind of impact that would have.
That would definitely cause some ripples, some yippiness at the front end of the yield curve that already is starting to get a little bit yippy. Longer term, we have to look at all of these dynamics. There is a breakdown, though, in terms of the efficacy of Fed funds policy right now at a time when there is a interest rate agnostic borrowing base, which is all of the hyperscalers that have an existential need to build out and to borrow trillions of dollars. And that is what people are struggling with, reconciling the many different pockets of economies that there are around the country.
That's why there's a bull parade in the equity market. Equity futures right now just about negative by 0.2%, pulling back from all-time highs. With an update on stories worldwide with your Bloomberg Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. U.S. officials saying Iran violated its ceasefire agreement with the United States. In a post on X, Central Command calling Iran's launch of a ballistic missile toward Kuwait a, quote, egregious violation. American Airlines CEO Robert Isom says travel demand was tremendous in the first quarter. Speaking with Lisa, Isom saying both business and leisure travel has improved despite the headwinds in the global economy.
Year-over-year revenue improved 10-11%, and we're forecasting revenue to improve 15%, year-over-year. In a year where price of fuel has spiked $4 or $5 billion, we're still projecting the same type of profitability that we had last year. That means good things.
Isom going on to say American intends to grow its premium seating at twice the rate of its main cabin seating. Perella Weinberg is cutting almost 10% of its workforce, including a dozen partners. Sources telling us here at Bloomberg the dismissals will be concentrated in industry subsectors that have lagged the broader market. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 13 minutes' time. Up next, we'll get you some morning calls. Plus, Sucharita Gadali at Forrester on an impressive set of results from some of the retailers out there this morning. Best Buy up about 10% in the pre-market earlier on. We'll have more on that in just a moment.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
I'm an AI optimist. I think this is a revolutionary technology that for sure has to be well managed, it has to be put in well. That's the way that we see AI. We see it as a superpower that will help us to be able to run the company better, improve our products, and ultimately be able to just do new things as well. It's a capacity creator.
That was the BNY CEO, Robin Vince. Great to catch up with Robin just moments ago. Check out the full interview on Bloomberg.com and, of course, on the Bloomberg terminal. If you're just joining us, welcome to the program. In about 15 minutes' time, inflation in America, expectations for PCE to jump to 3.8% in the month of April, a full percentage point above where it was in February. And as we mentioned a little bit earlier, the biggest two-month acceleration since 2021. The Fed feeling a little bit offside right now, going into that June meeting. Equity futures pulling back by 0.2% on the S&P 500, on the Nasdaq down by 0.3. In the bond market, treasuries, 2s, 10s, 30s, looking like this morning. Two-year yields in America climbing higher for 5 consecutive weeks. Can we avoid week 6? We're up this morning by 3 basis points, 4.06%. Encouraged by this move in crude, high by 2 to 3% throughout much of this morning. Brent at 96.60, WTI at 91. That's the price section. Let's get you some morning calls. First up, Barclays cutting its price target on Salesforce, keeping an overweight rating, citing relatively small quarterly revenue in the overall context. Your second call from JP Morgan, lifting its price target on Marvell to 240. The analyst highlighting growth across all key product lines. That stock is up by 1.4%. And finally, Wells Fargo boosting its price target on Snowflake to 300, saying its growth and outlook surpassed even the high end of buy-side bulls. That stock this morning, check it out, up close to 40%, up 38% in the pre-market. Unreal. Impressive results elsewhere too from the retailers, believe it or not, in a strong sign for the US consumer. More earnings on deck later. Costco and Gap after the closing bell. Bloomberg's Emily Cohn joins us now for more. Emily, welcome to the program. We were looking for some beats, we got some. Just walk us through what Best Buy and others are doing, where they're finding success.
So what we're seeing is that even in the face of economic pressure, consumers are still spending when the price is right. I think it's interesting to look at a store like Dollar Tree. They saw fewer visits, so people are pulling back on how much they go shopping, but then when they go shopping, they're spending more. So they saw their average ticket price was up. Dollar Tree, Best Buy, Kohl's, all did better than expected. So people still are shopping, which is an encouraging sign.
Emily Cohn there with the latest. Emily, thank you. That's an encouraging sign. People are still spending, even though prices are getting much higher.
And the fact that you're seeing stock prices up as much as they are means that people have already been somewhat skeptical, and you have seen these shares really beaten up as a result of that skepticism. The idea that the overall index is doing really well masks a lot of bad breath, a lot of really narrow leadership. And the question that a lot of people have is, are you going to miss out the rally in the other parts of the market as you realize that this strength is further and goes further than just artificial intelligence?
Sucharita Gadali of Forrester has this to say. Consumer spend is high because of gas and fuel prices. The average retailer is challenged getting shoppers to spend. Sucharita joins us now for more. Sucharita, welcome to the program. I asked this question earlier this week. Where's the sweet spot? And what are we learning this morning about where that sweet spot might be?
Well, the statistics that I'm looking at aren't if these companies beat Wall Street. I'm looking if their comp store sales and their overall revenues are up or down. So we can take a look at, for instance, Dollar Tree. Their numbers were actually up from an year-over-year standpoint in the high single digits. That suggests to me that the consumer is really looking for value. On the other hand, Kohl's numbers continue to decline. It exceeded Wall Street expectations, but I would really say, for the purpose of understanding retail, who cares? You know, are your numbers up or down compared to last year? Their numbers are down compared to last year, and that means that the department store sector, particularly in mass, continues to be struggling, and consumers are switching away from some of those discretionary items into essentials that companies like Dollar Tree sell. So I think that's really what's happening in the face of high inflation numbers.
That said, Sucharita, it seems like people's expectations are even lower than the reality. I mean, just based on the earnings response, the share price response to the earnings. What do you make of that? I mean, is all of that weakness that we're seeing in certain segments of the shopping mall area already been beaten up sufficiently that potentially has created value?
Exactly. And I think that that's really the Kohl's story, is that expectations have been so low, sales have been so challenged for so long, that if you are performing at par or you're barely, kind of showing like negative numbers that are not terrible, if it's like you're off by 1% or 1.5%, that's a win. So I think that that's really what we're seeing. It's not really a sign of strength for that particular retailer, but it's all about beating low expectations, a very, very low bar. The overall macro story is that consumers are spending. They are just not spending in these discretionary categories. We still have a K-shaped economy. People are spending on the essentials. And right now, one of those essentials is fuel and gas. And those prices are out of control, candidly.
So, Sucharita, all this makes sense intellectually, theoretically. And then we get the earnings, which show strength, which show reaffirming full-year forecast, which show that they're basically the same as where they were before we saw oil prices skyrocket. Where's the cognitive dissonance here between what people are telling us, what we see with our own eyes with costs, and the results that we're getting, where margins are expanding, and even places that cater to the lower end of the K, like Dollar Tree, are beating expectations?
Well, in the case of companies like Dollar Tree, the beating expectations is both a combination of the consumer in the bottom of the K switching their dollar share to that merchant, in addition to the fact that they're riding the wave of inflation too and able to charge higher for a lot of these essentials, even though the average ticket or the average transaction volume may be a little bit lower. So I think that's really what we have going on. And again, you know, kind of it is those essential items where we've been seeing higher prices for a number of years. And this is part of the reason that consumer confidence is as low as it is, and why shoppers are so frustrated, is because those essential goods are not, they're not where we're exhibiting value. So I think that's really what is happening. But again, it is more because the consumer is being forced to purchase these essential goods for a higher price. It's certainly not that they are leaning into discretionary items. We're not seeing strength that is outpacing any other category in sectors like apparel, for instance, or footwear.
Do you see any evidence that the higher income consumer is starting to face some cracks?
Not yet. There is, when we look at the higher income consumer, a significant part of their net worth is going to be in investments like real estate or in the stock market. And those asset classes still continue to do incredibly well for higher income consumers. And in terms of their spend level, a lot, they're even trading down. That's the only crack that we're seeing. But so they're able to bolster some of the sales at companies that are value merchants like a Walmart or a Costco. The only other place where we may see a crack is in luxury retail. Very, very high-end brands like LVMH or an Hermes. They may be not doing as strongly as they have in the past, but that's not driven by U.S. retail consumers. That's more because the Asian consumer is more distressed.
And some problems in the Middle East as well. Does not help. Sucharita, thank you. Sucharita Katali there of Forrester. Check out Best Buy, up by 7%. This is what people want. My experience at Best Buy. Bought a TV. Really tight logistics, very fast delivery, perfect, seamless. That's exactly what you want. That was my experience with that company more recently.
Well, try buying a Nintendo Switch too, because evidently that's what people are doing. They're going there and they're saying, we need to play video games. And so, John, when you start playing video games, you'll fully understand the draw to Best Buy, the excitement in seeing it in real action.
That's not going to happen.
You're not a gamer.
I'm not a gamer.
Maybe not. FIFA, though. I could see you getting into...
I used to do that when I was a kid.
Yeah, that's cool.
But not a kid anymore. Futures this morning, down by 0.2, harsh, too harsh. Down by 0.2% on the S&P. I'm not judging, I'm not. Might be, no, I'm not.
About to say, right.
Inflation data 5 minutes away, let's move on. PCE in focus, the Fed's preferred read. The Fed's gauge right now could be closer to 4% in about 5 minutes' time, closer to 4 than 3, and getting further and further away from 2. And they've missed 2 for much of the last 5 years. And now they seem to be waking up to the idea that that might be a problem. Matt Lazzetti at Deutsche Bank joins us next to react. From New York City this morning, good morning to you all. Equity futures on the S&P 500, negative by 0.2%. Yields just a little bit higher at the front end of the curve, up by 3 basis points. And crude fuel in the move. Brent and WTI higher by more than 2%.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Days, no losses on the S&P 500. Equities pulling back just a bit this morning, though. We'll see if this move sticks. We'll see if it holds. We're down by 0.2% going into PCE data in just a moment. On the Nasdaq, we're down by 0.3. In the bond market, yields are higher across the curve, particularly at the front end, higher by 3 basis points to 4.06%, with crude elevating and fueling this move. We're up by 2 to 3% throughout much of this morning. With your inflation data and more, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Where to begin? Let's do jobless claims because it's not going to really move the markets today. 215,000 up from 210,000, but still showing a stable labor market. Now, as far as inflation, which is the Fed's main concern these days, we're looking at PCE inflation up 0.4%, a tick lower than what had been expected on a year-over-year basis. That still puts us at 3.8%, up from 3.5%. And remember, the headline PCE is the Fed's 2% target. Core PCE up 0.2%, a little bit less also than expected, and that puts us at 3.3%, the expected figure, up from 3.2% in March. So more inflation on a year-over-year basis. Personal income was flat on the month. Personal spending up by 0.5%, which was as expected. That's a little bit down from the 0.9 that we saw back in March. So some movement on the consumer side, a little bit less spending, but still fairly strong with inflation up. Now the biggest question is how much of that spending was because of inflation. The increased spending was because of inflation. We also have durable goods orders out, up 7.9% on a headline basis after an 0.8% gain in the month of March. Now you take out transportation and it falls to 1.1%. So there's a big Boeing effect there. And then capital goods orders, non-defense, ex-air, this is what really matters, down 1.1% after rising 3.9% in March. The expectation was for a 0.4 gain. So some mixed news on consumers and business spending and some, as expected, news on inflation. It's rising still.
Mike McKee, thank you. Just on the margin, not as bad as expected. So equity futures with the smallest of bounces off the low. Equity futures down by close to 0.2%. Yields at the front end of the curve were advancing by close to 3 basis points, now up by around 2 to 4.05%. Much of the move this morning, the epicenter for it out of the commodity market. Brent and WTI still higher by more than 2%. Inflation is elevated, bottom line. And ultimately, for this Federal Reserve, this number's still uncomfortable. Even if you get a small downside surprise on a month-over-month read, this number, year-over-year, still uncomfortable.
Especially because people continue to spend. What I find notable, and you're right, that on the margins, this is a downside surprise, the right kind of downside surprise, but still we're at 3.3% year-over-year. When you take a look at the personal income and the personal spending and the real personal spending, you can see the income is actually slowing down, or actually not growing at all, but spending is increasing, either at pace or above expectations. This suggests is that people are dwindling their savings in a significant way. I just wonder how sustainable this type of trend is if the averages reflect anything real on the underlying.
I think it's the right question. Lisa. Mike, I hope you're standing by still, because I think that's the ultimate question for economists right now. Can the spending keep up with higher prices if you're not seeing it in incomes in this country?
Well, that's the problem, because people tend to spend out of their incomes, out of their paychecks, especially at the lower income levels. The folks who get more money from assets aren't affected, but the personal savings rate dropped significantly to 2.6%. So it does show people were going into their savings to keep up the level of spending. And so that, along with the drop in the overall spending rate, portends maybe a consumer slowdown ahead. People paying more for gasoline, people paying more for food, they may have less for other categories.
Mike McKee, appreciate it, sir. Mike McKee down in Washington, D.C. Matt Lazzetti of Deutsche Bank with us around the table here in New York. Matt, good morning. Good to see you.
Good morning.
What's the first take, the early take for you?
Yeah, you notice the inflation data. I think that we contextualize it within the past several years, and we think about 3.3% as being the highest since 2023. Now, obviously, that's not a good outcome. But I think if you strip out the COVID-driven inflation, this is actually the highest core PC inflation rate since 1992. We are moving in the wrong direction, away from 2%. And our view is that this is not simply about temporary supply-driven factors, tariffs and energy prices, that there is an underlying demand force that is more important. Trend inflation is stuck closer to 3%, and that therefore it is entirely appropriate for Fed officials to be thinking about raising rates.
Thinking or actually raising rates?
So far thinking. Our view is that the Fed is on hold, that they are roughly at neutral. I think you need to have a shift in the narrative from the Fed that needs to take place. They need to downweight the idea that this is about temporary forces. They need to downweight the idea that the labor market is not a source of inflationary pressures, because I agree with that. I think as you look more broadly, the economy is a source of inflationary pressures. The CapEx data that we just got was a little bit softer, but you were looking at very strong AI-driven CapEx growth. When you look at the output gap according to the CBO, it's plus 1.1 percentage point. You would expect that inflation is well above the Fed's target, given that output gap and given that backdrop.
Can the economy remain inflationary if people's incomes are not keeping pace and if they're spending out of savings pools that are dwindling?
Yeah, so I think that's an open question, and the income data this morning was definitely disappointing. I think that you have a consumer backdrop that can weather higher energy prices for a period of time. We have the benefits of the one big beautiful bill from tax cuts. You have a labor market that is producing meaningful income growth. You have 4% nominal income growth year over year. Wealth to income ratios are near record high levels. So I think the aggregate picture can continue to support a consumer that is spending. Obviously, that's not true across the income distribution. You have households at the lower end that are more negatively impacted by gas prices, more negatively impacted by higher interest rates. And so you're still going to have this great dispersion, I think, across consumers.
If the Fed did hike rates, would that slow any of the inflation in the economy that seems to be independent of Fed funds?
Yeah, so I think that's a question that I get asked a lot. In particular, is AI-driven CapEx going to slow simply because the Fed raises rates by 25 or 50 basis points? And the answer is probably no. The other point is that if it is demand-driven, you have to soften or weaken the economy in order to bring inflation back down to 2%. I think there was a period of time where we were all optimistic that the Fed and the economy was going to be saved by supply forces, that the big labor supply boom that we had and productivity growth was going to save the economy and bring inflation down. We are now entering a 6th year of high inflation. My view is that there's not very much evidence that you can get inflation back down to target without demand weakening. The question is, when does the Fed conclude that they are accommodative and they're not restrictive enough in order to get inflation down to 2%?
Do you think it would be appropriate for them to just shift to a 3% goal or a 2% average, say, over 100 years? This idea of, eventually,
they've done that, haven't they?
I mean, essentially,
Isn't that the last 5?
I mean, it's sort of like, transitory. We're all transitory in this stage of the universe. But I'm just wondering, from your perspective, is 3% a more appropriate level at an industrial build-out like the one that we're seeing?
I think it's a reasonable conversation to be having if the Fed was at 2% today. Having missed their target for so long and being worried about inflation expectations and an inflation psychology that is embedding higher inflation, a central bank has to be worried that moving the goalposts when you haven't hit your target, it actually makes it worse.
Matt, get
so
to the
they
headline.
move it to 3, why not 4?
How offside
and I
are
think
they?
people care about that difference.
Let's get to the headline. How offside are they? How much do they need to hike in your mind for next year?
So again, our baseline is that they're on hold here. But we wrote a piece recently with my colleague Matt Raskin. You look across a variety of policy rules, which just guides you about where the Fed probably should be given the current economic backdrop, and they are 50 to 160 basis points above current levels for the Fed funds rate.
So if they start moving, it's not once, it's not 25.
I think that's the other part. I think if the Fed concludes that they are too accommodative, that inflation is embedded in a problem, it'd be very strange for them to conclude that they are precisely off by 25 basis points. I think that they would have to view that a sequence of rate hikes is likely necessary.
So you actually think they do need rate hikes, but you have them on hold. Why? Because of politics won't allow it?
Well, no, I think we are optimistic still, somewhat on the inflation front. I think
you don't sound that optimistic.
I don't sound that optimistic. But I think that there's scope potentially that inflation could come down next year. Shelter inflation is coming off. There are still tariff-driven inflation effects. But in part, what I have to do as well is read the Fed's reaction function. It's not at all about politics. I mean, I think if you were to hear Chair Powell and Governor Waller, which I think were out of politics, there's just an embedded narrative that inflation is not a problem, and they're giving time for inflation to come down. And so I think that's in part, my call is both the economic forecast, but then reading the Fed's reaction function. The Fed's reaction function is not there for hikes yet.
You mentioned the consumer being able to get by with things like the One Big Beautiful Bill. The tax refunds now have been spent many times over, according to people that come on this program. They were used Christmas holidays. They were used electricity at the start of the year. Now they're being used for higher gasoline costs. At some point, are they done? Has the consumer now really just dried up in terms of the extra fiscal power they had?
Yeah, so I think there's the refund part, and then there's the additional tax cuts that everybody is benefiting from this year. And that part, I think, has not been completely dried up. But the longer that this war drags on, the longer that energy prices remain elevated for longer, the more worried you become about that outcome. At the same time, the more we muddle through where energy prices are high enough that they are inflationary, but not high enough to actually significantly damage the consumer and growth outlook, I think that's the most hawkish outcome for the Fed. That's essentially what Governor Waller has talked about, where we're kind of around $100 per barrel on oil. There's second-order effects spilling over into the inflation data. You get worried about inflation expectations moving higher. So for me, that's actually the most hawkish outcome, that we just remain in this muddle-through scenario with energy prices near where they are.
Why do financial conditions never matter when markets are going up? I mean, I ask this because ultimately the one method of transmission that the Fed could execute would be curtailing the party in some of the frothiest of stocks, which is the one bear case that people say, but it's not going to happen because the Fed isn't going to hike rates. At what point are financial conditions driving some of the inflation that we're seeing? Because people feel really wealthy when they take a look at their index funds. If they bought the NASDAQ, if they bought Micron 2 weeks ago, they feel amazing and they're going to go out and buy luxury goods. At what point is that going to become a problem for the Fed?
Look, I think it is already somewhat a problem. If you look at the Fed's own models for FCIs, financial conditions indexes, they suggest that financial conditions are adding a percentage point to growth over the next year, that they're additive of a percentage point. That is nearly as much as they were back in 2022 before the Fed started to raise rates. So if you think about an economy where financial conditions are extraordinarily accommodative, where fiscal policy is accommodative, where you have an AI-driven structural boom happening in CapEx, I think that would make you not all that surprised that inflation is actually well above the Fed's target and looks stickier than anticipated. Yes, oil prices is a drag, but it is offsetting these number of tailwinds that I think are continuing to support growth.
Elisa, you basically communicated the cash carry argument, which I think is probably the right one, that if we dropped the easing bias early enough, that you would have seen a tightening of financial conditions that would have done some of the work for them. Of course, markets have gone in completely the other direction because the idea that they still have an easing bias in the face of what we see right now in the economy, where growth at the average level is pretty decent, and what you see in energy and broader inflation, it's pretty amazing to see.
And the bond market is getting on board with the idea of inflation being a bit stickier. Stock markets are not buying the story that bonds are telling them. They're saying, we don't think that a Warsh Fed is going to hike rates. They might jawbone all they want, but we are not listening. But when you talk to strategists, if they were to hike rates, that would be another story.
Really enjoyed the note this week, by the way. The point you make is the right point. This muddle through that we've been talking about, the idea that things aren't terrible right now with energy, that we're not at 200, we're at 1. So you're at this muddle through where you don't see the demand destruction, but you do see the elevated prices. That's the nightmare for the Fed. The Fed knows what to do with extremes. They don't know what to do with this, and that's why they're in a bit of a bind.
Yeah, a supply-side shock that was actually a shock would actually be much more obvious. This is a supply-side unfortunate reality for the United States. Is absolutely a shock in other places, and that's why you see the Fed not seeing the destruction in terms of demand that they would otherwise see.
What did you say? If you strip out the pandemic, this is the worst inflation number since when?
1992 for core PC inflation.
Oof, wow.
I think that broader context is really important here. Yes, we think about everything within the context of COVID, but COVID was the biggest inflation shock in 40 years. Today's core PC inflation would be the highest since 1992, if not for the COVID-driven inflation shock.
And we've got an easing bias. Amazing. Matt, thank you,
I think
sir.
that'll come out in June.
Thank you. Matt Lazzetti at Deutsche Bank. You're not the only one who expects that change on June 17th. With an update on stories elsewhere this morning, with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, recapping the data we just got then, the PCE, the Fed's preferred inflation gauge, meeting estimates, the index up 3.8% in April, marking the biggest two-month acceleration since 2021. Jobless claims coming in higher than expected at 215,000 for the week ending May 23rd. Apple's overhaul of Siri will be a centerpiece of its next iPhone, iPad and Mac software. Sources telling us here at Bloomberg the update will feature a new interface and chatbot-style app. Siri will have the ability to understand personal data and analyze on-screen content. In sports, the Carolina Hurricanes are one win away from the Stanley Cup final after shutting out Montreal on home ice. The Canes scored 3 goals in the first period, and Frederik Andersen stopped all 18 shots he faced. The series winner will face the Vegas Golden Knights for the Cup. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Matt Stuckey of Northwestern Mutual on why he's underway US large caps with an equity market at all-time highs. That conversation up next.
We are dealing with supply issues, and so therefore fertilizer, the planting season, food security is high up there, but so too is fuel and energy. So yet again, as we had with Ukraine, the energy crisis, the food crisis, the cost of living, and that kind of fiscal space needs to be created for countries that are going to be dealing with a debt crisis. They are still repaying their debts. Inflation will result in interest rates that will put many countries in jeopardy on the debt issue. So we're looking to find solutions here from the IMF, from the World Bank. There have been many offers of the windows and facilities that could be put at the disposal of countries. But I think at this stage we need scale. Many countries are still recovering from the previous shocks, and some of those crises are not over yet.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
The inflation data, I think that we contextualize it within the past several years, and we think about 3.3% as being the highest since 2023. Now, obviously, that's not a good outcome. But I think if you strip out the COVID-driven inflation, this is actually the highest core PC inflation rate since 1992. we are moving in the wrong direction.
Framing matters, and that is deeply uncomfortable framing for this Federal Reserve under Chairman Powell, before we even get to Chairman Walsh. That was Matt Lazzetti of Deutsche Bank. Equity futures this morning recovering off the back of recent economic data. Equity futures down by not even 0.1%. 5 days, no losses. Could become day 6. The Nasdaq down by just 0.06%. In the bond market, yields were higher at the front end of the curve by close to 3 basis points. Now up just by 1. You'll notice the rally building at the long end. Not a big rally, I know, but yields are turning a little bit lower, 10s, 30s. Not a great read for growth. This mix in the data we got 20 minutes ago.
Yet you saw income not keeping pace with the spending that people are executing. You're seeing savings rates coming in. You're seeing spending continue to outpace what people can see from their wage increases. So this leads to this feeling that it's not sustainable, that it can only go so far. And so even though you are seeing resilience among some retailers, people are confident that it's not going to last forever.
Let's talk about some of those single names. Some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with a big mover to the upside, and that is Snowflake. Shares are still up nearly 37% in the pre-market after it raised its full-year outlook and said it signed a massive deal with Amazon Web Services for $6 billion, just helping to ease fears around the software sectors as investors had grown increasingly worried about that disrupting the software industry. Turning to the retailers, where we are also seeing a big upside move there. Wow, Kohl's now up 17.5% after the retailer posted a beat. But to be clear, comparable sales were still down and it still lost money last quarter. But both came in better than fear, showing you just how low the bar is after a brutal sell-off in this name and in the broader consumer discretionary space. And we end on Dollar Tree. Those shares also rising, now up 18% in the pre-market. Wow, I can't believe these moves. After the discount retailer posted a beat and a raise, and the consumer story here is interesting. Fewer people are actually going into the stores, but when they do, they are spending more. John?
Yahara, thank you. You can learn a lot about expectations with a move like that off the back of earnings like those. You learn more about positioning than you did maybe the numbers themselves.
Kohl's sales are still going down. So when you start taking a look at a 17% gain, you start thinking that bar is on the ground.
Let's talk about the mega cap stocks, the large caps in America, an equity market at all-time highs on the S&P 500 coming into today. Matt Stuckey of Northwestern Mutual writing this: we're positive on the immediate term on stronger broadening earnings trends, reinforcing the case for diversification. We aren't abandoning exposure to US large caps, but we are underweight. Matt joins us now for more. Matt, explain yourself. I'll ask politely. Just explain to me, with stocks all-time highs, why you don't like large caps right now.
Well, good morning, Jonathan. I think I would add a comment slightly underweight is probably to better kind of clarify our position. And in aggregate, if we look across different types of equity exposures in our portfolio, we're more neutral in terms of our exposures. We just prefer allocations to things like small caps and mid caps here, where that broadening out is taking place despite higher interest rates this year. You're looking at small caps and mid caps that are still on the leaderboards, above U.S. large caps, and it kind of goes to show that you don't have to just concentrate in U.S. mega cap stocks to earn, attractive returns in the equity markets.
To your point, we have seen that small cap outperformance more recently, Matt. I think last week was another week of just that. If it's not rates fueling it, Matt, what is it?
It's earnings growth, Jonathan. I mean, I think if you look to mid-May till present, we have seen an earnings revision growth story in small cap stocks and mid cap stocks. That's really been absent from 2023 through the second quarter of 2025. But as we started to kind of see some healing in the labor market, as we started to see growth start to spread out across the economy a little bit, as the Fed moved rates down about 175 basis points, that growth has started to spread to things like small caps that are more cyclical. Now, higher interest rates so far this year are a headwind to that. But despite that move from 4% to 4.5% on the 10-year, despite anticipated cuts from the Federal Reserve, now we're in polite company talking about the potential for hikes. Small cap stocks have still led this market this year, and I think that's just a testament to some of the rotation under the surface of the market.
If the Fed were to actually start signaling that they were ready to hike rates, because we are seeing the Matt, how do you frame out higher oil prices, given the fact that you're in much more consumer-exposed areas? I mean, do you see that as a potential problem, or is it a sign of resilience that hasn't been a main topic for a lot of these conversations?
I think it's the latter. It's more of a sign of resilience. It is a risk though that if this were to escalate further from here, if instead of $90 to $100 oil, we're talking about 125 plus, and that persisting throughout the summer, that could be more of a detriment to the consumer. And case in point is going to look at the last 6 months of a proxy of national income, which just jobs added, how many hours people are working, what they're being paid for that work. That's running around just over 4% or so. But if you look at the last 6 months of CPI, that's pushing over 5% on an annualized basis. And so there's some real income compression happening at the consumer level for those that don't have financial assets. So if that were to persist, that would be an incremental downward pressure on the consumer. And so that's definitely a watch point. I think if anything, tighter financial conditions through higher rates, through higher energy prices, to me, it just speaks to maybe a little bit of a narrowness coming into the markets. And we're seeing that under the surface ever since this conflict kicked off at the end of February.
Hey, Matt, it's good to see you. As always, Matt Stuckey there of Northwestern Mutual, and why is underweight the large caps, why the preference is firmly elsewhere at the moment, including small caps, which did pretty nicely last week.
Yeah, underweight, not really underweight, slightly underweight, maybe more sort of neutral. When you take a look at the overall portfolio, it's sort of leaning into some of the more cyclical areas, which is what we're seeing this morning. And it's not because there's such resounding growth there. It's that earnings have beaten there too, amid very low expectations already baked into the price.
Operation Economic Fury. Have you seen this message from the Treasury Secretary, Scott Bessent, just moments ago?
I didn't receive that.
Operation Economic Fury, is this about how they continue to go against the Iranian regime
Correct.
by their new OFAC sanctions
Troops
against
aren't getting
basically
paid.
the tolling booth?
Police aren't reporting for work. Cargo Island shut down. Iranian economy and currency are in free fall. Goes on and on and on.
Well, look, the Iranian economy is not doing well. But the issue is, of course, this is existential for this regime. So they potentially can outlast the domestic pressures that are going to be on this White House.
This market's not paying attention to that this morning,
Nope.
just about unchanged on the S&P 500 going into the opening bell. The cash open just around the corner. Coming up tomorrow, we'll catch up with Max Kettner of HSBC, why Max is still Max, bullish this market. Lindsay Roser of Goldman Sachs, Alex Ullman of Barclays, and don't miss this, the Chevron CEO, Mike Wirth, joining the program tomorrow morning. Looking forward to that. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake. While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Equity indexes at all-time highs and little change 30 minutes ahead of the start of trading. I'm Matt Miller. Danny Berger is at Goldman Sachs's Leveraged Finance and Credit Conference out in California, but she joins us for the rest of this program. Bloomberg Open Interest starts right now. Coming up, markets try to shake off another round of strikes on Iran with no peace deal in sight. A mixed bag for software. Salesforce disappoints while Snowflake absolutely soars on AI momentum, a new deal with Amazon. Plus, investors were bracing for more signs of a K-shaped economy, but this morning's retail earnings are telling a more resilient story. And in terms of the stocks to watch, retail results pointing to healthy consumer spending. You can see Best Buy right now up more than 9% in the pre-market. Kohl's and Dollar Tree both gaining almost 20. So massive, massive gains for some of these retailers. Tech stocks are, for the most part, taking a breather after a face-ripping rally of late. Salesforce gave a tepid outlook that added to stress about the possibility that AI will disrupt the software business. But Snowflake is absolutely surging on a strong outlook and a $6 billion cloud deal with Amazon. You can see the shares in the pre-market up 36%. Let's discuss all of that with Bloomberg Tech co-host Caroline Hyde. And Caroline, to me, the Snowflake story is the most interesting here because rather than concerned that AI will be eating its lunch, it's kind of teaming up.
Yeah, beat and raise is what we're able to get from Sri Ramaswamy, who's going to be joining us a little bit later. What's so interesting, though, is maybe you should never have bet against Snowflake. The CEO of this company used to run a generative AI company. He used to run ads for Google. He understands monetization at its very core. And so he's intertwined AI within Snowflake, having seen his startup Neva being bought by Snowflake. He then rose to be head of AI, then head of the overall business. And they've just been able to get Codex, for example. More and more people are coming to them for coding in the same way that we'd all worried that everyone would be relying on LLMs, whether it be OpenAI's Codex, whether it be going to Anthropic. But no, here is a company that's able to say, your data is paramount. I'm able to help you use the software to be able to navigate that data, and then in place be able to do coding and sell more than 7,000 subscriptions to that. It's just the ramp at which we're seeing. It's the growth. Whereas when you're looking at a Salesforce, for example, people are still questioning whether there's any organic growth here to be had.
You're so far away.
I know, I feel
Eric,
like I need to come closer.
What is going on here? Tell me about Salesforce, because we were talking about that yesterday. CRM has been kind of a poster child for these concerns. What do we know about the results?
TV magic. We know that they still delivered. Look, we got 11% revenue growth. We're still signaling that it's going to be accelerating organic growth in the second half of the year, but it is still a show-me story. This is still Mark Benioff trying to say record revenue, record cash, record overall growth for the company. But when you're seeing that a lot of the revenue coming in on the growth side is from Informatica, it's from M&A, is it really that they're getting more bums on seats? Is it really that they're able to continue to sell the rest of the business other than Agentforce, which I might say, annual revenue run rate of $1.2 billion is nothing to be sniffed at, but compared to the gargantuan amount of revenue they generally make, it's like 2-3%. People need to see it really accelerating.
All right, look forward to your program. Caroline Hyde co-anchors Bloomberg Tech at 11. I'll slide back over here to seat number 1 and talk retail earnings, because we saw some big gains in terms of stocks today. Best Buy, Kohl's, and Dollar Tree all reporting results that surprised to the upside. Emily Cohn, who leads Bloomberg's consumer coverage, joins us now. I guess we'll start with Best Buy. What did we hear from the retailer that investors like so much?
I think Best Buy had better than expected results. Remember, this quarter, we saw consumers getting their tax refunds back. It was the start of the war in Iran, so prices started going up. But I think what the theme of today seems to be across the board, that consumers are still spending when the price is right and when they see value on shelves or online. Shoppers are still spending. And we saw that with Best Buy, we saw that with Kohl's, and we saw that with Dollar Tree, 3 very different retailers.
Right. Well, although we see inflation numbers we're going to talk about in just a second with Michael McKee in Washington, D.C., continue to accelerate. And to me, when shoppers are going to Kohl's and especially to Dollar Tree, that means they're stepping down and really looking for bargains because they can't afford to go to the higher end stores.
Yep, I think we saw that with Dollar Tree. We saw fewer visits, so people going to stores less, but spending more on each checkout. So that's on account of, you know, maybe people saving up their shopping trips and spending more at each visit. Also, prices going up. Dollar Tree has, you know, more things that cost more than $1 now than they had before. I think one thing that we're looking for any commentary for now is how long can these lower price retailers keep their prices down as fuel prices accelerate? We heard Walmart say last week that if fuel prices stay where they are, we're going to have to raise prices in Q2 and H2. And if even Walmart is saying that, then these smaller chains are going to have to do the same.
All right, Emily, thanks very much. Emily Cohn covers retail for us on the BN side. Inflation pressures, as we've been talking about, continue to build. PCE inflation, now at 3.8%, is a full percentage point higher than it was just in February. And we've seen the biggest 2-month acceleration since 2021. For more, Michael McKee, Bloomberg's international economics and policy correspondent, joins us out of Washington, D.C. Mike?
Well, Matt, I want to start by pointing out the difference that inflation makes. You were just talking with Emily about consumer spending, and personal spending for the month of April was up 1% on a nominal basis. But if you deflate that, the real PCE spend was up just 0.1%. So a big difference in terms of the difference inflation made during the month of April. Now, this wasn't going to affect the first quarter numbers for the rest of the rest of the retailers, but we did see personal consumption slow in the first quarter in the revised GDP numbers, which pushed GDP down from 1.6% to 1.4%. Incomes also flat during the month, not a good look going forward. Durable goods orders were up 7.9% on a headline basis, but that was all Boeing, 165% increase in Boeing sales, and capital goods orders down by 1.1%. That's not good news. Now, on the inflation side, as you mentioned, we do have a tick up in the year-over-year numbers, even though the month-over-month numbers came in a little bit tamer. It just keeps going up. We're at 3.8%, and that's the headline PCE, and headline PCE is what the Fed's target is, that 2% target. So they're almost double that 2% target. And finally, we had jobless claims, and nobody's going to care today because it was 215 up from 210. So, you know, no real change in the labor market. And overnight, we heard from a couple of Fed officials, Lisa Cook and Philip Jefferson, who said inflation is their concern, both saying that they thought that the labor market was stable. Now, Cook said if inflation doesn't start coming down, she'd be willing to look at raising interest rates. So it is starting to become a major issue for the Fed.
All right, very interesting stuff, Mike. And of course, we may hear from the Supreme Court about Lisa Cook as well. We'll watch for those headlines to drop at 10. Micah McKee out in Washington could be rejoining us imminently. Now, Nuveen Chief Investment Officer Sarah Malik does join us now. And Sarah, you've said that you see really three drivers to this market right now. Obviously, the momentum trade and the AI CapEx is the biggest one. But lower 10-year yields, and they continue to come down today. Lower Brent prices, we're still under $100 a barrel, and then hopes for peace in the Middle East. I mean, why does this market continue to have those hopes as we, shoot at each other amidst this strained ceasefire?
Well, markets are balancing three forces right now, and that's, first of all, is that fragile ceasefire. Second is PCE inflation data, and third is very strong earnings. So on the positive side, even today's PCE inflation data, core came in under expectations. Now, a little bit worrying is that the savings rates dropped, and we are concerned that consumers are spending more perhaps than they're saving. But on the other hand, earnings have been very strong, not only for the first quarter, where we're running, in the end, will be above 25% year-over-year earnings growth, but for the full year, we expect over 20% earnings growth. And it's earnings that drive markets higher. Now, on the flip side, the negative is the fragile ceasefire, which is becoming increasingly fragile. The impact there is going to be, will the Strait of Hormuz reopen? And if it doesn't reopen for a long time, that's going to lead to higher oil prices that become chronic and lead to higher structural inflation. But history is on our side. Typically, June and July are strong months for the market, and what we're seeing is markets are starting to broaden just beyond that tech trade. I expect that continue to happen from here.
I mean, yesterday in his press conference, President Trump was comparing the time we've spent in Iran with the time we spent in Vietnam and Korea and World War II. When we start making those kind of comparisons, you can imagine this conflict dragging out. But as long as it remains in a fragile ceasefire and oil holds around $100 a barrel and the 10-year stays at $450, are we still okay with this massive investment in AI?
The ceasefire obviously is becoming very fragile at this point, and we'll see what happens from here. But markets really tend to follow earnings growth, and earnings growth has been very strong this year, driven by that AI and tech trade. And as long as that continues, markets will probably look past the war. And even though the war hasn't ended, markets have decided that it will end at some point, and that earnings will remain resilient. And so as long as we don't see cracks in the economy or inflation really start to spike, which today with PCE data, we did not see a spike in inflation above consensus. And if earnings can remain strong, driven by tech, and if you look at tech, the amount of spending we're spending on AI is actually still less than 1% of U.S. GDP. So we're not in a bubble in terms of technology, and that's the key that we're watching. We're watching for cracks in the economy and whether we're seeing a bubble in technology spending. We don't think we're there yet. Closely watching IPOs, though, and what happens with those and the valuations there. But since the economy remains strong, I think the markets can continue to hold these levels, and that's why you're seeing the markets hit new highs.
We're seeing strategists at banks across the street kind of gather around an 8,000 target for the S&P at year end. Some of that may be driven by euphoria about these massive IPOs. Are you confident or are you optimistic that we continue to climb from here into the end of 2026 as well?
It'll be volatile because of the situation in the Middle East, but I'm optimistic that if this earnings growth holds, which will be driven by technology, we can climb higher from here. We came into this year, we set our price target at the end of 2025 at 7,500 on the S&P 500. We didn't change that when the war started, but now, of course, we're doing the same thing, looking and saying, okay, we crossed that mark. Where can we go from here? I think you can go higher. You can probably go to at least 7,750, because with the 20+% earnings growth we're likely to see this year, you don't need multiple expansion for the markets in order to reach the S&P valuation of around 7,700 or higher. So that's the support for the markets. A lot of volatility there, which we'll see, especially in days like today, where it looks like that ceasefire may not be holding.
All right, Sarah, great to get some time with you. Thanks so much for joining us. Nuveen Chief Investment Officer Sarah Malik talking to us about these markets. Let's get live now to Danny Berger. She's at the Goldman Sachs Leverage Finance and Credit Conference in Dana Point, California. And Danny, what's on deck?
We have a really fantastic lineup here at the Leverage Finance Conference of Goldman Sachs. Look, it's a market where spreads are tight. Maybe, I know it's maybe blasphemy to talk about Jamie Dimon here at the Goldman Conference, but in his words, it is gung-ho, and maybe that's the feeling we're getting here. So we're gonna have a great conversation shortly with Miriam Wheeler, who heads Leverage Finance for Goldman Sachs. We'll also get a view on this markets with Ben Snyder, who recently upgraded his price target to 8,000. David Miracle, the chief U.S. economist, and Anthony Soho, the MoneyGram CEO, on their futures. They face pressure from immigration crackdowns and remittances there. All those conversations to come. You're watching Bloomberg Open Interest.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersachi in El Ula, Saudi Arabia, and this is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Getting out of high interest, look what's making headlines around the world. Both Iran and the U.S. are accusing each other of violating this fragile ceasefire after American forces struck Iranian military targets near the Strait of Hormuz and intercepted drones aimed at a commercial ship. Meanwhile, President Trump vowed the key global shipping lane will be open to everybody, despite the stalled peace talks, and that nobody will be charging tolls there. Caesars Entertainment is being sold to billionaire Tillman Fertitta in a $5.7 billion cash deal. Shareholders get $31 a share. That represents a 49% premium. Fertitta plans to combine Caesars casinos with Golden Nugget and Landry's restaurants, creating one of the nation's biggest gaming and hospitality empires. And Ferrari says critics are wrong about its first EV. The CEO, Benedetto Vigna, says the $640,000 Ferrari Luce is already drawing orders from loyal buyers and new customers as well. Despite backlash over the design, the former Ferrari chairman warned that the EV could destroy a legend, but Ferrari insists electric models remain part of the lineup. The Luce even got the Pope's blessing. I mean, kind of. He didn't really bless it. He got into it, and like stood near it, but I guess that's close enough. His Holiness, you can see here sitting in the first 5-seater that Ferrari has ever made, and Ferrari donated the car's steering wheel to the Pope. Not the whole car, but the steering wheel. Like, what is he gonna do with that? Anyway, let's get to the Goldman Sachs Leveraged Finance and Credit Conference in California, where Danny Berger is with Goldman's Global Head of Leveraged Finance, Miriam Wheeler. Danny?
And we're both laughing about the idea of the Luce steering wheel being donated to the Pope. I won't let that derail us, Miriam. Thank you so much for joining. Really great to see you.
Thank you for having me.
And thank you for having us at your conference. And look, it comes at such a fascinating time for this market, for this bond market. We were talking before, and you pointed out that a quarter of issuance right now is coming from AI, mostly to fund data centers. Is this just an initial first wave as we try to catch up with the compute necessity, or is this just the dominant theme from here on out?
You know, I think the #1 theme that our investors are focused on right now is hard assets and the infrastructure build out. If you think about AI and the CapEx associated, we really think that this is just a generational opportunity. You look at the US, we think you're going to need double as much power for data centers over the next couple of years. And the hyperscalers have said that they're going to spend $600 billion this year alone on AI CapEx. And so what we're seeing is that there's just a really big opportunity to finance this CapEx across all the markets that we touch: investment grade, bank market, high yield, and structured products. But in the high yield market specifically, as you mentioned, it really has been the dominant theme this year. 20-odd% of issuance, and we think that's going to continue. It's data centers, it's chip finance now, and it's power too, but that's absolutely what our investors want to focus on right now.
And I know you have a panel on this later, so I would love a little preview, because it's an interesting conundrum to say, yes, this is hot. We need this stuff. But what the world looks like in 5 years is so unknown. There are huge tails on both sides of this thing. Either it's a disruptive force that completely reshapes society, or we go too far. How is this market treating those kinds of risks? Are they being priced in yet?
So look, I think there are some natural checks when you think about the amount of development that can happen: land availability, power availability, and then just the long lead time for a number of these items. So that is providing some natural constraints for the market. But what I do think you're going to see, particularly in the leveraged finance market as we get more data, is differentiation based on track record, based on ability to deliver large projects on time and on budget. And if we have more data, we think that the market will start distinguishing more. But I think the backdrop is going to continue to be really strong, because this is a generational opportunity to help with this CapEx build out.
What do you think fuels that differentiation to come into the market? Because at the moment, it just feels like a frenzy, and that investors can't get enough, and they have the money to put towards it.
Yeah, so I think it's nuanced. I think it's lease structure. Do you have termination options if you're late in delivering the space? Who is your tenant? Are they investment grade? Are they non-investment grade? Where is the project located? How long is the lease? So it's very much a project finance type of backdrop.
So we also have had a very healthy issuance, especially this spring. How much of this has just been a backlog versus new robust activity in LBOs and otherwise?
So, you know, Q1 was a big quarter for M&A, but a lot of it was focused on sponsor and strategic activity, more than 25% up in total, but very concentrated there. The sponsor backlog is actually relatively light right now as we look forward, because so many of these transactions have been kind of financed in the IG market rather than the high yield market. So we've actually worked through a lot of the M&A backlog. I think that's positive for technicals as you look forward, given there's not a lot coming outside of AI. But I think longer term, we're optimistic that that sponsor activity returns. A lot of capital on the sidelines. DPI pressure remains front of mind.
But haven't we had that for some time, Miriam?
We have had it for some time.
So what finally brings sponsors back to the table?
You know, maybe it's the AI build out. I think a lot of our sponsors have shifted their focus to these hard assets. We're seeing some activity in healthcare. We're seeing activity in industrials. So I think it's going to be in this hard asset sector and infrastructure build out.
Is there a sort of, I mean, usually it's crowding out when you talk about government spending, but is there any sort of crowding out when it comes to AI? Unless you're spending on hard assets, unless you're coming to the bond market with those types of debt offerings, is there not a lot else that's attractive out there? If you separate some of the AI infrastructure plays, what does the rest of the market look like?
Well, look, I think you're going to see muted activity around software for a period of time. Even if you can distinguish winners and losers, there's probably going to be a large bid ask between buyers and sellers for a period of time there. So I don't think we're going to see activity there. I do think we'll see activity around staples, around healthcare. Europe is getting more active for the first time in a while. So we think we'll be busy, but it's going to be sector specific.
So software still feels toxic. Is there any signs of that changing?
You know, I think the market has stabilized around certain names, so I wouldn't say that it's toxic. I think it's more that you may not see big transaction activity until that gap between buyers and sellers gets closer together.
And spreads remain tight despite all of the volatility, despite inflation figures. I know we're going to talk with your chief economist in a bit. Inflation figures that are the highest annually since 2023. The war in Iran is still going. The Strait of Hormuz is still closed. Credit spreads as tight as they are, is it just because everything is great with AI in the economy, or is there some complacency in this market?
Well, you know, we are seeing bifurcation in the market. So if you look at the total credit spreads, to your point, we have basically retraced what we saw widening in February and March, really back to almost all-time tights on a, you know, going back to 2007 basis. But I think if you look under the hood, the market is differentiating. We're seeing a lot of desire for clean credit stories, and those names have really traded up. But if you look at software and if you look at other sectors that maybe are more sensitive to inflation and some of the effects of the war, I think those names have traded down. So I think the market is doing a good job of differentiating. But to your point, there's not a lot of supply coming. And so when you see a good new money name, people kind of do have to pile in right now.
Is there a scenario where some of those more interest rate sensitive sectors, that it spills over into the wider market? This was said also of software, that maybe it becomes like energy in 2014, that it has a greater impact. Are these things, can they remain isolated, or are there any concerns that it could lead to greater credit market ruptures?
We haven't really seen that so far. So I think if you look at Q1, earnings were pretty strong across the board. I think the economy has been able to absorb a lot of these inflation considerations. That's part of why rates are higher now, because growth has continued to be strong. So I don't think we see anything that's systemic at this point.
All right, Miriam, we're going to have to end it there. Thank you again. We're so excited for
I know you have coming to our conference.
And I know you have Caesars in the middle of their deal, and that deal you were very, very much so part of. So really exciting agenda on deck here at the Goldman Sachs Leverage Finance Conference. And Matt, of course, that was Miriam Wheeler, a partner at Goldman Sachs and the global head of leverage finance at Goldman Sachs.
All right, great to hear from her. We'll try and get her Ferrari Luce steering wheel for joining us. Danny is going to be back in just a moment with more, including Ben Snyder from that conference, the U.S. equity strategist from Goldman Sachs. Let's get a check of what's going on with markets, because we did eke out an all-time high once again yesterday. We were up, I think, just 0.02%, but that was enough to get us to 75.20, which was a new record. And we've been up for 8 weeks in a row. So those who say, like, watch out for volatility, we haven't seen it yet. It's just up, up, and up. Right now, futures are unchanged on the S&P. NASDAQ futures unchanged as well. The 10-year yield, though, coming down just a bit right now to 447, 448. And Brent crude, although it's up $1.83, is still only at $96.12 a barrel. We've got 4 minutes until the opening bell, and we're looking to see if we can get some momentum going, as momentum stocks have been so strong. And we've got some big movers to the upside today. Snowflake gaining more than 35%. Retailers like Dollar Tree up 20%, as well as Kohl's. You've got Best Buy gaining almost 10% in today's market. So some big movers to the upside. We begin the trading day with Goldman Sachs Chief U.S. Equity Strategist Ben Snyder on the other side of this break. This is Open Interest.
as an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller, and we're looking at futures that are very little changed after we eked out a gain yesterday on the S&P in the cash trade. We went from a close of 75.19 on Tuesday to a close of 75.20 on Wednesday. You can see right now we have red arrow there, a green arrow on the NASDAQ. You hear the opening bell. We look down the New York Stock Exchange and see, I believe, Dr. Joseph Schuster. He is the founder of IPOX, or IPOX Schuster, and First Trust Advisors, which I guess puts their ETF out, FPX, is with them there ringing the opening bell. Down at the New York Stock Exchange, you've got a spin-off ringing the opening, the NASDAQ, you've got a spin-off ringing the opening bell. So Octave there, a spin-off from, I want to say a Swiss or Norwegian, Swedish or Finnish, Swedish. There you go. Hexagon, I believe, is the software company from which they are off-spun. Let's take a look at some of the stocks to watch here. We've got, as I said before the break, some big gainers in retail. Best Buy, okay, in the cash trade, not as much as the futures, but it's up 7.5% after earnings surprise to the upside. The same is true of Kohl's, and it's up a whopping 23%. Dollar Tree gaining 13%. So massive, massive gains in some of these retailers, even though we have inflation as measured by the PCE up 3.8% year over year. That's the biggest gain, the biggest two-month gain we've seen since 2021, and over a point higher than we were in just February a few months ago. Tech stocks are taking a little bit of a break after a big rally of late, or some of them, I should say. NVIDIA is only up 0.4%. Salesforce is actually down after disappointing earnings at CRM, down 2.9, almost 3%. But Snowflake is still ripping face today after a deal with Amazon, a $6 billion cloud deal that sort of bolsters their sustainability in a world where people are concerned about AI eating the lunch of software, not at Snowflake. Let's get back to the Goldman Sachs Leveraged Finance and Credit Conference out in California. Danny Berger is there with Goldman's chief U.S. equity strategist, Ben Snyder.
Matt, thank you so much. That's right. I am here with Ben Snyder, who leads equity coverage here for Goldman Sachs. Ben, thank you so much. Thank you for having us. I got to say, I feel like the talk of your town was one was the Ferrari EV, and two was your 8K price target raise. Just what's some of the reaction you've gotten from that since you lifted your price target?
I think generally speaking, people are supportive. They understand the core underlying view, which is the earnings strength. right? We're not calling for an increase in valuation. We're not calling for some strange dynamic. We're really calling for an extension of what we've seen over the last several months, actually over the last couple of years, which is very solid earnings growth, powering the market higher.
How much of that, though, is very concentrated in chip makers, or maybe even in just Micron itself?
It's very concentrated. When we look at our earnings forecast, which is for 24% growth this year for the S&P 500, about half of that is coming from the AI infrastructure stocks. And actually, if you just look at the two largest semiconductor companies, they're about a third of that growth. So you're right, it's very concentrated.
Does that make you nervous, that it's so thinly concentrated, that the pillar is just so clearly on, two companies?
Generally speaking, I would say narrow breadth is one of the yellow flags we're seeing in the market. The hope, of course, of investors is that ultimately this broadens to bigger productivity. But at the moment, it is still pretty narrow.
What does it take for the rest of the market to participate in this? Because you have seen fits and starts. Equal-weighted S&P underperforms. Recently, it's had a bit of a tick-up to catch up with the S&P 500. Is the broadening trade alive? Is it coming? And what does it take for that to happen?
Over the long term, I think it's inevitable as we see those AI gains really spill out into the economy. But again, that's a long-term story. In the short term, I think lower oil prices, some confidence in the geopolitical outlook would allow the rest of the market to participate.
So we can talk about the geopolitics in a moment, but on that kind of future outlook, because you and I were talking about this in the break, who knows what the world is going to look like? Who knows just how disruptive or not this technology is going to be? When you're thinking beyond a year, how do you even understand what multiples to assign to a market that is evolving so quickly?
This is really the key challenge for an equity investor. If you're paying something like 20 times earnings, you're buying a very long stream of future cash flows. And today, given the AI development, it's very hard to know what those cash flows are going to look like in the future. And so what we see is two dynamics. First is valuation multiples have not risen at all over the last couple of years. As I mentioned, it's really earnings doing the driving. And then the second is investors are focusing on the place they have confidence in the earnings, like the semiconductor stocks you mentioned.
Does it also matter that retail participation has been quite large in South Korea with an index that's up 98% year to date, that you see retirees taking out margin loans at a record amount to buy stocks, that here in the US you have things like Robinhood giving people AI agents to trade and allowing them to do it on credit cards? Do you start to get worried when you do have more of that type of retail participation that seems to be driving parts of this market?
One of the things we wrote about in the note is that there are certain conditions that usually mark bull market tops. And one of those is what I called speculative mania. There are a number of ways to track that. And to your point, we can maybe see some hints that that's increasing. But more broadly, I still don't see it in the market.
Are IPOs another sign of a market top?
Generally speaking, one of the signs of speculative mania is a very large increase in IPO volumes. But here I'll make a point. If you look over the last 30 years, the average year has had about 100 IPOs. In 2021, it was about 200. In 1999, it was almost 400. So far this year, we've seen fewer than 50. So for all of the talk of this, still things look pretty solid.
The volume's going to be huge. Not volume, rather, but just the value is going to be huge because you are having things like SpaceX, OpenAI, Anthropic come to the market. Can this market absorb that supply?
You're right. We're forecasting a record year in dollar terms for IPOs, about $160 billion. But here I think the key point is corporate buybacks are going to exceed $1 trillion. So in our view, corporate demand is still easily outweighing supply.
So the IPOs come to market. A lot of the passive funds have them. Is there any sort of weakness that does come, though? It's just there's shifts around to try to allow these stocks into these various passive funds.
It's a major question. In fact, some days investors ask more about IPOs than they do about AI or about geopolitics. But when we look at history, what we see is there have been a number of other very large IPOs, similar in scale to what's on the calendar today when you compare to broad market cap. And none of those derailed the market. As I mentioned earlier, when you look at the math, it just doesn't seem as concerning as many people make it out to be.
Well, we might as well end on geopolitics if that's one of the other big questions you're getting along with IPOs and AI. We saw inflation come in. We're going to talk with David Miracle in just a moment. We saw inflation come in, not as hot as expected, but still on a headline level at 3.8% for PCE. You had yields nearing 4.5%. They back off. Is there a level you have in mind where it does present a risk to equity markets, that the 10-year yield gets to 5, what have you, that maybe markets and equity markets start to pay attention?
One of the relationships we've seen very clearly repeated in the past is when rate volatility jumps, equities struggle. We saw a hint of this maybe a week or two ago. So the typical relationship is a 2 standard deviation move in the 10-year Treasury yield. What does that mean? Today, that means about 50 basis points in a month. So if the 10-year yield starts to get close to that 5% level, yes, I think equities would struggle a little bit.
Ben, I one time had this conversation with a hedge fund manager that was like, all of you on Bloomberg TV are covering markets wrong. The only game in town are pod shops, and it's hedge funds that are essentially just momentum bets, and that's all this market is now because it's dominated by retail and pod shops, and the market is one big momentum bet. When you look at a continued melt up, I know you're positive on earnings, but is there some technical element to that where there are just so many momentum players in this market that it's a hard force to stop?
We looked at the momentum rally. It's been extremely sharp over the last few months, and historically, when you look at other momentum rallies like that, they have been another yellow flag to the long list that we're adding here. But the key differentiator here is that the momentum really has been driven by earnings. If we look at the stocks at the core of that momentum trade, those are also the stocks with the strongest earnings growth and the strongest increase in expectations going forward.
Is this the biggest price target, like 8K? Obviously it is, but with the most yellow flags? Because I feel like you're very bullish, but there's a lot of yellow flags under there, Ben.
It's a good question. We call this a bumpy path higher. This is not a call for people to run out and aggressively be buying tactically, but the core view is if the underlying earnings trend remains intact, the underlying market trend should too.
Ben, thank you so much for joining. Such a pleasure to be out here in this setting. The studio's good, but this might be a little bit better. Matt, with that, I will send it back to you. That's, of course, Ben Snyder.
I'm definitely jealous that you get to be in California, that you get to hang out with Ben Snyder, as well as Miriam, and I'm looking forward to David Miracle as well. Let's get a check on the stock market right now, looking at a little bit of a drop on the S&P 500, but from such incredible heights. Remember that we've been up for 8 weeks in a row, and we're still holding, even with this drop, over 7,500 right now. This is the move screen. I think it's the most dynamic way to look at any index on the Bloomberg terminal. You can see that the breadth here is to the downside, right? We have 153 stocks gaining, 349 are losers today. Importantly, you do have NVIDIA on the plus side of the ledger, so even a 0.7% gain adds 4 points to the index. You've also got Microsoft gaining today, as well as Lilly, AMD, and Oracle. On the downside, you've got Broadcom falling just 2% there, but also taking 4 points off of the index. Amazon, a loser today, as well as Meta, Apple, and Micron, which obviously, you know, Micron's been up like 800% or more year to date. Taking a look at the index divided by industry groups, you can see energy, healthcare, and IT are the only 3 winning groups out of the 11. On the downside, materials leading the way, industrials, consumer discretionary, and real estate, followed by the hyperscalers. Coming up, we head back to Goldman's conference to talk about the consumer resilience that we have kind of seen today with some of these shopping, with some of these retail results. Chief U.S. economist at Goldman Sachs, David Miracle, joins Danny. This is Bloomberg Open Interest.
Is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that.
And the speed of the business has never moved faster.
My career might stop. I'll still be driving something.
Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Time. This is Bloomberg. Time now for our top call. Some of the analyst action in focus this morning. First up, Bank America upgrades the lab testing company Agilent Technologies after a solid earnings beat. The firm points to strong execution and says there are few negatives to slow momentum, and you can see Agilent is up 14% in the early trade. Next up, JP Morgan is upgrading Dick's Sporting Goods following a quarter that topped earnings and sales expectations. The firm points to improved momentum across Dick's core business as well as its Foot Locker operations. Dick's shares up 0.5%. And finally, Wall Street is weighing in on Dollar Tree's upbeat first quarter. Truist calls results better than expected across the board. Meanwhile, Jefferies sees stronger operational discipline after its Family Dollar separation, but stays cautious on traffic and consumer pressure. Nonetheless, Dollar Tree shares up 16%. Now let's get back to the Goldman Sachs Leverage Finance and Credit Conference in California. We can talk about that consumer with Goldman's chief U.S. economist, David Miracle. He joins Danny now. Danny?
Matt, thank you very much. That's right. I am here with David Miracle. David, thank you so much for joining. Great to see you this morning in a timely conversation. So we just got PCE data. Month over month comes in a little bit weaker than expected, but we're still dealing with the highest annual inflation since 2023. What was your just initial reaction on that?
Yeah, that's right. So over the last few months, the headline numbers have started to look very different very quickly, rather than falling as we would have expected at the beginning of the year from the mid-2s down to something like 2%. Now we're in the high 3s, and we think we'll stay there for quite a while. The core numbers, I would say, quite a bit firmer than I think it would have been had it not been for the big spike in oil prices. You're seeing, for example, in categories like airfares, some pass-through from all of that. But so far, the effects of this still look pretty narrow. One way of seeing that is if you look at something like the trimmed measures that take out the more extreme price spikes, those still look reasonably under control. Another interesting aspect of the report is that real income growth is now very low, actually turning negative. And, I think that's something that's going to weigh on consumer spending going forward. Suddenly, people are grappling with this big increase in gasoline costs. You typically see people manage that in the short term by saving a little bit less, but the weakness in income is going to weigh on consumer spending.
Are you surprised we haven't seen that yet? That still this is a consumer that's spending?
Yeah, not so much. I would say you have to be a little bit careful with drawing big inferences from a couple of months of spending data. These numbers can be fairly volatile. A lot of the ups and downs in hindsight turn out to be a little bit misleading. So of course I would put some weight on what we're seeing in the latest monthly data, but I would also put some weight on the question of, well, what ought we to see going forward, given where incomes are, given that the saving rate is already very low. And I do think over the course of the year, we will see not terrible, but softer consumption growth than we would have without the big jump in energy prices.
And so you still in your forecast have a cut for this year, a cut for next year. What do we need to see for that to actually happen? Because at the moment, it's a market that's pricing in a higher likelihood of hikes than a cut.
Yeah, that's right. I think, the first thing, obviously, is the war needs to come to an end, and Fed officials need to feel like this is behind us. I think right now they feel, as many of us do in markets, that we just don't know the full extent of the upside risk to inflation. And as long as that's true, obviously they're going to be thinking more about hikes than about cuts. If we eventually get to that point where this is over, and we start to see the sequential inflation numbers come down, then I think you're going to have a range of views on the FOMC, much as you had a range of views on tariffs. This would look more like a tariff in that it would be a one-time price level increase, but if it's over, then I actually think underlying inflation trends are fairly soft. Some people might be more willing to put some weight on those softer month-to-month numbers. Other people might say, hold on a minute, the year-on-year rate is still too high. And because there's likely to be a range of views, I think a decline in sequential inflation wouldn't be quite enough. You would also need some labor market softening this year. Now, we're still penciling that in. I'm not certain about that, and hard to know the exact timing of when they might be comfortable cutting, but that's what you would need.
Just in the past week, I got to say, we haven't had really a range of views. It's been a lot of Fed officials who have come out and said inflation is a problem, and we're worried about it, despite an FOMC that left an easing bias in their statement. What do you make of that? Has something changed in the intermediary?
I think it's just the passage of time. I think what Chair Powell said at the meeting was very sensible, that this is making a change to the guidance is not something you do every day. You want to know that you're not going to regret it at the very next meeting. And I think it's perfectly reasonable that many of them are now feeling like this has been going on for a few months at this point, and we still don't know the end date. And so taking a more balanced outlook on where rates might be headed, given those additional upside risk to inflation, which no longer look like a brief temporary phenomena, that makes a lot of sense, and I imagine that they'll move in that direction.
Do you think that to any degree, we talked about the market pricing, which again is pricing in at something like 15 basis points worth of hike, so not a full one, but is a market that is almost pressuring Warsh as he comes in, that this is almost a test to him to see how much he can rally the rest of the FOMC to get something closer to what seems to be his easing bias?
I don't think that investors through market pricing are saying that they expect a hike right away. I think people are saying, look, we don't know the scale and the duration of the war and the consequences for inflation. And there is some risk, if this were to drag on long enough, that you might see bigger price spikes beyond just energy prices. If we start running out of things, if energy price spikes push up things like airfares further that are very energy intensive, if they create a little bit of contagion through inflation expectations, which we perhaps saw a hint of in the Michigan numbers, and maybe in those circumstances down the line, a hike might seem more reasonable. So I don't think that there's kind of immediate pressure on the Fed, no.
So David, today's one of the first days in some time that we haven't had a new high in equity markets. It has been record high after record high, really driven by AI. The world has talked ad nauseum about a K-shaped economy, but how much of this American economy is a consumer that's spending because markets are healthy, because investments are doing well? How reliant are we on an equity market that continues to gain?
Sure. I think that the K-shaped theme was a little bit overblown last year, but the kernel of truth in it was exactly what you say, that we have had strong equity market gains. We've not seen house prices do very much. So to the extent that we have a wealth effect contributing to consumption growth, that is a wealth effect coming from stocks, and therefore a wealth effect coming from the top of the income and wealth distribution, because stock market wealth is held much more unequally than, say, housing wealth. Now, I do think there is a tendency to exaggerate a little bit just how critical the wealth effect is to consumption growth. Most consumption growth comes from income growth, from people getting jobs, from real wage increases, and I think last year was no exception. This year, I think the K-shaped theme will make a little bit more sense because the loss of things like Medicaid and food stamps from last year's tax bill will hurt most at the bottom, and the increase in energy costs will also hurt most at the bottom. Whether the top outperforms, I think, very much a function of, do we see the stock market go up further?
Interesting. So K-shape makes more sense this year, but perhaps because the pressure on the bottom more so than the top. David, thank you so much for joining. That was fantastic. Thank you for having us here in this beautiful setting. That, Matt, of course, is David Miracle, the chief U.S. economist at Goldman Sachs.
All right, very cool stuff, very cool conference. So glad you're there. Danny Berger and Goldman Sachs chief U.S. economist David Miracle. We're going to bring you more from that conference throughout the next hour, including an interview with the CEO of MoneyGram, Anthony Suhu, again at the Goldman Sachs conference with Danny out in California. Now, Snowflake is surging on a strong outlook after earnings beat and a $6 billion cloud deal with Amazon. Joining us now to give us some detail and some color on both the earnings and the deal is the CEO of Snowflake, Sridhar Ramaswamy, as well as Bloomberg Tech co-host Caroline Hyde.
Matt, great to be joining you. And Sri, welcome to the network. Sridhar, extraordinary. You've just added $20 billion to your market capitalization. How does that feel? Reflect for a minute.
We had a landmark quarter, Caroline. Strongest sequential dollar growth in company's history. Product revenue up to $1.334 billion, up 34%. Net revenue retention rate, a key metric we watch, up to 126%. But I think the bigger news really was that this is the quarter where we clearly showed that AI is compounding Snowflake's advantage in data. We did this the old-fashioned way by creating amazing products like Snowflake Intelligence, which is our work agent, which doubled its adoption with respect to accounts, and a coding agent, which predicts code, or COCO, which is used by more than 7,000 accounts. Okay? And this is what gives us confidence in the business. That's why we raised the yearly guidance from 27% to 31%. Solid performance, but I think it's much more of what does this mean for our future that we are very happy with.
With product revenues up 34% on the quarter just reported, and your stock is up 35% right now. What exactly are your clients using you for? How is this actually building productivity?
I mean, first of all, it's a whole lot easier to get things done with Snowflake. This is what COCO facilitates. People are literally getting jobs 5 to 10 times faster. Part of many companies and getting them to be more productive is hugely impactful. Our data team, for example, has been able to get through their multi-year backlog in a matter of a small number of quarters. With products like Snowflake Intelligence, the end of your work is at your fingertip. To give you a very concrete example, I was at a conference, didn't know who I was going to be meeting, 30-odd CEOs. In 2 minutes, I knew which of them were customers, how much should prioritize. Of instant access, that's really driving business results. And we have great customers like using these products to great effect.
All right, I'm going to say we're having a slight audio issue. Sridhar, you're breaking up a little bit, and hopefully we can work on that and fix it. But, you know, I was thinking about this story all night long because, you know, for so long the narrative has been AI may disrupt software, and that has now changed with your results, with your Amazon deal, to AI may accelerate software, certainly in the case of Snowflake. What changed this quarter that proves AI is now a revenue tailwind rather than just a product narrative?
Well, first of all, we've been very, very consistent. Data platform, especially one that's based on a consumption for the value that they're getting, is aided by. I think what we also showed decisively this quarter is that ability to harness AI to get more value from Snowflake. People would build dashboards on top of Snowflake. Now with products like Snowflake Intelligence, all of the power of the data and so much more, the applications that you need, is there right within that work agent. It is that combination of both the secular drive that AI is providing for data platforms, plus our ability to harness AI ourselves and drive meaningful token consumption, for example, on.
We are still having that audio issue, so I'm going to ask this question, and maybe your team can just tweak some things your end a little bit quickly, Sridhar. But I'm really interested in the Amazon deal. $6 billion is a lot that you're committing in terms of infrastructure spend. What are you getting in return? How much more efficient is Graviton, is the Amazon chip, to your cost base?
First of all, they're a long-time partner. They are the biggest cloud service provider that we run on top of. We run on top of Azure as well as GCP. The really important thing with Amazon is how we go to our customers together. Both teams are extraordinary value that we deliver for our customers. And with deals like this, we get massive economies of scale that let us pass on some of these savings back to our customers. We announced a huge change in how we price AI that makes AI a lot less expensive for our customers. It's aided by deals like this because of this ability to bulk purchase confidently, which, as I said, in turn, we give to our customers, create amazing products on top that are very cost efficient and so on.
So, what does Amazon get out of this deal with you? I mean, of course, there's a massive headline of a $6 billion number, but how do they work with you and collaborate?
This deal makes us much more effective together. Amazon is interested in solving customer problems, and having a data platform is a key part of solving customer problems. Us being able to go to market together, we work at every level of the hierarchy. Matt and I are, Garmin, the CEO, and I are in constant touch, but so are our teams. It's that ability to collaborate at a deep level to solve complex problems, for example, like metadata migration, that makes us pretty unique. It is truly a better together story.
Better together is kind of the very thesis of why you're at Snowflake. Neeva was the company that you built, a generative AI company that Snowflake bought, and you became head of AI and now CEO. And you've been making other purchases. And I noticed Natoma is one of them. This is about managing data, actions of AI agents. Any more M&A that we should expect, Sri?
We will continue to be very open-minded about M&A. Natoma is a key acquisition because it widens the aperture of what is visible in Snowflake intelligence to all of the data that matters to you, Caroline, everything that you have in your email or perhaps your documents or other applications that you use are now visible to the work agent, which means that you can get much better insight. You can also take actions directly from Snowflake intelligence. We will continue to be very active on this front. Key pieces of technology as well as amazing teams that are going to make us so much better, like Neeva did.
All right, Sri, really appreciate you joining us. Fascinating story. Obviously, the business has accelerated tremendously, and the shares up right now 36%. Snowflake CEO Sridhar Ramaswamy, and thank you very much as well to Bloomberg Tech's Caroline Hyde for bringing us that interview. Definitely do tune into her show at 11 a.m. weekdays. Let's get a check on what's going on in the markets right now. We're just a half hour into.
From ABC News, I'm Sherry Preston. The Federal Reserve's favorite gauge of the economy shows inflation rising at its highest rate in 3 years. ABC's Jim Ryan says that news may quell hopes for an interest rate cut anytime soon.
The price index surged last month at an annual rate of 3.8% from April of last year. Not as bad as economists were expecting, but the highest rate since May of 2023. This first PCE report since Kevin Warsh was sworn in as chair of the Federal Reserve found soaring fuel prices a major driver of inflation.
Oil prices are up again this morning as hostilities flare once again in the Middle East. The U.S. striking Iran and Iran striking Kuwait. ABC's Ian Pannell is in the region with more on the very fragile ceasefire agreement.
The truth is this was the second round of strikes in about 48 hours, certainly second round that we've seen this week. You've also got escalation by Israel north of the border inside Lebanon, where there's supposed to be another ceasefire in place. And that's what everyone's talking about, accusing each other of violations of the ceasefire, and meanwhile, no progress towards this interim agreement.
A federal judge rejecting attempts to block President Trump's executive order restricting mail-in voting, saying such a lawsuit is premature since the restrictions haven't happened yet. In Laos, where 5 villagers have been found alive inside a flooded-out cave, efforts to get them out are taking some time. ABC's Britt Clennett with more on why.
This is a very complex, difficult rescue mission with divers navigating a pitch-black, narrow and partially flooded cave to try and extract those 5 gold miners and search for those 2 others who are still missing.
It's still too dangerous around a chemical tank implosion in Washington state to search for 9 people missing there. They're believed to have died in the blast. Top-ranked tennis player Jannik Sinner loses in the French Open second round amid searing heat that's been blanketing Western Europe. You're listening to ABC News. The Department of Justice launching a criminal investigation into E. Jean Carroll, who sued President Trump in civil court for sexual assault and was awarded a $5 million judgment.
This is yet another person that President Trump has singled out as one of his top political enemies, his top political foes that have demanded that he pay for what they believe are transgressions against them, and that now appear to be in the crosshairs of his Justice Department.
ABC's Alex Mallon. One of the most famous animals at the Bronx Zoo has died.
Happy, the Asian elephant, had been at the Bronx Zoo for nearly 50 years and became world famous in 2005 when researchers discovered she could recognize herself in a mirror, a rare sign of self-awareness seen only in a handful of species. But Happy's life also sparked debate. Animal rights groups fought in court to have her moved to a sanctuary, arguing that elephants don't belong in city zoos. New York's highest court ultimately ruled against that effort. The zoo says Happy was euthanized after her health sharply declined in recent weeks. She was 55. Dave Packer, ABC News, New York.
Brazil is set to join other Latin American countries as its lower house approves a constitutional amendment establishing a 40-hour, 5-day work week. Currently, Brazilians work 5 8-hour days, but then they also work 4 hours on a 6th day. This bill would end that and give them an actual weekend. Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube, streaming live at Bloomberg.com as well. Scarlett Fu, Paul Sweeney, we are here, and this is the Bloomberg Intelligence Program. Coming up, we're going to check in with Ira Jersey. Lots of economic data out there today to chew on. We'll see what this Federal Reserve is going to do moving forward, what's happening in the rates market. We're checking with Ira on that. Caroline Hyde is going to join us as well. She's a B-Tech co-anchor. Always a lot of news out there on the tech front. Snowflake, big jump in the stock here on an AI outlook. So we'll start with that one there. Brian Jacobson, chief economist at Annex Wealth Management, will get his thoughts on these markets, given some of the eco data we had today. And Mike McGlone, Bloomberg Intelligence senior commodity strategist, give us the latest on oil. We got oil a little bit higher here, up a couple of bucks. Or WTI crude oil sitting at $91 a barrel. So we'll break it down with Mr. McGlone. But right now, let's kick this whole thing off with John Tucker.
All right, guys, this flash brought to you by IBKR. With the Fed raise rates by 25 basis points in June 2026. Trade your predictions alongside your stocks and options at ibkr.com/predictions. Last trading day is June 17th. We're data dependent, so let's start with the stuff just out. Sales of new U.S. homes declining for the month of April by more than forecast. Among other things, the builder incentives failed to motivate people to jump in and start buying stuff. Purchases of new single-family homes decreasing 6.2%, so it works out to an annualized rate of 622,000 units for the month of April. Shares of retailers, they are higher this morning amid optimism. Shoppers are still spending, but the data that we had earlier today kind of raises questions of whether that's going to continue. We had the concerns about consumer spending with personal income for the month of April. That turned out to be dead flat. Caesars Entertainment, that's agreed to be bought by Fertitta Entertainment in a $5.7 billion all-cash deal. It stands to form a massive entertainment empire in the U.S. Going to have to pass muster with the regulators. Shares of Caesars right now up 1.4%. Overall, the S&P 500 pretty much dead flat, 75.19 on the index. It's down fractionally. The Dow Jones Industrial Average down 191 points at 50,452. The Nasdaq Composite Index is up just 1 point. The two-year yield up 1 basis point, 4.04%. As we look to oil right now, Brent, the active contract, 2% higher at 96.29. West Texas Intermediate crude, that is up $2.25 a barrel, 90.92. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul. Scarlett, welcome back.
Thank you. The band's back together again.
Yeah, absolutely. Now, you were out on a TV assignment?
Yes, I was in San Francisco taping something for our show, Chief Future Officer, which will be available in September. So we're doing a little bit of work ahead of time.
Oh, very cool. All right, we got Scarlett back. Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As John was just reporting, kind of red and green on the screen here. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Christina Aquino. Christina, what are you looking at today?
All right, Paul, let's take a look at Dollar Tree, one of the green stocks this morning. So ticker DLTR. Those shares extending opening gains now up more than 18%. And that is because we did get their first quarter results, beating estimates there. The company also boosted their full year earnings guidance. Now, analysts from Guggenheim pointing out that it was a low bar for the company to clear when it comes to its comp sales and EPS expectations, but they, of course, easily, quote, cleared that. Bloomberg Intelligence weighing in on these results as well. They do like the expansion of Dollar Tree's multi-price point strategy. They say that that remains a tailwind, but there's a little bit of caution when it comes to declines in store traffic this year versus last year, and that potentially points to some erosion of purchasing power amongst the lower income households that tend to be Dollar Tree's core consumers. I suppose, gains for a Dollar Tree sale situation, not necessarily good news for the economy, maybe a little bit of a mixed bag.
Pretty telling about where people's heads are when it comes to their sense of how much they can really freely spend. Let's stay with the consumer and retail theme and take a look at Best Buy.
Yes, taking a look at Best Buy today. Also, shares in the green, ticker BBY. Those shares are up now more than 14%. Again, first quarter EPS and sales beating estimates. Management also saying that same-store sales have, quote, started strong in May, though they do expect it to moderate because of the scaling of the Nintendo Switch 2 launch. So Bloomberg Intelligence weighing in on these results as well. They are expecting a little bit of a slowdown in same-store sales growth to about 1%. And, the forecast for fiscal second quarter appearing to reflect some tough comparisons versus their metric last year. But ultimately, the beats for the 1Q earnings are an encouraging sign for re-acceleration in the pivotal second half of this year.
What do we got? One more left, Snowflake.
Yeah, let's take a look at Snowflake. That share is roaring today. So ticker SNOW, Snow. Shares are up more than 36%, nearly 37%, Paul, at the moment. And again, another strong set of earnings, right? They have a stronger than expected annual outlook, also signing a $6 billion multi-year agreement to use Amazon's cloud services and chips. So Snowflake saying that product revenue will increase about 31% to $5.84 billion in the fiscal year ending January 2027. That is actually an increase from an outlook that they gave just in February, and also exceeding analyst estimates. Now, that share also getting a boost from a series of price target upgrades. They've been upgraded at Needham, raising it to 300 from 200. TD Cowen also raising their price target to 300 from 255 previously.
All right, Christine, thanks so much. Appreciate that. As always, Christina Aquino, managing editor for Markets Live for Bloomberg News, and giving us the stock movers. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcast, Spotify, or anywhere you listen. A lot going on out there. We had a lot of economic data.
Oh my gosh, if you type EcoGo on your Bloomberg, it just goes on for the entire page. I mean, it's just data point after data point. There's a lot that came out at 8:30. Then we also got new home sales at the top of this hour as well.
Yep. So, there's a lot to go here, but I think the inflation data was kind of the key for a lot of folks here. Ira Jersey joins us, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, I'm looking at the PCE data, the core month-to-month at 0.2. The consensus was 0.3. I don't know. What are you looking at? What is your market looking at here to get a gauge of inflation and economic growth?
Yeah, it took a little while to digest, right? Because like you guys just said, there was so much data that came out simultaneously. So that PCE data obviously is key because it is the number that the Federal Reserve uses to determine whether or not it should be hiking, easing, or doing nothing with interest rates. And a core PCE deflator of 0.2% actually is not terrible, right? That's a little bit above expectations. You annualize that, right? You wind up with around 2.5% PCE deflator, so above their target, but not significantly so. What I really dug into after this report is that 0% growth in personal income, because if incomes are flat, then it's going to be really difficult for there to be real growth with inflation as high as it is. Like even if it is only 3% going forward, that's not very good for the health of the real growth. So I did dig into that, and what I found there was a little bit interesting because wages were still growing a little bit, 0.2%. Again, not terrible growth there for wages, but it was really government transfers that slowed significantly. So those people receiving government transfers are going to find it more difficult to spend money, especially, again, given the increase in inflation and gas prices.
So given the range of data that we got, and here, just to recap again, inflation through PCE, personal income, personal spending, a revision on GDP for the first quarter as well, is the idea of stagflation back on the table?
Yeah, so it's modest, right? We're not talking about stagflation in the 1970s or 80 cents, right? And I think it is a lot different. But if you wind up with 3 or 3.5 or 4% inflation and zero real growth, then you'd have to call that some form of stagflation. And we've had different bouts of that in the past. Even in 2023, we had something similar. Like you could argue that we probably had a mild recession back during that period as well, although it was very short-lived. So yeah, I think there is the real risk of that, right? Because as you're forcing people to buy more, spend more on energy costs, that means that they have less for other things. And if incomes wind up continuing to be flattish, plus or minus, then it's just less money to spend, and that's going to crimp growth, and will have the stag part of that stagflation that certainly seems to be an issue. Now the question then becomes, Scarlett, will the Fed do anything about it, right? Will Kevin Warsh be able to convince other members to lower interest rates because of the slowing real growth, even if you have inflation that's pushing 3% or above 3%?
Yeah, there's a lot of talk right now that because of the energy shock, the window for a rate cut has been shut completely. Would you say that holding rates steady later on this month counts as a win for Kevin Warsh?
Well, certainly if they don't get more hawkish in their language and statement, then yeah, I think that would be a win for Kevin Warsh, right? If they wind up having a somewhat more balanced statement. It's interesting because the last meeting, of course, you had those 3 dissenters saying they wanted to get rid of the easing bias. The easing bias was so minute in that in the statement anyway. When they were talking about additional adjustments will count as, and additional adjustments may not happen is something that they could add to the statement, and that would be very neutral. But if they get more hawkish, then that would be a loss for Kevin Warsh, and I think it's going to be a tightrope that he's going to have to try to convince other members of the FOMC to kind of be balanced and be neutral. And I agree with that concept that that would be a win for him.
All right, Ira, thank you so much. Appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence down there in Princeton. All right, Scarlett, here's an odd headline, but I think we got to run it. U.S., Iran reach deal, but need Trump's final approval. It's according to Axios.
And we are seeing a bit of a reaction in markets. For instance, the S&P 500 and the NASDAQ, you were saying earlier that it was basically flat. They've now come up with gains, 0.3%, 4/10%. These are not sizable gains, but you do see a bit of a knee-jerk reaction. Of course, without any details, what does this mean? Yeah, and without Trump's approval, isn't that the whole thing, the whole kit and caboodle? I mean, if he doesn't want it, it's not happening. Exactly. So I don't know, but Axios is out there, so we'll go with it whenever. So we'll just bring it there. Let me just update, because Axios also says that as part of this potential deal that still needs President Trump's final approval, the U.S. naval blockade would also be lifted. Iran would have to remove the Strait of Hormuz mines within 30 days, and the U.S. officials said that a potential deal would mean no tolls and no harassment. A memorandum of understanding states shipping through the Strait of Hormuz would be unrestricted. That is not the case right now because we know that Iran basically has control over the Strait of Hormuz.
Right. Seeing, not surprisingly, cruise stocks up, Viking up 1.1%, Royal Caribbean up 2.3%. So we bring you the Wall Street angle as well. WTI crude oil was as high as $92.50, now $88.66, pretty much flat on the day. We'll have more coming up. This is Bloomberg Good Morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Yeah, we've been down this road before. Axios, as you guys were telling us earlier, is reporting that the U.S. and Iranian negotiators reached an agreement on a 60-day memorandum of understanding to extend the ceasefire and then launch negotiations on Iran's nuclear program, but President Trump has yet to deliver his final approval. On this report, we have Brent crude oil. It was lower earlier, so it's been all over the map. Right now, it's just slightly higher, just up 6 cents at 94.35. So appearing earlier advances, I'll say. Shares of retailers, including Kohl's, Best Buy, Dollar Tree, all higher this morning. There's optimism that shoppers are still spending. Dollar Tree, in fact, the best performing stock right now in the S&P 500. You have Dollar Tree up 17%, Kohl's up 17.9%, and then Best Buy is up just about 13% right now. Their earnings surprising to the upside. Right now, we have the Dow Jones Industrial Average up 25 points at 50,665. The S&P 500 19 points higher, up 0.25%, 75.39 in the index. And the Nasdaq Composite Index of 58 points. That's a rise of just about 0.2%. Yields lower once again. The 2-year more policy reactive, down 1 basis point at 4.02%. It's hot in Europe.
Yeah,
you're supposed to say, how hot
John?
Is it, John? Top-ranked Yannick Sinner loses in the French Open, the second round, because he was struggling from the heat, like in the 90s there.
Ooh. Well, he's from the mountains, like northeastern Italy, where they
have snow and stuff.
They speak German.
Yeah, it's basically Germany.
Yes.
Tyrolean.
Yes.
Italy.
He didn't learn English. I mean, there's Italians we got at the school.
Yeah, well.
Interesting.
Anyway, that's the update. That's my sports update. We check the markets and
Wait,
sports.
The French Open is on the clay courts? Is that right?
Yeah.
Okay.
Yeah.
So
Yeah.
does that retain more heat? I feel like it would.
I don't know. But they slide around.
Sure, said John.
Well, it's hot no matter what. We check the markets and sports right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, JT, thank you so much. We appreciate that. Scarlett, Phil, and Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. A lot of tech news, as always, and so fortunately we have an expert that can help us out here. Caroline Hyde, B-Tech co-anchor for Bloomberg News, joining us here in our studio. Caroline, let's start with Snowflake. There's a software company that said, we're doing just fine, thank you, and the stock is up like 30% or something crazy.
It is adding $22 billion to its market cap on the day. It is surging 35% because its product revenue is up 34%, and it guided that that's the kind of rate you should be expecting. This growth rate is going to be about 31% for the full year, and it's all about AI being intertwined into this business. They've got Cortex, which is their coding tool, more than 7,000 subscriptions to that already, and it's just adding to the annual revenue run rate where you can see monetization of generative AI. And also, look, they're striking big deals with Amazon, which seems to be a bit of a win-win. Yes, Amazon gets $6 billion of Snowflakes for infrastructure and chips, but Snowflake in return gets more deeply intertwined into Amazon's business model. They can build out to yet more customers, and also they get more efficient, cheaper chips. So the idea is they bring down their own computing costs.
Okay, so that's the kind of news that investors want to see. Marvell is a chip maker, right?
It is.
And the stock is down, but the headlines sound pretty positive.
Yeah, like this is a company that's many had been excited running into, like it was up about 100% so far year to date, and the rally had been extending it overnight. Maybe we pull back a bit today, and maybe there is profit taking, but shares initially post-market had been in the pre-market had been higher as the results of the outlook look pretty good. It's all about, again, AI. It's all about ASICs. It's about custom chips being built. This is about the future of how we're not just NVIDIA as the only key winner. Look, with Amazon striking its deal with Snowflake, it's seeing its Graviton chips being used a little bit more, maybe replacing an Intel. And Bloomberg Intelligence is saying around Marvell that they're raising the fiscal 2027 and 2028 sales outlook by about 5%, 10%. Stronger data center demand is really what's driving this accelerating growth. This is what investors want to see. A re-acceleration of growth, organic acceleration of growth, and that is coming in the back of whether it's AI adoption, whether it's AI infrastructure, no matter how you cut it. But maybe with some of these stocks, they have just run so fast. Remember, like the likes of Snowflake have been pretty beaten up running into these numbers.
It's interesting you mentioned, like with Snowflake, if you put up the numbers, and that's what a lot of, like Anurag Rana was saying, hey, these software companies, they've been beaten up, so the only recourse you have is to put up the numbers. Yeah. Snowflake did. I thought Salesforce did last night as well, but stock's only up like 1%, and their guidance was a little tepid relative to expectations. So maybe they didn't get the convincing job that they needed.
I mean, what more can Mark Benioff say apart from repeating that it was a record quarter and it was record sales and record cash pile? But people really want to see this acceleration of organic growth. Now, we know that Mark Benioff has been very good at acquisitions over the years, and Informatica was helping with this latest quarter, and we saw an addition of revenue there. But how much of this is actually Salesforce's bread and butter, more subscriptions, more bums on seats is kind of the way they're still currently asking for to be paid here. And with Anurag Rana's done such great work from Bloomberg Intelligence side, saying, look, there is still actually, apart from AI, there is a reticence in IT spending right now. We are nervous about the macro. So is Agentforce going to make up for that? The annual revenue run rate there is going to be $1.2 billion. That's nothing to be sniffed at. But in the grander scheme of revenues for CRM, for Salesforce, it's only a few percentage points. We need to see more addition there, I think.
Great context. And Caroline, before we let you go, I understand that you were part of a team that won an Emmy.
We did.
Whoa.
I'm a little tired today because the Emmys, my first time going. And yeah, we won for Primer. We do on Bloomberg Originals. We do a really interesting 20-minute primer on anything to do with technology, really. It was our first series that was up for the award, and then all about magnets and how important geopolitically they are, why China versus US, and these things keep coming back. We've got the latest, we just finished the latest series 2, where it's about nuclear, it's about semiconductors, it's about things that you're hearing about time and time again. How can you get an evergreen, non-hyped view on what this technology really means? Cut through the jargon, and we won an Emmy. I'm so excited.
Oh, where's the trophy? I want to see it.
Well, they're back being etched into. Apparently, they're quite expensive. You get one for free,
kidding.
which Alan Jeffries has got, who's the amazing producer on the show. And apparently, we've got to wait a few weeks for ours.
You have to order the rest.
Got to order the rest.
I see.
I would just walk around with it everywhere I
I've got a lot of photos. I'm gonna throw photos your way.
You can dine out on that one for a while.
Thank you for bringing it up, Scarlett. I feel
Caroline
very
Hyde,
lucky.
Emmy Award winner. She is, of course, our BTech co-host and, just one of our delights here at Bloomberg. Thank you so much.
Thank you. Thanks, Scar.
All right, let's talk about the markets right now because, Paul, we came in and we started the hour basically flat. And now we are looking at gains, at least for the S&P 500 and the NASDAQ. We're also seeing lower yields. So there's buying in U.S. Treasuries, and the 30-year and 20-year now below 5% once again.
Yep, absolutely.
Oil prices are just all over the place.
Yeah. U.S. and Iranian negotiators have reached an agreement on a 60-day memorandum of understanding to extend the ceasefire and launch negotiations on Iran's nuclear program. But it needs President Trump's final approval, so it's not really fully cooked.
It's not a done deal. Market's reacting, so let's get a take here from Brian Jacobson, Chief Economist at Annex Wealth Management, to give us his outlook on what this means. The fact that markets do move on this kind of headline that has not been verified, meaning it has not been confirmed by the White House. It's still very much a TBD situation. What does that say about how investors are kind of held hostage to the geopolitical headlines?
Yeah, I think that's a great way to put it, that investors are held hostage to more of the geopolitics than they are to the fundamentals, it kind of seems like. And we saw this on Monday with some of the market reaction at the open, all the optimism, on Tuesday with the memorandum of understanding, but then President Trump threw some cold water on it. So we'll have to see, is this headline, is it a lot of sizzle, or is there actually some stake here to it? And I think that's really a key question, because that's going to affect everything in terms of the health of the consumer, monetary policy. So we really do have to, I think, I'm hoping it's true, but until we hear it from the big guy, right, you have to take it with a little bit of a grain of salt.
Speaking of fundamentals, we certainly got a lot of economic fundamental data points today. I think a lot of folks were focusing probably initially on inflation data, the PCE. And I don't know, I'm just, as just a layperson, I look at the PCE price index year over year, 3.8%. That's not 2%, and that's higher than last
That's
period.
right. Yeah, there's quite a big delta between the 2% Fed target and where we are right now. But that gap can close. So when we look at the core, right, I think that was 3.3% year over year. Still, that is a wide gap, but it's not as bad as the headline suggests. I think that if, I've looked at the Bloomberg economics research, I think it's top notch, what they have said about the tariff-induced inflation peaking. If we can actually get now the Strait of Hormuz-induced inflation to also peak and roll off, maybe come August or September, we could see that headline number not at 2%, but maybe with a 2 handle on it, something closer to about 2.9. So at least if it's moving in that direction, I think that could really allay a lot of fears about whether or not the Fed is going to end up having to hike despite some of the pressures that consumers are still under.
We also got word that the economy in the first quarter actually grew 1.6% versus the previous estimate of 2%. Is this idea that the economy is just chugging along and doing really well, is there some flaw to that assumption now?
I think that there is. I mean, the economy as a whole is looking okay. It's looking resilient, but there's, I think, definitely pockets of pain. And even digging into the personal consumption expenditure data, right? We also get the personal income data, right? People get the income in order to spend it. If you look at the inflation-adjusted income, excluding transfer payments from the government, so that, in my mind, is a better read about the health of the overall economy, the private sector, the household, that has been shrinking. It's negative this entire year-to-date period. In fact, it peaked back in September. Now, the National Bureau of Economic Research, with their Business Cycle Dating Committee, that's one of the many indicators that they look at, which is real incomes excluding transfer payments. And if that peaked back in September, that doesn't bode well for the economic outlook. Now, thankfully, it does look like perhaps we're getting a good boost from all this capital spending by the hyperscalers and all sorts of other companies that want to take advantage of tax incentives from the One Big Beautiful Bill Act. So perhaps we could have continued consumer pain made up for by corporate boardrooms helping support the economy.
Brian, thanks so much for joining us. Really appreciate getting a few minutes of your time. Brian Jacobson, Chief Economist at Annex Wealth Management, located out there in Brookfield, Wisconsin. And again, just looking at the markets, I think the markets are saying, okay, I see the news report. Thank you, Axios. I'm going to wait. I'm going to wait and see how President Trump reacts to it. And that may be a function of how markets today react to the news. So I'm not sure how that all plays out, but it seems like we've got oil steady. We've got stocks fairly steady. We've got yields in just a little bit. So it seems like pretty calm out there.
And based on Axios's reporting, I mean, if there's some kind of movement, some kind of breakthrough the logjam of the Strait of Hormuz, while that is certainly good news for most economies around the world, how different is it from prior to the start of the Iran war? I mean, there was free transit through that Strait of Hormuz beforehand.
Well, now you're asking some difficult questions.
Right.
Some of the questions that need to be asked. I mean, ex post, ex ante, I don't know. At the end of the day, that'll be something for folks to kind of sort out. But
and for politicians to spin as well.
Yes, exactly. So we'll see how that plays out. But right now, we've got a little bit of good news out there, with some reporting that perhaps there's potentially a memorandum of understanding.
There's no denial from the White House.
No denial. And again, I think where the denial, if there's any commentary, will be on social media, and we'll pay attention to President Trump's social media postings and see how he feels about this. S&P up 16 points. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash brought to you by Chapter. The average couple spends over $300,000 on health care and retirement. Want to know how much of that you could keep? Find out today in 20 minutes with one free call to Chapter. Go to askchapter.org to get started today. Investors taking this news with kind of a grain of salt. The news from Axios that negotiators have reached an agreement on a 60-day memorandum of understanding to extend the ceasefire and launch negotiations on Iran's nuclear program. So we'll see. 6 of the 11 major industry groups in the S&P 500 higher right now, being led by healthcare. S&P 500 21 points higher. That's up 0.3% at 7541. The Dow 50 points lower right now, and the Nasdaq Composite Index up 78 points. That's a rise of 0.3%. We have oil right now. It was lower earlier. Brent, it's now back up 0.5% at 94.77 a barrel. Best performing stock in the S&P 500. That's Dollar Tree. Those shares right now are up close to 18% after they reported better than expected results for the first quarter. Also boosted its adjusted earnings per share guidance for the full year above the consensus estimate. And then the software company that's trying to integrate AI, Snowflake shares, they are up 35%. This is the cloud data software maker reporting first quarter results, beating expectations, also raising the full year forecast. And there's a post-pandemic boom in fragrance in the U.S., like perfume and stuff you spray among men.
Oh, no.
Well, dude, the number of influencers hawking fragrances to men on TikTok increasing 12-fold. Among men, fragrance use is highest in Europe, followed by the U.S. It's been one of the fastest growing categories across the U.S. beauty
I would say in
industry.
this country, way less than 5% of men use cologne.
Does aftershave count as in the same category? Because sometimes there's a set.
No, this is actually the perfumey stuff that you know.
All right, very good. John Tucker, thank you. That's good stuff. Appreciate it. As always, John Tucker with that flash there. We have got Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. Looking at the news here, again, as John Tucker was reporting, Axios is reporting that the U.S. and Iran have agreed to extend a truce pending the backing of President Trump. So let's get the latest on that. Tyler Kendall, she's down in Washington, D.C., Washington White House correspondent. Tyler, we've been down this road before, and it's almost like until we hear from President Trump, thumbs up or thumbs down, it seems like right now we just wait.
Yeah, that's a really good point, Paul. And we also have to hear from the Iranian side, too, that they've agreed to move forward with this diplomatic effort. The Axios reporting does match with what we've been reporting at this point for days, which is that the U.S. is pursuing this phased approach where you would see an extension, 60 days in this case, to the ceasefire that would prioritize reopening the Strait of Hormuz. President Trump yesterday in the cabinet meeting said as much, that would be the first thing and the main thing that has to happen. That would be followed by the U.S. lifting its naval blockade, though this reporting does put a little bit more of a finer point on some of these specifics, including that U.S. officials tell Axios that there will be unrestricted travel through the strait, which means no tolls, no harassment, and that Iran will have to remove all mines within 30 days. Keep in mind, we've actually seen Iran trying to tighten its grip recently, including overnight targeting with a drone some commercial ships in the strait, which then prompted a U.S. military response. The reporting also goes on to say that the memorandum of understanding here will include an Iranian commitment not to pursue a nuclear weapon. I will say that publicly, Iran's negotiating stance has been that they are not pursuing a nuclear weapon, despite Western intelligence assessments that suggest to the contrary. So not totally clear what sort of development there is in regards to that, though this reporting does indicate that the first thing that will be prioritized in the next phase of talks is what happens to that stockpile of highly enriched uranium.
And very quickly, Tyler, before we let you go, what about sanctions relief and the release of frozen Iranian funds? Because that was a big sticking point for the Iranians.
Right, and I actually asked Scarlett yesterday, President Trump, in the cabinet room, where the U.S. stood on this, if the U.S. was considering any sort of sanctions relief when it comes to Iranian crude, for example. And the president told me yesterday that they were not having these conversations, though this reporting does indicate that they will start to have conversations about potential financial relief once this memorandum of understanding is in place, and that this would be part of that 60-day negotiating window to try to get to a longer-term deal. The reporting also adds that maybe we could see something in the realm related to war damages payments, something else that Iran has demanded as part of any deal, saying that they will discuss a mechanism to help Iran start receiving goods as well as humanitarian aid.
Tyler, thank you so much for joining us. Really appreciate it. Tyler Kendall, Washington, D.C. White House correspondent, giving us the latest here on this news between the U.S. And Iran. You look at the markets here. Let's look at the energy markets. WTI crude oil up 40 cents to $89 a barrel. Had been as high as $92.50. So coming down off of this news here. Let's check in with Mike McGlone, senior commodity strategist for Bloomberg Intelligence. Mike, it seems like the oil markets, the commodity markets, even the bond and stock markets, everybody's just saying, all right, thanks for that headline there, Axios. We're going to wait and see what President Trump says next or communicates next. Is that kind of what you're seeing in your markets?
Yeah, absolutely, Paul. Well, crude oil, the front contract stuck between 80 and 100. Getting above 100 is a problem. It means mostly inflation. Republicans get hammered in midterms, and that bond yield stays above 5%. Staying below 80, which I eventually expect is what Mr. Trump needs. It's just a question of how he figures that, how to do that. And we're seeing that nuances now. The key theme is the U.S., the largest producer and net exporter of crude oil, did attack Iran. The strait is closed and prices are higher because of that attack. What's he going to do to fix that? We'll figure that out. So I still tilt over to that December contract. It's like $78 a barrel, and I fully expect it to head towards 50 by midterms. And we're seeing the nuances of how he's going to figure that out. I'm curious of how he does.
Yeah, so are we all. So is the market overall. Let's talk a little bit about Chinese demand for oil and how that factors into the price of Brent in particular, because everyone had said that China would certainly be one of the countries that would suffer the most from the closure of the Strait of Hormuz. But by all indications, it appears that the demand from China is not as high as many people anticipated.
Well, Scarlett, I really appreciate you going there. Our colleague Javier Blas, based in London, one of my favorite strategists and columnists, pointed out the demand from China has been declining. They've been averaging imports around 11 million barrels a day for a number of years. It's been flatlined. It's really dropped recently, partly because they filled up their strategic petroleum reserve last year, and now they're potentially utilizing some of that. But what they're doing is accelerating that process of technology replacing fossil fuels. EVs, renewables, electric cars, and the energy and density of batteries all going straight up, and China's winning there. But for now, they're helping alleviate this issue. It's like they had well planned for this event, and so far it's working out well. But it's the key theme to remember is even with their economy expanding, their crude oil demand actually was flatlining, and now it's declining. That's the problem with crude oil. The U.S. used to be the largest importer. Now it's China, and China's imports have probably declined. So I fully expect that crude oil price to continue to drift lower as we get through this crisis.
Mike, your world of commodities, you cover everything from soybeans to Bitcoin. What are you working on these days? What are the conversations you're having these days?
Well, definitely those two, Paul. First of all, soybeans have pumped up with corn on the back of crude oil, and it's a primary source of biofuel and food, and there's massive supply coming out of Brazil. So unless there's a drought, that price is going to go lower. And Bitcoin, to me, is my best leading indicator for all risk assets. It's down almost 20% on the year. It was up 10% in the beginning of the year. And I think that's an indication of what's going to happen for risk assets. And the stock market follows Bitcoin. That means everything goes lower. But there's a key problem with Bitcoin. It's a way oversupplied entity. There's massive supply of cryptocurrencies. It looked like a pretty good peak. And I think it's still going to head lower. And it could lead the way for post-inflation deflation.
And of course, no conversation with Mike McGlone would be complete without any mention of gold, which is, just kind of been, I wouldn't say struggling, but hasn't done a whole lot, even as the stock market has recovered dramatically since late March.
The fact of gold is right now, I mentioned that long bond yield around 5%. The price of gold, as of now, is about the highest versus a basket of U.S. Treasuries, most notably long bonds, since 1982. So gold just got way too expensive versus that yield going up. People look over and say, yeah, well, forget that rock. Maybe I'll buy U.S. Treasury bonds. So to me, gold put in a high, along with silver this year, that might last for decades. It's probably going to be range bound for 10 years, maybe around 3,500 on the bottom. It could reach a new high, but I think it's stuck in a range for a long time.
All right, Mike, thanks so much for joining us. Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. We'll get to the pork belly discussion next time here. S&P up 19 points, the Dow minus 64, NASDAQ up 72 points. So a lot of mixture out there. WTI crude oil now up $1, $89.70. This is
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. Well, one of the derivative plays of the growth of AI has been who's going to potentially lose in an AI world. And a lot of folks were calling out, earlier this year, software stocks, particularly software as services stocks.
Yep.
Names we've kind of all thought of as kind of Teflon names, like a Salesforce.com. Salesforce reported numbers last night. I don't know, the numbers look really good to me. The stock's up 1%, but they got to convince the street that they can continue to grow in a world of AI. So did they get it done last night? Anurag Rana joins us, technology analyst for Bloomberg Intelligence. Anurag, what did you hear from CRM, Salesforce, from their quarter?
So one of the most important things we learned yesterday was they are actually pivoting very strongly towards AI and, instead of subscription, but usage-based products. And the momentum is high, but what happens is whenever you go through this transition, when you don't grow seats, you will see a little bit of blip in terms of the bookings growth. So organically, if you take out Informatica acquisition, we are still looking at, soft 8, 9, 10% or so booking growth at this point. And I think that's where some of the concerns are. On the positive side, as I said, their usage of token is actually skyrocketed. And the company actually was very confident in calling out a second half rebound in organic sales growth. And I think we're all trying to figure out whether that will happen or not.
Right. And of course, Salesforce's own AI tool is called Agentforce, and that's something that has actually seen revenue pick up over the past couple of months and years. Anurag, you had mentioned the Informatica purchase. Does the advent of AI and the threat of it taking over software companies or taking over the roles of software companies mean that Salesforce needs to do more M&A?
So I think the company like Informatica, which is a company that does software for data management, I think this is where the biggest difference is going to be between consumer AI and enterprise AI, because data is the biggest differentiator for enterprise AI. So all the companies in the world need to figure out what is their data strategy. How are they going to take a look at their internal data, whether that's finance data, customer service data? How are they going to pool all of that together? And then they're going to train that or fine-tune that with a large language model. And that's where Informatica comes in. So to your broader questions, Salesforce should be doing more acquisitions. But frankly speaking, yesterday we saw a massive buyback. And I think that's what I like more at this point, given where the stock is, rather than acquisitions.
Anurag, talk to us about how these software companies typically generate their revenue. I'm particularly interested in the per seat model, how that works and how AI may disrupt that, because that's what I'm understanding is maybe a risk point.
Yeah, that is single biggest important factor right now. In fact, that's the reason we are not so bullish in terms of the organic growth rate of software right now, because the number of seats are not growing. People are not hiring at that same pace they were. In fact, you see layoffs right now. So when you see that, whether you're selling HR software or software to salespeople, you're going to see a decline in that. What Microsoft is basically telling people is it's not going to be just a subscription-based model anymore. It's going to be subscription and a usage-based models, which is just because you have a subscription to Gemini or a Copilot, that doesn't mean you can just burn all the tokens that you want. You will get up till a certain amount tokens to burn. And after that, you're going to be charged or metered for that use. We see that in coding tools right now. We see that with cloud computing services that's on AWS infrastructure. And I think a lot of that model comes to the SaaS model, that instead of just being seat-based, it's going to be either entirely consumption-based or a combination of consumption and subscription.
Is that something that investors have priced in already, Anurag, or is that something they're still working out?
I think one of the negative things about the software industry is that because of that disruption in the model, they will not be as profitable at this point. And that's partially the reason why the valuations are going down. A lot of these companies are making slow pivot to that shift, because on the buyer side, you really don't want to sign up for an unlimited plan without knowing what your token bill will be by the end of the month or the end of the quarter. At the same time, the software company does not want to give up that lucrative, very high margin seat-based business. So I think what we are seeing is a little bit of both. Companies are experimenting with pricing models that are consumption-based. The buyers are doing the same thing. And I think it will take, I think, 2 to 3 years before we finally figure out what combination of seat-based and consumption-based model wins. We think it's going to be more of an enterprise agreement where somebody like a Salesforce or a Microsoft will tell a company, you spend this much money with me every month, and we're going to give you all these products that go with it.
So just looking at Salesforce stock down 32%, I guess the market is in a wait-and-see mode. Is that the way to think about it?
Absolutely. So as I said, management really is saying they're going to see an acceleration in organic growth in second half. In fact, they've made a very big bet on it. They announced a $50 billion buyback, and they just finished a $20+ billion accelerated share repurchase plan. I think it is one of the largest that I have seen out there. So they are very confident in their own ability to improve growth rate, but the market is definitely at a wait-and-see mode at this point.
All right. Very good, Anurag Rana. Thank you so much. Appreciate that. Technology analyst for Bloomberg Intelligence. Boy, that could be a very good buying opportunity. And that's kind of what the company's saying. They're buying back their stock. And so we'll see if they can turn that around or reaccelerate the business. For our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just a moment with red and green on screen. The S&P up 25 points, the Dow down 33 points. But NASDAQ up 110 points. That's 0.4%. Yields coming in just slightly. 10-year yield down about 2 basis points, 4.45%. We're at 4.5% earlier today. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning. This is Bloomberg Intelligence with Paul Sweeney, Scarlett Fu, and Charlie Pellet. We have a market that is moving higher, at least when you look at equities, the S&P and the NASDAQ, both up at the moment. We're going to get into all the details later on, but we're also going to check in on some company news. Jody Laurie, our credit analyst, will talk to us about Caesars agreeing to be taken over by Tillman Fertitta in a $5.7 billion all-cash deal. We'll also get a read-in on HP's latest earnings, ticker HPQ, as well as a look ahead to Dell's latest results with Woo Jin Ho. He is our senior hardware and networking analyst. Sarah Ponzak, she is the senior vice president at UBS Private Wealth Management, will join us to give us her take on the markets as we see oil prices move higher and yields come in. Mary Ross Gilbert, our senior equity analyst covering retail, will talk to us about earnings out of Kohl's and a look ahead to Gap, which will be reporting earnings shortly. First, let's head over to Charlie Pellet for our Bloomberg Business Flash. Hey, Charlie.
Hi, thank you very much, and good morning, good day from New York. We've got the Dow lower, the S&P, NASDAQ. They are both advancing right now. Stocks and bonds rising after a U.S.-Iran deal report. Right to the numbers here, because we got the S&P pushing higher, up 31 right now, up by about 0.4%. Now it's 75.51, on track for a record. Dow lower, little change now, down 5, has been fluctuating. NASDAQ, though, advancing another 144 points, up now by 0.5%. All of this with the Russell 2000 index extending its advance, up now by about 0.2%. The 10-year at 4.45%, the 2-year 4.01%, and look at 30-year, below 5%, 4.98% right now on the 30-year. Spot gold up $21 the ounce to $44.75, up by about 0.5%. West Texas Intermediate crude holding below $90 a barrel at $89.16, up by about 0.5%, while a barrel of Brent, $94.51 right now, up by about 0.2%. So hopes for a diplomatic way out of the war in Iran, sending stocks higher today. As for the overall market backdrop, with these latest headlines, Brian Jacobson is chief economist at Annex Wealth Management, and he was interviewed right here on Bloomberg Intelligence.
So we'll have to see, is this headline, is there actually, is it a lot of sizzle, or is there actually some stake here to it? And I think that's really a key question, because that's going to affect everything in terms of the health of the consumer, monetary policy. So we really do have to, I think, I'm hoping it's true, but until we hear it from the big guy, right, you have to take it with a little bit of a grain of salt.
Brian Jacobson of Annex Wealth interviewed right here on Bloomberg Intelligence. Keep it locked into Bloomberg for any and all developments from the Middle East. Speaking of sizzle, Snowflake shares surging 34.5%. And right now we've got Salesforce, just talking with our Anurag Rana about that stock. Salesforce after earnings up now by 1.2%. Recapping, stocks higher, S&P up by 0.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet. Let's get a check on some stocks on the move this morning. Scarlett Fu with Paul Sweeney, and we're joined right now by our very own Christine Aquino. Christine, what do you have?
All right, Scarlett, I'm going to take a look at airlines, specifically United this morning. So ticker UAL, those shares are extending gains up 1.7%. Of course, we did just get a report from Axios saying that the U.S. and Iran have reached a deal to extend a truce and work toward an agreement to end the war. So it's not a deal to end the war, it's a deal to keep talking, which is still being taken as positive. And so that's contributing to gains for the airline. Of course, we are seeing as well oil pulling back, and that is part of what's boosting the airline stock today. We saw WTI settle below $90 per barrel yesterday for the first time in more than a month. It's still trading below 90 at the moment, though it is up on the day, but we'll see if that holds. Now, separately, we did get news from United, courtesy of their CEO, Scott Kirby, saying that the airline will not participate in industry consolidation anytime soon because it lacks a willing partner for a major deal.
Did I mention that I'm a million miler?
Oh, United.
Several times,
Okay,
yes.
just wanted to make sure. I got them in today.
Paul has status.
He only flies United. He will go out of his way to fly United. But you're based in New Jersey, so it makes sense.
I'm kind
That
of
makes
captive to them. Flying them today, as a matter of fact. Tyson, what's going on there with the chickens? Are they making chickens and cows?
They do, yes. The chickens and the cows, but the chickens are doing better for them than the cows at the moment. But Tyson Foods, ticker TSN, that is on back foot today. Shares down more than 5%. We did get news that the CEO, Donnie King, will step down after 5 years at the helm. And Jeff Schomburger, who's been on the board for a while now, will become president and CEO on the 4th of October. So King has, of course, led a company through some of the worst or the tightest cattle markets in decades. And that has led to losses for Tyson's beef business, as you say, Paul. But chicken has been doing really well for them. So that's been a bright spot that actually has allowed them to raise their full year profit outlook earlier this month. So, you know, people eating more chicken, especially around the Super Bowl, right? Like chicken nuggets, chicken wings.
Yeah, buffalo
I'm
wings.
watching now Dutton Ranch, which is a spin-off from the other one. No, not the lemon. Anyway.
The Kevin Costner.
Yeah.
Oh, Westworld, right?
No.
No.
That was a movie from like 25 years ago.
Oh, wait.
Yosemite.
Okay.
No, not
Thank
Yosemite.
you. Yes.
So anyway, I don't know. Anyway, that's about the ranching business, and that's a tough business. That's what I learned. All right, talk to us about Dell here.
All right, let's take a look at Dell, ticker DELL. Those shares are doing really well today, up 3.7%. And that is because a unit of the company won a $9.7 billion contract to help the U.S. military handle its licenses for Microsoft software related to emails, spreadsheets, other needs. It's kind of boring, but, you know, this is kind of the bread and butter sort of contract that a company like Dell would want, right? Because it's a big win. And, you know, the contract apparently doesn't involve newly appropriated dollars, but instead just consolidates funding from the various offices that previously sought software license agreements. One thing that I found out researching the story, the Pentagon is apparently one of the world's largest employers, more than 2.1 million service members, 811,000 civilian employees.
So that's a pretty big contract then.
Pretty big contract.
All right, Christine, thank you so much. Christine Aquino is our managing editor for our markets blog, MLive Go. So if you want to check out her work and her coworkers' work, just type MLIV Go on your Bloomberg terminal. And for more conversations like this, subscribe to our Stock Movers Reports, where we offer 5-minute audio reports on the biggest winners and losers in the equity market, available on Apple Podcasts, Spotify, or anywhere you listen. All right, it's Thursday, but there's still some M&A deals to talk about. And it's a fairly sizable one, if not one that we had anticipated for a while.
Yeah, and I'm glad we have our next guest because it's all about the debt side of the balance sheet.
All right, let's talk to Jody Laurie. Jody Laurie is one of our credit analysts here, and she covers the travel and leisure sector for us here at Bloomberg Intelligence. And it's about Caesars agreeing to buy, being taken over by Tillman Fertitta. Fertitta Entertainment is paying Caesars shareholders $31 a share in cash. But in order to pay that cash, they're going to have to take out some debt. So, Jody, this is something that, you know, feels like it's a long time coming because Tillman Fertitta has been working on this for a while.
Right. So, Scarlett, I mean, I think, you know, this has been rumored about since actually around the time of the Ides of March. I was super excited that the announcement would happen on the Ides of March, just for all the references with Caesars. Unfortunately, we had to wait another couple months. That said, I think, you know, what's been so compelling about this story, and I think what sort of brings up a lot of uncomfortableness in the bond market, is the history with the name. Now, mind you, the Caesars now is actually Eldorado that bought Caesars out of bankruptcy, and that's not the same Caesars that we're talking about. That was the leverage buyout that went through the restructuring. And even so, I think a lot of bondholders, for good reason, are a little bit uncomfortable by this story in general.
So I've got a net debt to EBITDA, and I went through the Chase Manhattan Bank credit training program way back in the day.
Nice.
So I know how to do this. but I've got EBITDA of only like 3.6. I got north of 6 times on a leverage basis. Jody, people like you guys don't like that.
No, we don't, Paul. And to make matters worse, the big question that we're grappling with is whether or not the change of control provision gets executed. Not to go into too much detail, but to make it as simple as possible. In the course of a transaction, there's some bond terms that allow bondholders to put the bonds back to the company. And so in those instances, you get 101% of par. And that's not potentially happening here. We're not sure at the moment. And what we're seeing, though, is that if you look at the bonds, they're not trading like they would be put back at 101% of par. So every indication we're seeing is that perhaps that's not going to get executed, which means that it's only, about a $6 billion price tag in terms of borrowing, as opposed to an $18 billion price tag in terms of borrowing. So that's a big nut to sort of grapple with, is whether they have to refinance all that almost $12 billion of debt, or if they just have to issue new debt and lever up the balance sheet further, and bondholders are along for the ride.
Okay, so any way you look at it, there's going to be a lot of moving parts here in order to get this deal done. Jody, you mentioned that there's some discomfort here for Caesars bondholders. Is this going to get in the way of there being enough demand? I mean, is this going to affect pricing and the concessions that might need to be made?
I think, Scarlett, it really depends on timing. It depends on the communication. We've been really sort of surprised over and again by the appetite of bondholders and potential creditors out there. Now, will they have to pay up for it? It's very possible. And I think that creates the sort of interesting component too, is that if you're talking about a company that is already having issues from a profitability perspective, cash flow hasn't been where it wants to be. Management was focused up until Icon got involved last year. They were actually focused on deleveraging, but they weren't getting EBITDA up. So they were bringing down debt and they were refinancing debt and they were improving the capital structure, but EBITDA wasn't budging. So now we're in a scenario where we say, okay, we're going to, lever up the company further from a net profit, a cash flow standpoint. What does that necessarily mean if, they're going to be paying up on an interest basis? So it's really a complicated conversation. And I think it's one where nobody's going to be looking at this lighthearted if and when the deal goes through and if and when they do issue debt. I think there's going to be a lot of people culling over many documents to decide if it makes sense for them.
Jody, thank you so much. Appreciate that. And Jody Lurie, Senior Credit Analyst at Bloomberg Intelligence, following the gaming industry amongst others. And again, the very highly leveraged Caesars, perhaps being taken up by Fertitta Entertainment. And then the question is, who's going to manage that balance sheet? That's going to be
will regulators even allow this?
I think they will, because they only own Golden Nugget and they own like Bubblegum Shrimp Company, so they own a bunch of stuff, but they only own Golden Nugget.
And you're saying Golden Nugget doesn't even compare to Caesars?
Well, there's the other publicly traded companies are massive and a much bigger market share, so that's not such a big deal. So it's just a question of can they manage the balance sheet, in my opinion. Let's get back to some tech, because why not? You can't go 15 minutes without talking about technology in this marketplace. Woo Jin Ho joins us here, Bloomberg Intelligence Senior Hardware and Networking Analyst. A lot of his companies reporting. Let's start with HP. What do we hear from them?
Yeah, I think they did a good job, right? Sales and EPS better than expected in the face of a very, very tough environment. And essentially there was a lot of pull forward of demand helping them in the quarter because people were afraid of rising prices. And that is going to hurt in the second half, by the way.
Do people still print stuff up? I mean, I know I do, but I've got some bad habits from
Carol
the 90s.
Massar still has the leading market share to all of Bloomberg, in my opinion.
I don't know. I'm right behind Carol because, when that SpaceX S1 came out, that took up a lot of paper.
I couldn't get it to format, though. So.
Now, they're not printing as much. HP is, finding a tough time. They have the yen headwinds that's dragging some growth. But it is still the profit center. It is about 19% profit operating margin for that business.
Wow.
And it is keeping EPS afloat, at least to the second half of this year.
So what's the call here for HP going forward? If you're long this thing, what are you banking on?
Well, look, there's really not much good going on in HP right now.
Okay.
Right? They're still in a CEO transition period. The last CEO, Enrique Lores, stepped down right before earnings. So they are trying to look for a new CEO. Hopefully they can find somebody who can change the tone and tone of the company over the long term. And then, quite frankly, the memory crisis is really going to put a drag on PC unit shipments for HP. So
how long is this memory chip crisis going to last?
I mean, look, I'm going to drag my guy Jake Silverman here, and he's going to tell me 2028.
Wow.
Ooh.
Okay. We had Jake in here a couple of days ago.
Yeah.
So let's stick with the 90s theme. You got HP, you also have Dell, right? Dell has won an almost $10 billion defense deal to streamline software buys. This is a big boost for the company, isn't it?
Well, I mean, if you look at President Trump's holdings, I think he pretty much said, you got to buy a Dell, right? So Dell is actually in his personal portfolio. And
There you go.
I think that Dell has done a very, very masterful job in trying to position itself in the AI server sales, as well as in trying to...
What is its pitch in the AI world?
Well, it is one of the leading AI server providers in the U.S. as well as globally. They have a guidance about $50 billion in AI server sales for fiscal 27 or calendar 2026. And look, that's the hurdle, right? There's consensus. Some of the analysts out there have a $60 billion bogey for the guidance for this year. So if they can hurdle that, if you look at how the stock has performed, it's over 2.5 times year to date. The rally might continue to go.
Stock all-time high today, up 5%, 155% gain year to date, 182% gain trailing 12 months. So there you go. I mean, who's the big competitor for Dell in their business, or competitors?
There's no one.
What's that?
There's
no one really.
I mean, look. Not to be facetious here, but there are only a handful of companies that have the type of scale that Dell does, right?
Yep.
And that helps in the supply crisis, whether it's on the memory or the component side, and that gives them some even a marginal pricing advantage to take market share. Right now, the one big competitor is probably Lenovo, but that's outside of the U.S.
Right.
On the server side and more on the Asia and Europe.
Which is why when it comes to defense contracts or anything like that, there's only one place to go to, essentially.
On the server side, for PCs, got to get a Dell.
Michael Dell, 7th richest person per the Rich Go Index.
I love looking at that function, Rich Go. Just a snapshot of everything that's happening.
So Dell's after the close today?
After the close.
Oh, okay. So what's the key thing we're all going to be looking for? I'm not going to be looking for, but you will be looking for.
AI servers.
Okay.
As well as PC profitability, PC and server profitability. So AI servers, like I said, $60 billion whisper number bogey that's out there. They guided already to $50 billion. I'm not sure they're going to quite get there, primarily because of the supply constraints. But on the server side, which is highly profitable or better profits, if they can show upside there, that can drive EPS higher.
All right, that stock currently up 5.7%, and as you mentioned, all-time high, right?
Yep.
$322 a share. All right, Woojin, thank you so much. Woojin Ho, he is our senior hardware and networking analyst, usually in Princeton, but joining us in New York for the day.
Somebody's buying him a lunch or a dinner. That's all.
Are you joining them?
No, but that's when I see my Princeton guys up here. I know.
You know something's up. There's a free lunch going on.
Exactly.
All right, we have equities in the green, at least if you're looking at the S&P and the NASDAQ, up by 0.4% and 0.5% respectively. Yields are coming in as well. From New York, this is Bloomberg Intelligence on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P, NASDAQ, they're both at records, and this Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. We have got the Dow Jones Industrial Average trading lower. However, the S&P, NASDAQ, they're both at records. This amid speculation that the U.S. and Iran are close to a diplomatic breakthrough in the war. S&P 500 index on track for its sixth straight day of gains. The S&P now at 75.54, up 33, up by about 0.5%. A retreat for the Dow, down 40 now, drop there of 0.1%, while NASDAQ up 153, higher by about 0.6%. The 10-year 4.46%, with the 2-year 4.02%, the 30-year 4.99%. Spot gold up $17 the ounce to $44.71, up by about 0.4%. And West Texas Intermediate crude up 1.6%, 90.07 a barrel on WTI. Barrel of Brent 95.02, up by about 0.8%. In the gaming industry, Caesars Entertainment has agreed to be bought by Fertitta Entertainment in a $5.7 billion all-cash deal that stands to form a massive entertainment empire in the United States. Tillman Fertitta has pursued a merger of his casino and restaurant business and the Las Vegas company for years. By the way, his empire includes lots of things, including the NBA's Houston Rockets, as well as a large stake in the betting firm DraftKings. Caesars Entertainment shares today, they are trading higher. Little change right now, up by roughly 1%. So again, recapping here, S&P up 33, up by about 0.5%. Scarlett and Paul, it's a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet, with our Bloomberg Business Flash. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We're broadcasting live from our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube and available on Bloomberg.com/video. There was a great article from our Natalia Knežević talking about how the next leg up in U.S. stocks may very well be driven by short covering in defensive sectors, basically the unloved parts of the market, which is anything that's not tech at this point. And she points to how the total bearish positions across North American stocks surged to a new high, $2.13 trillion, and looked at average short interest in S&P 500 stocks as well, being at the highest since late 2011. Let's bring in Sarah Ponczak. She is the Senior Vice President at UBS Private Wealth Management, joining us live from Boca Raton, Florida, and a friend of Bloomberg, having formerly been a reporter for Bloomberg News. Sarah, it is great to see you again. Thanks for joining us.
Thanks so much. Always great to see you guys.
So, Sarah, I wanted to get your thoughts on what Natalia points out, which is this idea that there's a lot of bearish positioning in U.S. stocks. And so if we continue to see positive catalysts for the market, that might drive a short covering rally here in the markets. How durable is something like a short covering rally for U.S. equities?
So just a short covering rally might not necessarily be the most durable, but I think we have to look broader and think about why are we potentially seeing this short covering rally? And largely what it's been driven by is earnings. This rally that we've seen has very much been an earnings driven rally, which therein has probably caused short covering for those on the wrong side of the trade, let's say. So think about it. If we look at the first quarter earnings season, we just witnessed the strongest year-over-year growth in 4 years since we were emerging from COVID, that post-COVID boom. And much of the earnings upgrades that we've seen have also been tied to AI. Artificial intelligence. You were talking about it. It seems like we can't stop talking about AI because it's so important. We're all using it in our day-to-day lives, I'm sure, at this point in time. And we're actually seeing productivity growth. We're seeing it drive revenues, drive earnings. So yes, could short covering be a part of this rally? Absolutely. But when we think about what's truly the underlying driver that we're seeing, it does seem like it's earnings and fundamentals at this point in time.
Sarah, what's the AI call these days from UBS? I guess in the early years, which were maybe 3 years ago, we were just buying kind of chip stocks, and that still works. But I know there's been some winners and some perceived losers out there. How do you guys think about it?
Right. Buying chip stocks does still work. Just look at semiconductor performance this year. It's been off the charts. But looking to the next leg, we also think about looking at data centers. Think about looking at infrastructure plays, power and resources plays that are tied to AI. And something that's actually really interesting, UBS put out a great report just this morning. It's the Global Family Office Report. We put it out every year. We surveyed this year about 307 family offices in more than 30 markets worldwide with an average net worth of $2.7 billion. So we're talking, the wealthiest of the wealthy families across the globe. And what's interesting is that even amongst these family offices, AI is far and away the most dominant theme. So think of it this way, roughly 65% of family offices that were surveyed are already allocated to AI-related investments, infrastructure, power, and resources included, not just chip stocks, but also looking to make further investments in the space. But probably this is a bit of a dichotomy, and we're all thinking of it this way as well, is interestingly, about 75% of those surveyed said that they believe that AI valuations are either definitely or potentially in a bubble. So it's this dichotomy in which we're making investments into artificial intelligence. We all believe and know that there is a long runway ahead of us, but at the same time, there are probably some pockets that are a little bit bubbly or overvalued that we need to be careful of.
So no one should be surprised if there is a pullback here, given what you just told us. Sarah, thank you for sharing the details of that. One thing I've noticed in your notes is that you see the Fed expected to resume rate cuts later on in 2026, which is interesting given that the narrative has really shifted away from loosening of monetary policy towards, at best, neutral, but some people are also talking about the prospect of rate hikes, especially after the latest bout of inflation data we just got this morning. Walk us through why you see rate cuts coming later on this year.
Right. You're absolutely right. I would say a few months ago, most people expected that we would see, interest rates stay the same or move lower. And now we're in a very different world with everything going on in the Middle East and Iran. We see energy prices moving higher. Our economists' view is that the move higher that we've seen in energy prices, which has therein driven the move higher in bond yields as well and interest rates, is largely driven by what's going on in the geopolitical realm. Our expectation is, yes, we're not where we were at the beginning of the year. We have to understand that energy prices are higher and that can flow through to businesses and goods as well. But at the same time, we do still feel that when we look at the inflation picture overall, even though, yes, the last couple of prints have been higher, we still expect a larger, shift lower in prices over time. We expect, economic growth, while it's been extremely resilient, to be a little bit more modest as well. And therein, we expect by the end of the year, it was that our expectation was for rate cuts, probably more so in the third quarter. Now our economists are calling for a cut in December and then maybe again, say in the first quarter or March of next year. So that's getting pushed back, but our expectation is still that a lot of the factors that were in play last year are still very much in play. And yes, what's going on in the Middle East is something that we all need to keep our eyes on. We don't expect that to lead to rate hikes as the market, is really pricing right now down the road.
Sarah, do your clients, to what extent did they call you, reach out to you and say, hey, I think I need to get some exposure to alternative investments, private equity, private credit, maybe hedge funds, things like that? How do you guys deal with that?
So it's a great question. And interestingly enough, I wouldn't say, other than some, UBS has some direct investments that we're able to co-invest into some single name, very popular names that we're all very well of that are still private. Sometimes we get calls surrounding investments and opportunities of that sort. But when it comes to investing in alternatives at large, private equity, private credit, infrastructure, real estate, it's not necessarily the clients asking for it per se. It's more so us educating them on the benefits of having investments like this in portfolios. We all know there's a very big name that's going to IPO at some point soon this year. It's going to become a public company as one of the largest companies in the U.S. economy. So if you think of yourself as an investor, fewer and fewer companies are going public these days or just waiting longer in their lifespan to go public. So if you're not investing in the private markets, what that means is you're really missing out on a huge swath of the U.S. economy that is growing at very strong rates and can also help provide diversification to portfolios, especially when we see, you know, valuations and the type of growth that we've seen in the last couple of years in public markets.
When they do consent to going into alternatives upon UBS's recommendations, for instance, how is that usually expressed? Going into it directly or through something like ETFs, which have tried to package all these alternative investments in more easily digestible wrappers?
Right. So there's a lot of ETF companies. I know you know the ETF world very well, Scarlett, but there's a lot of ETF companies out there that have been trying to give exposure to alternative investments in a more, let's say, transient or transparent, accessible way for retail investors. We still feel like when you look at the returns, it's not quite there. Still might make sense to actually go into a more traditional, you know, private equity fund, private credit fund, private real estate fund. Often the returns are better, and from a risk perspective, the risk-adjusted returns are higher as well. With that said, there's been a huge shift towards what we call perpetual or evergreen funds over the past couple of years, whereas it used to be if you were going to invest in private equity, that's it. You're locked up for 7 to 10 years. You know, you can't see your money. Now there's been this huge growth in this perpetual evergreen space where you can submit to get out on a quarterly basis oftentimes. But I think especially in 2026, many investors have come to learn that there's still private investments at the end of the day. A lot of these funds set gates. They set gates for a reason. And if a lot of people are trying to rush for the exits at once, like we've seen in private credit and some issuers, you might not be able to get out. They're still private investments. You still don't want them to be, you know, your entire portfolio if you need access to liquidity, but they do play a role.
Sarah, you used to, as Scarlett mentioned, used to be an employee here at Bloomberg. How long have you been at UBS?
I've now been at UBS since 2021. It was in the COVID era that I moved amongst many other people.
And what I've noticed is that titles get more and more grand for Sarah. Now she's senior vice president. The offices get bigger and bigger for Sarah. So she
has tracked this carefully.
I'm tracking your career from New York, so we're really happy to see you.
Thank you, Paul. I appreciate it.
Happy to see you doing well. Sarah Ponczak, senior vice president, UBS Private Wealth Management. Full disclosure, I'm a client of UBS. Tony O.C. is my man in town. So good stuff there, but the markets are moving higher. And South Florida, I mean, is there a better place and a better time to be in the financial? Great trade for Sarah. To be in the financial services business. I mean, Florida's always been extremely active financial services. Every company's down there in the
But the pandemic super juiced it.
Yeah, exactly. And now what used to be primarily a retail-driven market, individual investors, consumers. Now it's the institutional money has come down there.
Ken Griffin, right?
Yeah, exactly. So it's just extraordinary place to be if you're.
Would you go so far as to call it Wall Street South?
In a lot of instances, certainly investments, absolutely. In terms of just managing money, absolutely. And great place to be if you're young in financial services. Great place to be.
Or if you're older too.
Yeah, exactly, exactly. That's where they're going. I'm staying on the Jersey Shore. Don't worry about it. S&P 500 up 37, Dow minus 12, NASDAQ up 178. This is Bloomberg. Good morning.
Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, it's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks back in the green, specifically the Dow trading higher now by 19 points. This Bloomberg Business Flash is brought to you by Chapter. Why do millions of seniors overpay for Medicare every year? Because they choose their plan without seeing all their options. Chapter compares every plan nationwide. Free call under 20 minutes. Stop overpaying at askchapter.org. Stocks heading to records amid speculation the U.S. and Iran are close to a diplomatic breakthrough in the war. S&P on track for a sixth straight day of gains. The S&P right now at 75.58, trading at a record, up another 38 points, up 0.5%. The Dow little changed on the day, but higher by 18 points, up under 0.1%. NASDAQ up 177, up by 0.7%. The VIX now below 16 with a 10-year at 4.46%, the 2-year 4.02%, the 30-year 4.99%. West Texas Intermediate crude higher by 1.3%, 89.87 a barrel. Brent 94.56 barrel of Brent up right now by about 0.3%. Lots of earnings from retailers today. Dollar Tree up 17.5% after earnings. Best Buy up 16.9%. Kohl's stores up 16.2%. Coming up after the close of trading, we will be hearing from Costco. That stock lower by 0.5%. So how is the consumer holding up? Erin McLaughlin is senior economist at the Conference Board, and she was a guest this morning on surveillance.
I think the consumer is very resilient because the consumer still has their job. Right. So it just goes back to that unemployment rate being very low. Almost everybody that wants a job has a job. I think it's what is the consumer purchasing? Where is their money going? So we know they're going to delay their bigger investments, and we know they're feeling, that quote-unquote affordability pressure.
Erin McLaughlin of the Conference Board. I mentioned Costco coming up after the close of trading, again down 0.5%. Also coming up after the close of trading, we'll be hearing from Dell. Scarlett and Paul, that is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet. We also know that Gap will be reporting earnings as well. So the retailers' earnings parade continues. And Charlie mentioned Kohl's. Kohl's shares are up 16% on better than expected results. When I say better, it just means compared to estimates because the numbers are still going in the wrong direction here. We're still looking at a loss for the bottom line, and comparable sales continue to be in the negative range. Mary Ross Gilbert is our senior equity analyst covering retail and joins us now with more, especially let's start with Kohl's because I mentioned comparable sales down 1.1%. Analysts were looking for a drop of 1.7%. What is Kohl's doing differently to stem the tide?
Yeah, Scarlett. So what Kohl's is doing is they've really ramped up their private brands. Those are the opening price point items, and these are the things that their core low-income consumer really wants. And so they're seeing success in women's, particularly with their So Juniors line. So that's their own proprietary brand, So, S-O. And that was up 10% in the quarter. The overall proprietary brands was up 6%. But remember that they're also cycling a period in which private brands was previously de-emphasized. And so with the current CEO, Michael Bender, when he came on board, that was the first thing he did was ramp up private brands. And that's the reason why you're starting to see sales lift there. But Scarlett, you raised a valid point. Sales were still down. They were down 1.1%. They were cycling 4 years of stacked declines, really 3 if you exclude 2021 when they were really benefiting from that sort of post-COVID lift. So, sales are not in the right direction yet. Could they get there by the fourth quarter? Maybe. All of the initiatives that they're doing with these deal bars, these are items that are priced at like $4.99, $5.99, and everything is under $10. Same with the toy towers that they have, and then also they have impulse items, and so all of those little things add to the basket, and that's helping to minimize the declines in sales. But again, they're cycling 4 years of stacked declines going forward, so that makes for an easy comparison. And when we look at the data, we're seeing that the second quarter is tracking in line to slightly better than consensus estimates for a 1% sales decline in the second quarter.
Is this, how much of this is kind of the market they're in, the segment they're in versus their own execution?
Well, actually, Paul, so it's their own execution. And so the current CEO, and he's like the fourth that they've had in the last probably 4 years, it seems like he's making the most progress. But again, you know, we are coming from a long period of sales declines. So, but these little initiatives seem to make sense. They're doing a better job with planning and allocation. So their spring seasonal merchandise was up in the quarter. So that was encouraging. And they learned that because they sort of missed sales in the fall last year. The other thing is they've right-sided their promotional activity. They missed out on that during the crucial holiday period. So now they've really ramped that up because, let's face it, in the first quarter, there was a $2.6 billion gain just in off-price sales, just from the big three. So they're continuing to lose share to the big three in off-price. You know, we just had Burlington's numbers out today. Their comparable sales were up 6%.
Yeah, and then let's not even get into the TJXs of the world, which are kind of in their own category. I want to get your take on a more traditional retailer, kind of a legacy retailer, and that's Gap. Gap will be reporting results as well. It's got a number of different brands, Old Navy, Banana Republic, and of course I guess they call it just the blue brand, Gap overall. I think about Gap and how it's really picked up a lot of cachet of late. There's a collaboration with, I think, Victoria Beckham, was it?
Absolutely.
Yeah, and things like that get people's attention. I don't know if it's translating into sales, though. Is it?
Oh, it absolutely is translating into sales. When you look at their comparable sales gains, they've been higher than that of Old Navy. Old Navy is their largest brand. It's about 56% of revenues. Gap is the next largest brand, and that's, you know, almost 30%, somewhere around there. And so, no, they've been experiencing very strong comp gains there. I think what they're looking for in the quarter is, you know, somewhere around that 3 to 4% for the Gap brand. So you're right, you're seeing some strength, and I think that these collaborations, the campaigns all create a wonderful halo, and when you speak to millennials and Gen Z, you will hear them talk about Gap. So, in fact, I'm wearing a collab from last year. This is Gap X Malbon. It's a favorite golf brand, and I really like it, and so I hope they come out with another one. That one, and then Doan. I also like the Doan collab as well. So
it does work.
It does work.
So what are your companies, Mary, what are they saying just about the consumer in general these days?
Paul, what we're finding out is that the consumer, even at the very low end, is really proving resilient. So, in fact, that was something that Burlington noted, that they haven't seen any signs of weakness. And, of course, in the off-price, their customer base, you know, most of their customers are really at the very low end. They go paycheck to paycheck. And Kohl's is sort of similarly positioned in terms of their core customer. So same sort of thing, except it's hard with Kohl's because there's other issues going on in terms of execution. But generally, with all the retailers that have reported so far, we're not seeing any pushback or signs of hesitancy on the consumer part in spending. So I still think that if there's some fresh newness or something that's exciting and they have to have it, maybe they might pass up on buying a favorite food brand in the grocery store or cut back there. But if there's something that really makes them happy, I think they're going to make that discretionary purchase, particularly since really with a low unemployment rate, when you have a job, you feel pretty good.
All right, Mary, thank you so much. Really appreciate that. Mary Ross Gilbert, Senior Equity Analyst, covering all the retail stuff for Bloomberg Intelligence. She's based out there in Los Angeles for us.
I don't see a Gap collab on your jacket.
No, I'm sporting
right?
my University of Richmond, so I'm going down to Richmond today to celebrate my 40th reunion.
Fun.
College. How did that happen? 40 years. Yeah, we're getting there. We're getting there. We're going to check in. with Sam Fazeli. He is in New York. That can't be good news for
We were
anybody.
stunned.
We were
Stunned when he walked in.
Walked through the door, so we'll talk a little healthcare. That's coming up. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube. We're streaming live at Bloomberg.com as well. Let's talk a little healthcare. We're always stuff. It's like technology. There's always stuff in the news. There's always deals to talk about. There's always new drugs and tests and all that kind of stuff. Sam Fazeli joins us. He stays on top of that. Director of Research for Global Industries and Senior Pharma Analyst for Bloomberg Intelligence. He's based in London, lives in France, but he's in our New York studio. Go figure that out. I want to ask you just, in this world we live in terms of the Trump administration and how it views healthcare policy, what are the companies that you deal with, the Eli Lillys of the world, the Mercks of the world, how are they approaching getting stuff done? Because they're still with research and development. They're still trying to get things approved. Have they changed the way they do things?
I mean, the basic business of pharmaceuticals has not changed. You got to spend a lot of money, and that number depends on how you calculate it, right? To try and discover a drug, and a lot of money trying to get it to patients. And of course, we all know pharmaceutical companies are pretty well profitable.
Yeah,
right.
sure.
I mean, they're not lacking for decent fat margins, so they have a lot of room to play with. Which means that when you get pressures from MFN, when you get issues with the Inflation Reduction Act, MFN being most favored nation, etc., they have ways to dealing with it, and some of it involves actually doing what the president is looking for, or the administration is looking for, bringing manufacturing over to the US. But as you know, Paul, there's only so much of that he can do, right? Because you're not going to go back to making absolute basic ingredients. So But they are doing some of that, and I think they've been managing the desire by the administration to try and get some of that back into the US.
Has the most favored nations impacted their financials?
Have you looked at the share prices?
No.
no, but I mean, of course. Sorry, that's a horrible way of answering your question.
Yes,
but it is.
That answers it, though.
No, right? Okay. There are some who are doing worse than others, but it's not to do with MFN.
Yeah. Okay, I'm just looking at Eli Lilly.
Yeah, there you go.
All right.
It looks almost like a Micron share price.
Yeah, exactly. So what's the latest thing? You're here in the States on a Thursday, which tells me, I know your schedule, how you guys work in pharma. That means you got a big conference over the weekend.
We do.
You go into a classroom for like all day, Saturday and Sunday.
Altruism. It's all about altruism. Okay. We're doing this because...
Now, which conference are you going to?
This is the American Society for Clinical Oncology.
Okay, this is a cancer one.
Cancer one, yeah. And they have, and the week after is the American Diabetes Association, which has a lot of obesity data in it now, where my colleague Mike Shaw will be going. The interesting thing, of course, is that these conferences are coming up, and every year we all search for, is this going to be a big one? And of course, this one is to a degree. Although we know what's coming, we know that there's a drug for pancreatic cancer that has done really well. We're just going to get the full details there. And we know that there is a potential new therapy for lung cancer, potential. We're going to get the details there. And how big a change is it? Could it be practice changing, which the company who owns it thinks it is, or change of standard of care? That's the sort of thing we're looking for. So hopefully I can be back here on Wednesday, having all of that information in my head, and we can talk about it again.
So in the audience of these conferences, it's some investors or some Wall Street people, but who's the real audience?
Vast majority of physicians. Of the 50-odd thousand people who go there to be educated, to hear about the new drugs, to learn about the new drugs, to talk amongst themselves about how they're managing their patients. This is a medical conference, which we piggyback on. There's no doubt about it.
So, and then who presents here? They're not just saying, this isn't necessarily, I guess it is a sales pitch, but it's also the science behind it. I mean, what are they? They're presenting papers and all that kind of stuff?
Yeah, papers, science, medical data, new clinical trials. As I just said, a new therapy for pancreatic cancer, for lung cancer, for myeloma. They come and present their data, and it gives opportunity to physicians to discuss, argue, and parse the data.
Where are we broadly? Where are we on just the whole research and development for cancer? It feels like they're making a lot of, I guess, forward momentum here. I mean, I see more and more of it. We hear more and more of it. We read about it more and more. What's the next kind of milestone for that whole part?
Yeah, so what's happened with cancer is that we've got a lot of tools now to try and become more sophisticated in the way we target things that have gone wrong in the tumor cell without killing the patient because of side effects or causing awful, hair loss, gut falling apart, etc. That's becoming more and more doable. You can't get away. Side effects happen because biology doesn't just make one thing for one action only. It has developed the ability to utilize a same protein for different functions in different cells. So that becomes tougher. But the science is moving at that speed, and I think what we'll see is a lot of this coming up with a huge growth in oncology. But Paul, what's weird and interesting is that venture capital investment in oncology has gone right the way down.
Why is that?
Hard to tell. I think a lot of them have decided it's become too hard because success makes it moves the bar higher to compete with. So do I really want to go into that space, or shall I go into an area like neuroscience where we haven't hardly got much, Alzheimer's, Parkinson's,
right.
Psychiatric diseases. We have a lot of work to do there. So maybe that's what they're thinking.
Interesting. All right, so you're going to be in Chicago sitting in a conference room getting science dumped on you. When I go to a conference, it's at a golf resort, it's Vegas casino. That's how you do.
Yeah, we eat sometimes.
You eat well. Okay, maybe get a decent bottle of wine if you can find one.
Oh, well, we try.
All right, Sam, thanks so much for joining us. Sam Fazeli, he's a Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence, heading out to Chicago for a very important medical conference, oncologist. So we'll see how that plays out there. I don't see the promo. So, there we go. There it is. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121, access the world's only global audio business network. Coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. More headlines coming up. This is Bloomberg. Good morning.
I'm Michelle Franzen. New data signaling the economic strain for Americans due to the ongoing conflict with Iran and rising oil and gas prices. The Commerce Department figures show inflation is up 3.8% from this time last year. Costs for the basics, food, gas, utilities, and other things eating away at budgets. A separate report finding more Americans are going hungry now than at the height of the pandemic. Here's ABC's Rebecca Jarvis.
This new report from the New York Fed shows what they call a remarkable rise in food insecurity, especially among those living paycheck to paycheck. And it's especially troubling because it impacts those with young children. Between late 2025 and early 2026, there was a sharp rise in households reporting that they had to skip meals, use food banks, and rely on SNAP benefits or dip into savings to cover their groceries, which are now 2.9% more expensive than a year ago.
Treasury Secretary Scott Bessent says he's confident the economy can bounce back when a deal with Iran is secured. Bessent also announcing new sanctions on Iran's Persian Gulf Strait Authority that manages the passage through the Strait of Hormuz. The U.S. accusing Iran of ceasefire violations by targeting Kuwait. Iran also claiming the U.S. is violating the ceasefire deal. ABC's Ian Panel has more.
Iran is still saying it's not willing to make any concessions on its nuclear program. It knows full well what impact it's having on the world economy, what impact it's having domestically in terms of opinion polls and ratings for President Trump, and the impact on domestic consumers. And it knows, or it certainly thinks, that it can wait out its own economic misery. Now, that's an open question. How long can it endure what is a disastrous economic situation inside Iran?
The Supreme Court today ruling in favor of a black death row inmate from Mississippi who claims there was racial bias in the makeup of the jury that convicted him for his role in the killing of a grocery store owner. There was only one black juror on that trial. You're listening to ABC News. The Justice Department opening a criminal investigation into E. Jean Carroll. She's the writer that was awarded a settlement in a defamation case against President Trump.
Sources tell ABC News the investigation is allegedly centered around whether Carroll committed perjury during her civil lawsuits against Trump. Carroll was awarded a $5 million civil judgment in 2023 that found Trump liable for sexually abusing her in a department store dressing room in the mid-1990s and defaming her.
ABC News Chief White House correspondent Mary Bruce. Sources say the Coast Guard is asking permission to send divers to new areas of the Bahamas in the search for Lynette Hooker. The Michigan woman has been missing since early April.
Her husband, Brian, told authorities she fell off their dinghy during a storm as they were returning to their sailboat. He described the moment to our Victor Okendo.
The wind blew us apart so fast that I think she tried to swim back to the sailboat, back to our sailboat.
But now officials claim GPS data recovered from Brian's electronic devices does not match what he told investigators.
ABC's Hannah Bata. Former First Lady Jill Biden says she was worried then that President Joe Biden might have been drugged ahead of his widely criticized 2024 debate with President Trump. Details of her upcoming memoir shared by The Atlantic the day after CBS News released part of an interview with the former First Lady, saying she thought Biden was having a stroke. Michelle Franzen, ABC News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
So we have a deal, except we don't. Welcome to the Thursday edition, as Iran and the U.S. reportedly reached an agreement to extend the truce and reopen the strait. but no one's approved it, and so the wheels go round. We're going to get the latest on this in just a moment from Bloomberg's Washington correspondent Tyler Kendall. We'll walk through the market reaction to all of this with Bloomberg's Christina Aquino, and on this PCE day, we'll get into the inflation numbers out this morning with Bloomberg's Michael McKee, and we'll assemble our political panel this hour as President Trump says he does not care about the midterms, though the White House is paying tribute to Harambe on this Thursday. You can't make it up. And we start, as always, with a look at Wall Street. Charlie Pellet has the numbers for us live from World Headquarters in New York. Charlie, how we doing?
Right now, a lot of green on the screen here, Joe Matthew, but emphasize on right now. We have got stocks erasing losses. This after Axios reported that Washington and Tehran have reached a deal to extend a truce and work toward an agreement to end their conflict, keep it locked in to balance of power for any and all developments out of the Middle East and Washington. S&P right now up by 37 points, indeed a record 75.57, up by about 0.5%. The Dow also pushing higher by 27 now, up by about 0.1%. Nasdaq Composite Index up 168 for Nasdaq, higher by 0.6%. The VIX now with a 15 handle, the 10-year at 4.46%, the 2-year 4.02%, and the 30-year below 5%, 4.99% on the 30-year. Gold is up $28 the ounce to $44.82, up by about 0.6%. West Texas Intermediate crude holding below $90 a barrel, up 1.3%. Barrel of Brent, $94.58, up now by 0.3%. Lots for investors to digest today. A full serving of economic data, earnings news, and geopolitical developments. Sarah Malik is Chief Investment Officer at Nuveen Asset Management.
The ceasefire obviously is becoming very fragile at this point, and we'll see what happens from here. But markets really tend to follow earnings growth, and earnings growth has been very strong this year, driven by the AI and tech trade. And as long as that continues, markets will probably look past the war. And even though the war hasn't ended, markets have decided that it will end at some point, and that earnings will remain resilient.
Nuveen's Sarah Malik interviewed this morning on Bloomberg Open Interest. Speaking of resilient earnings, Snowflake shares are surging 37% after last night's report. Salesforce up now by 1.1% after the close of trading today. We'll be hearing from both Dell and Costco. Recapping, S&P at a record up 37, up 0.5%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, there's the man, Charlie Pellet. Thank you, sir. He'll be back in about 15 minutes with another look at the Thursday trade. You made it to Little Friday. This week is moving along, right? You had a long weekend. I hope you did at least. It's Thursday, and we've got a very similar news cycle than we had the past couple of days, with the gallon of gas going for $4.42. Does that feel cheap? Don't ask me about diesel, because we've got our eyes on oil prices like we do every day. Today, they're higher, even though there was some early optimism about a deal. Axios strikes again. It does seem like a daily thing, right? Axios puts a headline up in the morning that says, we're close to a deal. The markets take off. White House says, well, the president hasn't approved of that. Then the whole thing falls apart by the end of the day, and somehow the markets still take off. We are right at record highs. An S&P 500 still trading above 7,500. Even with crude oil tiptoeing higher, still below $100 a barrel. We're going to get into all of this with Tyler because, as is frequently the case when we start this program at noon, we're not really sure exactly where we stand with talks, with conflicting messages from both sides. Why don't we go back to where we started yesterday in the cabinet room? Because Tyler was in there with everybody else. They cram them all in this. There's no room, it's this big, long table. All the reporters are made to stand on one side against the wall. It's like a high school dance. Stand against the wall and hope that somebody asks you to ask a question. Tyler got a couple yesterday, by the way, as you heard live here on Bloomberg, with the president being asked repeatedly, what's the status of the peace talks, and will we get a deal? Here's what he said.
Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. Right now, I think it looks like they want to just make a deal. They want to. They have. I don't think they have a choice. They're just going back to the internet because they're getting clobbered. Their economy is in free fall.
They're going back to the internet. He's there. I guess they've been putting some internet service back on. The headline on the terminal: U.S. Iran agree to extend truce pending Trump backing. Axios says it's an Axios report still. at this point. But could we have a deal when we're shooting at each other? Because that was the headline we woke up to this morning. The U.S. striking Iranian military targets for the second time this week, and you've got air raid sirens going off in Kuwait. Said it responded to missile and drone threats from Iran. Ceasefire? U.S. forces shot down 4 Iranian drones fired at a commercial ship and hit a launch unit near the Strait of Hormuz. The ceasefire is intact? Iran targeted the U.S. base from which the strikes came. We got 4 of them in Kuwait, you know. That's why this is so delicate right now. And with the market near all-time highs, we explore the possibilities again. We asked Tyler to come over from the White House today. Sometimes it's hard. She's standing there on the lawn looking in the tent with the bright lights. We can actually see each other today. Tyler, welcome back. It's great to see you.
Thank you.
You can't see anything over there, right? It's very bright looking in the tent. I've done that before. It's not fun.
Well, that's what happens when the back is so exposed because the White House is white, for some
That's
context here
exactly
on
correct.
how we do it.
Okay, so let's add to that. What is the brightest, most painful shot in Washington? It is the U.S. Supreme Court.
Knew you were going to say that. I've done that too.
Little
As
test
a
there.
deal.
Well, you do it more often than I do. Anyway, welcome to the comfort of the climate-controlled studio. Axios out in front again. You heard my whole setup here. This is like rinse and repeat. Is anything new?
Well, a lot of the Axios reporting is what we've been reporting. We know that the administration is seeking what appears to be this phased approach where we would first see an extension of the ceasefire, the Strait of Hormuz would be reopened, the U.S. would lift its naval blockade, and then that could kick off a essentially delayed phase of negotiations on potential curbs to Iran's nuclear program. When it comes to the Axios reporting, though, we're getting a little bit more of the finer points that could be involved in a potential deal, including that it is imperative that there will be unrestricted access when it comes to the Strait of Hormuz, which means no tolls, no harassment, but also importantly, Iran would only have a 30-day time period in order to remove any of the mines that they've laid. So that's a little bit more of a firmer detail.
Does that also
we've gotten.
confirm that there are mines? There's been questions about that, right?
Well, I mean, considering that the U.S. had a military strike just the other day going after these boats that were laying mines, according to CENTCOM, it would appear that they're still trying to exert this influence in what is a very dangerous way, just underscoring how fragile the situation still remains in the Strait. It is also interesting because it comes on the heels of a lot of other efforts that Iran has been doing recently in order to tighten its grip. We saw this new authority established. We're seeing them moving forward with what is being called navigational services fees, what feels like a rebranded toll system. And we had Iranian state media earlier today confirming that the IRGC has let through 26 commercial vessels in the last 24 hours and vowed severe retaliation if the U.S. messes or disrupts, I think was the word that they used, their efforts to exert control over the Strait. So publicly, the sides feel very far apart, though we have heard from the administration that they are moving towards a diplomatic effort. So perhaps the Axios report helps to advance that narrative. There were a few other things inside. The Memorandum of Understanding will include an Iranian commitment not to pursue a nuclear weapon. Doesn't really feel new considering that Iran's public negotiating stance has been that they're not pursuing a nuclear weapon despite Western intelligence assessments to the contrary. But importantly, Joe, I will pull out this point. In the 60-day negotiating window, what is going to be prioritized is what happens to that stockpile of highly enriched uranium. So it feels like perhaps this is giving us a little bit clearer of a roadmap and how things could develop if and when we see it.
Did you bring the memo? You have the memo of understanding right here? Wow.
If only.
This is why we have her come over from the White House. We got to clear up a couple of things here. You were in the room with him yesterday. He didn't seem agitated as sometimes he might be in the back and forth with reporters. He seemed sort of blasé. And it got to the point where, because, you know, he said, well, maybe we'll just have to resume hitting them hard, or maybe we won't, was kind of his attitude. When it came to a couple of other things, though, including questions about the midterm elections, that's the new T-shirt that Democrats are making up today. I don't care about the midterms, he said. I think it was Rachel Scott who asked him. You guys are standing right next to each other. Bringing us back to that whole I don't care about Americans' finances. It's kind of a similar vibe. Republicans' heads explode when they hear that stuff. Does he not care about the midterms, or is he trying to make another point involving Iran?
It feels like the latter. It feels like he's trying to convince Americans. I don't even think I can say it feels like that. We've heard from U.S. officials. He's trying to convince Americans that this, what the White House has called a short-term disruption, will be worth it for the long-term gain of preventing Iran to have a nuclear weapon. The issue that's coming up, even within members of the Republican Party, like those more hawkish voices on Capitol Hill, like Senators Lindsey Graham, Ted Cruz, Roger Wicker, is that the contours of this deal appear to be postponing that dialogue about what potential curbs to a nuclear program will look like. And that has sowed some doubt in this. Also, the idea of short term, I mean, how many weeks are we into this? You mentioned higher gas prices. What sort of pressure does the administration face on the political front? Now, if we do continue down the lane of politics, so far President Trump has a pretty good track record when it comes to the primary season. All of the candidates he's been backing have been doing well in the Republican primaries. The question is, how does that translate when they're head-to-head with Democrats as we get closer to November? I will quickly add, while the polling is not in President Trump's favor when it comes to discontent with the economy, it's not necessarily great either with how Americans feel that Democrats would handle the economy. So they also have some room to make up on their side as well.
Wow, really interesting. Fascinating, actually. To clean up one last thing, you asked the president about a gas tax holiday. We're at still about $4.50, as I mentioned, just shy of. And there's been a thought, he said it himself, to suspend the federal gas tax is something that he would pursue, and he's got Republicans and Democrats ready with legislation. You asked him about a gas tax holiday, and he looked puzzled.
Yeah.
And he said, a gas tax holiday? He repeated it back to you as if the terminology was foreign to him. Is this a matter of semantics?
Perhaps I did clarify that I meant a suspension of the federal ast tax on a temporary basis, which is what the holiday would be.
I think he thought you were proposing a new federal holiday.
It could be a good idea, but we'll have to see, because this idea, while it does have bipartisan support, some economists have cast doubt on how much this could really impact retail gasoline. We know that it takes time for prices to trickle down. So it's definitely something to watch. He said that they may be talking about it, but that ultimately he wants to give negotiations 1 to 2 more weeks, in his words, before they make any such decision.
Boy, really interesting. We don't have time for Harambe. Did you see the Harambe tribute on the White House Twitter page?
No.
That's an official one, right?
I don't know. I haven't seen it, Joe.
All right, no, we're going to make time for... No, look, there it is. If you're with us on YouTube, this is real. The official White House X account posting a tribute to Harambe, the 17-year-old gorilla who 10 years ago today was shot dead by the Cincinnati Zoo's emergency response team. The White House calling him a true patriot. With apologies to Harambe and Tyler, for that matter. I'm Joe Matthew in Washington. You picked the right day to join us. Yep, there she is, Tyler Kendall. She's going to head back to the White House, presumably.
Yep, that's where I'm headed next.
In our next hour, it's amazing how this stuff works. Michael McKee, Christina Kino are coming in next as we watch the markets here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Looking at records right now on the Dow, the S&P, NASDAQ, they're all pushing higher. This as a rally in oil eases amid speculation that the U.S. and Iran are close to a diplomatic breakthrough. Keep it locked into Bloomberg for the very latest on any and all developments out of both the Middle East and Washington. S&P right now up 41 at 75.61 to underscore a record there up 0.5. We've got the Dow up 23, up under 0.1%. While NASDAQ is up 194 for the NASDAQ Composite Index, a gain there of 0.7%. The VIX trading right now below 16. We have got the 10-year at 4.45% with the 2-year 4.02% and the 30-year 4.98%. Gold is up $41 the ounce, up by about 0.9%. Spot gold at $44.95 the ounce. West Texas Intermediate crude is gaining 0.5%, 89.12 on WTI. Barrel of Brent 93.93, down by 0.4%. CVS Health has reversed a decision to restrict access to Eli Lilly's obesity shot Zepbound for certain drug plans after Lilly agreed to cut the price it charges many health plans. Lilly shares right now, they are surging by 4%. CVS shares up now by just about 1.1%. So again, recapping, we do have the Dow, the S&P, NASDAQ all advancing. S&P up 40 right now to 75.60. That is a gain of 0.5%. And that, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet will have much more on the markets coming up in just about 20 minutes' time here on Balance of Power. Welcome to the Thursday edition. It's great to have you with us here. Thanks again to Tyler Kendall, who's reading up on Harambe right now on this 10th anniversary tribute day. The White House, if you haven't seen this, calling out the great patriot in an X post today. Indeed, it was 10 years ago. Harambe was shot by the emergency response team at the Cincinnati Zoo and became a meme for the ages. In a tribute, White House calling him a symbol of loyalty, strength, chaos, unity, and the strange beauty of the internet, bringing millions of people together for one cause, never forgetting Harambe. I'm Joe Matthew in Washington. This is part of the conversation here today on Balance of Power, as the market is as well. We want to stick with this because we're getting into an interesting world here where the rinse and repeat of headlines coming from organizations, including today it's Axios, frequently is the case. Sometimes it's Bloomberg, Wall Street Journal, Washington Post, whatever. Somebody gets a phone call into the president, somebody gets a document in their hands, and it moves the market because it might mean a peace deal or it might mean that the two sides are walking away. We've had both take place today. We woke up this morning to reports that the U.S. was resuming strikes against Iranian targets and that Iran was lobbing drones and missiles or whatever else they have at U.S. interests, in this case, bases in Kuwait. Markets didn't like that. Axios headline hits. We've got another peace deal and the verge of a breakthrough, and markets take off. You just wonder when this whiplash starts to have a backlash on Wall Street. And that's why we wanted to talk to Christine Aquino for a moment, other than the fact as well that it's been a long time. Bloomberg's managing editor for markets is with us right now live from New York. Christine, it's great to see you. We could play the tape back from the last time you and I spoke, and we were probably in a pretty similar position. I'm just wondering if traders are enjoying trading on volatility right now, or if there's going to be some corrosive impact of all this whiplash here in the market.
Yeah, well, Joe, you know that volatility is, of course, excellent for banks' trading books. Yeah. I'm sure that they don't necessarily mind having to contend with all of these swings. But yeah, you're absolutely right. In general, there does seem to be a sense of fatigue amongst market participants when it comes to trying to parse the latest headlines when it comes to the U.S.-Iran relationship. And, you know, I think what's different the last time we spoke is that now we have Micron joining the $1 trillion market cap club, we've had a strong set of earnings from the biggest hyperscalers, the biggest tech companies, and that has provided a lot of insulation for the market to the extent that perhaps there is a sense that maybe markets are just kind of shrugging off some of the geopolitical risk because there is this massive AI-driven trade that's propelling it.
Well, you mentioned Micron, so let's go there. That was an insane move that we've seen just in the last couple of days. By the way, it's still got a bid today. Micron shares, which were lower earlier, are now up $10 or 1%. $938. This thing's up like over 800% in the last year. It's up over 100% this year. We got a price target this week of $16.25 from UBS. So, Christine, do we look back on this as the Henry Blodgett call on Amazon from 2000, that this was actually the turning point, this was the top?
Yeah, I mean, there's certainly a lot of anxiety over that prospect, Joe. But, you know, at the same time, anyone who kind of makes that call, at least when it comes to the top of the AI trade, has so far been proven disappointed. You know, there's a lot of caution actually over calling the top and calling the end of this particular trade just because, you know, there is seemingly insatiable demand for anything related to AI. Now, of course, beneath the surface, the story is morphing a little bit, right? A lot of focus at the moment when it comes to memory makers. And so that's why we have seen shares related to that space gaining traction recently. And that shows you know, that whereas the AI trade in general does seem to be chugging along beneath the surface, there are kind of nuances that are changing a little bit here. And so it really is now a question of, we're of course seeing a memory shortage at the moment. Is that something that gives certain companies pricing power, and is that something that's going to be a headache for other companies who don't have the same kind of pricing power?
Well, give us your broad view then before you leave us. Coming off of what appeared to be a pretty successful earnings reporting season, and knowing that we're still dealing with some inflationary issues that we're going to talk to Michael McKee about in just a moment. The fact is, Goldman Sachs this week joined several other big firms in hiking its year-end targets for the S&P 500, up to 8,000 now from 7,600. I think Morgan Stanley was already there. The analyst you're talking to and hearing from is bullish as they were at the start of the year, or did this earnings reporting season make them even more so?
I mean, it certainly did juice up the optimism that was already in the markets prior to the earnings season. But, you know, one thing that my team and I are watching out for, of course, is positioning and whether that's becoming overcrowded. I think that's definitely something to watch out for, because it is when you get that overcrowded positioning that any sort of seemingly minor news development, whether it's geopolitical or data, since we're going to get non-farm payrolls next week, that is what tends to cause an outsized reaction. If markets are going very much in one direction, it doesn't take much to pull them back the other way.
Well, with our eyes on Wall Street and the great help of Christina Kino, we'll keep you posted on everything that's going on. The S&P is up 41 points right now, 75.61. Christina, it's great to see you. She's on TV and radio more than I am because she's brilliant, kind of like the next person we're talking to here. Professor McKee is with us live in Washington as we keep our eyes on PCE data this morning. This is the Kevin Warsh world we're living in now. And of course, Michael McKee is Bloomberg's international economics and policy correspondent. It's great to see you. How do we set the table for Kevin Warsh with today's data?
Well, it's not what he wants to see, certainly. No. The inflation rate on a year-over-year basis, headline basis, is up to 3.8%. Going in the wrong direction, almost double what the Fed's target is. They don't target core, they target the headline. Right. But the core is up as well. So the question is, do you think that Kevin Warsh is really going to want to cut interest rates? Or is that projecting from Donald Trump? Because we wouldn't say it about any other Fed chair. We would say the Fed chair is going to do what the data tell them to do. Yes. If inflation's rising and they need to raise rates, they would raise rates. So we may be able to give him the benefit of the doubt for a bit. We have no idea whether Trump will.
Well, fair enough. And I think you and I discussed that it might be smart for him to take Truth Social off his phone now that he's got the gavel in his hand. But I did think this morning at 8:30 when the numbers came out, does this not give him cover? I mean, President Trump's talking to Scott Bessent and others to say, look, Mr. President, he can't You got to give them some time.
Yeah, you couldn't make a case for cutting rates now because inflation is going up. It's continuing to go up, and the Fed can't say they would cut rates. Right. The markets would go crazy. The question becomes, where are we going from here? And Warsh's argument had been that AI would give us productivity gains, and that would enable you to cut rates, which might have been an argument if inflation was stable. But right now, it's not, so you can't make that claim and think it's going to get you anywhere with the other members of the Open Market Committee because it's just too early to see the benefits from AI.
Interesting today, we're going to be hearing the stylings of Scott Bessent in the briefing room. That's, by the way, about 90 minutes from now. He's scheduled for a 2 p.m. briefing. This is normally the press secretary, but of course, she's out on maternity leave, and we've seen kind of a new season of The Apprentice. Marco Rubio got one, J.D. Vance got one, Scott Bessent gets one today. Is it because of the PCE data? And I mean, this is going to be a political conversation, not an economic one, correct?
I'm not sure. I suspect that a lot of this will have to do with the war and sanctions and inflation in a broader sense rather than an analysis of what this particular month means. And people will ask him, you know, what's the president going to do with Kevin Warsh? Is he going to give him a hard time or not? But I think this is, they're moving into sales mode with these briefings with cabinet officials because the midterms are coming up.
Well, so can I ask you, and I don't want to get you in trouble, you're kind enough to come in here, but is Scott Bessent becoming more of a Kevin Hassett inside this administration in terms of being a political animal? When we hear him in interviews, getting real confrontational sometimes with the interviewers, speaking about under Donald Trump's leadership, not as necessarily an economist would be talking at this time.
Well, I think you'd have to have a scale of, 0 to Kevin Hassett, but
fair enough.
You saw the cabinet meeting yesterday.
Yes, right.
All the members of the cabinet are obsequious and say really nice things about Donald Trump. And I think Scott Bessent has been doing that throughout his time at Treasury. He hasn't gotten worse. It's just that if you work for Donald Trump,
you're a political animal.
The moon and the sun revolve around Donald Trump.
So what will that mean for Kevin Warsh in his first news conference? You're going to be sitting in there presuming that he has one.
Well, that's going to be the question. The Fed's not going to do anything. They're not going to raise rates. They might take out the bias statement. A lot of members have said that they would like to see that go. But then the rest of it is all going to be like a theater review, a movie review of Kevin Warsh. Like, how did he do? How did he sound? Did he sound in control? Did he, is there a lot of opposition that he faced or something? So that's going to be kind of the market focus this first go round.
What's Stephen Myron doing?
Right now, he's not employed.
He's on the beach?
He's on the beach, but I'm sure that he was a chief economist at a hedge fund before he went to the White House, and he could do that again, or the president could find him something else to do.
I wondered if that was part of the conversation.
Myron says no, but we know that the president has turned around and hired people from one job to another in the past.
For sure. Absolutely. How was Bruce?
Bruce was great.
Was it great?
Yes.
I'm amazed you have a voice. I thought you'd be
I'm
hoarse
amazed
at least.
I had a voice too.
Yeah. Are your ears ringing? Bruce rocked the nation's capital last night. This guy was there. We're lucky enough to have him on Balance of Power. Michael McKee, a pleasure as always. With us live in Washington, I'm Joe Matthew. This is Balance of Power, the Thursday edition, and we're glad you're with us. We'll assemble our panel next with much more to follow on the fastest show in politics, only on Bloomberg.
1240 on Wall Street. We do check markets all day long here at Bloomberg. We're looking at records. We're off session highs, but nonetheless, the S&P right now, 75.59 where we stand, up 39. That is a gain of 0.5%. Dow Industrials up 21, up under 0.1%. NASDAQ also at a record, up 181 points, now up by about 0.7%. The 10-year, 4.45%. All of this with the VIX now below 16. The 2-year, 4.01%, and the 30-year currently yielding 4.98%. Gold up $46 the ounce, 4,500 even. That is a gain of 1%. West Texas Intermediate Crude, 89.05 a barrel, up 0.4%. Brent, the global benchmark, sliding by 0.5%, 93.81 a barrel. Darryl Cronk is Chief Investment Officer for Wealth and Investment at Wells Fargo Bank, and he told us this morning there is a lot of support for markets coming from Washington.
What people are missing is all the effects of the One Big Beautiful Bill, where now all that CapEx spend we talk about every single day can be depreciated in this year or next and not over a period of 5 to 10 years, which means all that CapEx spend goes straight to the margin, straight to the bottom line earnings growth, and that's not going to change. Like, we're not getting a One Big Beautiful Bill 2.0, regardless of what happens in the midterms.
Darryl Cronk of Wells Fargo Bank interviewed this morning on surveillance. U.S. auto safety regulators have opened an investigation into Rivian Automotive over the potential failure of a part that could lead drivers to lose control of their EVs. Today, we're seeing Rivian shares advance. They are up right now by about 3.2%. Again, recapping the Dow, the S&P, NASDAQ, all advancing. We are looking at records. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
Okay, Charlie, thank you as ever. I'm looking forward to the big debate a little bit later on. Can we watch this at work, James? It starts at 2:30 in the afternoon. Democratic primary, Michigan. This ought to be a doozy, right? McMorrow, Stevens, El Sayed, among others. That's a crowded stage. That's going to be a fascinating race to watch as we talk more about the midterms, getting into the throes of the primary cycle. Just don't ask President Trump. As he says out loud, he doesn't care. It was quite a moment yesterday, and we recall his statement in the driveway a couple of weeks ago. You know how we do this. Everyone's going to connect the dots when he said that he wasn't concerned about Americans' finances. The answers came from the same question. Reporters keep hitting him on this. Right? Are gas prices, or Americans' finances, or the midterms going to be enough reason for you to cut a deal with Iran? Is that informing your view here? Maybe hasten the announcement of something? The answer is consistently no. Here's what he said yesterday in the cabinet meeting.
They're going to outweight me, we'll outweight him. He's got the midterms. I don't care about the midterms. Look what happened last night. That was the prelude to the midterms. People understand it. They know that, very simple, Iran cannot have a nuclear weapon. I'm doing that for the world. I'm not doing it just for us.
The prelude to the midterms, referring, of course, to the defeat of 24-year veteran Republican Senator John Cornyn in Texas, having endorsed Ken Paxton. The question is, will Ken Paxton beat a Democrat? And more broadly, will other MAGA candidates actually be able to close the deal in a general election cycle, especially if the president doesn't care about the midterms? We get into this with our panel, and we've got a great one for you today. Republican strategist Maura Gillespie is with me here in Washington, founder and CEO of BlueStack Strategies, and Laura Fink, Democratic strategist, founder, CEO of Rebel Communications. It's great to have both of you with us here. And Maura, I'll start with you as our Republican. This is making GOP heads explode in Washington. When you hear the leader of the party say he doesn't care about the midterms, how do you strategize around that?
It's tough, I'll be honest. I think that when you're looking at midterms that have already, primaries have already shown that Donald Trump has a big voice there, right? He has a big impact, but I think it's short-term, it's short-sighted by looking at the midterms and looking at primaries as they're going to reflect in a general election. We saw that with Ken Paxton. His endorsement in the last minute, a lot of money was spent.
Yeah.
A lot of money was already spent in the primary, but a lot's going to be spent.
That's right.
Against Tallarico. And he felt so confident yesterday saying that, look what I did in Texas. Okay, but what happens when it comes to November and people are still feeling the pains of the grocery cost, of gas prices, of not being able to buy a home? And so the reality check there is that people didn't show up in Texas. I mean, the runoff was, 5% of the voting population showed up for that runoff, down 60% from who showed up in March for the primary itself. That's a small fraction of the population. And John Cornyn said so in his concession speech. A small percentage dictated the outcome. But that's what happens when people don't show up to vote. And those who voted for Donald Trump are frustrated with him. They don't feel at home in the Democratic Party or Democratic candidates, so they may just very well stay home. And so if you don't care about the midterms, you certainly should.
So what's your thought on this, Laura, other than, are you making bumper stickers and T-shirts with that line on it already?
Well, I don't think that might be spiking the football a little bit too early. We know that there are a lot of environmental factors that go into this, but I really appreciate Maura being straight with both the president and her Republican colleagues, because the president has been clear that he does not care about affordability. He denied its existence, and now he's saying he doesn't care about the pocketbooks of American people. He's building a ballroom costing billions of dollars. He started a war that has costed somewhere between $30 and $100 billion and close to $1 trillion if you count the economic impact. This is someone who, for his legislative agenda, is putting a slush fund in place to take taxpayer dollars and pay it to people who he determines worthy, a lot of them criminals and convicted criminals. So you take all of that together, and if you're at home trying to pay your bills, you wonder where is the president when it comes to what I'm going through? And I think those are the questions that Republicans are going to have to answer on the trail. And I think it's going to be a really tall order, because they've been standing with this president the entire time and not saying a peep about any of it.
Well, so the conversation goes on here with a war that's underway and doesn't appear to be ending anytime soon. If you listen to what the oil executives say, Maura, whether it's Exxon or Chevron, if we reopen the strait today, Bob McNally at Rapidan will say the same thing. It's going to take a couple of months for energy flows to rationalize to where they were before this all began. So let's say it ended today. It's going to take us till Labor Day to get that back together? And you know where I'm going. What happens after Labor Day? I mean, you've got early voting underway. Your door knockers are out. A lot of decisions, in fact, have already been made. If we're still paying $4.50, $5 a gallon, what does that mean come November?
There's only so much ground that people can make up in the month of October leading into the election, right? So Capitol Hill largely goes quiet here in October because people are going back to their districts to run for office and to campaign. A lot of decisions are already made. People have already baked it in that they spent their whole summer paying $5 for gas because it hasn't gone down, and their summer travels were upended, or at least incurring more costs than they were planning for. But when you look at it, and what Laura just said too, it's not just about the war in Iran, the costs that are happening. It's the separation of things that Donald Trump is doing versus what the Republicans in Congress are doing. Are they representing their constituents? Are they serving the needs of the people that they swore an oath to defend and to serve? And if they can't answer that question when they're home in October or home in August or this summer, that's going to be their problem. It's not necessarily just pledging loyalty to Donald Trump. Yes, that may get you through a primary. That's not going to get you through a general, especially at a time we're facing right now. And so a decision needs to be made. Are you going to blindly say, like Ken Paxton, that your biggest attribute is that you say yes to whatever Donald Trump tells you? Yeah. Is that your running platform? Or is it, I'm going to serve the constituents here at home in Illinois' X district or whatever it may be, and actually address those needs? That's a choice that every congressman person needs to make, but also I'd say for Republicans, now is that choice. Now is that moment to decide.
So then there becomes a question as to whether more Republicans will draw that line as we get out of primary season and get into the general election cycle here. Is your thought, Laura, that will happen, or this is Trump's Republican Party straight through November?
Well, I think the challenge that Republican elected officials have is that they've got to stand against Donald Trump. They've got to say, in debates and on air and in interviews and with journalists like yourself, you've got to say, hey, no, I think Trump was wrong about that. I would have done things differently. And you risk, drawing the ire of Trump or the lack of funding, et cetera. I think that they have a line to toe. I think what they're counting on, and what I think Democrats are rightly intimidated by and afraid of, is the Supreme Court decision that just got handed down, and the fact that redistricting and the gerrymandering gerrymandered districts, Republicans have a sincere advantage there. So even in the face of the environmentals, the districts are drawn so tightly in Republicans' favor. The question is, can Democrats overcome that gerrymandering in those districts? Because Republicans have been doing this for a long time, but I think have won that redistricting war. If that's, so the starting line is a little muddy. The question is, if Donald Trump's numbers continue to tank, if the economy continues to be problematic, which by all accounts, unfortunately, for working people, it remains. The stock market's flying, working people are struggling. And so if this continues to go on, the wind's going to be in the face of Republicans. So even with those redrawn districts, the question will not be, do they lose the House, but by how many votes? And the question again will be,
think we're already there?
Oh, sorry.
You don't think we're already there, Laura? Like, you redraw the maps all you want. I'm not sure what the advantage is at this point. I can't keep score anymore. If Republicans are up 4-10, I don't know what it is. But if Democrats think they can turn 30 seats, if this is a wave election, then redistricting doesn't matter.
Well, I mean, it used to not matter, but the problem is the numbers are, because of the aggression with which Republicans have redistricted, the numbers are different than in past cycles, and they have a more sincere advantage. But you're right, wave elections can surmount that. But the question is, do you come in with such a razor-thin majority, or a majority that you can't act? And do you take the Senate or do you not? And those are the decisions that will be made. But I don't think redistricting is a wash because the environmentals are so tough. I think it is a real challenge for Democrats, and they've got to be sober about that as they look forward.
Well, that's interesting, Laura, because that actually goes against what a lot of Democrats have said on the program, and even some Republicans who are trying to keep score here and look at the historical implications of this midterm cycle. How about you, Maura, at this point? I mean, if this is a wave election, will redistricting be a footnote?
It will be in the long-term picture, I think, because it's creating less competitive districts. And what that means for everyday voters is that you have less choices. Okay. We're already seeing, as I mentioned before, this small percentage who actually participates in the primary. What point would you feel as though is necessary to even participate if it's already been decided for you? And that's the problem, not only here and now, but long-term, having less choices, you're feeling less enfranchised to be part of this. And that's not good for our democracy. That's not good for our republic. And I think that I have a lot of concerns for Republicans moving forward, at least of this cycle, this midterm. I don't know about the Senate. I'm not there yet. You'll have to stay tuned to how I feel about the Senate. Yeah, it's going to change hands. But the House, I think because Mike Johnson hasn't made a foothold in having any stances that he can take personally, other than, yes, I support Donald Trump, and that's my policy plans for the year. Yeah. I think people are just looking for someone to be an adult in the room. And right now, neither side seems to be that person.
Interesting. You watching that Michigan debate today? Speaking of which,
very curious to see how Stevens does.
For sure.
There's a lot of pressure on her, I think.
A lot of pressure from establishment Democrats, and I guess there was too much pressure. I don't know when it comes to Governor Whitmer. This is a really interesting headline today. With only a few months left to her term, the governor says she is not going to stage a run for president in 2028. This is somebody who is considered to be on the short list and would be a formidable Democratic candidate. Laura Fink, how does that hit you?
Well, this is the first I've heard of it. I didn't catch that particular headline, but I think you're going to see more of that as people assess the field and their viability. And Gretchen Whitmer is a young candidate, so perhaps she thinks she's going to do better in a future election. But it is surprising, actually, because she was considered one of the front runners, and she has been positioning herself for a long time to sort of take on that challenge. And so, but I think you're going to see a lot more of that. And you don't always get the reasons why people choose not to keep their hat in the ring. You hear people back out for family reasons, et cetera. But a lot of times it takes years before you figure out what the real story was.
I want to have impact, she said in a statement. I want to do good work, but I'm also looking forward to taking a little bit of a break and thinking about it, not jumping right into something. So you're running against Gavin Newsom?
I can't help it when I think of Governor Whitmer. I think of that photo she did with that influencer with the Dorito, where she's feeding the influencer a Dorito as if it's the body of Christ. I'll never get that image out of my head.
I thought you were going to say the binders, hiding behind the binders in the Oval Office.
Wasn't a great one either. So I think between those two photos, if I were
maybe take a couple of years to.
I would campaign heavily against that. With those photos, just blast them everywhere because that's pretty damning.
Well, if J.D. Vance and Marco Rubio are the short list on the Republican side, you have Gavin Newsom, right? You have Governor Shapiro. Is it all governors on the Democratic side that you're looking at?
Right now it sounds like, because you also have Governor Westmore. People are talking about him.
Right.
So A lot of it does seem in governors, which is a little bit surprising, but we'll see.
We'll see. We'll have a lot more to talk about on that one. But pretty interesting development here today to see Governor Whitmer say no to 2028. We've got a great panel for you here today. Maura Gillespie and Laura Fink will be back in our second hour, in fact, moments from now, as we zero in on geopolitics and the back and forth here when it comes to the U.S. and Iran striking a peace deal. The markets are listening closely, and we'll have a lot more ahead as we welcome our global television audience. It's all next, right here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
It's deal or no deal again at the White House. Welcome to the Thursday edition as Iran and the U.S. reportedly reach an agreement to extend the truce and reopen the Strait of Hormuz. But no one has approved this, and the market is still asking questions. I'm Joe Matthew alongside Kaylee Lines in Washington on this Thursday. We have to remember, Kaylee, we started the day with news that the U.S. was striking targets in Iran, so the wheels go around again.
Yeah, once again, U.S. forces saying they were acting defensively and shooting down Iranian drones that apparently were targeting commercial ships near the Strait of Hormuz. So the ceasefire, while they say it remains intact, clearly is still seeing firing exchange. And whether or not it remains intact and for what period of time is the question we are dealing with today. We understand, and Bloomberg has confirmed what Axios first reported, that they're talking about extending this truce for 60 days, using that window of time to try to start talks over the nuclear program specifically. And
presumably reopen the strait while talks were taking place over the nuclear program. That part is unclear, though, and at the moment we are looking at oil prices. Well, I guess they're just heading lower now, Kaylee. They've given up gains from earlier, and stocks are starting to pick up some momentum here as well. So maybe we're getting back on the positive side of things. We've seen a real whiplash kind of market today.
Yeah, and we'll get a check on those markets with Charlie Pellet in just a moment. And as we consider what's happening in the energy market specifically and how it's feeding through into inflation, we obviously got PCE data today, and we'll be hearing a little bit more about the inflation story in an important conversation that will be taking place shortly with the St. Louis Fed President Alberto Musalem and Bloomberg's very own Stephanie Flanders. But before we get to that conversation, as promised, let's check in with Charlie, who's checking the markets up in New York. Hey, Charlie Pellet.
Thank you very much, Joe and Kaylee. Let me attempt to connect the dots between the falling oil prices and rising stocks. There was a headline moments ago on the Bloomberg Professional Service from Iran's president saying, quote, "We're not seeking nuclear weapons." Now, all of that is according to the semi-official Iranian Students News Agency. But again, the quote there, "We're not seeking nuclear weapons," that quote attributed to Iran's president. The headline right now on the Bloomberg Professional Service. So the Dow, the S&P, NASDAQ, they're all pushing higher. We are seeing the S&P 500 index, best level of the session right now, up 44 at 75.65. That is a gain of 0.6%. The Dow Jones Industrial Average also at a record right now, up 65. That is a gain of just about 0.1%, while NASDAQ up 217 for the NASDAQ Composite Index, higher by 0.8%. All of this with a VIX below 16, a 10-year at 4.44%, the 2-year 4.01%, and the 30-year 4.97%. Gold up $59 the ounce, up 1.3%. I mentioned a move lower for crude. WTI now down 0.2%, 88.47 a barrel, while Brent crude, the global benchmark, 93.36, a drop there of 1%. After earnings, keeping an eye on Snowflake shares, they are ripping higher now by 37.5%. Also after earnings, Salesforce up now by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. The question for financial markets, the question for those of us here in Washington is the same one. Do we have a deal or not? As Bloomberg and other outlets are reporting today that the U.S. and Iran have reached a tentative deal to extend the ceasefire for 60 days, using that time to negotiate over the nuclear program while the Strait of Hormuz reopens in the meantime. But of course, President Trump has not yet signed off. We actually haven't heard from him about this today, though we did hear plenty from him yesterday in the cabinet meeting about the prospects of a deal with Iran.
Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. Right now, I think it looks like they want to just make a deal. They want to. They have. I don't think they have a choice. They're just going back to the internet because they're getting clobbered. Their economy is in free fall.
Referring to the regime restoring some internet access in the country. Indeed, the accord for a 60-day extension of the truce and for negotiations to restart on Iran's nuclear program. There are big questions about whether this is sustainable. However, Kaylee, of course, we've seen this on again, off again now for weeks. We want to start with our political panel. We're going to talk more about this later in the hour with Congressman Mark Pocan of Wisconsin. But with us to start things off, Republican strategist Maura Gillespie, Blue Stack Strategies, and Democratic strategist Laura Fink, founder, CEO of Rebel Communications. It's great to have both of you with us. And Maura, I'm wondering your thoughts on the communications effort here. You're a communications expert and strategist. And when the White House is saying one thing, Iran is saying something else, and the stories continue to change day in and day out, keeping the markets certainly on pins and needles. How about voters? What is the impact when people hear so much conflicting information every day?
Well, I think it's also a concern about what are you getting their hopes up for? Are you telling them that the gas prices are going down? Are you telling them that they shouldn't be worried about what's going on here at home and what should be happening overseas? I think that there's a real concern, as well as, is this just a play with the markets? Is this something that the White House is trying to push the president to do? Is that why they got ahead of it? Because the fact that all the outlets are saying the president has not agreed to sign it yet, to me that's very telling. That the White House is already struggling with keeping the president on message. There's been plenty of people talking from within the White House who have been frustrated by the president's inability to focus on affordability, but his obsession not only with what's going on here in D.C., the architectural projects and things of that nature, his lack of focus on what's happening in Iran and kind of brushing it off and acting as though it's not a big deal. Yesterday during his press conference, he made a comment about blowing up Oman, an ally of ours. That is a comment that is not just flippant, and it's deeply damaging. And I think that there is a real concern when this kind of a story breaks where it says the White House has agreed to it, Iran's telling a different story, but the president hasn't weighed in. Unfortunately, in this world that we live in right now, nothing is going to happen until the president weighs in.
Well, so you weigh in, Laura, on this, knowing President Trump has repeatedly said he's not going to sign on to any deal unless it is a great one. If he doesn't agree to sign on to this, is that implicitly saying that this isn't a great deal for the United States?
Well, I trust what Donald Trump does and not necessarily what he says. And here we don't know what a great one is. By his terms, any deal that he signs will be a great one, whether or not we are actually in a slightly worse position than before the war. The goals of the war were regime change, for Iran to obliterate its nuclear program and for the world to be in a better place. But we don't see any of that particularly happening. The JCPOA, which the Obama administration negotiated, was put in place and put constraints on nuclear development in Iran. We have the same regime. We have the nuclear stores still in place, and we have spent billions of dollars, American lives, and the world economy is teetering on the brink. We've also emboldened Iran to tax the Strait of Hormuz and to understand just how much leverage they have in the world economy. And I think that leaves us in a worse position, not to mention our relationships with other countries, and the reliability of America as an ally is really being put into question. So inarguably, we're in a worse place. But is this deal there, or are we Lucy and the football again? I mean, Donald Trump is so erratic, it's really hard to tell. And I think voters have kind of tuned out outside of everything but their pocketbooks right now, because that's a truth that they can really count on.
Maura, before Congress left town, the Speaker of the House decided to pull War Powers resolution off the floor when it appeared it might pass. And I realized there were some Republican absentees, but we've heard from a number of members, Ds and Rs, say if that thing gets back to the floor, it's going to pass next time. As we question whether the president has found the line on this issue in Congress, do you believe that's the case? You used to work for a Republican speaker in John Boehner. Will that pass with this conference?
I think Republicans in Congress are realizing they need to reclaim their control. They need to reclaim the authority that Congress has and that the House has, the Senate has, but especially when it comes to this is impacting their constituents. And as Laura and I've discussed within our comments about the gas prices, that's affecting their constituents. That's who they serve. They don't serve Donald Trump. They serve their constituents. And this is an issue where they have to reclaim their power, and the separation of powers. We're celebrating 250 years of this country. Yeah. That's an important marker when you go home and you talk about what your role is, what you're doing for them. How are you providing and working for them? And this is a way of doing that. We already saw the Senate start to break off and show they're going to be willing to do that. I think there are House members who are realizing they're up for re-election, and Donald Trump's not. And their jobs are on the line. And this is an impact. I think one other thing I wanted to mention was, when this all started, it wasn't about the Strait of Hormuz that was open.
Right.
When this all started, we joined with Israel. Where are they in this conversation? They've been largely cut out. And let's not forget that that's what brought us into this in the first place. And I do think that that's also impacting some members of Congress back at home.
Well, when we consider what members of Congress might be willing to do, even if a war powers resolution were to pass, Laura, does it really matter? Isn't it just a symbolic vote?
Well, Donald Trump's going to do what he wants to do. It shouldn't be a symbolic vote. It should be constitutionally the power that Congress has to restrain the president from starting wars wherever they want. And so I think the challenge here, and I want to credit Maura again for sort of telling the truth straight. I think the problem that Republicans have politically is that there's no critical mass. That they see Thomas Massie stick his neck out on the Epstein files and get it chopped off in the primary. They same with Dr. Kennedy standing up to Health and Human Services Secretary Kennedy. You see this over and over again. John Cornyn just days ago, even though he stood with Trump 99% of the time. So there is no critical mass who are willing to stand up to this president. And I will be pleasantly surprised if that changes before Election Day.
All right, Laura Fink and Maura Gillespie, our political panel, trying to tell the truth. Thank you so much, both of you, for joining us as we consider the path forward for this conflict and, of course, ultimately what it means for the global economy. That is a challenge that policymakers have to deal with, not just on Capitol Hill, but inside the Federal Reserve Building and the various buildings across the country that the Fed inhabits as they consider the economic picture and the inflation picture that this has created. And it's on that note we turn now to the Reykjavik Economic Conference, where the St. Louis Fed President Alberto Musalem is sitting down with Bloomberg's very own Stephanie Flanders. Let's go live now to Iceland.
Well, thank you so much. I am indeed here in Reykjavik with Alberto Musalem. Thank you very much for joining us. In your speech here at this conference, you pointed out that the US has inflation running meaningfully above target, long-run inflation expectations creeping higher, and yet a real policy rate that was below the level that the Federal Open Market Committee think is neutral, so not actually applying any restraining force on the economy. All those things together sound like someone who wants to raise interest rates.
Great to be with you. That's right. Their real policy rate right now is running at around 0.5%, which is lower than the 1% that the committee believes is the neutral rate. I think you have to look at the full picture, and it looks to me like policy is at or slightly below the committee's long-run neutral level.
But if you combine that with the other things you talk about, you had emphasized the risks of the inflationary pressures on the demand side and the supply side of the economy. It sounds like you think they should be leaning towards tightening. It sounds like you might have been one of the policymakers in the April meeting who actually thought they should have removed the statement against tightening in the statement.
So yes, I supported the interest rate decision, but I thought the easing bias was no longer consistent with the outlook and the balance of risks, which in my mind, the balance of risk has shifted a little bit towards the inflation side and less towards the employment side. Whether the economy will require a hike or a cut or a hold will depend on the scenario. There is a scenario where inflation remains high. There's no disinflation in the next quarter or two. And in that scenario, the economy will probably require a hike. There's also a scenario where the economy weakens materially in the second half of the year because real incomes are challenged and corporate margins are challenged. In that scenario, inflation could come down. In that scenario, we would be thinking of no hikes, maybe even a cut. So there are two scenarios to play with here.
But looking down the track, at least the markets are now fully pricing a rate hike by March 2027. Given where we are now, how we think things are going to proceed with oil prices and some of the risks on the supply side that you talk about, do you think that's a sensible thing for them to price?
Again, I think there are two scenarios here, and I don't comment normally on market pricing. I'm more focused on what's best for the economy and for Main Street. Markets have repriced materially in the U.S. and in other countries in the front end of the curve. I think that's markets trying to understand what our reaction function is.
So I'm going to quote here, because in your speech, you talked very directly about the impact of AI on productivity and the long-run impact that could have on monetary policy and on interest rates. But you warn that policymakers cannot depend on a potential productivity boom from artificial intelligence to ease elevated inflation right now in the short term. And in fact, you seem to suggest that the build-out of all the data centers associated with AI was actually putting upward pressure on inflation. Do you think the incoming Fed chairman, Kevin Walsh, is one of those policymakers that's inclined to be hoping for that?
So I'll speak about my views. I am an AI enthusiast and productivity optimist. But at present, it's unclear that productivity, first of all, is higher than the long-term average. It's actually at or below the long-term average. And so to rely on productivity to do the inflation job seems a risky proposition because what if the productivity doesn't materialize in the future? We could end up with higher inflation today and in the future. And what AI is doing right now, it's not really expanding the supply side of the economy yet. What it's doing is it's putting upward demand pressures, through chip prices for the build out. In my district, I hear of construction companies shipping workers all over the country. It is specialized, trades persons to build out the data centers. So at present, it's more of a demand story from AI than a supply story, and you see that in the aggregate demand numbers and the percentage of CapEx that is coming from the AI build-out is material.
But of course, a lot of this does come down to how you think, in the scenario, the next sort of year and a half, that's what you're focused on when you think about where the policy is right now and in the next few quarters. There's obviously different pressures, right? Some have emphasized, even John Williams has talked about the disinflationary forces that come from AI. If you start to see people lose their jobs, if you see jobs eliminated as AI is rolled out. You've highlighted more of the supply side, the sort of upside pressures that come from data centers and other things, those kind of pressures on resources. You seem pretty clear that those upside pressures are going to be the larger factor, at least coming from the AI revolution in the next year.
I think there are two things. In the short run, I think the demand pressures are more prominent than the supply relief. I'm prepared to change my view if and when I see AI actually contributing to aggregate productivity growth, which we don't see just yet in the data, and when it becomes evident that that's actually putting downward pressure on inflation. At present, that's not where we are. Now, in terms of the long run productivity in AI, if and when we get productivity to grow above its long run average, where it currently right now is not, the impact on real interest rates will depend on how permanent that increase in productivity growth is expected to be. If it's expected to be very permanent, that will put upward pressure on real interest rates. If it's expected to be transitory, then the supply side will win, and that will put downward pressure on interest rates.
One other thing that's happened since the beginning of the Iran crisis is a real change in bond yields. And actually, we certainly think, on Bloomberg Economics, we think that's been largely due to an increase in the term premium, slightly an increase in what we're expecting on inflation, but mainly on the term premium. So in that sense, has the bond market already done some of the Fed's work for it? I mean, is that producing a meaningful tightening, even though you have a very low short-term rate?
So my interpretation of what's happened to bond markets is that they're seeing an economy that's resilient on the real side. They see a labor market that's been resilient on the real side. They see higher realized inflation. They see higher expected inflation. When I look at the decomposition, I arrive at a different conclusion than your team, which is a fantastic team. My understanding is about 3/4 of it was an increase in the expected neutral rate, policy rate that is, and about 1/4 higher term premium. Now, if you look at forward markets...
So just on that, you don't think it hasn't meaningfully tightened financial conditions if you're looking on that kind of medium term?
So I was about to say, if you look at the forward real interest rates, markets have raised the real implied forward. So the real interest rate a year from now, the real interest rate 2 years from now, have come up meaningfully in the last month or two.
But just going back to the thing, you don't think that it's made that the incoming Kevin Walsh is not his job hasn't been made any easier by the tightening in the bond market. You would still have to be focused on that short-term rate.
I think when he comes in, he's going to take a look at the. Oh, he has come in. He's been sworn in. He's going to have his first meeting next 2 weeks, and he's going to have to look at the economy, and we're all going to have to look at the economy and exchange views on the economy and exchange views on what the best policy for the American people is at that point in time.
Well, the other thing that the incoming Fed chair has talked a lot about is changing the Fed's communication tools. He said he doesn't want to see so much or indeed any forward guidance. He wants to have fewer public speeches. He wants to get rid of the dot plot. Lots of people come in saying they want to have less forward guidance, and then they find they want to say things to the markets. Do you think that he's going to have a similar kind of learning curve?
Well, he's been in the Fed before, so his learning curve will probably be much lower than somebody who had not been there before. He's expressed some views during the last year or so. Once he's in the seat, once he consults with the full committee, and I expect him to consult with the full committee on all these matters, he will try and steer the committee in a direction or another. And I think it's always healthy to look at your communications policy, your monetary policy framework, and see how to adjust each or both to make sure we're fulfilling the dual mandate as best we can.
But you're kind of on the opposite side of this, because you wanted to actually connect the dots to whole forecasts, not reveal whose dots they were, but make a bit more sense of what the dots represented, the bigger picture. Whereas he, instead of elaborating on the dots, he wants to get rid of them altogether. I mean, that's just a straightforward disagreement, right?
Well, I would say what I think I would favor the most, is that we have a communications policy that is very effective at transmitting what our reaction function is at any point in time. Right now we have the dots. We can make the dots more effective by connecting the dots in terms of transmitting our reaction function. Now, you could also think of not having the dots, but replacing them with something else that is effective in transmitting to the markets and households and businesses what our reaction function is.
The other big thing that certainly people in the financial markets have been very focused on in Kevin Walsh's comments is about wanting to shrink the Fed's balance sheet. And actually, Governor Michael Barr said just the other day that he thought that was just the wrong goal, that it would actually raise risk for financial stability, and that it wouldn't necessarily reduce the Fed's footprint in financial markets. What do you make of that?
I think that's something that needs to be studied, and we need to all review what the options are for doing that if we so desired. And I think it's very different to reduce the balance sheet from the supply side, which could be very disruptive, or reduce the balance sheet from the demand side for reserves, demand for reserves as opposed to supply for reserves. If we went in the direction of taking measures that would reduce the banking system's demand for reserves, then that would be, I think, a smoother path towards a lower balance sheet in percent of GDP, or a lower growth of the balance sheet in nominal terms, than simply reducing supply, which could be disruptive.
But other things equal, do you kind of share the desire on balance to have a smaller balance sheet?
I think there. I'm going to do a two-handed economist now. There are some benefits to having a large balance sheet in terms of financial stability, but it's also, I think, healthy for the central bank to have the minimum balance sheet that it needs to have to operate its monetary framework and to promote financial stability. Now, so I think we need to understand where that is.
Just a last question. When you talk about communications, and we've certainly had a lot of communications about the Fed from the White House, but also we have ordinary people who are coping with the impact of higher gasoline prices. We're definitely having a conversation about higher interest rates now that we wouldn't have expected to have 6 months ago. And I think a lot of people, whether in the White House or in the broader economy, would say, hang on, what is the Fed doing, thinking about raising interest rates in an environment where it can't affect the global energy price, that's the thing pushing up inflation, and it definitely can't affect the rollout of AI, because that seems to be just an unstoppable force. So why raise interest rates?
So our mandate is price stability and maximum employment, and right now we're above target on inflation, and so the possibility or probability that we might consider an interest rate increase in the future, I think, has to be greater than zero. The economy has been robust. GDP growth has been at or around potential. The labor market is right around, in terms of unemployment, right around its natural rate, around 4.3, 4.4. And so we're missing on one side of the mandate. Inflation expectations are drifting higher to some degree, and we're not missing on the other side of the mandate. So you have to take all the factors, and we have a statutory responsibility to hit both sides of the mandate.
And finally, you did mention Kevin Walsh was sort of is in the building and has been sworn in. He talked in the past about wanting to break some heads and have a sort of revolution, be an agent of change in the Fed. Is that the way that he's presented himself internally? I think
the new chair, or Chair Walsh, I should say, will be asking some very profound and deep questions about many ways in which we operate, monetary policy, communications, operations, and so I think that's refreshing. A new leader should always come in with a vision and asking very deep questions about how things were done in the past I expect that to be the case.
Alberto Musalem, thank you very much for joining us. And I think we'll even forgive you for disagreeing with our US economics team. Thanks very much.
Stephanie Flanders, we thank you as well for bringing us an important conversation here on Balance of Power. I'm Joe Matthew alongside Kaylee Lyons in Washington. And ahead of our conversation with Congressman Mark Pocan, who's going to be joining us live in just a moment, the Democrat from Wisconsin, with the latest on so many issues, including the war with Iran. We want to update Wall Street very quickly. Charlie Pellet has the latest on the markets from his perch in New York. Charlie, how things going?
Right now, do want to begin with the 10-year. The yield there, 4.45%. The 2-year, 4.01%. And the 30-year, below 5%, 4.98%. We did have the Dow wavering, but right now higher, up 11, trading at a record 50,655 on the Dow. Little changed, up under 0.1%. S&P up 42. That is a gain of 0.6%. NASDAQ higher now by 217. That's a gain of 0.8%. Spot gold is advancing by $50 the ounce to $45.04, up 1.1%. West Texas Intermediate crude. It is a mixed picture for oil right now. WTI at 88.96 a barrel. It is higher by 0.3%. We're seeing Brent crude retreat to 93.8 a barrel, down now by just about 0.5%. Briefly, keeping an eye on some of the retailers. After the bell, we'll hear from Costco. Right now, Dollar Tree after earnings up 18.8%. Best Buy after earnings up 17.8%. Kohl's rounding out a stellar day for retailers, up 18.2%. Kaylee and Joe, that is a Bloomberg Business Flash.
All right, Charlie, we thank you. It's a market that's gone through a couple of different phases today based on headlines coming out of Washington as we woke up to news today that the United States had resumed strikes against Iran. Several targets, not unlike this time yesterday. But then, of course, Kaylee, the news cycle started to change a lot. And now Bloomberg is talking to sources who say we may well be on the verge of a deal to extend the ceasefire by 60 days, reopen the Strait of Hormuz, and continue a side negotiation about the future of Iran's nuclear program. The problem is we've heard reports like this before, and it's unclear what we should be taking seriously.
Well, and whether or not we take it seriously might depend on what we hear from President Trump about it. He's not commenting directly on this today, and our understanding via sources familiar is that he still needs to approve these terms. So as we consider what these terms may be and the prospect of their approval or denial, we turn now to Democratic Congressman Mark Pocan of Wisconsin's 2nd Congressional District, who is joining us now on Bloomberg TV and radio. Congressman, welcome back to Balance of Power. As we consider the terms, as we at least understand them to be a 60-day ceasefire extension, within 30 days, Iran would be removing mines from the Strait of Hormuz. Commercial shipping would flow unrestricted. Once again, are these terms you believe the United States should agree to?
I have no idea where this president is with this war. This has been a war of choice from the very beginning. There was no imminent threat to the United States. We've seen this same act before. Whether or not it's real this time, I don't know. They were just exchanging fire within the last 24 hours. All I do know is that this president has fumbled this entire war in a most magnificent way. The fact that we're paying almost $2 more per gallon for gas, the fact that we've doubled diesel costs for my farmers in Wisconsin, doubled the cost of airline fuel, spent over $90 billion on this war, and we may not even get to where we were with the deal we had under President Obama. I wish I could tell you there was any clarity with this, but with Donald Trump, there's rarely clarity.
Well, Congressman, with that said, and I know you've been clear calling this the president's unnecessary war with Iran, if we were in a world in which you were advising the White House, would you withdraw forces now? Or do you need to continue that pressure to find a diplomatic solution?
Yeah, the problem is they went into this without a plan. We had constituents that were caught over there. Clearly, there was no plan. We dealt very directly with some people on that. There's no plan on how to get out of this. They didn't really anticipate what was going to happen at the Straits of Hormuz. And we're not just affecting American consumers, but some of our best trading partners around the country, South Korea, Japan, they don't have natural energy sources. 70% of their energy comes through the Straits of Hormuz. We're hurting those people that are buying things directly from the United States, which hurts American companies. I just think Donald Trump has to, I know it's hard, but put the ego aside. He's the narcissist in chief, and try to understand that this has been a complete debacle and that we've got to reverse course as quickly as possible.
Well, it is a question of how quickly is possible, given our position here and the fate of a lot of commercial and energy flows, particularly for the global economy. In the balance, Congressman, we still have American troops in theater, at least for the time being. The Pentagon has not yet sent you and your colleagues a supplemental funding request. Do you have any idea as to when exactly that could come and what that number would look like and whether or not you would approve it? I know you've advocated for less defense spending, not more.
Yeah, look, 6 years ago, we started, Barbara Lee from California and I started a Pentagon Spending Reduction Caucus when we were spending roughly 650 plus or minus $20 billion on defense to try to keep it in check. They failed the last 8 audits. They can only account for 55% of their equipment, and yet we keep giving them money, and that was to hold it in then. We're at $1 trillion now, 6 years later, and the president wants $1.5 trillion for essentially defense contractors. This isn't really money that's going to the military. A small part of it is, but most of this is going to defense contractors. So we'll see what they give us, but many of us are really concerned because every dollar that's going towards the Pentagon is not going to healthcare or housing or veterans, because veterans dollars are separate than defense dollars. So, you know, a lot of us, especially me on appropriations, are very concerned about that. We think this is pretty irresponsible spending. And now he's cost us at least $90 billion more that we didn't need to have had to spend.
Well, Congressman, you agree with Steve Ellis at the group Taxpayers for Common Sense out with a statement following the House committee revealing details of this proposal. The nation cannot afford this bloat, he writes. We're up to our neck in debt, with interest payments now surpassing $1 trillion a year and interest rates rising. Meanwhile, the Pentagon, which still can't pass an audit, wants to spend taxpayer dollars on a gilded battleship that cuts against its own vision for a more agile and distributed naval force. What do Democrats do if that's the case then? Can you get to this in committee, or will Republicans in the majority make this a law?
Well, this is one where the public, I think, needs to get a little bit involved, because $1.5 trillion for the Pentagon is as much as the next 35 nations combined. That's a lot to be spending, a lot more than we need to be spending. And that is in lieu of other things, including middle-class tax breaks, in lieu of health care, in lieu of education, in lieu of housing, in lieu of veterans, and so many other programs. So I think people really do need to have a bigger concern. And just to give you an idea of some of the spending that happens and why it is a boondoggle in many ways, the most recent class of aircraft carrier, the Ford class, when the toilets get clogged, they literally have to flush $400,000 worth of acids down the toilet to unclog them, which is the definition of flushing money down the toilet. We need to get a better grasp on how much we're spending on defense, period. But right now, I don't have a lot of confidence in Pete Hegseth, a former Fox News host who now is running the Department of Defense. I don't think they have a game plan of what they're doing, and I think everyone is actually seeing that happen in real time.
Well, as we consider whether everyone is seeing the things you are seeing, Congressman, it does seem that more Republicans are starting to become wary of being mired in this conflict in the Middle East. We saw the Speaker polling a vote on the War Powers resolution before the Memorial Day recess, but that is going to have to come to the floor when you return. Do you expect that it will pass?
Yeah, I think we're very close to it passing. It already was very, very close. The Senate did just pass, right? So I think we're on the cusp of it, which is why it got pulled last week. They played a game with saying the number of days that they needed to have us vote on it. But, you know, I think there are enough Republicans to join, and I believe this time it will be every single Democrat, to make sure that we're doing what the Constitution says, which is Congress initiates any war, and therefore the War Powers resolution is so needed. I'm sure that's why Donald Trump's trying to quickly get something put together to avoid that, but at the same time, we want to make sure this is done right, and it's past time Congress get involved.
What happens if the administration just blows right through it? How do you hold the White House accountable?
Well, and that's where we're going to be able to see what power Congress actually has. Constitution makes us a co-equal branch of government. Speaker Mike Johnson might want us to be a subservient branch, but I think there are enough Republicans and Democrats who don't believe that is the case that we should be following the Constitution, and that means, it is Congress's ability to deal with this. So I think that vote very likely could be next week, and, hopefully we can bring some sanity to what's happening, because right now the president has fumbled this miserably, and, I don't want it to cost more American or Iranian lives.
With the View from Madison, Congressman Mark Pocan, Democrat from Wisconsin's 2nd District. It's good to have you back, Congressman, on Bloomberg. It's been some time. I'm Joe Matthew alongside Kaylee Lyons in Washington. As we wait for word from the White House, there's really been no action on Truth Social today. Never mind conversations or public comment from him on any of this. They're presumably reviewing these options right now.
Yeah, I guess we'll see if we hear from the Treasury Secretary about it. Scott Bessent is going to be briefing the press in the White House briefing room at 2 p.m. Eastern time, and we'll have some of that for you here on Bloomberg TV and radio. I wonder what kind of questions he could get around the Strait of Hormuz and inflation in particular. So stay with us for more here on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow just moving lower right now. Little change. The key takeaway, retreating from a record, down just about 7 points, under 0.1%. S&P, though, pushing higher, up 41 right now, higher by 0.5%. NASDAQ also at a record, up 217 for the NASDAQ Composite Index. That is a gain right now of about 0.8%. Source telling Bloomberg that Iran and the U.S. have reached a tentative deal to extend a ceasefire and work toward an agreement to end the war. The 10-year currently at 4.45%, the 2-year 4.01%, and the 30-year 4.98%. All of this with the VIX below 16, I should say. We have got spot gold at $45.04 the ounce, up 1.1%. West Texas Intermediate crude up 0.2%, $88.90 for a barrel of WTI. Brent 93.79, barrel of Brent down by 0.5%. CVS Health has reversed the decision to restrict access to Eli Lilly's obesity shot Zepbound for certain drug plans after Lilly agreed to cut the price it charges many health plans. CVS shares are up by 1.1%, Lilly up by 3.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you, sir. He'll be back at the top of the hour with more on the markets, 2 p.m. Eastern Time, to kick things off on Bloomberg Business Week Daily. Balance of Power, the Thursday edition, live from Washington right now as we consider what we might hear from the White House. There are a lot of questions about what the president is up to now that we do understand, according to reporting from Bloomberg and other agencies, that there is a deal on the table for an extension of the ceasefire between the U.S. and Iran by 60 days. That would also include reopening unfettered access, reopening the Strait of Hormuz, and continuing negotiations over that 60-day period with regard to the country's nuclear program. The most recent we have heard, and the president needs still to approve this if it's going to be enacted, the most recent we've heard was yesterday in the cabinet room as the president met with his cabinet, brought reporters in for a conversation, and made clear that he was not being motivated by politics here in the United States. Listen.
They're going to outweight me, you know. We'll outweight him. He's got the midterms. I don't care about the midterms. Look what happened last night. That was the prelude to the midterms. People understand it. They know that, very simple, Iran cannot have a nuclear weapon. I'm doing that for the world. I'm not doing it just for us.
Of course, Bloomberg's Washington correspondent Tyler Kendall was in the cabinet room with the president for those comments, and she's joining us now live from the North Lawn of the White House. So, Tyler, I don't believe you or any other members of the White House press pool have had the chance to see the president today. We also haven't heard from him on True Social. Do we have any sense as to whether or when we may hear from him on approval or not of this tentative agreement?
Well, Kaylee, that is the big question that we are all waiting for, though we are expecting to hear from the U.S. Treasury Secretary Scott Bessent at the top of the next hour, and perhaps that will give us some insight into where the U.S. stands when it comes to these diplomatic negotiations and whether or not we are getting closer to a deal, because as you both mentioned, sources confirmed to Bloomberg that a potential 60-day memorandum of understanding is currently on the table, but it's awaiting President Trump's sign-off. And so far, the sides have appeared publicly to still be pretty far apart on some of the main issues. We did get a statement out of Iranian state media citing one Iranian official that says progress has been made, but a lot of sticking points still remain here. But it does appear clear that we are moving towards a phased agreement, if we get an agreement at all, that would prioritize reopening the Strait of Hormuz. President Trump said as much just yesterday. That would include the U.S. probably having to lift its naval blockade, of course, a big point of leverage for this White House. And only then, once those components are in place, could we move into this secondary phase of negotiations for potential curbs on Iran's nuclear program. At this point, this reporting would indicate that there has been progress from the two sides. Yesterday, President Trump said that he wasn't satisfied quite yet. So we have to see if there were agreements made here on some of those key points, mainly the Strait of Hormuz, because Joe and Kaylee, we heard earlier today from Iranian state media threatening retaliation if the U.S. disrupts their control over the strait, as we see the country impose these navigational services fees, set up this new authority, and confirm that so far they've let through 26 commercial vessels in the last 24 hours, seeming to suggest that they're not quite ready to let up their grip on the strait just yet.
Yeah, realizing we have not resumed military action outside of the few strikes that we've heard of in the last couple of days here. Tyler, there's a new report out from the Center for Strategic and International Studies that questions what we have in our supply of munitions, that the U.S. used so many interceptors from missile defense systems like the Patriot, like the THAAD that we talk about so often, that stockpiles will not be replenished until 2029. We've still not heard any acknowledgement to that from the administration, right? The only thing that the President, Pete Hegseth, have suggested that we have unlimited munitions. Is that the case?
We are expecting the Treasury Secretary to likely address this during the briefing. Joe, we know that revitalizing the defense industrial bases, we talk a lot about here on Balance of Power, has been a bipartisan priority that at this point has spanned multiple administrations, but it has raised alarm bells. And it's also raising some questions on Capitol Hill about why we haven't seen that supplemental funding request yet when it comes to being related to the conflict in Iran, as the administration will likely have to ramp up the production of these critical munitions and stockpiles as the war drags on. That, of course, contributes to the timeline that lawmakers are looking for and the timeline that Americans are looking for. You mentioned and played that soundbite from President Trump earlier, talking about the midterms and that this will be worth it to ensure that there are curbs when it comes to Iran's nuclear program. But Joe and Kaylee, it's probably worth pointing out that we have heard some concerns from some hawkish Republican members on Capitol Hill that they don't want the administration to give up leverage without concrete details on what those curbs could be. The reporting does indicate that in this 60-day potential memorandum of understanding, we would see talks about enrichment levels as well as what happens to that stockpile of highly enriched uranium prioritized in this 60-day period.
Tyler, thank you so much. Live from the White House. On a sunny day here in Washington, Bloomberg's Tyler Kendall. Oil prices have largely flattened out. Crude oil in New York, WTI, is up about a quarter right now, just shy of $89 a barrel. Brent is, in fact, lower. It's down about a $0.50 to just under $94 a barrel. And we mentioned that with the idea of the Strait potentially reopening imminently. The president was asked about it yesterday in that cabinet meeting, and who would control the Strait, knowing that Iran has attempted to create a system, a tolling system, that some have already paid to get through the waterway. Listen to Donald Trump.
The Strait's going to be open to everybody.
And who would control it?
It's international waters. Nobody's going to control it. We're going to watch over it. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. They would like to control it. Nobody's going to control it. It's international waters, and Oman will behave just like everybody else, so we'll have to blow them up. They understand that. They'll be fine.
A comment that raised a lot of eyebrows, as Oman, of course, is an ally, and questions as to whether he meant to invoke that name or Iran. Let's add the voice of Clayton Siegel, a senior fellow at the James Schlesinger Chair in Energy Geopolitics, Energy Security, and Climate Change Program at the aforementioned Center for Strategic and International Studies, CSIS. Clayton, it's great to have you back as part of our conversation.
Joe, Kaylee, great to be with you again.
Let's go up to 30,000 feet here, because we've been splitting hairs, parsing words, trying to figure out where we are. Has anything changed since the last time you and I spoke when it comes to reopening the Strait and the way the market should be interpreting all of this messaging?
It sure has, to the tune of we're working toward a 1 billion barrel shortfall, cumulative, since the war began. So let's just look at the math. Before the war, it was about a 104 million barrel a day world market for oil. And we're missing now about 14 million barrels a day that's been shut in for several months. So that's how we get toward that billion barrel figure. If your viewers are savvy business people, if I told you you're running a business or a P&L and you're going to be spending more than 100 and you're only going to be taking in 90, that's a problem. That's going to raise flags. How are we doing it? It's just simple deficit spending. We are borrowing from inventories around the world, oil that's held by industry, oil that's held by governments, like in our Strategic Petroleum Reserve, in order to spend down those inventories and infill the shortfall of oil supply. But it can't last forever, because just like the dollars in a rainy day savings fund, you can only spend them once.
Well, so when we consider the prospects here of potentially, if the terms of this particular agreement, as we understand it, are agreed to, it would mean that the Strait of Hormuz is going to reopen unrestricted. Within 30 days, Iran would move mines out of the strait. How quickly then does it translate to a resumption of the kind of oil flows that we were seeing prior to this conflict, or can it ever reach those levels again?
So if you have those starting assumptions where I'm a bit dubious, I think that it will still take some period of many months in order to restore production levels to where they were before and get shipping sufficiently prepared to start moving barrels in and out of the region like before the war. But we're doing a lot of work to talk about the potential for a quick solution here, and especially the idea of like toll-free shipping through the Strait of Hormuz. I feel like the old metaphor, you can't put the toothpaste back in the tube. Tehran knows that it has this tremendous leverage over the world economy, even over some decision-making, arguably here in this town. It's not likely going to cede that new authority, even with an agreement.
So you think the tolls are here to stay?
I think that some Iranian influence over who ships and who doesn't ship through Hormuz is probably here to stay. Yeah, in some
when are the buffers gone? Is it mid-June? Is it by the 4th of July? When are we down to paycheck in the oil market?
Well, that's a great question. It probably is a summertime event, and we're spending down these inventories, as I said. The way the mechanics work is there's this phenomenon called tank bottoms. And if you imagine you're drinking your drink with your straw, you can't get every last drop, right? You have to have some residual at the bottom. Maybe it's a retail metaphor for an industry problem. But the bottom line is you're going to get to those operating minimums probably in summertime with the kind of drawdown rates that we're seeing, which are very aggressive, again, both on the industry side, but also the strategic reserves. For a couple of weeks in May, just this month, the United States drew down like 41 million barrels between industry and strategic petroleum reserve. We are providing a tremendous lifeline to the world market to manage through this crisis.
Well, so as we consider our own reserves, knowing the Strategic Petroleum Reserve obviously was depleted starting back in 2022 after Russia invaded Ukraine, and we've seen a rebuying effort, but we still have a long way to go. What does it look like for other countries ex the United States? We know China had a larger buffer than most. Do they have a longer time window?
Well, China's in a really interesting position to manage their interests through this crisis, largely owing to that huge stockpile that they've built in recent years, 1.4 billion barrels in total between industry and government. That means that they don't have to buy the high. And really interestingly, we've seen them slash the volume of crude imports. They were bringing in 11 plus million barrels per day before the war. They're down to 9 now, and it looks like it's going to be trending even lower. That's the luxury of not having to buy the high. So it's really the United States and China that are largely resupplying, giving this life extension to the global oil market, and again, the world economy.
So how do we rationalize what I think we can call optimism in the energy market? Every time there's a whiff of a deal, oil prices decline. We're back below 100 WTI and Brent, as we mentioned. If I'm an oil trader listening to you, I don't make sense of this.
Well, if you're a futures trader, I think you're doing exactly what you're supposed to do, which is not express a bullish position on oil fundamentals through a long futures position. It just doesn't pay because there's this put out there, and any next tweet or post could send prices 5, 10 plus % lower. Who wants to hold that position? So you got to find another way to express that fundamental bullish risk.
Well, when we consider then the prospect of where prices are going to go, if you're talking about us being potentially months away from inventory depletion and that's going to create a real supply problem, do we not get to the demand problem first if prices remain at least at the levels that they are at now? Is there not going to be somewhat of a correction due to demand destruction?
Well, part of this grace period is we're not getting the full market signal for demand to pull back. We saw at the beginning of the crisis when prices were really spiking, some of the countries in Southeast Asia did start to limit demand, work from home, other similar mandates, but it didn't really take off worldwide. And when you have this resupply going on, it's not really necessary everywhere. So until you get to those really high prices that would cause people to pull back on oil use, you're not going to get the proper signal to rebalance the market lower.
Interesting. We haven't talked about Venezuela much. How much oil are we getting from Venezuela? Obviously, we're keeping a lot of oil from getting to Cuba. But is that heavy crude helping to make the difference at all with what's happened in the Middle East?
You know, every drop counts right now, but it's still a drop in the bucket from Venezuela. The good news is we're back up to substantially 1 million barrels per day, and we had come down when we started the quarantine last December. So that's great that we're back up there, and we probably will be able to increase supply from Venezuela by a couple, maybe 300,000 barrels a day in the next year or two. But we have a 14 million barrel a day deficit, so do the math.
Doing the math with Clayton Siegel. from CSIS. Thank you so much, as always, for joining us. He, in addition to being with the Energy Security and Climate Change Program at the Center for Strategic and International Studies, is also a senior fellow and James R. Schlesinger Chair in Energy and Geopolitics. It's a long title.
Card.
Yes, and we're glad Clayton could share some of his expertise with us here on Bloomberg TV and radio, and we'll be hearing more on this, I assume, from the Treasury Secretary, Scott Bessent, in just a few minutes.
Time to get your seat in the briefing room. We'll meet you back here at 5 p.m. Eastern Time for the late edition of Balance of Power. Alongside Kaylee Lyons, I'm Joe Matthew. This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, kicking off this Thursday here in the surveillance studio. I'm Matt Miller, along with Alexis Christophers. We are filling in for Tim and Carol. We're not.
I can't believe they gave them the same day off.
Yeah.
Therefore, we are here.
Whoever's in charge of scheduling.
I don't know.
Dropped the ball. And the same is true at the White House, right? I mean, Caroline Leavitt is out, and she's got a rotating cast of characters filling in for her.
And today we're going to hear from Treasury Secretary Scott Bessent. Actually, any moment now on when he begins speaking in the press room there at the White House, we're going to bring that to you live. We can see a live picture of the podium right now, and we don't know exactly what he's going to be talking about, but there is certainly a lot of economic data for him to sift through if he so chose to. We got the PCE, the Fed's preferred inflation gauge today, coming in, month over month, a little cooler than expected.
In terms of inflation month over month, but year over year, it's still up. The PCE number, 3.8%. That's a full percentage point higher than we were just in February, right, which is just 4 months ago. And we've seen the fastest 2-month gain in inflation as measured by PCE since 2021. I filled up my gas tank the other day for my Dodge Challenger Scat Pack wide body.
Cool car.
It was $6.56 a gallon.
It's like you're in California with a price like that.
All right, we have Jordan Fabian right now, White House news editor from Bloomberg, to fill us in on exactly what we can expect to hear from Scott Bessent, who, Jordan, as Alexis mentions, there's a lot of economic data today, but he lately has seemed to assume the role of Secretary of State as well as Secretary of Defense, wading into topics that a Treasury Secretary normally wouldn't touch.
Yeah, that's right, Matt. He's got his hands in a lot of different pots. China is another one. He was accompanying the president on his trip to Beijing and had a wide portfolio as far as tariffs and all of the business deals they were discussing. But today, he's going to be pressed, I believe, on the economic data that was out this morning. You were just talking about it. Higher inflation. He's started to wade into some Biden-like territory, saying this is transitory. The gas prices are going to go down once this conflict in Iran is over. Of course, all that remains to be seen, and he'll have a lot to answer for an administration that came in to office elected to bring down those prices. They've only continued to creep up. And also the conflict in Iran itself. What is the status of the deal making there? There was a report this morning that we've confirmed that there's a tentative agreement, memorandum of understanding to extend the ceasefire. What does that look like, and what are the chances that President Trump is going to sign off on that? All those questions are likely to be posed to the Secretary of State this afternoon.
I'm also wondering if he's going to touch on our new Fed chair, Kevin Warsh, because you have to think that these numbers this morning, these PCE numbers, are not going to change the narrative for the Federal Reserve, that, Wall Street is still banking on Fed rate cuts, or rate hikes, I should say, rather than Fed rate cuts.
Yeah, that's right. And he's going to have to, I think, tread carefully a bit, given that the president in the swearing-in ceremony for Kevin Warsh tried to set the tone to say, hey, we're going to allow him to be independent. I know that was a concern for investors and people on Wall Street, bond investors, et cetera. All the interference that happened under his predecessor, Jerome Powell. If you have Scott Bessent coming out hard here and demanding rate cuts, it's going to certainly set them perhaps on a collision course again with the central bank, just as Warsh is taking power. I would expect him not to go there, but certainly it could come up, and he'll have to be careful how he answers the question.
I mean, I can imagine with the Axios report, and now Bloomberg has confirmed that we've got some kind of memorandum of understanding to extend the ceasefire that isn't, right? I mean, we continually fire throughout this cease. Most of the questions will center around the Strait of Hormuz.
Yeah, that's right. And there's a couple questions of let's say a deal is consummated, can they get Hormuz back to what it was on February 27th? And how fast can they do it? You've heard all kinds of reports that there were sea mines put in there, that Iran is talking to Oman about a tolling system. Is it going to be freedom of navigation, or is it going to be restricted? How does it look like? And also the broader context of you have a deal that possibly is giving U.S. sanctions relief to Iran, essentially to put Hormuz back to where it was, without getting to the key reasons why the president said he went into this conflict in the first place, which was to prevent Iran from getting a nuclear weapon. A lot of that is left to be negotiated later. So that seems to be a loss for the president there. How does the Secretary of State explain that?
And certainly there were reports this week that it might take 30 days to open the Strait of Hormuz if and when a deal is finally signed by the two sides. Is that what you're hearing, Jordan?
Yeah, it's quite possible. I think there's a lot of practical considerations to go through, like the safety of navigation, the freedom of navigation. Like I was just mentioning, are they going to continue to impose tolls, or will ships be able to transit? What role is the U.S. Navy going to have? We've been hearing persistently that they would maybe look at escorts through potentially dangerous areas. Are they actually willing to do that, or is that viewed as too dangerous? So it seems to me that 30 days they would need at least to work out some of those practical questions to get the strait back to where it was pre-war.
All right, Jordan, we're going to keep you with us as we await Scott Bessent at the podium there in the White House. Right now, though, I want to get over to Charlie Pellet for a Bloomberg Business Flash. Charlie?
All right, thank you very much, Matt and Alexis. We are looking at a mixed day right now for the U.S. equity market. The S&P, NASDAQ, they have both been higher for most of the day, but the Dow swinging between gains and losses. Lower right now, retreating from a record down 29. Looking at a loss now of just about 0.1%. S&P pushing further into record territory. 75.65 where the index stands right now, up by about 0.6%. NASDAQ also at a record, up now by 1%, up an additional 252 points. All of this with the SOX advancing 1.6% and the VIX below 16, the 10-year 4.45%, the 2-year 4.02%, and the 30-year 4.98%. Gold up 1.3%, 45.13 the ounce, while West Texas Intermediate crude, let's call that flat on the day at 88.71 a barrel. Brent crude 93.60, a drop there of 0.7%. Coming up after the close of trading, we will be hearing from Dell and Costco. And Matt and Alexis, that is a Bloomberg Business Flash.
Charlie, thanks very much. Charlie Pellet there with the Bloomberg Business Flash. I'm Matt Miller. I guess I'm in for Tim.
I would think so, and I'm Alexis Christophers in for Carol Masser today.
They are off right now, and we're waiting for, as we have been saying, Scott Bessent, the Secretary of the Treasury. He's filling in for Caroline Leavitt, who is off today. It's really interesting that they put different cabinet members in place for the White House.
Interesting that he's the one today, though, because it's a day of very heavy economic reports, and he's going to be asked questions by reporters about the administration's handling of the economy as we move closer to these midterm elections, with gas now at its highest level in a couple of years.
Yeah, it's something that I think a lot of people notice, especially around Memorial Day. Let's get back right now to Jordan Fabian, Bloomberg News, White House editor. Jordan, what do you think are the most important economic questions facing the White House? I mean, President Trump did come into this second term with a goal to reverse the Bidenflation, as the Republicans call it. And although we're not at 9% on CPI, we're still far above the Fed's target. And today's PCE number came out at 3.8%.
Yeah, that's right. And it's a good opportunity to take stock now that we're more than a year since the inauguration of have they lived up to the promises. They have a number of problems, obviously the self-inflicted problems of the war driving up consumer prices, and also looking at, how have they tried to rein in government spending? It doesn't seem like they've done that. In fact, the signature tax bill they passed last year actually increased spending. And so I know that government debt and deficits is something on the minds of folks when we're talking about inflation. They haven't really taken a big bite of that problem, despite all the promises that were made early on about cutting the size of government with Elon Musk, Doge, et cetera. So, if we get into some deeper questions, those are some of the issues that might be raised there in the briefing room.
We also saw the unemployment lines get a little bit longer last week, right? Initial jobless claims up by 5,000. Also, first quarter GDP revised down to 1.6%. That's from that initial reading of 2%. I'd have to think, when we're going to be going to him in a few seconds, he's going to be asked, Bessent, about the state of the economy.
Certainly, the job market has been pretty resilient, but there are some pockets of weakness. And look, overall, you look at some of the surveys from the Conference Board, CEOs that I think are starting to wonder, is this economy actually strong? Like, what is going on, and do we need to pare back?
All right, Jordan, we do see Treasury Secretary Bessent walking out to the podium. Let's listen into him filling in for Caroline Levitt.
Next week, so I don't want anyone yelling, reclaim my time. So let's start out with Trump accounts. Trump accounts, I believe, are the most important benefit for young people since the GI Bill. Today, the app is now available on all major platforms, bringing the president's vision directly to American homes. Nearly 6 million American children have been signed up for Trump accounts, which will launch on July 4th. And I would encourage all of you to go to trumpaccount.gov to sign up. We had a historic tax filing season. We passed the largest tax cuts in American history. The average refund this filing season is nearly $3,300, an 11% increase from last year. And importantly, very importantly, 62 million returns, 44% claimed at least one of the president's signature tax cuts. No tax on tips, no tax on overtime. The reduced taxes on Social Security benefits. 85% of our seniors paid no taxes, and the auto deductibility on loans for American cars. And to remind everyone, Democrats, every Democrat voted against those programs. We've had sustained and resilient GDP growth. Real GDP has risen 2.6% over the past 4 quarters. Atlanta Fed's GDP now predicts 3.8% for this second quarter. The U.S. energy dominance, part of our resilience stems from our energy dominance. Natural gas is down, is my belief, and the futures market is showing us oil will be lower than pre-conflict levels. We are more resilient to energy price fluctuations due to President Trump's energy dominance and deregulatory agenda. The United States is now the world's largest energy exporter. The United States has never exported so much energy or produced so much energy. Main Street Prosperity, the average 401k is up almost $30,000 since President Trump's inauguration. President Trump RX has already saved Americans over $600 million. I'm sure all of you will want to report on that. And the unemployment rate remains low at 4.3%. So with that, I'm happy to ask questions. I will mention 3 weeks ago, I got an honorary degree from the University of South Carolina. So if you really want to get a question, you can call me Dr. Bessent. So,
I want to start with these Trump accounts. You know, there's a lot of people, a lot of working class Americans that maybe don't have the financial expertise when it comes to stock markets and investing in general. In what ways are you guys simplifying this for all those Americans so that it's not just for one class of people, but all Americans can have it?
Well, that's a great question, because 38% of Americans have no exposure to equities. They don't share in the great innovation, the machine that is the American economy, our great capital markets, which drives our prosperity. So if your child is born during President Trump's administration, Treasury puts in $1,000 as a seed investment. We've also created 6 learning pods, so you can go online to the app that went up today and learn. And I think that this is going to be, I've been a big proponent of financial literacy, and I think this is going to be one of the greatest real-time financial literacy educations in history, because it won't be, there's a street in New York called Wall Street. This is what I don't really understand what happens there. American family is going to be able to look on their phone every day and see. And, I think it's going to drive people to try to understand what they've got here. I think we're going to create a generation of shareholders. Ed?
Thank you, Mr. Secretary. I guess first, we're starting to see this disruption of the oil supply through the Strait of Hormuz affect economic data. First, is there a deal on the table for a 60-day ceasefire to continue that? And then second, how fast could inflation then recede or retreat, or is inflation sticky? Because the PCE was at a 3-year high.
Well, first of all, PCE today, month over month, was 0.2, which was, we're looking at decimal points, but the estimate was 0.3. So 1 month doesn't a trend make. And what we've seen is actually oil prices are down about 10% in May. There are almost 2,000 ships waiting to come out of the Gulf. And I think the oil market is going to be very well supplied on the other side of this, and that we could see prices come down very quickly. We saw the UAE, leave OPEC. So I would expect on the other side of this that gasoline prices will follow.
Is there an agreement on the table?
Sorry?
Is there an agreement with Iran on the table?
The teams have been going back and forth. And President Trump has made it very clear, he talked about it at the cabinet meeting, that he has several red lines. And Iran has to turn over their highly enriched uranium. They cannot pursue a nuclear weapon. And the Strait of Hormuz, back to your question on energy, has to free transit. Navigation of the seas has to be free and open as it was before. So he's not going to take a bad deal. He's going to make a great deal for the American people. So, Peter.
Thank you, Dr. Besson.
Yep.
How long until we see your signature next to President Trump's face on a $250 bill?
Well, again, as Treasury Secretary, I have 2 mandates for U.S. currency. At present, no living person can be on U.S. currency, and the currency must say, "In God we trust." So right now there is proposed legislation in front of the House, in front of the Senate, to change the first requirement so that a living person, Donald J. Trump, could be on a $250 bill. So it's all in the hands of the, it's all up on Capitol Hill. So at Treasury, we prepare things in advance. So we have prepared in advance that if the legislation is passed, but we will stick to the law.
And something that came up yesterday also at the cabinet meeting, President Trump said, Oman will behave just like everybody else, or we will have to blow them up. Are you guys back there in the West Wing making plans for a new war with Oman?
Again, I think the president wanted to punctuate freedom of navigation in the strait. I had a call with the Omani ambassador this morning, and he assured me that there were no plans for tolling the strait. As he said, our countries have had 200 years of good relations. He wants to have another 200 more. And I told him that this was a non-starter, and he did not want to risk either the Omani individuals or Omani financial institutions getting sanctioned.
Dr. Becker.
Thank
you, Mr. Secretary. Is it in the U.S. interest to waive some sanctions on Iran or to unfreeze some of their assets before Iran has made concrete promises about getting rid of their nuclear program?
Again, I'm not going to preview the deal, but I would think that the things would go very slowly in terms of that. So we'll see.
Dr. Just to follow up on that, because it's our understanding that the U.S. has committed to discussing the matter of sanctions relief during this negotiation period. So just to be clear, is sanctions relief for Iran on the table?
Again, it is a multifaceted agreement, and nothing is going to be on the table until we see the Strait of Hormuz open and the Iranians agree that they have to turn over the highly enriched uranium and that they can't have a nuclear program. And to be clear here, that this administration, President Trump, has done something that no other administration is able to do. We have gotten the Iranians to talk about their nuclear program and to perhaps commit to not having one. That has never happened before. It had been off the table. So I think when you look at the results of the kinetic action of our economic pressure, it has worked to bring them to the table and have a discussion on this.
Mr. Secretary, I just want to follow up. You said that the teams have been going back and forth, but can you confirm whether or not a tentative agreement has been reached in these negotiations with Iran?
Again, everything depends on what the president wants to do. And President Trump is not going to make a bad deal for the American people, for the U.S. And he was very clear at the cabinet meeting on the yesterday what he wants.
Secretary Assistant Dr. Kara from Lintel TV. I'm sorry, did I steal this question because I'm not that person?
No, it's you.
Okay, thank you so much. Thank you for taking my question, Kara from Lintel TV. I really wanted to get your thoughts on digital currency. A lot of our viewers are increasingly worried that digital currency could one day be used to track people's spending or limit personal freedom. What's your philosophy on that, and what safeguards is the Treasury and this administration putting in place to make sure new digital payment systems protect Americans' privacy and freedoms in the future?
Well, so this administration has been very clear. There will be no central bank digital currency, which I think would be the first step toward tracking. So we have taken that off the table. We passed stablecoin legislation with bipartisan, and the Clarity Act is now up on the hill, and I think it has bipartisan support. And the most important thing we can do is to make digital assets come into the United States, make the U.S. the home. Our regulation, our best practices are what will ensure good standards for these. When you look at digital assets, all the nonsense that happens, all the things you read about, that's because it's the wild, wild west offshore, so we got to bring it on shore. So I would encourage the House and the Senate to get clarity done. Jack?
A lot of people talking about the IRS settlement, and which has been rolled over now into this weaponization fund over at DOJ. Wanted to get your comment on the decision process, as much as you can tell, how that settlement came to be, how it was rolled over to DOJ, and then the process for those funds now as it's played out.
Good. So thank you for the question. This is going to be the only question I'll take on this matter today. So there's ongoing litigation, so it'd be inappropriate for me to comment. President Trump is a great American who has endured more than 10 years of nonstop harassment and weaponization from the federal and state government actors. A bad actor at the IRS leaked more than 400,000 tax returns, including the Trump family, all the employees, and that's how we got here now. No American should be targeted for political reasons, and every citizen deserves fair treatment and full protection of the law. The Department of Justice represented Treasury and the IRS in this matter, and I'm going to have to refer any questions to Acting Attorney General Todd Blanche. So.
Thanks. So President Trump has said that we can expect interest rates to come down very quickly. A number of times he did that last week. But the market at the moment broadly does not expect any rate cuts this year. You know, JP Morgan said this, Morgan Stanley, and so on. So who is right, the president or the market?
Well, I think, again, I believe that we will get through this challenging period now. On higher prices. On the other side of this, I've said publicly that I think we'll be back to substantial disinflation. But most importantly, I think we've got the Warsh Fed now. It's a new day at the Fed. The Treasury Secretary and the Fed Chair have lunch or breakfast every week. I had my first breakfast with Chair Warsh this morning, and I believe that he will do the right thing to balance inflation and growth.
Secretary, thank you, Secretary Bessent. I hope you were calling on me.
Yes.
So I'd like to ask you if you could provide a little more detail on what you're doing to shut down Iran's airlines, and also on sanctions relief. A senior administration official briefed reporters over the weekend that sanctions relief will be commensurate with nuclear concessions. But at some point, if the enriched uranium is given up, should we expect pallets of cash to be flown to Iran? Could you describe how that looks?
Well, a couple of things. On the airlines, one thing that we're not going to do is restrict movement for religious reasons. So Iranians who want to make the pilgrimage to Mecca or Medina will be allowed. We will also allow valid humanitarian reasons. But the other thing we can do is that when these airlines fly, they have to be refueled. They sell tickets. They pay landing fees. Anyone who accepts those, we will sanction. So they should be very clear that the state-owned Iranian airlines, they are outlaws and cannot do this.
Secretary.
Since you're the White House briefer today, I know you've been asked this already, but I'm wondering if you can just confirm on the record
that there is a tentative deal that has been agreed for a 60-day extension of the ceasefire and then a continuation of nuclear talks?
Again, it's always a mistake to get out ahead of the president, so it is all going to be the president's decision. I think that we can see that the president very clearly stated his three: open the strait, highly enriched uranium, no nuclear program. So
Those things are those things part of the temporary deal right now, sir? Are those three aspects that you just outlined part of the temporary deal that has been agreed?
that if there can be no deal without those, why would there be a deal without those?
Mr. Secretary, thanks so much for taking the time. President Trump at the cabinet meeting said he thought that reducing fraud would help to balance the budget. You put out the goal of getting the deficit to 3% of GDP. What's your timeline for achieving that? And how do you think what can you say to make the markets, given where rates are, like kind of process kind of what your plan and agenda is?
Well, the GAO numbers, not my numbers, believe that there's about $500 billion a year of fraud. So could we very quickly get $250 billion of that? The budget deficit is approximately $1.8 trillion. So that would reduce the deficit substantially. If we could get that $500 billion number, I think it would engender confidence. You'd probably also go into a virtuous cycle as the budget deficit narrowed, interest rates would go down. No one reports it, but last year we actually had a fiscal contraction. Just to remind everyone, we inherited the worst budget deficit in history when we were not in a recession or not at war, 6.7%. We brought that down to about 5.5 or 5.4% this year. I think we can stay on a good trajectory.
Mr. Secretary, without an executive order, does the U.S. government have adequate defenses in place to address the risk created by Anthropic's new AI models?
We have great collaboration between all of the labs that have the large language models, but between the U.S. government and the labs. So,
Thank you, Mr. Secretary.
Yep.
Is me? Okay. Thank you, Mr. Secretary. Appreciate it. First, did you speak with the president before this briefing? Did he show any willingness to this 60-day ceasefire extension?
I didn't see the president today.
And then I just want to follow up. When can Americans, the average American, and can the U.S. economy work for the average American without a deal with Iran?
Again, I believe we've already seen oil prices come down substantially. We are pumping more oil than we've ever seen before. And as I said, these are short-term challenges that we will get over, and I think we'll move forward. So, in the White?
Mr. Secretary, just to follow up.
No, in the White.
Oh, thank you, Mr. Secretary. Appreciate it. Given how much this upcoming midterm election will hinge on the economy, what did you think about President Trump's comments in the cabinet meeting yesterday saying he didn't care about the midterms?
So you're calling President Trump a statesman? You're saying that he is taking a statesman-like position, that he has a core belief, and he believes that the most important thing is for Iran never to have a nuclear weapon. So I believe those things can be true, that we can do well in the midterms, that we perhaps have the makings of a deal here, and I believe that, and look, the economy, that it is challenging now, but unemployment is still low, tax refunds were high, and consumer spending is still quite high. So in my private business over the years, I always looked at what were consumers doing, not what they were saying. And I'm in constant contact with the banks, and every income quintile is still doing well. Amen.
Thank you, Mr. Secretary. On the $250 bill, Mr. Secretary, you said the legalities of it are up on Capitol Hill, but I just wonder what your opinion is personally. Do you think it's a good idea for the president to put his face on America?
Again, the president doesn't do it. The House and the Senate have to do it.
Secretary Bessa, Secretary Bessa, what are
remaining assurances that President Trump needs to see in order for him to sign off on the agreement with Iran?
I don't think it could be clearer. Yes.
You're following in the footsteps at the podium there of Secretary Rubio and Vice President Vance. There's been quite a lot of talk about their possible presidential ambitions. Does your presence here today indicate that we might see you running in 2020?
No, I think it just means they've run out of things on the food chain.
There's been some back and forth over the last several days, and also with the U.S. attacking Iranian drones yesterday. This morning, CENTCOM put out a statement that Iran had launched this ballistic missile towards Kuwait, calling it an egregious ceasefire violation. How can the administration still argue that a ceasefire is in effect?
With the Iranian government, we did not have regime change, but we changed the regime. As President Trump said at the cabinet meeting, as we've said other times, the first layer of leadership was eliminated, the second layer, and we're now at the third layer. And the way to think about it is the Iranian government, such as it is three pillars. It is the elected government, it is the IRGC, and it is the clerics. And they are having trouble communicating. So we are being patient. We do not have unlimited patience. President Trump always prefers a peace deal. So everything we have done thus far has been defensive. And at present, that is what we will continue doing. But if President Trump doesn't think he can get a peace deal, then kinetic is back.
Thank you, Mr. Secretary. Are you hopeful that the oil prices will go down once this conflict is over, given the fact that the Strait of Hormuz remain closed, and by the time this oil gets to the major markets, could be 2 or 3 months?
We see that the market, I believe, is very well supplied right now. The market seems to be going into balance for itself. So I think that as the strait opens up, we're going to see this burst of ships come out. So we may actually see how quickly can it be refined, how quickly can it get to its destination.
Thank you so much, Alina Shirazi from the Daily Mail. You wrote resilience on your cabinet note meetings. Several times the photographer zoomed into it. Are you trying to keep the president calm? Are you trying to keep yourself calm? Why did you write all those notes?
So people could look over my shoulder, photograph them, and think they got a scoop. So,
is the United States considering a reconstruction program for Iran if a deal is signed?
Again, I think we got to get to the deal before we get to the other side. Before we get to the you in the pink.
Mr. Secretary, in the red?
No, in the pink.
In the pink, thank you. Cristina Londoño with Telemundo Network. Mr. Secretary, how effective do you believe the current Treasury restrictions have been in pressuring the Cuban government? And also, if you're in the room when those talks are being held, are there any plans to either tighten the sanctions or to ease the sanctions against the Cuban government to get some type of change?
Again, that's going to be up to the Cuban government. That they can go up, they can go down. That we've tried to get humanitarian aid in, and the regime rejected it. So because they wanted to go through their corrupt system. So they could go up, they could go down. It's carrot and stick. Secretary Rubio doing a fantastic job of managing this process, and we at Treasury are working with him. In the red.
Thank you. Reagan Reese with the Daily Caller. I want to ask you about Antifa. In October, the Treasury Department started working with the FBI to investigate who's funding Antifa. Can you give us an update on that investigation? How close are you guys to finding out who's funding Antifa?
It is ongoing. We've made substantial progress, and I think in the weeks and months ahead, we're going to have a lot to report. One thing that did go underreported that I would point out to all of you is the IRS is now giving guidance on the Form 990, which nonprofits they have to file. And we are going to encourage or demand that nonprofits know their grant recipients. So if a grant recipient is violent, If they are suppressing people's rights, then you are responsible for that. And I think that's a very good first step. Yep.
There's new government data that shows that Americans are now saving a smaller share of their incomes than at any time over the past 4 years. Are you seeing signs that American households are dipping into their savings to pay for the higher costs of things like gas and groceries? And does data like that concern you right now?
Well, so a lower academic literature would tell you a lower savings rate can mean one of two things. The kind of the doomer view that you took, or that people have more confidence, or it could be something else, because for instance, stock market gains or 401k gains might not show up in savings, so they're looking at that, think that they can draw down their household savings.
You're obviously concerned about the risks posed by advanced AI models like Mythos to critical infrastructure. The financial sector is concerned as well. What types of changes are being considered to the AI executive order so it can pass? And do you believe that an AI executive order needs to include the pre-public access for government?
Again, we're working very closely with the large language labs. They've been excellent partners, and we are going to get a solution that solves for the maximum calculus. What we want to do, the U.S. is the AI leader in the world. We're an AI superpower. China is second. They are trailing substantially. We want to make sure that we keep that lead. So we are working on the exact calculus between innovation and safety, and we want to optimize for that. So you in the glasses.
Thank you, Mr. Secretary.
In the glasses.
Thank you very much.
No, you don't have glasses on. You in the glasses.
Thank you for taking my question. There was a report this morning that Justice Alito's son is working in your department. Can you confirm that that's the case? And if so, do you believe that that means that he should be, that the justice should recuse himself from cases that involve your department?
I am sure that Mr. Alito follows all legal and ethical guidelines, and I can assure you that at Treasury we follow all the legal and ethical guidelines.
Thank you, Mr. Secretary. I have two questions for you, but just to follow what you said about the.
Well, you didn't call me doctor, so I only get one.
I'll shoot for two. You said that it's up to Congress. The president's face is on a $250 bill, but it is actually the Washington Post that's reporting two political appointees from the Treasury Department who have asked agencies to be ready to do that. Do you think politically it's a good idea to put his face on a $250 bill when people are struggling to afford gas and groceries?
I don't really understand this Washington Post article. That who hears from the Post? Yep. Terribly written, terribly edited, because basically what it says is that Treasury is following the law, and that we've created the bill, and that it's up to Congress, but that we follow the bill and it's up to. I didn't really understand what the story was.
So,
but anyway,
appointees aren't involved in that. Two of your political appointees.
Yeah, of course, but we prepare for everything if it gets passed. Just like we were ready 6 months in advance for the one big beautiful bill for tax guidance. So we have to prepare in advance. You can't draw something up the day before.
Politically, do you think it's a good idea though when people are struggling to afford gas and groceries?
Look, I think it has. I think that it's bifurcated. That do you think we should have a 250th anniversary, the celebration?
Well, that's happening anyway. But putting the president's face on a $250 bill is
But Caitlin, it's not happening anyway. It's happening because it's being funded by private citizens, by the federal government, by state governments, by municipal governments to celebrate our country. And I don't think that there's anything untoward about having the President of the United States, the person who was President of the United States, on the 250th anniversary bill.
On Russia sanctions, what you just commented on there, Mr. Secretary, about the $1.8 billion fund. Is it accurate that the General Counsel of the Treasury Department resigned over that?
I will not be taking any other questions. I will not be taking any other questions.
But you know, Wall Street over here.
So,
given the scale of the assault from Russia on Kyiv in recent days, and the fact that diplomacy seems to have settled down, there is no diplomatic talks happening right now between Russia, Ukraine, or the U.S. What about sanctions? Is the U.S. considering sanctions on Russia at this time?
Well, the U.S., this administration has put the hardest sanctions on Russia of any country. So let's review how the sanctions regime has gone since the Russian action on Ukraine. Biden administration put on what I would call mild sanctions because they were worried about gasoline prices going up into an election. It would be an unstatesmanlike sanctions. Probably the worst national security advisor in the history of the country, Jake Sullivan, in an act of bravery on his way out the door in January, they raised the sanction level on behalf of the Trump administration. We let those in situ when we took office. They fast forward to October, and President Trump instructed me to sanction the two largest Russian oil companies, Lukoil and Rosneft, which we did. No other government has done that. So no one has done more sanctions than the Trump administration on Russian oil. Here, who wants to own this? Gray hair. No, gray hair. No, you don't have gray hair. Well, maybe you do.
Thank you, Mr. Secretary. When you had breakfast this morning with Fed Chair, did you request that the Fed lower interest rates?
I had breakfast with Chair Powell 41 times, and I never did that. Last question.
Thanks, sir. Governor Gavin Newsom has floated this idea of a 100% state tax on Californians who receive money from President Trump's anti-weaponization fund. Your response to the governor's call for 100% tax?
There's no cure for stupid. Okay. Thank you all.
All right, that was obviously Treasury Secretary Scott Bessent taking questions in place of Caroline Leavitt at the White House. I'm Matt Miller with Alexis Christoforous. We're in for Tim Stenivek and Carol Master today, but quite a lot of information there from the Treasury Secretary, and he seemed in a very good mood as well.
Yeah, he was, cracking some jokes there as well. This was a wide-ranging press briefing. He started out talking about the Trump accounts, where the government's going to gift $1,000 seed investment to newborns if people sign up. That's going to happen July 4th. He talked about the average refund for folks this year with their taxes.
$3,300, 11% higher than the same refund that they got last year.
Yeah, average 401k up 30% since Trump, $30,000, I should say, since the inauguration. Unemployment rate 4.3%. So he sort of started by highlighting all that is good.
Not far off 30%, by the way. I would think it's about 19%, actually.
You know what? We're going to check your math, but I bet you're right. I bet you're right, Matt. But of course, he was asked repeatedly, is there a deal on the table between the U.S. and Iran? He sort of skirted that. He again said that the president has 3 stipulations here. One of them, the strait needs to be opened. Iran cannot have a nuclear program, and they need to surrender their enriched uranium.
Yeah, and he refused to go much further on that. He wouldn't verify, he wouldn't confirm or deny whether or not the Axios report that the U.S. and Iran have reached an agreement on an extension of the ceasefire has been reached. The president, according to Axios, says he needs a few days to deliberate on that.
He also said he had breakfast with Kevin Warsh, the new Fed chair.
He had breakfast with Kevin Warsh. He said he had breakfast with Jerome Powell 41 times and never asked him to lower interest rates. I think the implication is that he wouldn't have asked Warsh that either. He did say a couple of things. There will be no CBDC. There will be no central bank digital currency under this administration. He talked about the attempt to put President Trump's face on a $250 bill to mark the 250th anniversary of the United States. Interesting that George Washington strongly objected to having his face on U.S. currency because he thought it looked too much like sort of the royal leaders of Europe. And of course, there's an amendment that you can't have a living person on U.S. currency.
But the administration is trying to have that rolled back.
They're trying to lift that law for this president who probably doesn't have the same objections to his likeness on a currency. So I think a really interesting press conference, although the most important questions he was asked probably were on the $1.8 billion weaponization fund, which also grants President Trump and his family members and his business immunity, no more IRS audits for them, and no more federal lawsuits against them in perpetuity. He referred all of those questions to Todd Blanche and didn't answer any further questions.
And, I was looking at the market while all this was going on. Not a lot changed while Scott Bessent was talking, but why don't we hand it over to Charlie Pellet now for a wider look at what's going on in the market. Charlie.
All right. Thank you very much, Alexis and Matt. Indeed, while Dr. Bessent was talking, we did see the Dow Jones Industrial Average decline. Little change, though, as you say, while the actual press conference was underway. S&P 500 index holding at a record, up 40 right now at 75.60. That is a gain there of just about 0.5%. NASDAQ pushing higher at a record, up 236, up by about 0.9%. And NASDAQ, the NASDAQ Composite Index, also right now at a record. NASDAQ 100 Index also advancing by about 0.8%. Right now we are looking at a rally in oil that is waning. West Texas Intermediate crude, though, holding on to a gain of 0.7%, 89.33 a barrel. Brent 94.10, lower now by 0.2%. The VIX trading below 16. We've got the SOX gaining again today, back to its winning ways, up 1.3%. The 10-year 4.45%, the 2-year 4.02%, and the 30-year 4.98%. So again, recapping here, the Dow lower, down 0.2%, S&P up by 0.5%. Matt and Alexis, that's a Bloomberg Business Flash.
All right, thanks so much, Charlie. I want to check in with Dan Flatley now, Bloomberg News U.S. Treasury reporter for us there in D.C. So, Dan, you were listening to what we were just listening to, Scott Bessent there at the White House. I'm going to start with this. Did anything surprise you that he said this afternoon?
Well, one of the more interesting things he said, Alexis, was that this proposal that was reported on earlier by the Washington Post about President Trump's face appearing on a $250 bill was something that would be decided by Congress. There's some legislation up there that's sort of languished over the last year or so, and he said that the Treasury Department would follow the law, which requires that, one, no living person appear on any U.S. currency, and two, that the currency says "In God We Trust." So he made those remarks, which was kind of something new in terms of that story. We didn't get much in terms of the deal with Iran, only to say that he does see that is Treasury Secretary Scott Bessent does see a deal imminent, and gas prices and some of the other price pressures coming off a bit. But of course, that all remains to be seen.
He also argued, Dan, that the Trump administration has put heftier sanctions on Russian oil than any administration in history, obviously in the history of the entire universe. But haven't those sanctions been lifted ever since our excursion into the Middle East?
Yeah, that's a great point, Matt. So yeah, I think he's, it's all kind of a matter of perspective, but earlier in President Trump's second term, going back to last fall, some of the sanctions that were put on Lukoil and Rosneft were considered to be some pretty draconian measures that were taken, and I think at the time people were impressed by that. Of course, as you point out, there have been successive waivers. I think we're now on our third waiver for some of that oil that has already been loaded onto tankers. And so I think that there were some frustrations last week. Actually, I was in Paris for the G7 meeting from the Ukrainians and from some of the U.S.'s European allies that the U.S. wasn't going harder on some of the sanctions related to Russia. But as you mentioned, the situation in Iran and in the Persian Gulf and in that region has really complicated those types of economic tools.
It's interesting because this administration argues so often that we are energy independent, and the problems in terms of oil transporting or not through the Strait of Hormuz are the problems of the Europeans and the Asian countries who aren't helping us there. So why would we bother to lift sanctions on Russian oil?
Yeah, it's a great question, Matt. I think that there's again, it sort of depends on what part of the globe you're looking at this situation from. But certainly there is some frustration among some of the U.S.'s allies, as I mentioned, that the U.S. has undertaken this war, essentially, in the Middle East to accomplish some goals that were a bit muddled at the outset. Now we're talking about nuclear talks. Secretary Bessent said that this was the first time that Iran has come to the table to discuss their nuclear program. I'm not sure that that's strictly true. Obviously, there was a negotiation over the nuclear program in 2014 and 15 under the JCPOA. But be that as it may, there's certainly some conflicting goals, and to put economic pressure on Iran may mean that you have to relieve some economic pressure on Russia in order to keep sort of the global price of oil tamped down a bit. And so I think that you have those competing priorities, and there's some frustration from the U.S.'s part, obviously, that the Europeans and some other allies are not joining in on the fight with Iran. But at the same time, they're frustrated with the U.S. on Russia.
All right, Dan Flatley, Bloomberg News U.S. Treasury reporter there for us in D.C. We appreciate it. Thanks so much. And we're going to have much more coming up here, including continuing to dissect these comments from Treasury Secretary Bessent, who said oil's going to bounce back relatively quickly once a deal is had. We're back after this.